not only short-term weather, but also long-term climate change eventually.
The digital twin of the Earth, what is being twinned?
Yeah, all the processes on this planet. Think of like the atmospheric processes of convection currents, storms, right? Even really like fine scale features of cloud turbulence, what's responsible for hurricanes, for instance, how would this hurricane paths change, and can we come up with the right risk assessment? Because these are chaotic systems. These hurricanes can go in so many different ways. Can we really hone in on what is the risk to different human populations based on what we see today? So these cheaper and faster weather forecasts with AI will also enable us to create better probabilistic assessment of extreme weather events.
Let's talk about some of the other fields that AI is making transformations in the scientific process. For example, genomics or even drug discovery. What's going on there?
Oh, it's such an exciting time there because, the same kind of generative AI that we see for language, you can replace the letters of the English alphabet instead with nucleotides. ATGC, if you recall what makes up our DNA, right? And with that letters, you can now ask the language of the genome and have a model learn that.
So if there are tasks that artificial intelligence can make more efficient or even replace humans in a lab, what's kind of the vibe in the scientific community? Is there as much fear as there is in other industries that AI could take their jobs?
I don't think it'll happen anytime soon, and maybe never, because humans are such creative beings, right? We're always thinking of the, next unknown question, right? There's so many deep mysteries of the universe. There's so much we still need to understand, and AI is a tool. This will enable lab scientists to rule out a lot in simulation before they can go and do their experiments. So they only need to do a few. But then I feel like there'll be always things that'll be still unknown and to be conquered.
There's a lot of, I don't want to use an unpleasant word, but there are a lot of people who don't believe in things like climate change. And there are a lot of skeptics who believe that science is out to get them, or that, we're all just sitting here lying. Is there work being done that you think could actually win over some of these skeptics? Is there a way to demonstrably show them?
Yeah, I do think all the work we're doing will help towards this, because, this is not some model that's in some supercomputing facility, right? Not available to the public. You can download this and go try some of this yourself. Just like a video game, you can play the game of climate change one day, right?
Quantum physics.
So everything becomes accessible. At least my hope is, chunk of the community that is curious will have resources online that is much more open, so they feel like they can participate in that.
If you think about the scientific journey that humanity's been on over the last 300 years, it's been quite good. Just take us 10 years from now. Like, how different will things be?
I think the whole process of scientific research and development will be accelerated many, many times, right? Even orders of magnitude in some areas. And that'll just mean that we can quickly rule out things that don't work and hone in on things that work. Certainly, drugs designed by AI, they're already coming into trials, and that'll just increase fully. Personalized medicine for cancer and all of these, where we really haven't been able to understand, right, for various different targets, how to quickly design drugs. This can make it much faster and also cheaper, because right now so many of these treatments are too expensive to be done at scale. So it'll make this democratized and cheaper. And yeah, I think this will hit every area. I don't think any area is immune to this.
I think it will be interesting, won't it? 10 years time, if it takes the average drug 10 years to come to market, and if AI systems right now are coming up with some of the potential candidates for a future successful drug, then in 10 years' time, are we going to see a waterfall of new drugs?
It may not be a huge number, right? Because you can't test all of them. It'll be more targeted. It will be personalized. It will
actually work.
Exactly, effective.
Thanks so much for joining us.
Thank you. It's
Thank
been
you,
fascinating. Yeah. Thank you for taking the time.
Yeah.
Over the past decade, China has gone from a Silicon Valley copycat to a top contender in technology on the world stage.
Its ascent is peaking at a time when geopolitical tensions with the US and Europe are intensifying, and the rise of artificial intelligence has sparked a new arms race.
The US is rushing to curb China's influence in AI while balancing the need to regulate the powerful technology within its own borders.
How America manages these competing priorities will have implications for where the balance of power in tech will shift to next.
On this episode of AI IRL, we'll explore how China's playbook went from imitation to innovation and discuss what's at stake in the competition between these two superpowers.
Mustafa Suleiman, thanks so much for coming in. Now, you are the co-founder and CEO of Inflection AI and a venture partner at Greylock. Some people will know you as one of the co-founders of DeepMind, now owned by Google. Tell us, what made you want to start fresh with Inflection?
Well, now is really the moment. I mean, it was very clear to me during 2020, 2021 at Google when I was working on Lambda, the conversational AI that now powers Bard, that these large language models were truly going to be the future. And I wanted to start a company to build personal AIs, an intelligence that is completely aligned to your interests on your team and really functions as a personal assistant or a chief of staff, one that knows you intimately and over time can actually help you with practical tasks like scheduling, prioritizing, planning, and those kinds of things.
And that's what you're working with Pi.
Exactly, yeah. Pi stands for personal intelligence, and we see it as your personal assistant, essentially.
How do you feel about the concentration of power in technology right now among the big companies coming out with their own AI models? Microsoft, Google, Meta.
Well, I mean, I think you're right to point out that the big companies have the resources and the people and the compute infrastructure to be able to adapt and compete faster than ever, right? And that is a very impressive, reality of how technology works these days. It requires a huge amount of compute. And at my own company, Inflection, we've managed to raise a lot of money and build one of the largest supercomputers in the world. But on the flip side, the other trend that's taking place is that the open source movement is now almost at cutting edge. I mean, it's probably about 12 months behind the very largest models built at the big tech companies. And so that's kind of a contradictory trend. Like the big companies are getting bigger and better faster, but also everybody is now going to be able to get access to these same capabilities in open source.
Let's fast forward a little bit into the present day where the world order has changed since you first entered the tech industry. How did China go from being a copycat culture to a contender when it comes to digital innovation and specifically AI?
Yeah, I mean, China is more than a contender. I think in many respects, it's one of the leading players now. I mean, they've always been incredibly creative. And I think that we may have sort of overstated the extent to which they were simply copying, what we were doing. And I think it's important to remain humble about the fact that, these ideas are going to be widely available to millions and millions of people. And, in many respects, all of our cultures are, equally creative, and they've been able to take, tools and ideas that are available both in open source and the academic literature and move them forward, innovate at the cutting edge. They've produced a lot of very good papers, contributions to the academic conferences that have been peer reviewed. So, I just think overall it's better to take an approach of humility, acknowledging that, they're also going to be a really significant player in this field over the next few decades.
How would you rank the United States in terms of technological prowess in that world order?
Well, I mean, there's no question that we, in the US and in the West more generally, are currently in the lead. I mean, we have the very best, most innovative technology companies and technology hubs. Without doubt, Silicon Valley is leading the pack. And I think we'll continue to. I think we worry too much that we're going to sort of be dislodged from our podium position.
For how long do you think?
Well, I think the question is, what does it look like to be dislodged? And is that really the right framing in the first place? Like, what is the difference between first and third? And, people talk about there being a race for AI, and it's very unclear what that looks like to come second or third in that race. I think it's sort of the wrong metaphor.
We're talking about superpowers, Clash of the Titans sort of stuff. It reminds me of back when the previous US administration banned companies from doing a lot of business with Huawei, and Huawei ended up basically having to get a lot better very quickly at making its own chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, it's talent that drives, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, it's still really important to be physically proximate to other people who, are working with you in the office. I mean, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. We're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Like, do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years' time, those kinds of AIs are set loose on the open web in a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking, we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors. But what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from US sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the US really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, US policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
how does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is almost, it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is just very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil jumps as the United States completes a third consecutive round of strikes on Iran. President Trump pledges to reinstate the blockade of Iranian ships in the Strait of Hormuz, demanding a 20% fee from all other tankers using the waterway. Asian stocks and U.S. futures fall while Treasury yields hold gains as inflation concerns rise and traders boost Fed rate hike bets. Plus, South Africa plans to boost its strategic oil reserves for the first time since the 1970s to mitigate supply shocks. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Before we start with the show, a packed show we have for the day filled with all this geopolitical news that is still happening in the region. But before that, let's get a quick check on where markets are this morning. U.S. futures, Asian equities are trending lower. U.S. futures 0.2% lower, and then the MSCI Asia Pacific is almost 0.7% lower. Now that's led by a drop in South Korea's Kospi. This is what we've been talking about over the past 3 days or so. SK Hynix extending 3 days of drops in South Korea. The ADRs had dropped 9% yesterday. This is after the Friday debut that was 13% higher in the United States. But our story this morning is on oil prices that are gaining out of the tensions that are happening in the Middle East. But we're also keeping an eye out on the yields. The 10-year notes in the United States are edging higher slightly this morning. And this is as traders await for Kevin Warsh in front of the Congress today, but also we await the June inflation data out of the United States coming out later in the U.S. Trading hours. I just want to flip the board slightly. I know we took a quick look at the performance of SK Hynix, but if we flip the board and take a look at what SK Hynix is already doing in Seoul trading today, this is the intraday performance, 3.9% down at this point. Now this is again extending 3 days of drops, and I mentioned the ADR listing, that debut listing in the United States. It did phenomenally well, 13% higher by the close on Friday. But yesterday we saw a drop, and that brings the net of what the ADRs did to about a 2% gain. So really trimming down the gains. And this, according to traders, could be some profit taking, but it could be some bigger fears about the AI trade and what could happen there, especially ahead of that earnings season. And we'll talk a little bit about the earnings season and what companies are reporting from the United States later today. Big bank earnings coming out. We'll talk more on the show about that. Let's turn back to the regional story and the extension of those risks stemming out of the Middle East. Oil is trading higher as the United States and Iran resumed strikes. That's after President Donald Trump reinstated the U.S. blockade of Iranian ships transiting the Strait of Hormuz. And he's also demanded a 20% reimbursement for all other cargo shipped through the waterway.
So we're just going to hit him very hard. And we're gonna keep the strait, and we'll probably run it. We'll become the guardian of the strait. Maybe we'll call it the guardian angel of the strait. And we should be reimbursed for that. When we do that, we're going to be reimbursed because the other nations are very wealthy. They're on our side, and we can't be expected to do that for nothing.
For more on this story, we're now joined by Stuart Livingstone-Wallace, our executive editor for the Middle East, North Africa, and Russia. Stuart, further escalations in the region into the early hours of this morning. Central Command, just moments before the show, said that they finalized the latest round of strikes. Where do things stand as of now in the Middle East?
So, as always, hard to predict. I think the next thing we're watching for is what does the Iranian retaliation look like? Do they follow the same playbook as the last few days, where it's the same sort of 3 or 4 states that they're going after? Or do they widen that out? That's number one. Number two is what exactly are they going after? So far, they seem to have restricted themselves largely to ships on the water and also to US military assets. Now, if they widen that out to infrastructure or other targets, then you can read into that a severe escalation, and you would anticipate that the US will respond in kind. The US itself, again, largely seems to be targeting military infrastructure on the coastal areas. If that changes, then that changes the dynamic.
We're also waiting to see the status of those technical talks, if they're going to happen, whether they're going to happen, when they're going to happen. Yeah. But I want to focus a little bit on our reporting from today, Stuart. Our big take for the day is about the last 1,000 days in the Middle East, riddled with a lot of wars and a lot of conflict. How have those 1,000 days reshaped the Middle East, in a sense.
Right. I mean, look, that's a 4-hour program, but I'll give you the potted version. I think you put it into 3 categories. So number one, and you have to lead with this, is the human suffering. So the death toll has been horrific. The ongoing human suffering is appalling. We're talking probably into at least 6 figures in terms of the number of people who died. And there are millions currently displaced across the region. So that clearly has to be number one. Number two, I think the geopolitical aspect of this, you're getting redrawn alliances, you're getting new defense alliances popping up. So, notably between Saudi Arabia and Pakistan, potentially that brings in Turkey and so on and so forth. Very strong alliance between Israel and the UAE. And then the third is the economic one, and that's probably the one that's having the biggest impact globally, just in terms of business, global trade, because this region was so dependent on global trade. On the energy front, it's half the world's proven oil supplies are here, about a third of the proven gas supplies are here. If this region becomes as unstable as it has been and can no longer guarantee that supply, that has all sorts of ripple effects. So that was already happening in terms of the sort of the deglobalization, as it were, but I think this accelerates the process. And it'd be very interesting to see what that will look like on the other side of the planet in a decade from now. I suspect that effect will be very profound.
Yeah, fascinating reporting by our teams, along with our geoeconomics teams as well on the Bloomberg terminal. Stuart, thank you, as always, for your time. Stuart Livingstone-Wallace, our executive editor for the Middle East, North Africa, and Russia. Now, let's continue this conversation about what is happening in the region, the shipping routes, and everything to do with the Strait of Hormuz. And we now have Dimitris Maniadis, Maersk's CEO, joining us. Dimitris, thank you for joining us this morning. A lot is happening in the region. We're circling back to the Strait of Hormuz. The news overnight about President Trump saying a 20% fee on all these cargo ships, and the blockade returns again on Iranian ports. Perhaps I start with a simple question. Were you blindsided by this new revelation by President Trump?
Good morning, Abir. It's a very sad day. Again, unfortunately, after rejoicing from the signing of the Memorandum of Understanding, which was basically a big misunderstanding as it proves to be, we are shocked to hear both the 20% toll fee that the President of the United States announced for opening the Straits of Hormuz. The naval blockade, I think, is not a surprise. It was something that we saw coming back into the scene.
And Dimitris, so, I mean, I know the news is quite fresh. It's just been announced. Ships probably and ship owners probably haven't had time to digest what is happening or how to carry through their movement. But just with what we know for the time being, what do you think people are going to start doing in the Strait of Hormuz? I mean, I was taking a look at your data from July, the couple of days before any of this was announced, and almost half of the ships that are going through the Strait of Hormuz you mentioned are going through the Iranian-approved pathway, if you were. So what do ships decide to do now? How do they carry through?
Well, right now, both corridors, the north and the south, are effectively closed. The PGSA has announced a suspension of issuing permits for vessels to transit through Iranian waters. Last night, again, we saw vessels trying to transit the strait from the southern corridor. However, 2 VLCCs, very large crude carriers, were attacked. Both of them were owned and operated by the UAE. Unfortunately, on one of those 2, the Mombasa, we have 1 crew member that has been killed and 8 others that have been injured, 6 of which we hear are seriously injured. So all this negative news is definitely a downturn to any optimism and any intent to transit and return back to some kind of normality in the Strait of Hormuz.
Yeah. And I mean, the IMO has questioned the legality of all of this, whether it's President Trump's issuing of 20% fees. Our reporting suggests that would come about $30 million or so for a very large tanker with current crude prices, or the Iranian fees that were ensued. Do you see those legal disputes becoming the new norm when it comes to transiting the Strait of Hormuz just going forward?
That's a very good question, and your math is correct. a 20% toll fee that POTUS wants to apply will amount to that, to around $30 million at current oil prices. I think that at the end of this war, because at some point it's going to end, there's going to be a huge legal battle that will be played out in many different arenas through many different actors. There has been a series of illegalities that have been put forward by states. And this latest announcement, if it is enforced, is definitely against the law.
Dimitris, we're also talking about really hefty fees here, if actually translated in reality. 30 million is a big sum for a ship owner to start paying. So the question is, if the Strait of Hormuz becomes structurally more expensive over the next 12 months or so, what other realistic shipping routes can you go through?
Well, a lot of the commodities have been diverted to terminals in the Red Sea through land pipelines. But again, that doesn't make up for the loss that has been endured. To be honest with you, there's so much commodity, there's so much oil and product coming out of the Persian Gulf that by ships that it would be impossible to mitigate the loss, the full loss, through alternative routes, at least in the short term. If the Gulf cooperation countries build alternative pipelines, then yes, definitely that could be a solution. But that is a very long-term solution.
And Dimitris, just briefly, finally, who do you think pays for this fee? Is it insurance? Is it ship owners themselves?
It's all of us.
All right. That was the brief answer, I guess, then. Dimitris, thank you as always for your time. Dimitris Maniatis-Marisks, CEO. Now, still ahead, how the GCC is shifting from aiming to power global growth with energy capital and infrastructure. We'll speak to BlackRock Investment Institute. That is coming up next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Horizons Middle East and Africa. Bond traders are ramping up bets for a July Fed rate hike. This is ahead of this week's U.S. inflation print. And it comes as Fed Governor Christopher Waller says officials may need to raise rates to tame price pressures.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
We're now bringing in Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, good to have you with us this morning. So much is happening in the region, but also so much is happening globally. Perhaps we start with the Fed after that sound that we just heard. Kevin Warsh testifies in front of the Congress later today. What do you think is going to be most surprising to markets? Would it be a hawkish tilt, more clarity on what comes next, or something else?
I think he will try to be as unclear as he can, reflecting a genuinely unclear situation. So I think just about the same moment he gets up on stage, we'll get the CPI print. So he'll presumably have foresight on that, but he'll have to react to that a little bit in real time. And of course, we're dealing with a more difficult situation in global energy markets, which is likely to feed through into inflation in the US. So I think it's extremely uncertain. It seems to us that the Fed under Warsh is potentially moving in the direction of less clarity, if that makes sense, less forward guidance, less kind of dots and so forth. And that to me at least seems reasonable, given it is such an uncertain world as we're kind of experiencing again here in the region.
Yeah, but bond traders are now factoring in a coin toss, if you were, for the July meeting. It could be a hike, it could be a cut. We just don't know yet. And you just mentioned Kevin Warsh is moving towards this unclear path of setting the tone when it comes to policy making. But objectively speaking, what do you think he should be doing at the time being with this renewed risk out of the Middle East?
Well, we think the wait and see 50-50 is kind of the right call. So we think in the round, to give you a straight answer, we think they'll do nothing, they'll stay neutral because it is extremely uncertain on both sides of the mandate. I mean, we're not sure of the AI impact into jobs, disinflation potentially there on the one hand, and on the other hand, what we call a world shaped by supply, these kind of supply constraints, be that in the semiconductor supply chain or the Strait of Hormuz, creating higher prices in a kind of an inflationary context. So just kind of chilling out, waiting for a little bit more data and more information. I think the Fed's going to need to be a lot more confident before they go in either direction. So for now, pause for thought, try and stay calm, do the institutional work that they want to do, and try and wait and see, even in a world where the market's going to be demanding as many answers as we can get.
Okay, or chilling out. I like that to be a quote for you. But let's move on to some market moves, some market names. I don't know if you heard, but we were talking about SK Hynix at the top of the show. What is happening in the memory chip game, essentially, last week's drop? It still does not offset the gain that we've seen year to date, but it's a massive drop that we've seen in names in the industry last week. Where do you think we go from here when it comes to demand for memory chips?
I think the demand for memory chips is very huge and the supply is very constrained. So I think the profitability of these companies looks very strong. However, the market is aware of that. And I think in Korea, we've had a little bit of a leveraged buying frenzy on the retail side, and that's unwinding. Yeah, that's fine. That's happened. Obviously, it's very uncomfortable, and it is a market fundamental. It's driving prices, and that makes it fundamental, at least in my mind. But the supply constraint, this AI situation we've got, where hopefully we're on the path to abundance, economic growth, and so forth. But to get there, we're going to have to work through a lot of scarcity, be that power, be that permitting, be that data centers, and for sure memory chips where there just aren't enough and the demand continues to kind of take everyone by surprise. So I think this is a very interesting example of where the fundamentals are like very, very strong, but that doesn't mean for some period of time the stocks can't go down. So that's why actually we cut EM equities to neutral in our second half outlook just a couple of weeks ago.
And sticking with the AI theme, but moving to the region we're at now, you have a recent reporting about AI in the GCC. Where do you think things stand when it comes to comparisons globally, but also what sovereign wealth funds and the governments here are doing to kind of solidify the AI demand game?
I think on the demand side, I mean, as an AI user here, our engagement with, let's say, government kind of apps and so forth is just very good, right? It seems to me paying for parking is a pleasure and so forth. So the kind of technology enablement for citizens here is, I think, globally world leading, and that's not going to change. On the supply side, what I think is interesting is an evolution more in the direction of what the Chinese call self-reliance, and I think that is going to impact the AI game. So data centers probably, they don't just need energy, they probably need some form of defensive capability, whether that's going underground or whatever it might be. I'm not a kinetic expert, but some version of that. And I think you're right at the hint in your question. Some of that money that's been exported, some of that capital that's been exported from the region is likely to stay at home to help achieve both economic process, but also societal kind of needs around AI and the broader kind of national security needs.
And just to go back to the geopolitics, Ben, because it is happening as we're speaking, do you think investors have mispriced the fact that this could go on for much longer than anyone had really expected?
I think the market's aggressively having to recalibrate today. So I think just from I guess before the weekend, there was a sense that there's lots of oil around, the risk of a glut, and there was a sense in markets that oil prices were very likely to continue down. Of course, we were aware of the tail, but I don't think people were expecting the tail to print kind of so quickly and to, frankly, escalate so dramatically with the seeming suspension of the MOU, the blockade back from midnight our time later this evening. So I think the market was wrong. That can happen, and underestimated the tail, both in terms of the timing and the pace of escalation, which has been, frankly, a little bit more than we were expecting and the market was expecting.
Yeah, quite dramatic moves into the early hours of our morning. Ben, thank you, as always, for your time. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joining us at the table. Now, coming up, Wall Street is bracing for a massive payday as big banks look to pull in near record trading profits. We'll have more of that on the show later. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
The earnings story has been so powerful.
Bloomberg is first to break the numbers.
Blackstone reporting a larger than expected jump.
All right, guys, I want to go to T-Mobile.
We're keeping an eye on those earnings out of Oracle,
Meta, Amazon, Microsoft, Google.
With the smartest insights.
We have seen a consumer that has been and continues to be resilient.
There's a lot of reason to believe that there's still a huge amount of growth here.
Continuing coverage on Bloomberg.
Welcome back to Horizons Middle East and Africa. Bloomberg has learned that Saudi Arabia's new startup carrier is set to lock in additional aircraft from Airbus and Boeing. Riyadh Air is firming up options for about half a dozen wide-body Airbus A350-1000 jets. This is along with about 30 Boeing aircraft. The state-owned carrier plans to announce the deal at the Farnborough International Air Show outside of London next week. Huawei and Apple extended their lead atop China's smartphone market in the June quarter. Latest data from IDC shows that each grew shipments by about 20%, even as the overall market fell by 4.3%. They were the only major vendors to expand, helped by strength in the priciest segments. IDC says memory costs are up nearly 300% from a year ago, making life harder for Android vendors selling lower-end phones. And Bloomberg has learned that a group of U.S. states is poised to sue Paramount Skydance to block its $110 billion acquisition of Warner Brothers Discovery. That's despite the deal already securing approval from the Justice Department. Opponents argue the merger could reduce competition in Hollywood by combining major film studios, and streaming platforms. Now, a quick look at where equity benchmarks are before we head into the break. We're still seeing lower moves by the S&P futures and other major benchmarks in the United States. Oil prices ticking higher as escalations in the Middle East continue. $85 on the barrel for Brent. Now, coming up, renewed tensions are putting the Gulf economic reliance to the test. We'll discuss that next. This is Bloomberg.
Wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil jumps as the U.S. completes a third consecutive round of strikes on Iran. President Trump pledges to reinstate the blockade of Iranian ships in the Strait of Hormuz, demanding a 20% fee from all other tankers using the waterway. Asian stocks and U.S. futures fall while Treasury yields hold gains as inflation concerns rise and traders boost Fed rate hike bets. Plus, South Africa plans to boost its strategic oil reserves for the first time since the 1970s to mitigate supply shocks. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Two themes in the market still this week, and that is tech, but also geopolitics stemming out of the tensions in the Middle East. So let's take a quick look at where equity benchmarks and other risk assets are sitting this morning. We're still seeing lower moves by the S&P futures, 0.2% lower. We're keeping an eye out on memory chip names, namely SK Hynix, but also Micron in the United States. We're also keeping an eye out on the AI rout that's plagued markets over the past couple of weeks. We await key earnings data coming out later today in the U.S. hours. Big names in the financial industry are reporting. We'll have more of a preview on that later in the show. But then Asian equities already trading this morning are 0.7% lower. There's no surprise there. The Kospi in South Korea is weighing on the overall index. We'll talk a little bit more about that in a second. But the big story for us in the Middle East is Brent crude prices. Look at that. We're in the 80s again, almost $85 on the barrel. Now, we haven't seen that number in about a month. Yesterday's gain in Brent crude price is about 9% higher. That is the biggest daily gain in about 5 years. And there's no surprise there. The escalation that we're seeing in the Middle East is quite surprising. President Trump saying a 20% fee on ships transiting through Hormuz. Iran saying it will forever be the guardian over the Strait of Hormuz. And all in the time of ships standing still, not really aware of what to do at these times. And then the yield on the 10-year notes, 4.62 almost, and not doing much of a movement, a little bit lower today. Two things we're waiting out for in that space. It's Kevin Warsh testifying in front of the Congress later today, but also the June CPI data coming out from the United States. We'll see what traders decide to think about what happens out of those two things. For now, for July, we're expecting a 50-50 between a cut and a hike. Now, if we flip the board, we take a look at some of the interesting names, or one name, SK Hynix, that is the intraday performance, 3% almost lower. The ADRs in the United States, they debuted on Friday, a 13% gain on Friday. That was mitigated yesterday with a 9% drop. So the net performance of SK Hynix in the United States is about a 2% gain so far. That is the two-day performance. This morning in Seoul, already trading, it is 3% lower, weighing on the Kospi. No surprise there again. It is the second biggest constituent in the South Korean index, and that could be for multiple reasons, possibly some profit taking, possibly bigger fears about the AI game. But turning back to the region again, the renewed escalation between the United States and Iran has put the Middle East's economic outlook back in focus, with higher oil prices and fresh uncertainty over the Strait of Hormuz rattling markets. Joining us now to discuss the economic prospects of this is Carla Slim, Chief Economist for the Middle East, Pakistan at Standard Chartered. Carla, good to have you on.
Good morning.
Welcome back.
Thank you. Good to be back.
Look, I mean, we just had the latest reporting from you guys about the economic model, or the economic disadvantages that this region will suffer from what is happening in the Strait of Hormuz and the Iran war. So you're citing a 0.4% contraction for GCC countries. That is from more than 4% gain last year. What are you seeing there?
Good morning, Abir, and it's great to be back with you in the studio. So yes, we've just published our global economic outlook, where we've reviewed all of our forecasts for all of the economies that we cover. And this morning, we also published a note to try to provide some extra color on GCC average growth specifically, weighted average growth. So when we look at the biggest economies in the GCC, obviously the UAE and Saudi, given the sheer size, their growth numbers will affect the GCC weighted average growth more than the other economies. And we're seeing a lot of differentiation in how these economies are absorbing the impact of this large external shock, right? So the UAE and Saudi's growth numbers are still in the positive. And this is why we end up with only, quote unquote, a negative 0.4% growth number for 2026. This is a sharp slowdown from almost 5% that we saw in 2025. And we expect it to be a sharp rebound as well in 2027 to about 6%.
Carla, is this a starting point? Because the escalations in the region are happening by the second, and they have the potential to upend, everything from investments to economic growth models. So is this contraction, minor contraction for the time being, a starting point? Could we see further contraction in their economies?
So that's a great question, Abir, especially as we enter this phase where it seems that the de-escalation is not looking to be a linear process. So it's possible that we might be in the situation where we have to ask this question again and again, that we have some level to varying degrees of re-escalation, and how does it impact our growth forecasts and our outlook again and again. I think for us, the way we see it is that as long as we're not at the peak of the kinetic phase of the conflict, which is where we were in April, we've been in a phase of resilience in these economies. So how do we define resilience? The PMIs are in expansionary territory. Inflation rose, but is still within well-managed levels because housing is not rising as fast as it was anymore. And the liquidity situation has been really separate from the growth absorption of the shock. So this has not mixed into also a liquidity crisis as we had seen in prior episodes. So we will likely move from resilience to recovery towards September.
And this is all underpinned, according to your reporting as well, by an investment boom that will continue to happen. So walk us through the contrast there, because we're seeing a contraction, but we're also seeing the investment continuing to happen in momentum. So why is that?
So the way we see that is that the tourism impact and the external shock impact that really affected oil exports. So we have an external shock where oil exports and tourism have decreased. On the other hand, we have a domestic demand expansion that continues. Consumption growth within the GCC is well and alive from the domestic demand point of view, even though tourists' numbers have decreased. And then public investment has accelerated. So it's not a situation where investments have remained stable. They have actually been increased in order to make permanent some of these temporary routes that have emerged as alternative routes to trade and to supply chains. So as governments look to make these more permanent, investment is increasing, and that is offsetting the external shock and the negative impact from lower tourism and lower oil exports.
Okay, and that is on the oil exporters, focusing in on one oil importer, that's Egypt. It was going on a good economic trajectory before all of this started happening. Last month, they left their benchmark unchanged, but their outlook is getting quite better. What is your thinking on Egypt? Where do things go from here for the country?
I think Egypt is another exhibit where we've seen also resilience as this geopolitical crisis has unfolded. Because yes, the Egyptian pound did reflect initially some outflows, and it weakened initially at the onset of the eruption of the geopolitical escalation. But then we've seen retracement, we've seen appreciation, renewed inflows. The investment case for Egypt remains quite attractive given the global situation. In a world where many analysts expect, including ourselves, expect the Fed to remain on hold, Egypt has also remained on hold, and we expect the CBE to continue holding rates. So rates remain elevated from a nominal perspective and a real rate perspective. And this reinforces the investment case and the resilient case of Egypt.
All right, Carla, we're going to have to leave it there, but welcome back and thank you for joining us. Carla Slim, Chief Economist for the Middle East and Pakistan at Standard Chartered. Now, Delta Airlines CEO Ed Bastian says he expects higher oil prices to stay sticky for longer. We spoke to him at the carrier's headquarters in Atlanta about the impact of rising fuel costs on the business.
Our consumer has the ability to sustain this level. In fact, we saw it in the quarter. We made at 9% operating margin with fuel prices much higher than where they are in the existing, the existing landscape. So I think oil is going to stay sticky for longer. I'm not sure it's going to be in crude, though. I think the refined costs or cracked spreads are where you're going to find it's going to take a lot longer for that to come down. All that's going to mean is those brands that bring value to consumers in terms of experience, bring opportunity for people to go and explore and give them adventure as their means for enjoying life and getting away. And our international travel season is looking very, very healthy. Businesses, international, as I just said, American Express, our loyalty programs, our cargo business, we have so many different lines of business, including here in the U.S., our domestic travel. It's all doing very, very well, and I don't see fuel prices deterring that.
You talk about how this has been a sea change in terms of the ability for airlines to catch up with the pace of inflation. Not completely, but enough. You saw a big jump up in airline prices over the quarter. How much further does it have to go to catch up and potentially offset stickier oil prices?
If you look at post-COVID, airfares are about 10 to 15% below where inflation has been. So I think there's still significant room.
So if oil prices go further, you think that airfare prices could go higher without causing just demand destruction?
I think so. We just saw it in the quarter.
Is it going to come across the board or more particularly with the premium cabin?
It's going to be in the premium cabins. When we look at the lower end of the market, the low fare carriers, they're still losing a lot of money. And so while Delta, which sits at the top of the food chain, did very well, we represented 60% of the overall profits for the industry, our estimate in the quarter, despite only having 20% share. It means the other 80% still has a lot of work to do to get caught up, and it's going to happen by being more disciplined in terms of the strategies they deploy, making certain that they can only put out capacity that is profitable, that will return a margin to them.
That was Delta Airlines CEO Ed Bastian speaking with our own Bloomberg's Lisa Abramowitz. Now, coming up, South Africa is planning a massive 36 million barrel oil stockpile, its first strategic boost since the apartheid era. We'll tell you why that is happening next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to Horizons Middle East and Africa. South Africa plans to increase its strategic oil reserve for the first time since the apartheid government stockpiled crude in the 1970s. The move aims to protect the economy from global supply shortages and price spikes caused by the war in the Middle East. For more on this story, we're now joined by our energy reporter, Paul Burkhardt, who is in Cape Town for us. Paul, good to have you on this morning. How will this plan be implemented, first of all, and how does the government plan to pay for the billions of dollars worth of these new oil stocks?
So the outline that's emerging is from a draft policy document that is out for public comment right now, and the ambition is for South Africa to build 60 days of oil supply, mostly crude and some products. It would also require wholesalers, importers, and the trading companies that bring fuel into the country that it depends on to keep 21 days on hand. And so just the government piece of that alone is about 36 million barrels if you calculate the demand. So it's a really big ask, and the way, and probably the sticking point is how they plan to pay for that. So the only details right now are that National Treasury and the South African National Petroleum Company would be strapped with figuring out the financial instruments to guarantee and to go out and buy. Probably initially it sounds like about 10 million barrels a day. Obviously they don't really want to do that today, but it would be to create the stockpile that gives it more of a cushion, the government to avoid supply shocks, to avoid higher oil prices and physical shortages.
And Paul, so then why did South Africa sell off its previous oil reserves if they are so important?
Yeah, it's interesting because in the 1970s and 1980s, South Africa built up really a very large amount of oil stocks, but that was to survive sanctions that were imposed on the apartheid government due to its policy of racial segregation. And so, we saw in the last 30 years after the election of Nelson Mandela that, the imposition of sanctions wasn't really going to be an issue. And so those supplies were sold off gradually. And now we find ourselves with, less than 2 weeks of supply here. And I think with every crisis, whether it was Ukraine before and now the current war, the government really decided that it needs to take steps to create more of to mitigate these oil supply shocks.
All right, Paul, we're going to have to leave it there. That was Paul Burkhardt, our Bloomberg energy reporter. Now, for a look at some of the other stories that we're following this morning, Bloomberg has learned that Kenya is considering buying back as much as $500 million of its Eurobonds to extend maturities and ease repayment pressures. The proposed buyback would be the fourth by Kenya in 2 years. And Kenya spends more on debt servicing than on health and on education. The IMF classifies the East African nation as being at high risk of debt distress. Diamond giant De Beers plans to halt production at its South African mine for 2 years. The move comes as the one-time monopoly continues to wrestle with one of the deepest crises ever to hit the industry. De Beers has sought to lower production to try and support prices, but a glut of stones from Angola and weak demand has undermined those efforts. The European Union has approved new trade prohibitions on Sudan's gold sector as the country's civil war enters its fourth year. The measures include an import ban on Sudanese gold and a ban on selling cyanide and mercury to the country. And the restrictions are part of the EU's attempt to curb industries that can fuel Sudan's civil war, which has been ongoing since 2023. And coming up, Wall Street's trading bonanza is poised to keep rolling. 5 of the biggest banks are expected to report earnings later today. We'll tell you what to expect of that next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Welcome back to Horizons Middle East and Africa. Wall Street's biggest banks are set to report massive second quarter profits driven by near record stock trading revenues. However, higher interest rates may put pressure on struggling consumers to repay borrowing, forcing lenders to set aside more money for bad loans. For more on what to expect later today, we're now joined by Balazs Penz, our Deputy Managing Editor for APAC Equities. Balazs, good to have you on. Later today, we're expecting a bunch of earnings to be reported. JP Morgan, Goldman Sachs, among many others. What is driving, or what would drive, do you think, trading revenues?
That's right. We have 5 big Wall Street banks coming out with an earnings report. And let's just spare a thought for all the bank analysts who will have to digest all that. But certainly, we expect bumper numbers for trading revenues coming off, of course, the first quarter, which was a record for trading revenues for many of these banks. And this quarter seems like it was very close to that, driven by volatility in stock markets. First and foremost, we had the whipsawing headlines from the Middle East driving markets up and down all through the quarter. We also had the ebb and flow of sentiment about the AI trade, which also led to some gyrations, and volatility is a great time to make money on the markets, and that seems like that's what animated a lot of investors, so that drove up trading activity, and that's what we're going to see the numbers coming up just now from these 5 massive banks.
And Balazs, M&A activity has also made a strong comeback in the quarter. What is behind that?
That's right. We had some of the biggest deals ever in this quarter. We had, of course, the SpaceX IPO, $86 billion, which is the biggest ever. We just started coming off of the largest ever U.S. share sale by a foreign company, SK Hynix. A lot of this is being animated by the AI build out, by the AI trade. A lot of these companies need to raise money to increase production because demand is so voracious for their products. So we have seen a lot of M&A activity, a lot of deal activity, both in terms of IPOs, but also other types of share sales. When you look at activity here in Asia, we've seen a bunch of Chinese companies coming to the market with various instruments, whether those were convertible bonds or secondary share sales. So there's been a lot of activity when we see this AI build out, and that also adds to the excitement around the trading, around the volatility that also animates investors to try to get into it. So it all feeds into that bumper trading revenue for these banks.
All right, Balazs, we're going to have to leave it there. Balazs Penz, our Deputy Managing Editor for APAC Equities. Now, before we head out for the day, let's take a quick look at where equity benchmarks are sitting by the end of our show. We're looking at S&P futures that are that are flat at this point. They are trading flat to the downside, however. So quite a bit of fluctuations that we're seeing there. We're also keeping an eye on some of the individual names, namely those ADRs in SK Hynix and what they're going to do later today. The net performance is at around 2%. We're also keeping an eye out on the big banks. Balaj was just talking about the Goldmans, the JP Morgans reporting later in the day today. NASDAQ 100 futures are only slightly higher now. NASDAQ is the tech-heavy benchmark in the United States, so perhaps pointing towards a slightly more positive session in the United States. Dow Jones futures slightly lower, 0.2 lower. And then the Euro Stoxx 50 futures are 0.6 lower. Perhaps that geopolitical tension in the Middle East is factoring in. And speaking of that, oil prices are ticking higher this morning, but a hot headline flashing across the Bloomberg terminal moments ago about the Japanese 20-year bond yields falling 11.5 basis points to 3.630%. Now, this is possibly out of the remarks by Japan's finance minister floating the idea of adding government bonds to a tax-free investment program for individuals. So that flashing across the Bloomberg terminal just moments ago. Now, that is it for Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Stick around with us for Daybreak Europe. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but it is going to be a platform that runs in parallel to our more traditional exchanges.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. The blockade is back. Brent touching $85 a barrel for the first time in a month as the U.S. strikes Iran again. President Trump reinstates the blockade of the Strait of Hormuz, demanding a 20% transit fee. Fed in focus, energy shock fuels bets on a July rate hike as Governor Waller says rates may have to rise. Inflation data and testimony from Chairman Kevin Warsh later today. And 5 of the biggest banks on Wall Street kick off earnings season. We're expecting nearly $39 billion in trading revenue. Good morning. This morning, we're kicking it off with the equity markets here across the board and across the world. We are seeing some selling there in Asia Pacific going to unchanged territory, some more muted action in Asia than what we saw yesterday, but still there you can see it. Asia Pacific MSCI index basically unchanged for the day. Going into the European session there, so European stocks 50 futures down by 0.6%. And again, the S&P futures a little bit more muted than what we saw yesterday across the selling in America. S&P futures down basically 3 points this morning. When we take it cross asset, we see much more of the action will be focused on across the day. Brent oil in full focus there. You'll remember at around this time yesterday, we were trading still below $80 a barrel. We are now trading close to $85 a barrel for Brent crude, up about 2% this session. The U.S. dollar index down by 0.1%, and U.S. yields full focus. As we hear from Kevin Warsh a little later today, we get that inflation data and, of course, a radical sort of repricing of Fed expectations after the restart of the war in Iran. We're also watching a number of different risk events throughout the day. We'll be listening to the Governor of the Bank of England, Andrew Bailey, speaking before UK Parliament at 9:45 UK time. That US CPI data, all important, at 1:30 p.m. UK time. And, of course, 3 p.m. Kevin Warsh speaking before the House testimony. Of course, the main risk event of the day, if you're French or Spanish, the semifinal of the World Cup.
We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up discontrolling the whole thing.
There, the President of the United States speaking from the Oval Office, vowing U.S. control of the Strait of Hormuz. The U.S. President has reinstated the blockade of Iranian ships and demanded a 20%, quote, reimbursement for all other cargo that is shipped through the strait. There's a lot to unpack. We have team coverage for you this morning. For the latest on the ground, Horizon's Middle East anchor Abir Abu Omar. For the impact across the oil markets, Wrong Way Neo, and the downstream read-through, inflation from our MLive strategist, David Savage. Abir, let's kick it off with you. We know there have been strikes overnight. What has Iran's response been? Where do we sort of find this story this morning?
Good morning, Ollie. A sense of deja vu, really. I don't know what to say that's different from yesterday, for example, when we reported those tit-for-tat strikes continuing to happen into the early hours of our time in the Middle East here, where the U.S. started by hitting targets in Iran, citing that a lot of those were military targets. Iran hitting back countries in the region, namely Kuwait, Qatar. Yesterday, or into the early hours of the morning here in Dubai, we saw attacks happening again. Iran hitting countries in the region yet again. That includes Jordan. Oman had also suffered some attacks by Iran. And then at the whole, with this whole thing happening, the Strait of Hormuz really comes back into focus this time around, Ollie, with President Trump overnight saying that he will issue this 20% fee on ships. And I know my energy colleagues are on this panel. They'll talk a little bit more in detail about that later. But that equates to about $30 million for a single ship, according to our reporting, or a little bit more than $30 million with current crude prices at $85 on the barrel. So we're seeing these new elements come to the Strait of Hormuz. Iran saying through the foreign minister that it will continue to be the guardian over the Strait of Hormuz and that it will forever be the guardian over the Strait of Hormuz. And just before we started speaking, just moments ago, we heard from the Iranian parliament on a post on X saying that there is this strategic action for the security and sustainable progress of the Strait of Hormuz, that this new bill was approved by the parliament. We don't have much clarity on what that means or what it will ensue, but it essentially suggests that it would legislate a framework for ships in the Strait of Hormuz, including fees. And so now we're seeing both sides of the table, both Iran and the United States, saying that they will will issue fees, and then ship owners are still trying to decide what to do with that. And traffic in the Strait of Hormuz since yesterday has been nearly at a standstill.
Yeah, Abir, it's sort of remarkable. The only thing that there seems to be consensus from on the Iranian and the U.S. side, at least in the last 24 hours, is that there's going to be some kind of toll or fee. The question is who is going to charge it. The difference is the Iranians don't need to have full control. They can just disrupt it in order to basically say they have control of the strait. In order for the United States to charge a protection fee, they need to have total control of the strait. Is total control of the strait a realistic ambition for the United States?
That is a really good question, Oli, and it's still unclear whether that could be the case for the United States. For the time being, President Trump did say that he will have a blockade on Iranian ports. Now, that's proven to be slightly successful in the past, but then bear in mind that in the past, Iran was not able to send out its crude shipments. That was part of the clause that we had talked about when it comes to the 14 concession MOU, where Iran was able to sell its oil, but then that was revoked by the Treasury when Iran started hitting ships. But then what Iran has been doing in the Strait of Hormuz is, as you have mentioned, disrupting the traffic. And it doesn't have to be big hits for ship owners to decide to just hold still for the time being until more clarity over the situation ensues. Yesterday, we heard from the UAE's defense ministry saying that Iran hit 2 ships, killing 1 person and injuring several others. And so if these attacks continue to happen, that's alone for ships to decide that maybe it's time to take different routes or to turn off their transponders, as they have been doing over the past couple of months or so. So how realistic, your question about how realistic is it for the United States to take control? A lot of unclarity about the situation still. For the time being, we're talking to ship owners. Our teams are talking to those ships trying to make their way through the Strait of Hormuz. And it does look like yet another layer of complication from the Middle East this morning. And this is what you're seeing reflecting in Brent crude prices at almost $85 on the barrel, the first time in about a month.
Well, Abir Abu Omar keeping us abreast of all the layers of complexity. Thank you, as ever, this morning. Brent futures have spiked above $85 a barrel for the first time in a month. Let's bring in our Bloomberg Asia oil trading reporter, Rong Wei, now. I'd like to just break this down for you. There's 2 segments of this now that the President of the United States has sort of introduced to the gas and the oil market. There is first the blockade. There is second this idea of the fee. How are the 2 sides, how are oil and gas sort of traders and, of course, the sort of cargo companies sort of viewing both of these things?
Right, so if you look at the latest developments from Trump's proclamation that it would essentially set up a blockade on Iranian ships coming out from the Gulf, we have seen this happen before, of course, and of course in the interim period, Iran has successfully still managed to bring out vessels carrying Iranian crude out into the market. But do note that in terms of this Iranian oil trade, it maintains, the dynamics maintains that pretty much China is the major buyer that has continued to purchase Iranian oil. But the latest, as it stands, Chinese demand has been really low lately. If you look at the latest data in June, China's crude imports fell to its lowest in nearly a decade. So in terms of supply risks, there doesn't seem to be much action going on in terms of how the blockade could actually impact Iranian volumes being brought out to the market, because essentially apart from China, no one else is really purchasing these barrels. And if you recall, when the US sort of set up this waiver to allow other mainstream crude buyers to purchase these barrels, a lot of them had held back because they fear secondary sanctions, as well as other repercussions that may arise from buying these barrels during the short waiver period. But of course, like Ollie, like you mentioned, the more pertinent point that the market is looking at is the 20% fees that we have spoken quite widely earlier. Now, of course, a lot of shippers agree that these added costs will be passed down to the consumers, which of course raise price premiums for major crude importers, especially here in Asia. And the timing of the announcement and the lack of details on how it's going to be implemented has sort of left Asian traders blindsided. In fact, I think one of the more memorable conversations I had with traders here this Asia morning was one Singapore-based trader essentially quipped. He was questioning how did the US arrive on this arbitrary 20% number, and he even joked that it felt felt like Trump was bringing US's its tipping culture all the way to the Straits. So it remains to be seen actually how these fees would actually be imposed and how much of it would actually impact extra shipping. But I think, Ollie, like you rightfully mentioned, what we can agree and what the market agrees as well is that following this war, it seems like some form of fee payment structure would remain. Earlier this month, we actually had a report. We do believe that some of the leading European powers have sort of considered that payments for transits through the Strait of Hormuz is inevitable. And now I think the overnight developments essentially seals the deal. And all eyes are on how all these would actually play out.
Yeah, wrong way now. Thank you so much for that. Yeah, I think the Europeans were expecting to pay a fee. I don't know that they were expecting it to pay to the United States. And as the price of oil rises, so too do bets for a July interest rate hike from the Federal Reserve. Traders now await upcoming U.S. inflation data and Fed Chairman Kevin Warsh's appearance a little bit later today. We heard from another Fed Governor, Chris Waller, signaling that further rate hikes may be warranted should underlying inflation continue to reflect broad-based price pressure.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
So some strong words there from Chris Waller. Let's bring in David Savage, Bloomberg's MLive strategist. You know, this is a real sort of paradigm shift in terms of what the expectations of the Fed were really expectations that things were going to remain sort of nothing really to see here this year. That is now changing pretty dramatically.
Yeah, absolutely. And so, you know, we look at that pricing for July hike. It's now basically a coin flip. So last week, that was more like 20 to 30% odds. The jump in oil prices, and then, of course, Governor Waller's comments there, have put July's meeting in play. And certainly that's of interest to traders ahead of U.S. CPI and Warsh's testimony today. And I think those 50-50 odds, make some sense, given that, much of the disinflation narrative that, traders on the sides that we should be moving away from rate cuts was really built around headline CPI coming down because oil prices
Streeting with over 30% of votes in our survey. I think that's not a huge surprise. He is known to be a lot more centrist in his views. Ed Miliband is sort of associated with higher spending plans and potentially therefore higher taxes. But the market is very much saying Ed Miliband first, and then Ed Miliband last, but Wes Streeting, coming out on top by quite a wide margin over the other candidates who we, put forward as likely options. Darren Jones, coming in quite weak as well. John Healey, the former Defence Secretary, coming in quite a way behind, but the next best considered after Wes Streeting. But lots of people actually chose someone else and put in a suggestion of their choice as well, but that was 16% of votes. So there's certainly a lot of variety in people's thoughts, and I don't think there's a certainty there at all.
And more broadly, how is the market and how are sort of the market viewing the effect of a Burnham in sort of 10 Downing Street on broader UK assets?
Yeah, so overall, market participants do expect Burnham's premiership to have a potentially negative impact on UK assets. About 40% of the respondents said that it would make them more bearish on UK assets. And about another third were already bearish, and they said it wouldn't make any difference to their opinion. That was a lot more than those who said it would make them more bullish. And I think when we look at the individual assets, they do see gilt yields rising slightly to an average of 10-year gilt yields about 5%, and they see the pound on average coming back to about $1.30. But there was quite a wide range of variety in the responses, and these aren't huge moves. I think what really is the strongest takeaways from this survey is that overall a bearish attitude to assets, and the fact that there are quite strong opinions on who would make the best chancellor. And I think a lot is riding on that, because there is a lot unknown actually at the moment about Burnham's economic policies and what he'll do. So I think really markets are waiting to find out who the chancellor will be. Particularly, we've actually seen quite a steady period for gilts through all this until now.
Yeah, and very quickly, you've also put a question about expanding potentially the BOE's remit to beyond inflation and price stability, but also to growth. What did you learn from that?
Yes, so actually the suggestion that has come from Burnham's camp about expanding the Bank of England's remit to include growth as well as inflation, the idea of sort of higher growth policies that might come from Miliband weren't very popular. This particular policy did seem to strike a chord with market participants, and they were broadly in favour of that, which I think is quite important, particularly as we look forward to the central bank and what they're going to do the rest of this year. The market has been quite fluid on that, and the moment still pricing in one interest rate hike by the end of the year. But the situation is fluid, and perhaps a lot of market participants expect them to keep rates on hold. So I think it will be quite interesting to see what they do. And of course, if their remit was to change, then that would make their job potentially more challenging, but also potentially easier, depending on what their focus is. They've talked a lot about growth recently.
Yeah. Of course, it's a debate that we're hearing a little bit more in other central banks and other nations as well. Morwayne Iconium, thank you so much, co-editor of Bloomberg Markets Today. Coming up, no fewer than 5 of the biggest banks in Wall Street kick off earnings season today. We'll tell you what to expect with your preview. That's next. And this is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasadja in the Lesotho Highlands, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. The blockade is back. Brent touching $85 a barrel for the first time in a month as the U.S. strikes Iran yet again. President Trump reinstates the blockade of the Strait of Hormuz, demanding a 20% transit fee. And the Fed in focus. The energy shock fuels bets on a July rate hike as Governor Waller says rates may have to rise. Inflation data and testimony from Chairman Kevin Warsh later today. And 5 of the biggest banks on Wall Street kick off earnings season today. We're expecting nearly $39 billion in trading revenue. Good morning as we enter the session this Tuesday, looking at the markets across the board here, seeing a more muted reaction across equity markets. There you can see it in Asia Pacific, really turning things around over the last couple of minutes. In the last 30 minutes, we were dead flat really about 30 minutes ago. We're now up by 0.5%. Euro Stoxx 50 futures, though, remain in the red. They're down by 1/3%. And there you see a little bit of gain there from the S&P futures. We're down very, very slightly at the top of the show here, and you see 30 minutes later gaining ever so slightly by about 0.125%. Going on to the next board and cross asset, what we're watching, of course, Brent crude in full focus here with the renewed blockade of the Strait of Hormuz by the President of the United States. Brent crude up there almost at $85 a barrel, up by 1.44%. The U.S. dollar index down by, again, about 1/8% there, and then yields in focus here across the curve, across the world. U.S. 2-year yields down there ever so slightly. You get about a 4.2795% yield on that U.S. 2 years. Time now for your front page news across the world, starting with the Financial Times, with reports on the latest strikes between the United States and Iran, and the President Trump demanding a 20% fee on cargoes passing through the Strait of Hormuz. And the Wall Street Journal saying that a wave of Iranian nationalism is drowning out its diplomats. It's adding to that fervor whipped up during the conflict that is making it harder to compromise and easier for hardliners to stymie progress on negotiations. And Germany's Handelsblatt says shipping companies are ordering more oil tankers than ever before as a result of the increased charter rates resulting from the Hormuz blockade. And you can get a roundup of all of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Well, the 5 major banks on Wall Street are reporting a little bit later today. They're kicking off earnings season for us all. A global surge in deals and IPOs is expected to drive blockbuster results as volatility from the ongoing U.S.-Iran conflict fuels equity trading revenues. For more on what to expect on an important day for bank earnings, we're joined by Bloomberg's editor, Balazs Pence. So listen, we've been talking about trading revenue, not just in this quarter, not just in the last, but for a number of quarters. How long will this party continue, and will it continue into this quarter as well?
Well, as long as we have days like today, Ollie, like the headlines that you just read through, that's a great example of what's been driving that record revenue in the first quarter and what's likely to drive very close to that, something very close to that in the second quarter. We had these whipsawing headlines coming from the Middle East every single day, driving up volatility. We had the ebb and flow of sentiment around the AI trade also increasing volatility, particularly here in Asia. So banks that were more exposed to the Asian trade, like Morgan Stanley, are probably coming out for the better for that, because volatility is a great time to make money on the markets, and that's animated a lot of investors. Trading activity has been through the roof and has been very strong for a few quarters now, and that's what we're going to see when those 5 Wall Street banks report earnings in the single day. So spare a thought for the bank analysts having to digest all that as well.
Yeah, and we'll also spare a thought for some of those who have been waiting for the revival of M&A and, of course, the IPO market. And that is something that we've seen come back with some very blockbuster names listing. What are we expecting in the sort of deals front?
That's right. And it doesn't come more blockbuster than SpaceX, which was the biggest ever IPO, which happened in this quarter. And we've seen a lot of companies along the AI supply chain coming to the market because they need to raise money. They need to increase production. They need to supply their customers, and this voracious appetite for all along the supply chain needed for the AI build out. So we've seen a lot of deals, not just IPOs. We've seen other types of deals, whether it comes to convertible bonds or whether it came to block trade, secondary share sales. A lot of companies have been in the market, both in the U.S. and here in Asia as well. We've seen a wave of Chinese AI-related companies come to the market in various ways, and that's something that we expect to continue. We're just preparing for a big chip maker IPO here in China. There are obviously big U.S. AI names expected to come to the market as well. So IPO M&A activity has been very, very strong, and that's also something that feeds into the volatility, that feeds into trading enthusiasm, and feeds into revenue for these Wall Street banks.
Well, Bloomberg's Balazs Pence, thanks so much for that preview today, and I'm sure we'll potentially be speaking to you tomorrow to get your sort of dissection of what we get out of the United States. Thanks again. And we'll be speaking with the CFO of Wells Fargo, Mike Santomassimo. That'll be at 8 p.m. London time, and we'll take it from the banking sector over to the telecom sector that we're watching this morning here out of Sweden. The Swedish telecoms company Ericsson's second quarter earnings have fallen in line with analyst forecasts as it faces rising component costs. The outgoing CEO says that the results underscored, quote, disciplined execution. We're joined now by Bloomberg digital infrastructure reporter Paula Dönecke. So talk us through this report a little bit. What did we get? Is this sort of in line with analyst expectations? Were there any surprises here?
Good morning. Yes, it's a slight beat actually, but broadly in line with expectations, and that is good news for investors already because it was a tough quarter for Ericsson. We had 6.9 billion in adjusted EBITDA, that is Swedish krona, and yeah, that will be good news.
And thinking about where the company has faced pressure this quarter, where have been the sort of pain points for Ericsson?
So it's always costs, and Ericsson has been trying to cut costs for a while now. This quarter, especially, they are still seeing impacts from the Middle East, but these are subsiding. The more important topic now is the component costs that comes through chips, but also other components which are in short supply due to the build out of digital AI infrastructure in other parts. So obviously this is something that Ericsson hopes to profit from further down the line as they are building out these networks, but it's also something that now adds pressure on their cost base.
Yeah, absolutely. I mean, I think it's sort of interesting to watch Ericsson because you have this sort of dynamic in Europe where you have this great need for telecommunications, the build out, as you say, there of the digital infrastructure, while at the same time, European governments basically blackballing and cutting out, Chinese companies like Huawei. This really should be sort of a tailwind for Ericsson. What can we look forward to Ericsson over the next couple of months?
Yes, I mean, exactly. This discussion about blocking out Huawei will be very closely watched by Ericsson. It's a huge opportunity for them to replace those ports in European networks. Another thing that will be very interesting, the current CEO, Börje Ekholm, will be leaving the company after almost a decade in the top job. And Per Narvinger will take over. He's currently the head of networks. And I mean, for now, he's been with the company for a long time, so maybe he'll continue, but it might also be that he changes the strategy. That's definitely something I'll be watching closely.
Well, thank you very much. We'll also be watching very closely Bloomberg's Paula Dunica with the latest there from Ericsson, the Swedish telecoms giant. Now let's get to some other corporate news that we're watching this morning. Shares in Watches of Switzerland jumped after a report said that Britain's largest Rolex reseller held talks in recent months over offers to take it private. A report from Reuters said CEO Brian Duffy engaged with unnamed suitors, but the company is seeking an offer of more than £7.50 per share. The company declined to comment when approached by Bloomberg and is set to report earnings at 7 a.m. UK time. And Bloomberg has learned that Shein is targeting a Hong Kong listing as soon as August after securing long-awaited approval from China's securities regulator. Sources tell us that fast fashion retailer could raise between $2 and $3 billion in the IPO, marking its latest attempt to go public after failed listing efforts in the United States and in London. The offering comes as Shein faces pressure from slowing business growth amid rising competition. And a group of U.S. states has sued to block Paramount Skydance's $110 billion acquisition of Warner Brothers Discovery. That's despite a deal that's already secured approval from the Department of Justice. Opponents argue that a merger would reduce competition in Hollywood by combining major film studios and streaming platforms. And Bloomberg has also learned that Saudi Arabia's new startup carrier is set to lock in an additional aircraft orders from both Airbus and Boeing. Riyadh Air is firming up options for about half a dozen wide-body Airbus A350-1000 jets, along with about 30 Boeing aircraft. The state-owned carrier plans to announce the deal at the Farnborough International Air Show outside of London next week. Well, coming up, SK Hynix rebounds after a record fall on Monday. More on that story next. And this is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football. And you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome back to Bloomberg Daybreak. Europe shares in SK Hynix rebounding after a record 15% tumble yesterday. It was very sort of difficult whether we should take a sort of bullish or bearish approach. So hopefully we can get a little bit of insight on that from Lian Ting Tu, Bloomberg's managing editor for Asia Equities. We've had a lot of volatility from SK Hynix over the last couple of days. Where do we find that volatility today?
Yeah, it's really up and down and all over the place. I think a lot of traders are talking about how, you know, the dual listing right now is giving them a bit of a heart attack 24 hours a day. So for today, I think two layers of sources for volatility. One is memory sector itself. Stocks in memory sector have run up so much. Now people are assessing whether the earnings for the sector is near a peak. So every data point is really getting scrutinized pretty hard by the investment community. That's why we're seeing, every little data point is having such a big impact on these memory stock names. And second is market structure. In Korea, these two stocks, SK Hynix and Samsung, they account for more than half of the market weighting. So if one stock moves, it tends to pull the whole market along with it. And also on top of that, lots of leveraged ETFs are built on SK Hynix and Samsung, and they tend to have to mechanically rebalance. So they need to buy on the days when shares are up, they need to sell on days when shares are down. So that really amplifies the daily swings for both SK Hynix and Samsung, for that matter, Kospi as well. And if you look at a batch of leveraged ETFs around those stocks launched in late May in Korea, they are nearly 50% down from their listing prices. So a lot of retail investors who are the main buyers of such products are holding losses.
Right, and when you think about now that dual listing, as you allude to there, that there might be sort of a heart attack for the traders that now have to watch this 24/7, maybe in the short term providing some volatility as the sort of respective pricing gets there, but could it also have the potential of sort of smoothing out the trading as you can take kind of pressure out over that 24-hour period?
Right now it seems that the feedback loop is being reinforced through that dual listing, because before, essentially, SK Hynix is a sole story. Wall Street would react to that, sometimes directly or through the likes of chip names such as Micron or NVIDIA. But right now, the overall Wall Street trading would set the tone for sole trading. And because of all these leveraged ETFs and margin loans, that tends to amplify all the moves in SOL. And that then gets fed back to Wall Street. So right now we are really seeing some kind of unhealthy feedback loop going on right now. And Korea, because of its position in the AI hardware supply chain, it's very much critical to that supply chain right now. Wall Street is really reacting to all the Korea volatility. And because Korea has a bunch of concentration issue and leveraged ETF issue, that kind of volatility right now really gets amplified globally.
Well, Lian-Ting Tu, thank you so much there. Bloomberg's managing editor for Asia Equities, keeping us across all that important volatility over in Korea. Now to some other top stories that we're following this morning. Japan's finance minister has floated the idea of adding government bonds to a tax-free investment program as the government steps up efforts to attract cash to domestic markets as the yen trades near a 40-year low. Satsuki Katayama said the yen-denominated assets would become more attractive if the administration advances its growth strategy, and the nation's massive pension fund could revise its portfolio if needed. And China's exports and imports beat all forecasts in the month of June as the AI boom lifted demand for chips and data center hardware across Asia. Exports rose 27% from a year earlier, while imports surged 36%, the fastest pace in 5 years. That left a trade surplus of more than $125 billion, the second biggest ever. China's crude imports, meanwhile, plunged 41% to the lowest level in almost a decade as Beijing cut foreign purchases after the war in Iran began. Well, coming up next, we'll take it back to the politics. Hungary's parliament votes to remove the country's Orban-era president. More on that move next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe. Well, Hungarian lawmakers have approved a constitutional amendment to remove President Tamás Sulyok, an ally of the former Prime Minister Viktor Orban. The legislation passed with two-thirds majority held by Prime Minister Péter Magyar's Tisza party in Parliament. Magyar spoke following the vote at about the president's political fate.
The president now has two options. Either he resigns now, in which case the Speaker of the Parliament will temporarily take his place, and then she will sign the bill, and after that, the law will be promulgated. Or he signs this constitutional amendment by himself. We have just fulfilled the will of our voters.
For more, we're very joined by Zoltan Seyman, Bloomberg's Eastern Europe editor. So listen, we've been talking now, it's been sort of a while since Magyar has taken office. There's been this sort of great sense of trying to the de-Orbanification of Hungary. How significant is this step in that process?
Yes, hi Oliver. It's definitely significant. It's probably the most significant step since April's landslide election victory for Péter Magyar. Although the Hungarian president is largely a ceremonial office, clearly for Magyar, he is a symbol of the Orban regime, a vestige, if you will. So he says, even though he would be unlikely to block any serious change in terms of government policy, he says Sulyok needs to be removed because he was fully aligned with Viktor Orban ever since he took office.
And thinking about the sort of broader project for Péter Magyar, obviously there was a huge amount of optimism for those who are sort of anti-Orban and pro-Magyar after his election, obviously with that two-thirds majority. But for those of us who have sort of lost sight of it since he was elected, how is that process going? And is there still that faith that Péter Magyar can bring all of those changes to bear?
Yeah, I think that's a really important point to make because let's remember a little more than 3 months ago, Orban's regime seemed invincible, both from inside Hungary and probably from outside Hungary. I mean, President Trump has, he repeatedly hailed Orban as sort of the symbol of a strong leader. Now he's watching the World Cup. He's nowhere to be seen as Péter Magyar is taking a sledgehammer to sort of his political heritage. And he's moving at warp speed, really unfreezing European funds, tackling corruption, as he says, trying to rebuild the rule of law, and also to claw back, potentially billions of euros in plundered state assets.
Yeah, and let's also think about Hungary and its sort of position in geopolitics on the wider stage, obviously within Europe and within the world, because obviously it's a relatively small nation, but has been the single blocker of a huge amount of EU action, obviously falling now more in line with the EU. And so basically give us some context around that, but also how close Hungary is to actually getting those frozen funds from the European Union.
Yeah, let's start with the latter. I mean, it is close. It's essentially, it has access now to those funds. It's now really sort of getting the projects for which it can actually tap the money. And, they are under that high deadline, especially the post-pandemic European Union funds expire at the end of August. But now it seems that they have the projects lined up for it. They have the political green light from the European Union and the member states. So really now it's just up to the government to move and to tap those funds. So I think investors also realize that that money is likely going to come, if not in full, but most of them will arrive. And geopolitically, obviously, as you mentioned, Magyar's message was that Hungary is coming back to Europe. It's going to rejoin the European mainstream. It's going to be, as he says, a constructive voice in the room, both in the European Union and in NATO. Now, that doesn't mean that it's going to say yes to everything. You can tell that Magyar likes to drive a hard bargain. As he says, he's defending Hungary's interests, just like other leaders are defending their own.
Right. Well, Bloomberg, Zoltan, Simon, thank you so much for your time there from Budapest on the latest from Péter Magyar, the Prime Minister of Hungary. Let's get to some of the charts that we're watching a little bit later today. Ahead of that all-important U.S. CPI rating we're getting a little bit later. We're going to hear from Chairman Warsh a little bit later. But we've been watching a big repricing in terms of the market action and where they expect rates in the United States to go. We are now potentially going to get a rate hike this very month. That's a very radical repricing from what we've seen over the last even couple of days, and you can see it there, the sort of spread between the two-year yield versus the Fed rate now reaching the sort of highest level that we've had in a number of years, in almost 4 years. We're also looking at crude imports out of China. This is another story that we're watching really closely. Didn't get a lot of airtime, but this is the sort of impact of the war in Iran and the impact that it's having on Chinese crude imports. Crude imports plunged 41% in terms of their imports from a year ago. That is the biggest plunge on record, and they purchased the smallest volume in China in almost a decade from outside of the country. And of course, the final thing we're watching for the sort of main risk events for those of you who are engaged on the World Cup, who might be Spanish, who might be French. And today, obviously, on the French National Day, Bastille Day, we have France versus Spain. That'll be at 9 p.m. on the continent. You go to the Poly market odds in terms of what they're expecting after 90 minutes of play. 41% chance of a France victory, a 30% chance of a Spanish victory, and of course, a 30% chance of a draw after 90 minutes of play. I'm sure that will be watched very closely by you all across the world. And of course, the other risk events we're watching this morning, the UK Governor of the Bank of England speaking before Parliament at 9:45 today. At 1:30, we get that all-important U.S. CPI data we've been talking about. And of course, we'll be hearing from Kevin Warsh before the House Banking Committee a little bit later today. That'll be at 3 p.m. UK time, 4 p.m. on the continent here. And later this morning, we'll get a check-in on the deals outlook with Jim Zentler. He is the president of Apollo Global Management. That's an exclusive conversation on the opening trade at 8:30 UK time. That'll be at 9:30 for those of you here on the continent. The opening trade is up next, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. It is Tuesday, July the 14th. Here's what's on the agenda. Oil hits $85 as Trump says a U.S. blockade of Iranian ships is back. Rate hike bets ramp up on renewed inflation fears, while the chip stock volatility remains. And Japanese bonds rally as the government touts support.
Tom, you mentioned Brent at $85, and we're just pulling away from that a little bit. We absolutely hit that overnight, and that has weighed on risk sentiment. The run-up in oil prices yesterday certainly weighed on risk sentiment. But as we hit 85, we pulled back a little bit. We're at 84.48, and that seems to have changed the dynamic just a little bit. We've seen European futures look more positive, US futures certainly look more positive, and the Asian session, MSCI Asia Pacific, ticked up into positive territory and remains there. So to some extent, the European futures picture is telling yesterday's story. Yesterday in the US, we closed around session lows, and so as a result, we have to move lower at the start of trade, but down 0.3%. How long will that be sustained? Will we tick up if that oil price continues to move away from the highest levels that we've seen? The Japanese 30-year yield, we put this in here because there's a really interesting conversation developing in Japan as to whether the government is going to change policy around savings accounts and pension funds to try and push people more, incentivize people more into the Japanese bond market. We'll get to that shortly. The countdown to the opening trade starts right now.
So has the paradigm shifted on Iran? Has the paradigm shifted back to what we saw at the start of this conflict? We do not have a full-blown war between the two sides right now, but military attacks continue on both sides. The US and Iran exchanges military blows, and this blockade is now going to be back in force, the US says today. President Trump also saying he wants to charge 20% on ships travelling through the Strait of Hormuz to compensate for the US naval assets in place and aiding some of those movements. For now, it seems there is very little traffic going through the Strait of Hormuz, but the strait, in terms of the blockade, is back, and Brent and oil prices up a little over 10% in the last 2 days.
Yeah, absolutely. So I was emphasising the pullback from 85. That was really because in the moment, that's what's dictating risk appetite in the Asia session. But really, yes, the big story over the last 24 hours has been that big move higher in the oil price. And it seems to be that application of a 20% or the suggestion that President Trump will impose a 20% fee for doing this, toll for navigating the Strait of Hormuz for these vessels or to keeping them safe or for something. And that seems to be the thing that really shocked the markets. It blindsided the industry, according to our reporting. And that 20% fee would be some 16 times what the Iranians have been charging. The Iranians seem quite happy to see the US talking about a toll, talking about a fee, but suggesting, oh, we would charge a whole whole lot less than this. So you've got both sides trying to project themselves across the Strait of Hormuz, trying to take control of that shipping channel and impose themselves in that way. So we're watching what happens with oil prices. The US plans then also talking about a blockade of Iranian shipping, and that's another thing that pushed the oil price higher in yesterday's session.
Natural gas prices in European natural gas prices have spiked as well, so we'll continue to monitor that. On some calculations then, to your point around the fee and the toll, $2 million is approximately what the Iranians have been charging on and off to some of the ships. On some calculations cited by Bloomberg, you could be talking, if that 20% is imposed, and there's lots of question marks over how you would actually implement that. If that 20% is imposed, it could be accounting for about $30 million per vessel, depending, of course, on how much oil is being carried. So we're watching European natural gas prices as well. Brent up, and so that ties us into the inflation story. Interestingly, China, we know that China has played this central role in actually keeping a cap on global oil prices by radically reducing their imports of oil. We had a reminder of that today with data, export and import data out of China. The imports of crude to China in June falling by 41%. So China is going to be absolutely critical going forward in terms of what happens with this oil price and the inflation story.
Absolutely. We will continue to watch that. Let's talk about what's going on the inflation story then in the US and Fed expectations as a result of that. We're looking ahead to Kevin Walsh. He'll be on Capitol Hill. We are looking ahead to CPI data out of the US. That will be something that the market is watching for. And we are seeing in the run-up to those, reflecting the higher oil price, increasing bets on a July rate hike. We see that in interest rate options. We also see that in the short end of the Treasury curve. So markets of all kinds seem to be adjusting to the idea, at least temporarily, at least as we saw oil prices spike up towards $85, that this was going to be something that would reignite the inflation debate. Does that make, then, the July meeting more live? Yesterday, I was sitting here about this time suggesting that maybe July wasn't live. We had a 25% chance of a hike. Now that looks like a 50% chance of a hike, and some people are talking about this now being a live meeting.
July is now seen as live, to your point. Interesting to hear from Chris Waller overnight as well of the Fed, of course, previously sounding pretty dovish, but yesterday saying, and I quote, if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. More than 40 basis points now of hikes priced in by the markets for the Fed. The ECB as well. Also, traders now fully pricing another hike in September, more than 40 basis points priced for the ECB by the end of this year. We're also, of course, thinking about what's happening in the chip space. I mean, again, the volatility back. SK Hynix, their ADIs, of course, in the US, falling by about 9% yesterday, almost back to those kind of IPO and listing levels on Friday. A bit of stability, it seems, in the Kospi today. Again, but that volatility has been there.
That volatility has been there. And where does it leave us now? We have this US ADR listing and we have a Korean listing. Does this create stability, or does this drive instability with some sort of feedback loop that we can't quite ever get on top of? So we'll continue to watch that and looking ahead to all of those inflation-related events later on today. Let us talk about Japan then, Tom, because we have an incredible picture developing, or at least it looks very different. The Japanese JGB's picture looks very different to what we're seeing in the rest of the world, where we're busy factoring in higher oil prices and higher yields.
And let's see to what extent there is a read across from this significant rally that we're seeing in JGBs right now, with yields down sharply, and particularly on the 10s and 20s, and towards the back end, the further back end as well, the 30s. So you're seeing yields drop between 7 and 18 basis points. So a significant rally in Japanese bonds. There was been an auction of 20-year debt that's been well received. And we've had, and this seems to be the catalyst, comments again from the finance minister of Japan suggesting two different measures in which the government could support buying of JGBs. One through including them in savings, tax-free savings accounts that are available for Japanese citizens. And one is, again, looking at least being open to considering the pension fund, that massive JPIF pension fund in Japan, potentially changing its framework. And even if it doesn't, on the current metrics and the current framework, at the upper end, it could still buy more JGB. So it seems that the finance minister is saying that these two factors are being considered.
Yeah, absolutely. And no decision yet, but these initiatives are moving forward, is the way that Katsuyama is talking about this, the finance minister over in Japan. And we just showed what this looks like, what this is doing to the Japanese bond market. It is suggesting that there could be more buyers out there in the future, and that has shored up the bond market, as you said, and brought yields down. And that really does stand out as very different to what we've been seeing in the past 24 hours in other geographies. And interesting thinking about other geographies, you know, the European investment community, the UK government, plenty of other geographies, often trying to think about how you incentivize more money to stay at home rather than see it all disappear off to the US or increasingly to Asia for some of these chip-related and AI-related investments. So no doubt lots of people will be watching this with interest. Let us tell you what is coming up on the programme in terms of the conversations we'll be having. Michael Brown will be with us, Franklin Templeton, Global Investment Strategist. We will also speak to Maria Weitmana, State Street Equity Research Head. How carefully do we need to think about whether there's more to play for in chip stocks, or are we comfortable with loading up on tech stocks? She's been someone who's been very pro-tech in recent conversations. We'll also be speaking to Jim Zelter, Apollo Global Management President. The private credit story, really fascinating right now. We will continue to get Apollo's perspective on that.
Here's what else we are going to be thinking about throughout the day. Today, US bank earnings get underway. Bank of America, JP Morgan Chase, Wells Fargo, Citigroup and Goldman Sachs all reporting. So a really big day for the US bank earnings story, kicking things off later. 1:30 p.m. UK time, we will get, talking inflation, we'll get that US June CPI, the inflation print. At 3 p.m, Fed Chair Kevin Warsh testifies before the House Financial Services Committee on the semi-annual monetary policy report. There'll be a lot of people tuning into that. And later on in the day, ECB President Christine Lagarde will be meeting with US Treasury Secretary Scott Bessent in Washington. UK Chancellor Rachel Reeves and Bank of England Governor Andrew Bailey will deliver speeches at the City of London Corporation's Financial and Professional Services dinner later as well. I believe that is likely to be Rachel Reeves, the Chancellor's last major public speech in her current role. And that is otherwise
known as Mansion House. We should call it that, shouldn't we? That's what it's called, the Mansion House address.
Yes.
Let us talk about the bank earnings story then, Tom, because that is going to be really interesting. We mentioned this yesterday, 5 banks reporting all in one day, some of them with overlapping corporate calls, overlapping investor calls. So that's going to be complicated for everybody to navigate. What's going to be the big theme? Is it going to be high trading revenues? Is it going to be M&A that's in focus? Is it going to be net interest margins with expectations rising about higher interest rates? I mean, all of those, I suppose.
So deal activity topping $2.5 trillion in valuation value, in transaction value in the first half. And that is on that's on track to beat the 2021 record. So on your point, a lot of deal activity. That should be positive for banks. And, of course, the volatility that we're talking about again today around oil prices, around geopolitics, around inflation, around semiconductors and chips. All of that arguably potentially a benefit for these banks as well as they come through with these earnings.
Absolutely, and that will be really interesting because that will be evidence of the broadening of the AI theme, won't it? If we're seeing IPOs in the AI space and not so much M&A, but certainly IPOs and other lending activity for the AI sector, that would be a really interesting dynamic around the banking sector and one to watch, and linking it to the tech story. Coming up on the programme, then we will look at your stocks to watch at the open, including the Rolex reseller Watches of Switzerland. We've spoken to them on this programme before. We'll discuss the company's earnings and reports in other media that it held talks over potential takeover offers. Plus, Wall Street banks are set to report near record trading revenues when earnings start coming in later today. We'll break down those numbers. Up next, we'll be joined by Freya Beamish, Chief Economist at TS Lombard. What kind of investment climate are we in right now? She has some interesting views to add to that conversation. Please get in touch with us. IB plus BBTV Go is the function to use to do just that. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
President Trump there vowing U.S. control of the Strait of Hormuz. The U.S. president has reinstated the blockade of Iranian ships and demanded a 20% reimbursement for all other cargo shipped through the strait. Oil gained on these developments. Brent rebounding earlier today to its highest level in almost a month. It got over $85 a barrel. Let's bring in Bloomberg's Abir Abu Omar, who's in Dubai with all of the latest for us. What do we know about the strikes overnight and I suppose importantly what we've heard from the US president about his intentions?
Good morning, Anna. Well, a sense of deja vu in the region this morning. We're seeing these continuing tit-for-tat attacks by the United States, a third consecutive night of strikes by the United States on Iran, including some of the famous southern provinces in Iran. Iran striking back on the region as it had in the past couple of months or so, hitting countries like Jordan, Kuwait. We reported some infrastructure damage there yesterday. Jordan cited some damage to some air bases there. But really, Anna, at the heart of all of this is now the Strait of Hormuz. We have talked about the concessions over the 14-clause MOU that was signed in Switzerland, but the Strait of Hormuz is very much back in focus now, with President Trump talking about that 20% fee. Our teams have calculated that would come up for about $30 million or so per ship, per very large crude tanker with the current oil prices. So that's a very hefty fee for ships. That compares to about $2 million from the Iranian side, according to our reporting as well, citing sources. And so both sides are now not backing down. The U.S. has reinstated this blockade against Iranian ports. Iran says that it will forever be the guardian of the Strait of Hormuz. Earlier in the day, we heard from the parliament in Iran saying that they've developed a mechanism to overlook the Strait of Hormuz. Unclarity there about what exactly that will ensue or how exactly that will legislate the movement of the ships in the Strait of Hormuz. But for the time being, it does look like both sides are adamant on this control over the Strait of Hormuz. It's not really clear just exactly how that will take effect in real life, what the U.S. side, how the U.S. side will control it and how the Iranian side will control it. Now, this is all happening as we await for a confirmation on whether the technical talks will continue. President Trump, in the sound that we just heard towards the end of it, did say that the technical talks could continue. We don't have any time frame on whether that will happen or not. But this is all underpinned with traffic in the Strait of Hormuz at a near standstill at the time being. Anna, we await more clarity on what ship owners decide to do with this new revelation from the morning, and with Brent crude prices at around $85 a barrel. That's the highest level in about a month.
OK, Bloomberg's Abir Abu Omar in Dubai with the latest out of the region. Abir, thank you. Let's bring in now Freya Beamish, Chief Economist at TS Lombard. Freya, good morning. Do you revise your inflation expectations on the back of the change that we've seen in the Middle East?
Not for next year, yeah, obviously, for sort of the shorter term. For me, the US inflation story has never actually been about this Strait of Hormuz shock. It's more about US domestic inflation that I think is sort of gradually warming up and sort of failing to come back down. I think the energy shock for us, the main sort of financial takeaway is that we're just not getting compensated in the fixed income space for these types of shocks. So we keep on seeing inflation being higher because we get lots of these little shocks now. Little is a sort of a strange word in this context, but I mean little in the sense that it's not big enough to tip the US economy into recession. It's not big enough to really spike inflation into a different regime where you get that kind of volatility that's sticky and stays for a long time, and is obvious from the perspective of sort of the 10-year that we're stuck in that sort of stagflationary regime where the bond is not hedging for equities. But because we're in what we think of as a sort of a new macro regime, you keep on seeing the same types of shocks. And so on average, the inflation forecast is higher than people expect, but sort of for the wrong reasons.
And in that new macro regime that you've outlined, and we'll get into that in more detail, you have suggested that the factors underpinning that will mean that yields have to rise higher from here. And that kind of ties into your point. And what we're seeing today reinforces that point to some extent. Yields have to go higher. Where are we? I mean, we have seen the bond sell-off, and it's been pretty pronounced this week, if we put Japan to one side, at least for today. Where are we in that journey?
Yeah, I think we're sort of part of the way there, but by no means fully priced. The 2010s was actually the abnormal period, if you look at sort of the historical correlations. And we've had actually really over the period of sort of hyper-globalization, where you've had this global positive demographic dividend that's offered by sort of cheap Chinese labor, this very abnormal period where you've got negative correlation between bonds and equities, and that's the environment that we're all sort of used to. We're now in a regime where, because of the effects of globalization and reduction of inequality between nations, which created a much more multipolar global order where you get these types of shocks more often. So the likelihood of this type of shock has risen systematically. Try pricing that over a short period of time. And then within nations, there's a lot more political instability, again, partly because globalization increased inequality within nations. So we have more sort of interventionist policy, which might take the form of sort of positive fiscal impulse, which could sort of help to catalyze and kind of play into the AI story and create a much more balanced global growth story. But at the same time, we also have this greater likelihood of negative supply shocks, which, as I said, are very hard to price over any short period of time.
And how are companies going to be rewarded through this kind of cycle then? Because you've made the point then, Freya, in your notes that this could go one of two ways. Either companies are rewarded for chasing revenues, chasing growth, or they're rewarded for, the old world where you protected margins and you cut costs. I mean, could both be true? Just depends which sector you're in, or how are you thinking about that?
Yeah, I think so. So because we've got this kind of confluence of greater likelihood of positive demand shocks to try and cater to that electorate that feels sort of left behind by the previous regime, and negative supply shocks, both of those things are sort of possible. And I think part of the reason why we see so much volatility in markets is because if you get lots of the positive demand shocks and the supply side, potentially through the adoption of AI, is able to respond to that, you get into this whole new sort of virtuous cycle, which has very different asset market implications than the negative supply shock.
Yes.
regime.
Does the politics that's brought us to this place, though, Freya, is it patient enough to watch those supply side reforms come through?
So that's the the countries that outperform over the next 10 years are going to be the ones that don't just opt for the sort of the short-term populist positive demand shocks and the negative supply shocks, the sort of tariffs and de-immigration. They're going to be the ones that really repair the supply side and help the business sector to respond to this environment. I think the reason, for instance, in the UK, why we have such high gilt yields is because we've had a sequence of sort of bad policy over quite a long period of time now. And so gilt yields are high for sort of all the wrong reasons. It's all about sort of negative supply shocks and the deterioration of the bond's hedging quality for equities, as opposed to sort of that kind of what we call demand repressurization and sort of response of the supply side and the new virtuous cycle.
Freya, is the Fed behind the curve?
Yeah, I think, and under any normal circumstances, and because there are so many different types of shocks hitting the economy, that's why it's quite hard to tell sort of how far behind the curve they are. But I think under any normal circumstances, looking at the inability of the labour supply side to respond to that sort of demand resilience that we keep on seeing over and over again in the US economy, we probably are in an environment where this economy can sustain higher interest rates in a positive sense. And the main risk is actually, especially when you've got this new general purpose technology, that you almost have this kind of dual, not so much the K-shaped economy, but the sort of the tech economy versus the non-tech economy, in which interest rates should be even higher to sort of curtail the buildup of leverage in that new tech economy. Okay. And the rest of the economy can probably take that. So terminal rates should probably be, 3, 4, 5 hikes over the next 12 months.
Thank you very much. We'll keep that in mind. Freya Beamish, Chief Economist at CS Lombard.
OK, here's what else you need to know this morning then. A heat wave and the World Cup prompted Britons to splash out on pints of beer, clothes and electronics in June. That's according to Barclays data. Card spending rose 1.9% from a year earlier. So close to 2%, obviously. Spending in pubs soared during England's matches, while families bought fans, cold drinks and summer clothing to cope with one of the hottest months of June on record. UK Chancellor Rachel Reeves, meanwhile, is set to use her last speech to the City of London to defend her government's fiscal rules and issue a coded warning to the next Labour government. In her speech at Mansion House tonight, Reeves is expected to say that plans to boost the economy will only succeed with the support of financial markets. The European Union has failed to endorse a new sanctions package against Russia, putting the bloc at risk of undermining one of its key tools to restrict the Kremlin's oil revenue. Separately, ministers did agree to 250 new listings targeting banks, crypto operators and tankers, allegedly enabling workarounds for Russia. So there's a deadline, which is Wednesday, Anna, in terms of this price cap on Russian oil, I believe set at around $44 US. If they can't, and they so far haven't come to an agreement on that, then you could get to a point on Wednesday when that cap ends, which obviously would benefit Russia and Vladimir Putin. But the Europeans still working to see if they can come to an agreement before that.
Yes, they need this cap to work in a world where oil prices have spiked substantially on the back of the war with Iran. Interesting also in the US context that we've got reporting, White House sources telling Bloomberg that President Trump is going to be backing Lindsey Graham's Russia sanctions package. President Trump himself, his language seemed a little more lukewarm on the idea. He was saying he was going to look into it, but a little less convincing perhaps. But that is certainly something that we will be watching. And also the EU and the UK coming to an agreement around the UK participating in some of the weapons provision to Ukraine via that the loans that Europe has been giving to Ukraine. So we'll watch that and that relationship between the UK and the EU.
France, the UK, Denmark and other nations as well working on a replacement or at least an addition to the Patriot missile system as well for Ukraine, which is interesting.
Coming up on the programme, we will talk to Michael Brown, global investment strategist over at Franklin Templeton, as bond traders ramp up bets for a July rate hike in the United States. That is next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, the network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
We are 30 minutes from the start of opening trade, of course, this Tuesday. European futures, after ending the session yesterday flat, currently pointing down by 0.6%. It's a slightly brighter picture as Asia closes out its session. US futures, Nasdaq 100 futures, after a rough day yesterday, pointing to gains of 0.5%. There's a bit of caution, but maybe some stability in these markets. But Europe doesn't seem to be playing that role right now, with futures again pointing low by 0.6.
Let's go to the bond market, Tom, because here we are seeing a continuation of the theme of yesterday, which is higher oil prices triggering higher inflation expectations and therefore pushing yields higher. So we see bond markets out of favour, yields going higher. That was yesterday's story. But after the close of these European bond markets, we saw oil prices go further still. They're back above $85 a barrel once again this morning. So we've sort of turned around once again and moving higher. And as a result, yields are on the rise. In particular, I can see the Italian yield at the 10-year horizon up by 4 basis points. So it does seem as if a combination of what's going on with oil and some of the repricing of the Fed curve, maybe that is having an impact. Let's get to that story now. Bond traders are ramping up bets for a July interest rate hike ahead of US inflation data and Fed Chairman Kevin Walsh's congressional testimony. Let's think about where we are on these bond markets now. Michael Brown joins us, global investment strategist at Franklin Templeton. Michael, really good to see you.
Morning. Yes.
Thank you for being with us. So European bond markets continue to price in, as we saw yesterday, the higher oil price, nervousness around inflation, and the US narrative seems to be leaning in that direction as well. We're pricing in now a 50% chance of a hike in July, when yesterday it was not seen as a live meeting. What are you expecting in the very short term then on the Fed's agenda?
We're quite sanguine, to be perfectly honest with you. We don't see a rate hike from the Fed this year. Even though we sense that Walsh is probably a little bit more hawkish than the market would like to believe. So the underlying CPI issues, and we're going to see some more data on that today, I think are going to be OK. Remember, if you go back to 2022, the US economy was brilliant at taking in an oil price shock, whipping it through the system and getting it out really in a 4 or 5 month period. So I think we're through it. $85 today, yes, market's going to react to that sort of stuff. But honestly, I think right here we should be fairly sanguine about both inflation prospects in the US and perhaps actually optimistic that inflation is going lower in Europe.
OK, well, that's interesting, because I was going to say, you know, maybe the US has a different dynamic. There's the AI trade driving inflation maybe more than the oil story. But in Europe, it has been about the oil story, hasn't it? Concern around inflation. And, I mean, should we be sanguine with oil at $85? Should we be starting to think about something more systemic underneath the oil markets these days, a sort of floor in oil prices that wasn't there before, as we see the US now talking about a 20% toll for taking crude through or taking energy products through the Strait of Hormuz?
Which, by the way, would be about $1 on the price of every barrel of going through a VLCC. So just to think of it in that particular way. Why am I more optimistic about European inflation? It's because the European economy is just dull. It's just stuck. It's stuck in a rut at this point in time. You know, we can see, I mean, Hayes' numbers yesterday showed us how weak the German employment market is at this particular moment in time. So there is no great life to the European economy. And as a result, their ability to pass through prices, we think, is pretty low. And on that basis, therefore, you start to get optimistic about where your pricing situation will be in Europe as opposed to the US. But as I say, the US, which is a stronger economy, it's going to hit its medium-term growth objectives for the first time in several years. But its ability to get it in, get it out, I think, is the thing that will save it, and we'll see a downward trajectory in the second half of the year.
Michael, can I bring it back to the European corporate story then? If they can't pass on those costs, margins are squeezed and earnings get challenged?
Well, you're going to see a little bit of margins rising in the second quarter, which is why earnings estimates and average earnings estimates have been rising at 2 or 3% into this particular...
And you're comfortable with those increases?
Yes, because I think that's the inflationary piece coming through, and it's utilities, it's banks, it's driven in those particular sectors. So overall, and the other point is to say that the European markets are not the European economy, quite the opposite, otherwise they really wouldn't be interesting at all. But at this particular point in time, with the bias that we've got in the markets, I am comfortable with those estimates, and I'm comfortable actually that European earnings might be fine this year, as opposed to normally you'd see a 7 to 8% earnings cut.
What would you be buying in Europe right now? What sectors stand out to you?
Well, it's large cap value. I mean, it's really, really simple. So yes, I'd still be buying the energy stocks at this moment in time, because again, we're locking in some cash flows which are decent. I think the banks still look interesting at this particular moment in time. I'd be a little bit worried about the late cyclicals, but the early cyclicals are still there. And yes, we're still going to run the AI trade. It's not going away. If you're thinking medium term, obviously, defence had a great run last year and construction alongside it, but I think construction is something you should think about from a 27 point of view.
And Michael, over in the US then, stocks there, we saw a dip yesterday. You're buying dips, are you? Or are you buying dips in 2027?
No, we will buy dips here, because although the markets have run quite well and you've had decent rates of return, and this earnings season, there is a heck of a lot of expectation into this earnings season. So it's often better to travel than to arrive. If we're right about the inflationary outlook at this moment in time, which is benign, we're right about the earnings outlook, which is decent, then yes, you should start to think about buying those dips and buying them hard for 27.
And any particular, where exactly is that? Because we've actually seen really interesting dynamics since the start of the year between the hyperscalers, firstly on the rise, then giving way to the semiconductor makers, the memory chip manufacturers, and then a bit of rotation back maybe from semis into hyperscalers. So where in the US tech space do you buy?
Go broad.
So not even just tech.
Well, I've just said, like, the US earnings numbers, the US growth numbers are going to be up with the normality, which is we haven't seen for several years. So obviously that's telling you the breadth of the US economy is good. In which case, small cap, mid cap, that's where we see more excitement at this moment in time than in the large cap or the large cap growth. But I don't think they're going to massively underperform. As you say, Mag 7, negative returns year to date, it's rallying back a little bit at this point in time. But actually, overall, go for the breadth of the US economy. And I'm afraid that the breadth of that and the strength of the economy really does stand out as very different from the rest of the world.
And yet you do not see the Fed hiking this year. If the Fed does hike, if the Fed hikes, the Fed could hike this month. I mean, that's the traders pricing a 50-50 chance. Would that challenge your view on small and mid caps in the US?
No, it wouldn't necessarily. I think it would challenge the balance between growth and value. And I think you'd have to start to look at that element, because clearly at that point, the Fed are confirming that the economy is on a faster than median growth track, which is 2.75% or better. And I don't think that's in people's estimates for next year. In fact, I think the median estimate for US growth for next year is 2%. And if you like what I'm saying here, it's probably going to be exceeded. But on that basis, you'll be moving yourself into that sort of slightly more growth, slightly more creative space than going for the value end, again, of the small and mid-cap area.
Michael, maybe you can help me with something that I was wrestling with yesterday, and that is if we see AI spend broaden out into, it's not just tech companies, it's lots of companies spending on AI.
Yep.
Where do I see that? Some of it might be in CapEx because they might be buying software that they can amortize, but some of it might just be in all kinds of different line items in the P&L, not labelled as AI spend. Is it going to be very obvious to us when companies of all types are spending a lot of money on AI? Do we have a sense of where this shows up?
It's going to come through SG&A, right? So you're not going to see it unless somebody wants to break it down to an individual line, because it will come through general expenses.
Yes.
Okay. And the question is, what are the savings that you're getting from that cost at that point in time? And you're seeing the whole debate about tokenization and token restriction going on at this moment in time. And what I would say is most people are using it. Most people are probably not using it awfully well. The speed of take-up is actually better at the large corporate level than at the small corporate level. Yeah. However, if you're getting that balance between productivity gains and elsewhere, and the FCA were talking yesterday about productivity gains that they're getting from AI. If you get that balance right, you should see it as a net neutral for margins in the first piece, and then obviously acceleration of margins as we go forward.
Okay, so we might have to lobby for some of that transparency a little bit.
Yes, I think that's quite possible.
If they've got good stories to tell, companies will no doubt want to tell them. But, if the story is a little more nuanced...
We'll try and play our part when we interview the CEOs of these companies during the earnings season.
And I think you'll hear the word AI and productivity over and over and over again.
Just
Your
a little
word
bit.
Chart, it's going to be huge.
Absolutely.
Yeah. Very briefly, you think there could be... You're relatively confident about the incoming... UK government?
Yes, I am actually, because I think...
Although we don't know the make or shape of it. We don't
know, but take your lovely poll saying that Ed Miliband is the least attractive person as Chancellor of the Exchequer for the markets. Go back and read the 2015 manifesto, and the first word in it is, we will balance the budget.
Mm-hmm. And that was under him.
That's his show. He's running that show. Go back and read the 15 manifesto. Go back and read other things from Ed Miliband. It is far more conservative than people would have you believe.
You wouldn't be worried about Ed Miliband?
Right here, right now, the evidence says you shouldn't be worried about it. And discussions such as a land taxes are going forward at this moment in time. Yes, that is an interesting idea if it's offset by different taxes and it's tax revenue neutral, but it's really, really difficult to do. So in the short term, I wouldn't actually think it's going to have much of an impact, if any impact at all. And goodness me, we could do with a change of atmosphere.
Michael Brown, thank you very much indeed.
You brought your own change of atmosphere this morning. You woke me up this sleepy Tuesday.
Don't need caffeine when Michael's on set, do we? Michael Brown, Global Investment Strategist at Franklin Templeton. Now, Fed policymakers warning rate hikes may be needed to tame these rising prices.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
That was Fed Governor Chris Waller. We're going to take a closer look at how central banks are viewing the inflation fight. That is next. This is Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Welcome back. This is the opening trade. 15 minutes then until the start of the trading day here in Europe. And we're kind of telling yesterday's story with the European equity market futures picture. It's negative, Tom, quite significantly, but US stocks closed near their lows in the US session yesterday. Despite oil prices going higher once again and staying above $85 a barrel, the mood in equities has changed a little. NASDAQ futures at least pointing higher by 0.4%, and the Asia session turning around a little bit, and MSCI Asia Pacific is up by around 0.4%.
Yeah, and in the bond story, global bonds, there's big divergence between what's happening in terms of the moves in treasuries and European bonds, where you're seeing a sell-off and yields up, versus what's happening in Japan. Japanese government bonds climbing then after remarks, pretty significantly as well, with yields down sharply. Remarks by the finance minister boosting sentiment towards sovereign debt. And as a 20-year auction attracted strong investor demand, the moves came after Sasuke Katayama floated the idea of adding government bonds to the tax-free Nippon Individual Savings Account program, and added that the government pension investment fund will make portfolio adjustments if needed. Let's bring in Bloomberg senior editor Brian Fowler in Tokyo for the details. Brian, what do we know about the inclusion of JGBs potentially in this tax-free savings account program, and what that could do materially, if at all, in terms of supporting demand for government debt in Japan?
Yeah, Tom, there's actually three ideas that she floated today. So let me just do them quickly. One was to make JGBs exempt from the inheritance tax. The second one was, as you said, was to make JGBs eligible as assets to be included in the NISA stock program, where investors invest after-tax funds, and then those funds, those assets are no longer subject to capital gains taxes. And then the third would be to encourage pensions to channel more of their funds into domestic assets. And the potential impact is huge. Now, what can actually be done? The first two steps would obviously be the easiest to get done. I think there could be some political backlash about the inheritance tax, because, of course, that would be a gift to the wealthy class, and Japan's already kind of grappling with a K-shaped economy issue. But those two steps could be done. I think the bigger impact would be on the pensions, but that's a little bit more complicated.
Yeah, let me ask you about that, about the conversation around the GPIF, the pensions, and what might happen there. I mean, and we should point out that on both of these initiatives, the finance minister has talked about these initiatives moving forward, even though she's made no decision on whether they actually come to pass or not. But what significance would GPIF changes hold?
Yeah, so, I mean, first of all, the GPIF sets its allotment targets every 5 years. It reviews those. And most recently, it did that in March of last year and decided to retain its previous settings, which were 25% each in domestic stocks and bonds and 25% each in overseas stocks and bonds. So that is intact for the next 5 years. Having said that, it has some wiggle room in the sense that it's got 6 percentage points, which it can kind of veer away from those targets. And in fact, it's already doing so. As of March, it was 26.9% of its assets were in domestic bonds. So it's already a little heavy on domestic bonds. But if it were to push that even further toward the limits of what it can do in terms of the wiggle room, that's another $50 billion that could be going into that market. So the potential is quite big in terms of the impact. I guess the big question would be what gets sold off in order to generate those funds. I think if it's U.S. Treasuries, that's going to be a big problem. U.S. stocks, maybe not so much.
Brian, thanks very much. Bloomberg Senior Editor Brian Fowler with the latest on what's moving Japanese bond markets. Let's pivot our attention to the European Open. It's only 12 minutes away. Let's turn our attention to the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Good morning, Mark. You're here in London, which is excellent news for us. So we're once again faced with a higher oil price this morning, 85.50. And for a long time, yes, the language has all been around tit-for-tat skirmishes at the edges of an MOU that left the talks intact broadly and the ceasefire broadly intact. Is that still the case when you've got President Trump talking about a 20% toll through the Strait of Hormuz? I mean, how fundamentally do we have to rethink what's happening in the Strait?
I'm not sure how much has actually fundamentally changed versus how much the kind of interpretation of the situation has changed. So, you know, a week ago, the idea was this is going to be tit-for-tat strikes as go on forever. This is going to be one of those like strange ceasefires where there's never really a ceasefire, but it's not going to really escalate again. It's all noise. It's not tradable. There's enough oil in the world. They'll find a way to get oil out there ahead of the midterms. It was the kind of narrative we got. Now, the slight tweak is the same starting point of it's like tit-for-tat strikes are going to continue forever. It is never going to end. The ceasefire is going to, you know, never really be a proper ceasefire. But we need a higher premium for oil prices as a result. And I think that's really, really important. People have realized that both sides can find it easier to disrupt the other side. So the US can disrupt Iranian flows. Iran can cause enough problem in the Strait to keep on disrupting kind of general flows. And therefore, the Strait of Hormuz in terms of shipping is not going to normalize probably again this year, or maybe ever again to the way it was, because we're going to build alternative pipelines by next year. So ultimately, I just don't think it's ever going back to the way it was. And therefore, we need a slightly higher price in oil prices going forward. And that is changing the whole dynamics around the rates conversations for central banks everywhere.
Do you think that, so structurally higher inflation as a result of that, and whether Kevin Walsh actually addresses that, whether he nods to that in his testimony today, whether he has to accept that maybe we're in a world of structurally higher inflation?
He might do that. As we all know, he's going to try to say as little as possible, but he'll be forced to. It's so long speaking, he's going to end up saying stuff. We're going to overinterpret what he says. I think it is structurally higher inflation, but it is obviously supply-side inflation, so it makes it a little bit more complicated for central banks. Look, the Fed is definitely live for July. For the data today on Wall Street is really, really important. I'm in the camp that they ultimately won't hike rates. But, you know, you can't have that view, super high conviction ahead of the testimony, ahead of the data today. I think he wants to sound like very open-minded. I don't think he wants to sound conclusive either way. I think we might still be in a situation that tomorrow where July is still live, but ultimately I think the Fed will disappoint.
That's an interesting point you make about whether we overinterpret. I mean, he deliberately does not want really to communicate any guidance. So what is the point of talking for so many hours, I suppose, is the, you know, I know he has to make his appearance, but from a market's perspective, is there really anything to listen to?
Yeah, look, I think people still are trying to know who he is, know what his biases are. I mean, you know, this is a person who's portrayed very different images on his inflation hawkishness over the past 20 years. And so therefore, I think people are really trying to find out what is the true Kevin Walsh as Fed chair. So I think that people do need to kind of study it and interpret it. You know, the problem is that we've now had, 16 years of kind of having these press conferences and so much kind of forward guidance, the dot plots, and we've gone through a world where people stop looking at data. We talked about this a lot in the program, and I used to get really annoyed at people like who wouldn't look at the data, and then they'd wait till a Fed person told them what the data said a week ago, and then finally relax. You're like, we knew the data already. So I'm delighted we're going back to a world where people actually look at the data themselves, but people will overinterpret in the short term.
Let's hear it for thinking for ourselves then, Tom.
Yes, we'll try and do more of that.
Yeah.
And Mark Cudmore is that inspiration, joining us on set this morning. Bloomberg Markets and throughout this week, I believe. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Go to MLive Go on your terminal. Let's get your stocks to watch this Tuesday and bring in Chloe Melly. Chloe.
Good morning, Tom. Ericsson is going to be in focus this morning after reporting a drop in earnings, and that was due primarily to those rising costs for key components. It said it would try and mitigate the impact of that cost inflation, but that margins would be under pressure. It is quite interesting to see just how much Nokia, its closest rival, has really outperformed Ericsson, but in large part because of that real focus on AI that Nokia has had, whereas Ericsson has stayed more of a pure play telecom player. But it is also worth noting that the CEO actually of Ericsson said this morning in the statement that Ericsson would move more towards trying to capitalize on this AI boom as well, saying that it has expanded into those attractive growth areas and was trying to move towards that as it moves towards the physical world as well. So we'll see if that's really enough to reassure investors after this mixed performance over the second quarter. Moving on to more earnings, and we've got the logistics and shipping company Hapag-Lloyd boosting its guidance last night, citing a growing market demand and also this rise in container rates, which of course has to do with those continued disruptions in the Middle East. Those market dynamics are the same ones that have been cited by Maersk when it boosted its guidance as well earlier this month. And so this logistics shipping sector is going to be very much in focus this earnings season, and this boosted guidance could also lift the shares for Hapag-Lloyd this morning. And finally, let's go over to Airbus because we have got a report that that Riyadh Air is in talks with both Boeing and Airbus to buy planes from those two. This comes after a lot of delays to the start of operations for Riyadh Air. It was supposed to start in early 2025. It's kicked off operations just this month. But we could see those orders for new jets boosting the shares in Airbus this morning after we can see here it has just started to catch up with Boeing recently.
Chloe, thank you. Chloe Melly with some of those stocks that are on the move. There are plenty of things that we're watching this morning, aren't there, when it comes to these markets. I'll add in that we'll watch oil companies, energy companies as well, of course, because we've got a higher oil price up above $85 a barrel once again. And just in yesterday's session, we saw energy was the best performing sector, and that could be again
the worst performing was travel and leisure on the higher oil price as well. Of course, we'll watch gilts at the open, given the sell-off that we're seeing in European bonds. Interestingly, Bloomberg Intelligence crunching the numbers and suggesting that European companies set to post the biggest increase in profit growth in 3 years. On aggregate, earnings gains of 11.5%, according to the data from Bloomberg Intelligence.
It's interesting. Short-end European government bond yields up quite substantially, to your point, Tom.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry Yan in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Welcome back, everybody. A few minutes then until the European cash equity trading session opens. And this is the handover from the States. And it does tell us something useful, but we have other elements we need to add in as well. So this was where the European markets closed. And after that, we saw US markets trading lower, tracking lower, and actually closing near session lows. So that is interesting, and we need to factor that into our European session. Add on top of that, the fact that we're back to session highs on oil once again this morning, so above $85 a barrel. And that could be something that puts pressure on some areas and also supports some areas of the European equity space, notably energy stocks. So what does all of that add up to then? When we look at the European futures picture, we are expecting to go weaker. I wonder how long that is sustained for, though, Tom, as we see US futures actually turning a little more positive, Asian futures turning a little bit more positive, though perhaps maybe more on the tech side of things.
On the individual stocks that we're watching with that energy component, of course. So BP here in the UK, just one example. Given the strength that came through for the energy sector yesterday, we'd expect further gains for the oil majors on the higher Brent prices that we're seeing. Ericsson talking about potential pressure on margins. That is called lower. Ericsson, so we watch that stock, of course, and watches, fortunately, not witches, watches of Switzerland coming through with earnings that essentially met estimates. It's also a takeover speculation as well for that company. So we are keeping an eye on watches of Switzerland as well, Anna.
Yeah, absolutely. So lots to watch when it comes to the European earnings dynamics. We've seen some quite punchy estimates as to what European corporates will be able to do this European earnings season, the US earnings season as well. So we're watching for that to unfold as we approach the European earnings season, of course. The focus today, perhaps more on the US. The bank earnings season is fast approaching. We've got 5 big banks reporting today, so that's going to be certainly an area of focus for us. But right here, right now, we have the European equity market session just getting underway. And actually just to the downside, in fact, I'll just give that a moment to settle down because that looks a little bit unusual if we have all of those open right now. The DAX doesn't usually open this quickly, which makes me suspicious of what I'm seeing here on my screen. But Tom, as we are waiting for these European markets to open and actually waiting for them to open to the downside. So I might suggest we disregard what we're seeing on the screen right now. Maybe you have some better data for us.
Anna, your instincts are absolutely correct. What we're seeing right now across the benchmark is a drop of 0.5% on the stock 600. The FTSE 100 is down a little over 0.2%. The CAC 40 over in France, this is a big move lower, down 0.9% in France on the CAC 40. You're seeing losses of 0.6 on the FTSE MIB in Italy, and 0.8% is the drop that currently seeing on the IBEX. Across your sectors, unsurprisingly, we're seeing very similar dynamics to yesterday across the European equity space, with energy at the top with your sector. It's gaining 1% in terms of the upside for that sector. On the downside, once again, it's travel and leisure falling 1.4%, again being hit by the higher oil prices. Basic resources is also in the positive category. So we've got 3 sectors that are showing gains. Energy, basic resources and chemicals. Energy up front, of course, with gains of 1.1% right now. And again, the pain traders for travel and leisure currently down 1.5%. Banks also feeling a bit of a squeeze, down 0.9 as a sector.
Yeah, it's really interesting, isn't it? Actually, today, the story yesterday was higher oil prices. The story today is higher oil prices. And the move is a little more extreme today in that we've got only 3 sectors in positive territory, including energy, not surprisingly, whereas yesterday, by the end of yesterday's session at least, we had a slightly fairer split between those sectors going higher and lower. In terms of individual movers then, BP, Total, Shell, you get the picture. There's an energy theme to the upside, basic resources represented with Glencore and chemicals with BASF. To the downside, looks like a fairly mixed bag. Safran in the engine space, we've got some luxury stocks on the back foot. So Richemont, I see, is in there, LVMH and Hermes. So actually not that mixed. And EssilorLuxottica is quite a luxury flavour, consumer products and services flavour to the things that are moving lower. Those large cap stocks over in Paris doing badly then, and that is weighing on the CAC 40.
So that's the stocks picture. We want to reflect on what's happening in bonds, with gilts opening pretty sharply lower, particularly at the front end, with yields up at 9 basis points, close to 10 basis points. So you're at 4.43 on the 2-year. The 10-year in the UK is back above 5%, with yields up 6 basis points. You are seeing a sell-off in the sovereign debt of Europe, but it's more pronounced here in the UK. You put Japan to one side because there's a strong rally there for some very different reasons as the government looks to support JGBs in a strong auction. Put that to one side and you're seeing a sell-off in global bonds. Yields up sharply, particularly at the front end here in the UK. Close to 10 basis points is the move. 4.44 right now on the 2-year, Anna.
Yeah, pretty substantial moves then across Europe and even more so, here, as you say, here in the UK. Let us talk about where we are on the broader investment landscape. Maria Weitmaner joins us, Head of Equity Research at State Street. Maria, really nice to have you with us. I wonder, as we see oil prices once again above $85 a barrel, how much is that making you rethink equity allocation or equity strategy from here? What impact does this higher oil price have, Maria?
Yeah, good morning. Thanks for having me. Always a pleasure. So it's a kind of higher oil prices replaying what we've seen earlier in the year. And the reaction of investors earlier in the year when oil price increased was stay sanguine, focus on earnings, look where the strength is, and kind of progress. So that's, obviously we are getting into earnings season, so that's great. We're going to get more updates, more information there. And secondly, on kind of multiples, we get some ideas in terms. We're having Fed meetings, so today is kind of a pivotal day as we're going to get quite a lot of update. But in terms of investor reaction to the kind of first increase in oil price earlier in the year, what did they do? They focused on sectors with better earnings. That was tech. That's where they kind of piled money in. And I would not be surprised to see something similar.
OK, so if we see dips in tech or the broader US equity landscape, Maria, are you buying those dips?
Yeah, I think for us, buy the dip in tech has been a strategy because that's where we consistently see very strong earnings, very stable earnings, very predictable earnings. So that was a good strategy for us. So that we would like to stay with that.
What is the nuance, Maria, within that call on tech that you've been consistent on? And do hyperscalers fall into that basket? Do you have a barbell approach? Are you concerned about what's happening in the semiconductors? Do they look a little rich to you? How are you thinking about the nuances within that tech call?
Yeah, I think that's a very good point. I think up to, I don't know, a few months ago, it was just big tech trade. We still like mega caps, but within the sector, we are increasingly looking at software. So software has been kind of sold very aggressively. If we look at institutional investor holdings, that's where positions are the lowest. And we're beginning to see kind of two things that's encouraging for us. One is kind of stabilization on fundamental side. We see kind of analysts stabilizing their margin expectation, revenue growth is kind of coming through, management talking about kind of ability to retain clients. And at the same time, we see institutional investors starting to buy from this big underweight position. So that's really encouraging. So we see some positivity there.
OK, interesting on your views around software and some positivity there. Where does Europe sit in the AI story at this point for you, Maria? Is there an adoption story that we can play out as investors when it comes to European equities, or something else that could give European stocks further upside in this trade?
On AI specifically, I think we like generally like picks and shovels. So like Europe has some companies that kind of feed into the kind of chip production, so that's very helpful, and we still know that demand for kind of memory and semiconductors is much higher than supply, so there is a big support. But the flip side of it is we don't have too many companies in Europe that are linked to the AI trade. So kind of relatively speaking, Europe is still for us kind of one of least favorite regions. We still don't see enough earning growth in the region overall. So we favor kind of US, Asian equities, and we kind of remain underweight European stocks.
And Maria, do you think that this earnings season, and you can talk about the US or Asia in particular, maybe Europe too, but given what you've said, maybe the other regions, is it going to be this earnings season that shows some evidence of tech spend, AI spend broadening out, or is it too early for that?
Obviously, really important to look out for it. I mean, we're still a little bit skeptical about it. I think we still see quite like a very substantial concentration in tech spend, and so it's still kind of peaks and troughs in that trade that tend to benefit. Little sign of broadening.
And the small caps picture, is that in the US? You say that the small caps picture looks a little bit fragile. I guess this all adds up to one part of the US narrative, the tech narrative, doing really well, and the rest of the economy less so. Is that what's driving your thinking?
Yeah. I mean, we're still kind of big believers in this kind of K-shaped economy, and larger companies tend to benefit. And I mean, for small caps in particular in US, I mean, the picture is still fairly challenging. I mean, we still see about a quarter of small cap companies are loss-making. If you look at kind of margin pictures of profit margins in S&P or like mega caps have been improving very substantially. Small caps are really struggling to maintain profitability. And I think a lot of it for small caps, I mean, small caps is high beta. So we have a kind of economic growth, kind of economic surprises being positive. Market is excited about it. They're buying small caps on this expectation that things are broadening out. But underlying micro fundamentals in smaller companies are still very challenging. They're still very interest rate sensitive companies. So high interest rates or kind of lack of cuts, let alone hikes, are really detrimental for those companies. So yeah, no, we worry about small caps. There are lots of hopes, lots of expectations there. Reality, and I mean, again, we're going to earnings season. We'll see some confirmations of that. Reality, to our mind, is still not there.
Okay, so it sounds like you're focused on the top end of the K rather than the bottom end because of those concerns. What is the picture? How resilient are European corporates to the energy story, or do you play European energy on the back of an assumption maybe that we get sustained friction in the Strait of Hormuz? Maybe $85 is the new normal for oil.
Yeah, I mean, we see Europe as very much kind of geopolitical price takers. So oil prices are high, but it's not just about oil prices. If we look at like natural gas, heating oil, so those prices are very, very elevated. They didn't go down as much as kind of oil price on a kind of leg down. So European companies Europe is kind of energy hungry, lots of kind of industrial manufacturing companies. So they tend to struggle with higher oil price. So that is still there. But for the stock market, more importantly, is that European stocks have performed reasonably well in the first half of the year and like Q2. But a lot of it, actually very substantial proportion of it, came from multiple expansion, not underlying earnings. So, I mean, again, in the earnings season, we would be looking very, very carefully for kind of guidance and realization of those better earnings that kind of market already priced in. So for Europe, I would argue that the bar for earnings season is much higher than other regions.
And Maria, we're looking ahead to both Kevin Walsh appearing on Capitol Hill today and CPI data out of the US. The expectations around CPI actually that year on year we get a bit of a drop down in the CPI numbers, but obviously with oil prices where they are, the narrative could be a little bit different. How are you thinking about the inflation story in the moment in the US?
So we are fortunate enough to own price stats, the companies that track online inflation around the world. And what we saw in US in June, headline inflation, headline online prices have dropped around 20 basis points. That's the biggest drop in 18 years. So the headline inflation is definitely coming down. So that's a positive. On core, I think the important point to make is that when oil price was going higher, we've seen we've seen very little transmission, very little pass through into core. So core has not increased as oil price was going up. So consequently, we don't see oil price decreases making core to come down quite a lot. So our kind of expectations are around 0.2 month-on-month increase on core. So kind of broadly in line with consensus, maybe slightly weaker. But yeah, we're seeing kind of continuous deceleration in inflation, broadly speaking. We see the base effects from kind of last year tariffs dropping off, kind of normalization in oil prices. So all those things are positive, and very little kind of sectoral push in inflation. Maybe the only exception is electronics, where we see kind of higher chip prices weighing on CPI. So that's probably the only sector where we need to be a little bit more careful.
OK, well, we'll get that data 1:30 p.m. UK time. Maria Vaitmana with that view on the equity space, of course, globally, head of equity research at State Street. Remains conviction, of course, that conviction around the tech story remains for Maria. Let's get to your core six right now. Briefly check in before we get your stocks to watch what's happening across the core six here in Europe. So a big move for the luxury space again to the downside. LVMH down 2.2%. You're seeing some losses as well for some of the consumer-focused businesses. Some of the staples like Nestle down 0.7. Schneider Electric, which plays into the data center story, down 0.5. One stock that stands out in the core six is ASML, interestingly, up 0.3%. So there's some optimism there around one of the key providers of kit into the semiconductor story, up 0.4 on ASML. Let's get your stocks to watch, individual stocks on the move, and bring in Chloe Mellick. Chloe.
Good morning, Tom. We are seeing a huge drop for Ericsson this morning after the telecom company flagged that margins will come under increasing pressure because of the rising cost of some key components. And so we're seeing the shares down more than 8% this morning. So a very steep drop for Ericsson there. This is further widening the performance gap between Ericsson and its closest rival, Nokia, which has banked a lot more on this AI boom, while Ericsson has remained more of a pure play sort of telecom player, which may not have paid off as well as it wanted to. So we're down quite significantly there. Moving on to another earnings story, but a positive one for Hapag-Lloyd, which is up this morning, up almost 6% after boosting its guidance. It said that it was benefiting from growing market demand and also those rising container rates. This is the same thing that Maersk also cited when it upgraded its own guidance just a couple of weeks ago. And so the shipping sector is really benefiting from this disruption in the Middle East. And that's the same case for oil majors, which are also in focus this morning and also in the green. The likes of BP, Eni, all of those names up very strongly this morning. BP in particular, because of these rising oil prices. Trump has reimposed a blockade on Iranian ships transiting through the Strait of Hormuz. We are seeing that boosting oil prices and therefore boosting all of those oil majors this morning. On the flip side, of course, that means a bit of a tougher day for airlines, for that travel industry, taking quite the hit this morning because of this disruption to oil flows and potentially those higher fuel costs coming back on the agenda. And so we're down really across the board there. And finally, EssilorLuxottica is also down this morning after being downgraded by Goldman Sachs, with the analysts saying that there was going to be some tougher comparatives for the AI glasses that Essilor is making in a collaboration with Meta, and also rising competition from the likes of Google, Samsung and Apple as well. And so we're down more than 2% this morning on the back of that downgrade as well.
Chloe, thank you. Chloe Mellick with us with those stocks on the move. And there are some. Coming up, though, we will talk about oil prices. Oil trading higher.
world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. We are 19 minutes into your Tuesday session. It's risk off, at least when it comes to European equities, on higher oil prices and renewed geopolitical tension. So you're seeing a downside right now across the European benchmark of 0.5%. The DAX in Germany down 0.4, close to 0.5, as you can see. The CAC growing over in France, losing at 52 points. Here in the UK, the FTSE 100 holding at 10,479. And you do have a bit of support coming through from the energy sector, which is up 1.3%, one of four sectors in positive territory, the rest facing pressure. Travel and leisure, the biggest loser across your sectors, down 2% right now. It is all about what's happening in oil. Brent futures then spiking above $85 a barrel for the first time in a month. That as President Trump reinstated the US blockade of Iranian ships transiting the Strait of Hormuz. Let's bring in our energy reporter, Anthony De Paola, for the details. Anthony, what does the blockade mean for the global energy supply? Is it being reimposed? What does it mean in practice for shipments through the Strait?
Good morning, Tom. Yeah, I mean, there's a couple different factors that will be influencing the market here. I mean, first of all, specifically to that issue of the blockade, what the U.S. is going to do is block any Iranian vessels going to or from Iranian ports. So that would cut off that kind of resurgent Iranian oil flow. So we have seen a lot of Iranian oil tankers leaving Iranian ports after the MOU was signed. They had a lot of oil stored on vessels. Those have all left. We had a report of about 57 million barrels of Iranian crude leaving ports in and around the Gulf area and heading to market. A lot of those have still been sitting on ships out in Asia because China hasn't really been buying, and they've been the main buyer of Iranian crude. So even when the sanctions, the U.S. sanctions against Iranian crude sales were lifted, those have now been reimposed. Even when those were lifted, there still weren't many takers for that Iranian crude. So that will be that flow should be blocked off. But also what it does is that announcement of that 20% fee is, of course, bringing up prices because that will make everything more expensive coming out of the Gulf. That's the 20% fee that President Trump said would be imposed for protecting Hormuz. Of course, we still have Iran interfering with vessels and shipping there. We did see two ships owned and operated by ADNOC L&S, the shipping arm of the UAE oil giant. Those were targeted transiting through Hormuz in the early hours of this morning here. So that's another big risk. ADNOC has been one of the most aggressive in terms of getting its oil out under cover of darkness with their transponders off. So this potentially is a risk to those flows.
Yes. I mean, both Iran and the US then claiming this role of guardian in the Strait of Hormuz right now. We've talked about the oil price then, Anthony, about that up by 3% this morning. Is that wide across other products coming out of the Gulf, gas prices, for example?
Yeah, and gas will be up, of course. We've seen product prices up as well, refined product prices like fuels in Europe in particular, where you are, because you don't have a lot of that product coming in from Russia because of some attacks on refineries there. And Gulf products, which would normally take up some of the slack, they've been slower coming out. They've been being produced and been exported, particularly from the Saudi Red Sea, some from the Persian Gulf, but not anywhere near the volumes that they were prior to the conflict. Of course, there's a lot of Atlantic Basin diesel coming across to Europe as well, too. But we are seeing that gas increasing, which is vitally important for Europe this summer period. They need to increase the stockpiles of gas to prepare for the winter. Of course, last week we saw a Qatari LNG ship hit as well, too. So this is really going to have some impact on that rampant recovery that we were seeing, and that's going to be a problem going forward, Anna.
OK, Bloomberg's Anthony Di Paola with that update. Anthony, thank you. Let's get you some updates right now when it comes to the semiconductor story, because Bloomberg is reporting that Samsung is in the early stages of exploring a potential offering of American depository receipts. That, of course, after the successful listing of ADRs for SK Hynix on Friday. So Samsung is exploring this. They have not yet appointed any banks. It's very early stages. They have looked at this option before. It's obviously a complicated business, but they are reviewing whether or not this is an option, according to our reporting. OK, one to watch. Let's return to other corporate news here in Europe. Watches of Switzerland's annual revenue jumped by 13%, supported by strong US demand that the luxury watch retailer said is laying the foundation for long-term profit growth. It comes after shares of the Rolex reseller went higher yesterday following a report that it held talks over potential takeover offers. Let's speak now with our Swiss luxury and industrials reporter, Allegra Catelli, who is always close to these watches stories. Allegra, why would the company be interested in going private, or what do we know about the future of this business? Let's start there.
Hi, thanks for having me. Yes, as we know, the luxury space has been going through a bit of a tough time of late. So for a company like Watches of Switzerland that has such an exposure to the watch space and the luxury space in general, it's not inconceivable. Their share price, even though it's gained quite a lot this year, is at about half of what it was in 2022. So it's not so surprising that it might have attracted offers. At the same time, when I did speak to the company yesterday, they said that these discussions were held in the past. I've been also asking sources around this. And so it doesn't seem like anything is happening right now. Others in the space, like Swatch, had also considered going private. So it wouldn't be inconceivable. OK. And Allegra, they also came out, Watches of Switzerland, with earnings today. What did we glean from those numbers? What we understand is that the US market is extremely strong at the moment. They also said that they've seen encouraging signs on the UK side of things. The US market is a market that they've entered 8 years ago, and already it makes up for half of their sales. So it's quite a it's quite a driver in terms of these returns. US customers really like gold watches, big watches, and they have a lot of spending power. So, and they're using it. So that's a driver. That's definitely a driver of growth. OK, Allegra, thank you for that update. Allegra Catelli, our Swiss luxury and industrials reporter. Coming up, we are going to be talking to Jim Zelter, president of Apollo Global Management, as the firm's deal-making nears a record for the year. That exclusive conversation is coming up. This is Bloomberg.
anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome back. This is the opening trade, 30 minutes into today's session, and European equity markets certainly on the back foot. Is this yesterday's story? How much is this going to be a persistent theme, this negativity in European stocks into the trading day ahead? We have a US stock seeming to try and draw a line in the sand ahead of inflation data, ahead of Kevin Walsh speaking later on Capitol Hill, but we do have the oil price persistently higher, above $85 a barrel once again, and the European equity markets finding it heavy going to overcome that. In particular, the CAC 40 then, Tom, where we see some of the luxury names under pressure.
Yes, that is the story, isn't it, in terms of the energy hit to European stocks. As we look ahead to those risk events, as you say, in terms of CPI, inflation out of the US, and of course Kevin Walsh. Right now, volumes are down versus the 20-day average, close to 20%, 17% right now. But you are seeing that negativity when you split the board on the stock 600. So you're seeing 470 stocks, roughly 469 in negative territory, just 123 posting gains so far, 31 minutes into the Tuesday session. Let's split the board and have a look at some of the positive stories. And this does come down to earnings. We've got some positive outlooks coming through. So Hapag-Lloyd, of course, in the shipping space, revising up their outlook, or at least posting a positive outlook. So the stock gaining on the back of that. Allegro, this is a first half earnings story and some optimism on the numbers that have come through for Allegro and Micronic as well. Also, the outlook being boosted by that company, and the stock is rallying 13%. It is upgrading its full year outlook. On the downside, a lot of this does come down to the energy story, to the $85 a barrel story. Ericsson is more about a margin story. They're warning on costs into the back half of the year and a pressure story around margins for that telecom equipment maker. Intercontinental Hotels and LVMH, this is about the energy shock, of course, luxury and travel under pressure, as there was yesterday as well. LVMH then down 2.7% in the luxury space, and then in the travel and leisure space, you're seeing airlines under pressure as well, of course, currently down 5 points or 3.3% for that particular stock. Anna.
Tom, let's get an update on the other stories that we are covering then this morning. Bloomberg has learned that Samsung is in the early stages of exploring a potential offering of American Depository Receipts, or ADRs. According to sources, the company has held preliminary discussions with banks, but hasn't yet made a decision about whether to proceed, and will monitor the volatile memory chip stocks as part of that decision-making process. The US President Donald Trump has reinstated the US blockade of Iranian ships transiting the Strait of Hormuz and is demanding a 20% reimbursement for all other cargo shipped through the waterway. Iran sees any challenge to its authority in the strait as a breach of the interim peace agreement, the MOU, and insists that the renewed blockade may prompt further attacks on commercial vessels. And bond traders are ramping up bets for a July interest rate hike ahead of US inflation data and a testimony before the US House by Federal Reserve Chair Kevin Warsh later today. The market is pricing in a rate increase by year end and a second one in by mid-2027. Tom.
Now, Apollo, as we think about the macroeconomics, a factor, of course, for all investors, arguably as well for private capital, private equity, and Apollo Global Management is nearing, despite this higher interest rate regime that we're seeing, the geopolitics, Apollo Management is nearing a record-breaking year for acquisitions. It's launched a £5.7 billion takeover bid for EasyJet and is buying a €3 billion stake in Bayer's contraceptives unit. The investment firm's massive spending surge puts it at odds with the broader private equity industry. Most rivals are actually struggling to close new deals. Very pleased to say we're joined by Jim Zelter now, president of Apollo Global Management. Jim, thanks for coming into the studio. So on track for a record year for Apollo when it comes to acquisitions. What has been driving that? Does it continue?
Well, I think it's, first of all, always great to be here in London. Great weather. I think this has been a trend the last several years. Our business has really continued to evolve beyond our private equity roots of 36 years ago. Today, we're a little bit over $1 trillion of assets, with credit being 80% of that. And most of our deployment the last several years, 80% plus, has been in the credit areas and mostly investment-grade credit. Certainly, topical in the last couple of days, on the last few days, in terms of what we've announced over here is some in the equity side, which I'm sure we'll get to. But certainly, it's a robust economic backdrop, particularly in the U.S., but also in some areas over here as well. We've talked about this global industrial renaissance of many industries needing tremendous capex to growth. And we find ourselves in a very unique position to be able to provide that to many companies. And you and the team have been pretty constructive on Europe. You're obviously here in London, so no doubt having some pretty consequential meetings. Is it a valuation story in Europe? Is it the AIs? Is it that Europe actually does have some role to play in AI? What makes Europe attractive in a moment of flatlining economy? Well, I think the big story globally, it certainly has been an AI technology story, but there really is, we've been very consistent the last 2 or 3 years, this global industrial renaissance, whether it's energy transmission, whether it's industrial revitalization, defense, and many other areas. And if you look in Europe in the last 24 months, between transactions we've helped with financing Air France, Vonovia, RWE, EDF, Bayer, as you mentioned this past week, these companies need a tremendous amount of capex to compete on the world stage. Many governments in the past had been the purveyor of lots of capital for capex. Today, government pocketbooks aren't as buoyant to be able to provide that. So we, along with the investment grade market and the non-investment grade market, are really a provider of a lot of that capital.
Jim, good morning. Nice to see you. Help me keep up to date with what it is you want out of these businesses in Europe that you're investing in then, because we see names, somebody like Apollo going after something like EasyJet, and then you think, but this is quite a low margin business. This is a low cost business. In the olden days, we'd have thought of maybe businesses such as yours going in and wanting to strip out costs and make them more efficient. I mean, maybe that is part of the story, but surely there aren't many costs to strip. So what kind of thinking goes into making a play for something like EasyJet, where there might not be the cost base to attack?
Well, I'm sure you can appreciate there's very little I can say particularly about that transaction. I will say to you, in the private equity area, we have a long history of investing in airlines and aerospace. So, we've had successful investments around the globe, whether it's Atlas Aviation, whether it's, Sun in the U.S. We've done quite well in that sector. That's an equity investment. The others that I mentioned to you earlier, Vonovia, Air France, Intel, those are all really debt financings that we've provided. So I think we're extremely active on the debt financing side in Europe because of our role working with the banks as these companies need capex. But I think there are, a tremendous amount of great businesses over here. It's a very large economic backdrop for us to be able to deploy capital. And, in the last 24 months, I know I've been to Germany a half dozen times. I know my peers have as well. So there's certainly a lot going on here. When you have a firm with the breadth and scale of our toolbox, we can provide debt, mostly investment-grade solutions, as well as some equity solutions. It's a very positive story.
Okay, and thinking about all that you just said there, you've been to Germany quite a lot. You were earlier mentioning that government pocketbooks are stretched, and you guys have a bit of money to spend, to invest. Makes me think of the defence sector, because this is an area we talk a lot about needing capital and needing investment in Europe. Is that somewhere that you're looking to increase exposure?
Yes, I think again when you think about, I think when we sit back in the next 24 months. We'll look back and say, well, we talked a lot about AI and the hyperscalers, but really there was a major capital expenditure need around a lot of companies. What's going on right now in the Middle East with the supply shocks of oil, I think it's making many companies look at their supply chain finance and just-in-time finance and inventory finance. So every economic event creates a variety of financing needs. In the wake of that, we saw it during COVID with supply chain. We're seeing it right now with the incursions of the challenges of the Middle East conflict. And so many companies are thinking about how do they finance themselves appropriately? Are there assets on their balance sheets that they can redeploy in a more effective way? In the end of the day, this is all about companies doing things that optimize the equity returns of their business. And if you'll see, a lot of the companies that we provide these debt financings to, their equities have done quite well in the wake of that. Intel's the best example. The stock's basically tripled since we gave that financing out 24 months ago in Ireland. We saw a nice return from Bayer last week. So I think the marketplace likes to see a breadth of financing capabilities from these companies. And again, because of our unique structure, not only having a very large third-party institutional business, but a very large insurance and regulated balance sheet, we use both of those appropriately in the investment grade world, mostly, but a little bit in the non-investment grade world to put that capital to work.
Given that you are financing some of this AI infrastructure, whether it's Intel in Ireland or Anthropic and Broadcom in the US, what assumptions are you and the team making about hyperscaler spend? How comfortable are you with the trajectory of spend right now and the return on investment? What are you modeling?
We really, as a debt investor, you're really trying to make sure that you've got your downside protected. So many of the transactions that we've provided capital to have either an amortizing structure where we get paid off every year, and we're really trying to avoid that residual risk on the back end. So for our transactions, the Broadcom transaction in particular, that was a 5-year amortizing piece of paper. For the Intel facility, we were just really basically the capacity of the chips. So when you are a debt investor, especially top of the capital structure investment grade, you're really trying to box your risk. You're not taking the residual equity returns that you might be if you were a VC investor or an equity investor in a lot of these names.
Do you think the infrastructure spend continues at pace at the kind of level we're seeing now?
I think it's going to be a great question. I think when you see companies like Alphabet do their $85 billion financing between equity and mandatory, I think the refrain is every precinct is needed. There's a lot of conversations about private credit, about investment grade public credit, about equity. It's going to need all of these asset classes to really contribute, because the vast size of capital needed is really something we've not seen in the past. And the impact of the construct of the IG market, I've talked a lot about to your colleagues in New York, the construct of that. These hyperscalers were negligible players really in the IG space several years ago. They'll be up to 7 to 10% by the end of this year. So the whole construct of how these companies finance is very, very different and unique.
Yes, and Jim, can I ask you about something that's sort of quick, fast developing, has been for the last 6 months or so within the private credit space, and that's that, we've seen around BDCs, so those companies in the States that do a lot of private credit. They've had a lot of software exposure. They then faced a lot of redemptions. Is this something that worries you as part of the private credit landscape at this point?
You know, I think we get asked that a lot. I think clearly it's not systemic risk. It really is, you know, the non-investment grade private credit area. It's about a $3 trillion asset class. This BDC area is about 400 billion of that. So it's really a very, very small corner. It's the same type of redemption provisions that institutions would have in terms of a drawdown vehicle. So I think there will be a breadth of dispersion of returns amongst managers because of either software or other areas. But I don't see it as one where it's systemic risk by any means.
Do you think there are some BDCs out there, business development companies, that won't make it through this period?
You know, like any asset class, like the hedge fund industry, it's really just a structure, and it's really then how you actually invest in it. And certainly there has been very little dispersion of performance between top quartile and bottom quartile the last 5 years. I think the next 2 or 3 years, you will certainly see a wider dispersion of performance amongst those.
So you say it's not systemic, which seems to be something that we hear from various people, Jim. Fitch did publish a report yesterday, though, pointing, or earlier this week maybe, pointing to hidden leverage in private credit BDCs through their use of joint ventures. Are there other things like that? Are you worried about that? Or are there other things like that we should be more concerned
You know, I think as we sit here again in 24 months from now, we talk about the disruption from in the software industry. I do think other industries will get disrupted as well. For us, I think it's naive to think that the only sector in the world of credit, public and private, that's going to get disrupted is the software space. I think there's a variety of other distribution businesses or other businesses that may be asset light that took advantage of great margins that I think in the world of AI and disruption, there will be more. So I think you have to have a much broader lens when you think about the challenges going forward in portfolio construction.
Jim, on the here and now, we're getting to the foothills of the earnings season. US banks reporting later today. What are you and the team going to be watching for when it comes to earnings broadly? What is top of mind for you as you scrutinise those numbers?
Well, I suspect they will be quite strong. I mean, a tremendous amount of interstock volatility in the quarter, tremendous amount of financing activity. But yet index is quite higher at the end. So, you know, I am curious some of the regional success of some of these firms, not only the U.S., Europe, but also Asia, certain countries in terms of performance. But I suspect they will be quite strong. The capital markets pipeline has been extraordinary. The investment grade issuance has been extraordinary. Equity issuance, record quarter, I believe. And also M&A has been quite strong. So, you know, the macroeconomic drivers of the CapEx cycle, the risk-on mentality, capital investment, pretty strong to be able to get in the way of right now.
Jim, thank you very much. Thanks for your time. We appreciate it. Jim
Always
Zelter,
a pleasure.
Apollo Global Management President. Coming up on the programme, as we've been discussing, the US's biggest banks are set to report record revenue for the second quarter, with Wall Street's trading bonanza poised.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. 49 minutes into a session that actually looks to be deteriorating a little bit. The oil price keeps on pushing higher, and European stocks are not proving to be resilient to that. So the oil price is at $86 now, so 86.18 on the Brent price. And so as a result, we're down by 0.8%. So we started this program, Tom, talking about how the European stock story maybe was yesterday's news because it was catching up with the US. Well, with these higher oil prices, we seem to be adding another layer of risk off as we get, almost an hour into the trading day.
Yeah, even US futures, or at least on the S&P E-mini, is pointing lower by 0.1%. There's still a little upside flag for the Nasdaq 100 after a difficult day yesterday. We'll see how that evolves, of course. Let's look ahead, meanwhile, to what else we are watching throughout the day. Today, really kicking off the earnings season with US bank earnings. Bank of America, JP Morgan, Chase, of course, Wells Fargo, Citigroup and Goldman Sachs all reporting. At 1:30 p.m. on the macro front, we get the June CPI, the inflation print out of the US. And at 3 p.m. then, so after the inflation story, we get the Fed Chairman Walsh testifying before the House Financial Services Committee on the semi-annual monetary policy report. We'll see if he says anything, reacts to that inflation data, says anything about rates, trajectory ahead, maybe not. Later on, ECB President Christine Lagarde will meet with US Treasury Secretary Scott Bessent in Washington. And the UK Chancellor Rachel Reeves and BOE Governor Andrew Bailey will deliver their Mansion House speech just across the road later today as well. Let's get more on what to expect then from Fed Chair Walsh. Bloomberg Managing Editor Jill Desis joins us now for a preview. So, Jill, we mentioned we're going to get CPI data, inflation data for the month of June. No doubt those on the FMC will be scrutinising, particularly the core part of that data set. What are we expecting?
Yes, Tom, actually, we may be looking at a decline in CPI, perhaps the first monthly decline since the pandemic, 2020. That's probably because what we've seen in recent weeks is a pretty significant decline in gas prices. So after a lot of those inflation pressures were obviously driven up in March, April, May, you might be seeing that cool and come off a little bit. You're looking at some of our estimates right there, including that month-on-month figure that I was just mentioning. So that's really what we have to look forward to. Obviously, we'll see what the numbers ultimately show us, but I do think the timing, obviously, of Warsh's testimony coming right after is, pretty interesting.
Yeah, and Jill, will Walsh want to give any message at all in front of Congress today?
So Anna, I'm not sure that he's actually going to go ahead and give us any kind of an indication as to what to expect in terms of a rate decision, rate hike coming later this month. One thing that Warsh might choose to do, remember, this is first of all testimony that takes place over a couple of days, 2 days, but one thing that he might choose to do instead is try to figure out a way to present his broader agenda for the Fed, including more details on those task forces that he just set up. There is this big to-do over all all of these really key names, including a lot of critical former central bankers, major executives and such, looking at all areas of the Fed. So the one thing that I would kind of look towards is, be a bit surprised if he goes in, super specific and deep on sort of expectations for, what that decision may be. And instead, I would look to see him, reflect a little bit more on some of those broader policy aims that he has for the Fed. But obviously, we'll have to see what happens when that testimony comes up. And I think, again, that coming just after that CPI print, it's all kind of, just really interesting timing here.
OK, Jill, thank you very much indeed. Bloomberg's Jill Desus with that preview. And we're going to have coverage, of course, of Kevin Walsh's testimony to the House Financial Services Committee from 3 p.m. London time.
Staying with the US, and 5 of the biggest banks are set to kick off a marathon earnings day. For more, Bloomberg's Tom Metcalf is with us, European finance coverage, who leads, European finance coverage. Good morning to you, Tom. So how on earth do you keep across JP Morgan? I'm reading this list because I can't remember it. But JP Morgan, Bank of America, Citi, Wells Fargo, Goldman Sachs, all reporting in one day. How does anybody have the brain space?
There's going to be a lot of coffee, and it's pretty unprecedented. I can't remember such a concentration of all the big banks effectively, apart from Morgan Stanley, which reports tomorrow. So it'll be really interesting. There was a wonderful article about how bank analysts are trying to cope, and effectively for everyone, it's just, oh my lord, let's all hands to the pump.
Yep.
And the challenge will really be, obviously the results come out fairly staggered, but pretty close together, but then some of the earnings calls actually overlap as well. So, I think there'll be a rush of data, and, to be honest, it will probably take, till through the end of the close of the US to kind of really be able to pick out everything, I suspect.
I wonder if there'll be a test of AI in this situation. Maybe it helps.
This is maybe where you get the efficiencies coming through, or at least you get a lift or some assist. What is helping these big banks in terms of cashing in on trade? Volatility's there. Are they going to execute on trading?
Yeah, that'd probably be the most closely watched number, those trade and revenue figures, and particularly the stock trading. So first quarter was effectively a record. What we're hearing is that Goldman might break its own record again, maybe top 5 billion for the second quarter. But yeah, broadly speaking, expecting very strong performance in that line, as you can imagine, from the volatility and all the trading that's been going on in these current times.
So cashing in on trading is one of the themes. What about also the fact that we've seen lots of IPOs? I mean, SpaceX is just one of them, but there've been others. Is that going to be a big feature of this earnings story?
Yeah, it should really be strength across the board. And actually, we had a story earlier about Rothschild here in the UK, where you can just see, the compensation for bankers going up as this sort of deal splurge really starts to translate into, deals being completed and stuff. And look, you had SpaceX in the quarter just gone, but obviously those those margins are pretty thin, but it just speaks to the sense of this is a real glut of deals, and that should again be good for those capital markets business.
Tom Metcalf, fantastic. Thank you very much indeed with that update, that preview, again, as we get into really into the thick of it with earnings season and the look ahead to US banks. And, of course, we'll be covering that, the team in the US, throughout the day when those numbers cross. Tom, thank you. We're going to be speaking as well with the CFO of Wells Fargo, Mike Santomassimo, at 8 p.m. London time. So that is one for the calendar. The other one for the calendar, before we get to that, is a game.
Yes.
Between France and Spain. This is going to be gripping viewing, isn't it? France versus Spain, two big beasts. They have their history, of course. Interesting, the betting odds are on France, just about getting it, versus Spain. But two fantastic teams.
Yes, I know Didier Deschamps, the French boss, has been predicting a spectacular semi-final. I mean, those odds tell, well, I don't know, does that tell spectacular? That tells very undecided, which could be spectacular, couldn't it? And that's only up to
the Polymarket odds.
And that's only up to 90 minutes, of course. We should point out it can't be a draw in the end because somebody has to go through to the final on Sunday.
OK, 8 p.m. UK time, 9 p.m. if you are, of course, on the continent. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
President Trump says the U.S. will become, quote, guardian of the Strait of Hormuz after completing a fresh round of strikes on Iran. Bloomberg learns that Samsung is in the early stages of exploring a potential U.S. listing after SK Hynix raised $26.5 billion last week. Plus, Wall Street's trading bonanza is set to generate almost $39 billion of revenue. 5 of the biggest banks report earnings later today. But first thing is first, of course, we'll look at CPI, and U.S. futures seem pretty much steady. Again, traders, I guess, refraining from any big bets ahead of a jam-packed day that will see the unofficial start of the earnings season. We have all of the banks. And then we also have the testimony from the Fed Chair, Kevin Warsh, and that U.S. inflation data. I'm also looking at crude prices. One cannot look at Brent crude prices every hour, but we try to do every 2 hours. 86.08. Look, high crude prices really keeping bets on a July U.S. interest rate increase in place, with also swap market signaling a chance of a hike when the Fed meets later this month. And the picture for European markets are actually a little bit more of a downside, so they're not quite seeing the steadiness and optimism that we're seeing in U.S. futures. The DAC and the CAC 40 down between 0.3 and 0.7%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in just a moment, we're joined by George Saravelos from Deutsche Bank to discuss inflation, of course, what that means for FX and especially dollar. But we also have a Bloomberg scoop on Samsung on a potential U.S. listing. So we'll get to that. But first, U.S. military says it has completed another series of strikes on Iran and will resume a naval blockade later today. Well, Jeff Mason, Bloomberg's White House correspondent, asked the president in the Oval Office about the military escalation.
Mr. President, just on Iran, you have said now to Congress that we are back at war. How long do you expect this to take, and what's the legal basis?
Take what?
The war.
Well, I think it's going very fast. We had a deal yesterday or the day before yesterday. It was all done, and then they broke up that deal immediately. We're not going to put up with it.
Well, let's bring in Abir Abu Omar, Bloomberg Horizon's Middle East anchor. Hi, Abir. So what do we actually know about the latest strikes and what's different about the U.S. strategy in the Strait of Hormuz?
Good morning, Francine. We're seeing a continuation in the region from these tit-for-tat strikes between the U.S. and Iran. This morning, in the early hours here in the Middle East, the U.S. Central Command saying that it finalized a third consecutive night of attacks in Iran. Some of those southern provinces were hit. You're seeing now the pictures of Bandar Abbas being hit, a port city. Iran striking back against targets in the region. That includes GCC countries, namely Jordan, Bahrain, Kuwait, Qatar, and it also hit 2 UAE ships in the Strait of Hormuz yesterday, resulting in the death of 1 person, 8 other people injured. So you're seeing this escalation in the rhetoric, especially over the past couple of days. Now, that already started at the beginning of last week, Francine, when Iran started by hitting an LNG-laden ship in the Strait of Hormuz, flagged to Qatar, the U.S. striking back against Iran, and then President Trump at the NATO summit saying that as far as he's concerned, the ceasefire talks are over. Now, just at the top of this segment, you heard him saying that the U.S. will strike Iran very hard, but then towards the end of that, he did say that the technical talks could continue and we could still see a result in all of this. Now, just to be sure, we're not clear on whether these technical talks between the U.S. and Iran are set to continue. We expect a continuation. We don't yet expect a full return to a full-fledged war similar to what we saw in March, but the complication in the region is prevalent this morning, especially in the Strait of Hormuz. What's different this time around is that the U.S. came out and said, or President Trump came out and said, that a 20% fee on tankers would be implemented. That would amount to about $30 million per very large crude tanker, Francine, at the current oil prices. So you're seeing Brent crude really reacting very quickly to this news, $85 on the barrel. That is the highest level that we've seen in about a month. We still continue to see or monitor the movement in the Strait of Hormuz that seems to be, at least for the time being, at a standstill, with a lot of ships deciding to go through either dark or hold still for the time being.
Abir, thanks so much. Abir Abu Omar there in Dubai. Now, traders ramping up bets on a July Fed rate hike as oil advances for a second day. The dollar easing this morning ahead of U.S. inflation data and, of course, Fed Chair Kevin Warsh's appearance later today. Now, the Fed Governor Christopher Waller signaled that further rate hikes may be needed to tame rising prices.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
Now we're joined by George Saravelos, Global Head of FX Research at Deutsche Bank. George, thank you so much for joining us. What actually is driving FX? Because you have this renewed concern about the Middle East. You have AI valuations. I mean, you have a lot of data in the U.S., but you think it's yields that's kind of the common thread.
As you say, there's so many things that have happened this year, but the remarkable thing in FX is just how low volatility has been, and as a result, carry trades have done the best. If you're a high-yielding currency, you've outperformed the low-yielders. And I think underpinning that is this global growth resilience, which we've seen despite all these shocks. Now we're seeing another shock out of Iran. But globally, if you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
Is that worrying because something will happen that, are we seeing dislocations that point to something a little bit more severe?
I think what's worrying is that there is a certain extent of positioning in the market on risky assets, whether it's in equities, in FX it's most expressed as carry trades. But at the same time, what's actually fairly reassuring is the fact that despite all these shocks, global growth is holding in very well. And I think there's two reasons behind that. Fiscal policy remains very activist globally. In the US, we had OBA. Even in Europe, you had some fiscal easing. In Asia, you had price caps for consumers, so they don't see the oil price increase. And of course, the AI story, which is leading to these big upgrades in Asia growth. And that's offsetting the oil shock to some extent. So,
George, talk to me about dollar. So dollar, has a lot of things going on for it. Like, what's your target for here until the end of the year?
Well, I think, as you said, there's so many things going on, and to some extent they're offsetting. So you've obviously seen the Fed repricing, but we've seen global central bank repricing as well. So if you look at relative rate differentials, they've not moved all that much. The global growth environment has been a negative for the dollar because it's supporting all these high yielders. And then on the other hand, of course, you have this debate around the Fed. So at the moment, we think the dollar is relatively fairly valued. Against the low yielders, probably you can see more dollar strength if the Fed does go on these hikes. But I think the key question for me for the dollar is, does the Fed only do these 2 hikes? Is it a tweak? Or are we going back into full-fledged hiking cycle where we're talking about 100 basis points, potentially even more? And that would be a much more dollar bullish environment. So we're definitely on the lookout for that. I think the CPI number today, as Governor Waller said, is going to be very important. And we see how Fed policy evolves.
I mean, what are you expecting from Chair Warsh?
Well, I think at the moment our baseline is 2 rate hikes for the rest of the year, so a recalibration. We'll see what he says this afternoon. I think when he was in Sintra, we saw he actually didn't say all that much, kind of staying faithful.
He was good. It was diplomatic.
Staying faithful to this mantra of not much forward guidance. But then we see Governor Waller saying how much the Fed could react to one data point. So I think there's still quite a lot of uncertainty. Baseline is he doesn't provide that much guidance as far as July goes. And I think the market is much more likely to react to the CPI rather than what he says.
George, I mean, I'm looking at headlines, and they came in a couple of hours ago saying, 2 UAE tankers were attacked, and of course this brings fresh risk to flows from Hormuz. But how's it possible that we're not really seeing anywhere else, apart from the price of oil, certain days?
So I think the key question from a market perspective is how many ships go through that strait. At the end of the day, it just boils down to that transit route. And even as of Saturday, there was a news flow of around 20 ships going through. Of course, now it's very likely that goes back down again. If it remains closed for the next couple of months and there's nothing going through, I think the oil price will go back up. But things move so quickly that every other week, I think the market is taking some statements with a pinch of salt in terms of how long the duration of this re-escalation lasts.
And George, I mean, it's clearly the Asian economies that suffer the most because of higher energy prices. Does that have a direct impact on their currencies?
Well, it's interesting because they suffer the most, but they've also been the biggest beneficiaries of the AI, let's call it, revolution. And I think especially currencies like Korea, Taiwan. For example, if you look at central bank pricing for Korea, you're now pricing an incredibly hawkish Bank of Korea, and rates in Korea are almost as high, or actually even higher than the US. So effectively, these 2 forces have offset the AI against the oil shock. And I think if you're looking forward, it's probably more likely the AI shock dominates in the medium term.
I mean, how do you look at AI? Because we haven't really seen any kind of real-world application for transformation of the economy, but we know it's coming.
So with AI, we published a big report where we separated it into 2 parts if you're trying to analyze the macro impact. The first part, which we're living through now, is the CapEx build-out. Yeah. And here it's a lot more about the production of the chips, the digging of the holes for the data centers. And the clearest beneficiaries are things like NVIDIA, the Asia economies that are producing the chips. The second part is once you've built the data centers, who's the beneficiary of the revenue? And here, the clear answer is the US with the hyperscalers. I think there's a very big debate in terms of the frontier models versus the models produced out of Asia. But from a currency perspective, the biggest impact is going to be seen, I think, when the models roll out and the revenue starts streaming in terms of the dollar. The question is, are equity valuations at the moment reflective of the expected revenue? And I think we're at a stage where risks are fairly two-sided, where the market does worry about excessive valuations, and if revenues end up disappointing, that could end up being a negative for the dollar at this stage of the cycle. Second part of the cycle, a bit further out.
And so further out, and this is when we start looking at productivity and also job losses.
Productivity, job losses, the revenue that's being generated, the deployment, the full-fledged deployment of AI in the economy. And I think the market has some very optimistic projections in terms of rollout. We do read quite a few stories in terms of restrictions, whether regulatory restrictions, the cost of tokens. But I'd say the bigger picture question mark on AI or observation is the market really struggles to see around the corner. There is a lot of information asymmetry. So 6 months ago, very few people were talking about the memory surge. You've got companies, if you take Japan's largest company now, which has exceeded Toyota market cap, 6 months ago, it was one of the smallest companies. So things are changing very, very rapidly, and I think the market is learning by doing so, to speak.
George, what's your take on yen? And then we'll get on to sterling.
Well, we have fresh headlines again with the government trying, I think, to manage yields down in terms of these discussions around potentially repatriating money back or potentially shifting money from onshore deposits to JGBs. So there was reporting today that they may be considering tax-free treatment of Japanese government bonds. I think all of these should end up being positive for the yen, but the market is very doubtful because historically, there's been a lot of jawboning, but in terms of action, it's been quite slow. So we're waiting to see for more specifics and timelines in terms of these policy shifts. But I think if we were to see stronger indications of, for example, the GPIF changing allocation, that would really be a very positive thing for the yen.
And sterling, I mean, it's half. Of course, we're looking at the BOE. Andrew Bailey was also very careful in Sintra, but it's also a politics story.
Absolutely, and we're going to have a new Prime Minister. I think few would have thought a few months ago that if we're in the run-up to a new premiership with Andy Burnham that would be seeing sterling actually outperform so much. I think the reason is the market was pricing a lot of risk premium into the event. And if you look at a lot of the headlines and the news flows that's come out, effectively the market is hearing what it wanted to hear. So, for example, there's now a discussion of bringing forward the spending review, which was due next year, into a budget event in October, which will provide much more flexibility, it will provide transparency and clarity. So in that sense, the market's bringing down the fiscal risk premium, and that's why sterling's doing well. We have had that view that sterling could outperform, but I think now we've priced a lot of good news. So it's going to be a question of delivery.
So what happens next, George? As always, thanks so much for joining us, George. Sarah Vellister, Global Head of FX Research at Deutsche Bank. Now, Bloomberg has also learned that Samsung is in the early stages of exploring a potential U.S. share sale. Now, for more on our scoop, we're joined by Matt Bloxham, Senior Analyst at Bloomberg Intelligence. Matt, good morning. So why might Samsung be pursuing this sale?
Yeah, good morning. I mean, a couple of reasons here. I think probably most importantly that it opens up the huge investor base in the US, many of whom either won't be able to directly invest in the stock locally or struggle to and just kind of get put off by the implications. And as we saw with SK Hynix last week, there's a huge amount of pent-up demand for anything to do with the kind of AI trade, and I think in particular kind of with the memory stock. So that would be the kind of most important aspect. But obviously also, you know, SK Hynix raised over $26 billion from that issuance last week, and you know, Samsung's a big company, but you know, if you can kind of raise capital cheaply to kind of fuel the next round of investments, then that's also a good opportunity for them.
So, Matt, does this mean more market volatility as a result?
I mean, I think it certainly could do. We've seen that also with SK Hynix. Obviously, there's a lot of interesting conversations and analysis around there about these leveraged ETFs that are sparking up. And certainly there's, you know, a lot of excitement in the US market that the SK Hynix ADR and potentially Samsung ADR kind of create new opportunities for US leveraged ETFs. And that inevitably creates volatility. And, you know, we've seen that very clearly in the Korean indexes in the last couple of weeks because there's so many leveraged ETFs there already.
Matt, thank you so much, as ever, for joining us. Matt Bloxham, there, Senior Analyst at Bloomberg Intelligence. Now, coming up, Wall Street's trading bonanza is poised to keep rolling. The biggest U.S. banks are set to kick off earnings season with results later today. Of course, we'll have your preview next, and this is Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, 5 major Wall Street banks report later today, kicking off earnings season with a bang. A global surge in deals and IPOs is expected to drive blockbuster results as volatility from the ongoing U.S.-Iran conflict, of course, fuels equity trading revenues. Well, we're now joined by Tom Metcalf, Bloomberg's EMEA Finance Managing Editor, and Paul Davies, who covers banking and finance for Bloomberg Opinion. So thank you both for joining us. I mean, it's a big day, right? So then we can relax with a bit of football afterwards, relax or not relax so much. Profits high, regulators easing rules. Like, what are you expecting from the big banks?
We're expecting some really big numbers. We're expecting a lot of some very high revenues reported from the markets desks, and obviously, investment banking fees also looking incredibly strong. I mean, some of it will be a touchdown on the first quarter, but people are already saying for the year as a whole, we're going to have record M&A volumes beating 2021. Record IPO proceeds beating 2021, and that's still with a lot of deals aren't running at as high a level as they have done in like previous booms. They're still kind of, when you compare it to sort of stock market capitalization or GDP, the volume of deals being announced is still sort of below the 20-year average. And IPOs, we're still missing, a lot of private equity exits. We're still missing that huge SPAC boom that we had in 2021. There's still more that could come out of this, I think, is the message.
Tom, what are you looking for? I mean, again, it's also great insight into AI, how they use AI, thoughts on, we'll hear from some of the chief executives on how they see this going forward, but also, I guess, the health of the U.S. consumer.
Yeah, absolutely. And, be interested to see how they say those retail customers are doing. And look, even whenever there's been sort of widespread turmoil in the world, the American consumer, as broadly speaking, at least as the banks see it through their window, they're often just saying, we're not seeing any signs of distress within that particular cohort. And obviously that doesn't probably include, the absolute lowest income people who are really struggling in many economies. But that will be the other side of the coin. Capital market business is booming. You suspect that's also going to be supported, on the retail side, obviously with interest rates staying higher. That's, broadly speaking, should still be good news for banks. But if that starts to inject pain into the consumer side of things, that could be more of a cause for worry.
So what can we expect in terms of dividends and buybacks?
So we've already had a round of kind of dividend increases announced, sort of just after the stress test results this year. I mean, I think one of the interesting things now is, profits are so high, banks already were sat on an awful lot of spare capital. There's more regulatory reform and kind of rule easing coming down the pipe. Yeah. So the question is, what do they do with all of this spare money? I think we've already had something like over $100 billion worth of stock buybacks from the big 6 banks so far this year. As I say, they've already upped dividends after the stress test. And the next thing is, well, how much of it do they invest in growing their balance sheets? Goldman Sachs kind of led the way in the first quarter by really expanding prime brokerage, lending into M&A deals. And I'd be looking closely to see how much some of the other banks follow that and really start deploying more capital into markets and deals.
Tom, if you're a bank CEO today in the U.S., what do you actually worry about? Is it geopolitics? Is it AI? Or is it just the uncertainty of it all?
Yeah, probably the bubble, right? But there's been no sign of that actually starting to really hit. And obviously Iran's going sideways again. But again, there just seems to be this ability for markets and the consumers with that disposable income to just look by that. And, so broadly speaking, as Paul's saying, I'm expecting actually very positive sound-ins, the usual warnings, but no sort of real pain points yet.
What should we make of private credit? Because I get so much pushback from, the private equity people, but also some of the banks. When you talk about risk in private credit, should we really worry about it, or should we worry about it, but it's like a sideshow?
it's kind of it's a story of two investors still at the moment. I think on the one hand you've got these retail sort of wealth individual investors who have been pulling money out of a lot of the big funds. And if you listen to them, a lot of them are saying this is coming out in Asia much more than in Europe and certainly than the US. And on the other side, you've got institutional investors who seem to keep ploughing more and more money in. And the fact that there has been some credit concerns and some liquidity issues, and that has kind of led to a bit of spread widening, that's drawn some of the institutional investors back in a bit more as well. So, we've got to look closely for more credit deterioration, and there will be more of that, but exactly what investors do, how they react to that is still kind of to be seen, I suppose.
Tom, I know it's a difficult question because the earnings are out later, but if you're to look at the 5 banks, or actually all the big Wall Street banks, who's coming up trumps? I mean, it feels like Jamie Dimon with Fortress Diamond, one of the biggest bank in the world, but Citigroup's also doing great.
Yeah, I'll be actually really interested to see how they do this quarter. Obviously, there's that turnaround story under Jane Fraser. And talking of deal making, they are making that big push, that big build out. So it'll be interesting to see if that's, reflected again in the numbers or what they're saying. I just think every bank has a really interesting story. I mean, look, if Goldman's stock traders again beat that record in this quarter, that will really jump out. But that's the funny thing. You've got 5 of these big banks reporting, so it's actually going to be quite difficult for them to cut through. So I'd probably put my money on a JP Morgan or Goldman just because they tend to sort of resonate most on the street.
I mean, if you're part of, some of these subscribers of some of these massive IPOs, does it reflect already in the numbers now? Or it's maybe a bit too soon? So
the SpaceX IPO, the fees for that will be in because that's listed. So that's $500 million between... Well, I don't know, almost every bank you can think of, but with a few big leaders. The M&A, we're talking about announced deals. The fees that they're collecting now are deals that have closed in this quarter, so they would have been, historical. But then we've got a bunch more IPOs supposedly coming up. Anthropic, OpenAI, companies like this who are also going to be great beasts bringing in lots more fees.
Are they a game changer, actually, for the banks, or does it just attract in some of the smaller IPOs?
I guess there's still a bit of a debate about the extent to which the scale of these IPOs sucks money out of other possibilities. If SpaceX had gone incredibly badly, then OpenAI and Anthropic would not be getting done at all. I think it's still doing okay, so there's still sort of profits to be recycled into new deals. But, there's only so much equity money to suck into new IPOs. So, if all of these big deals keep coming, then some of the smaller possibilities, might not make it.
Tom, the real biggest story of the day is that with 5 bank earnings, Mike Mayo has to skip the gym. So you're going to cruise, right? Because Paul cruises. He looks at everything and then he writes 1 or 2 columns. How's your team going to do it? Because some of these earning reports are also hundreds of pages and they come at you at once. Yeah,
it's going to be an extraordinary day just purely from a coverage point, whether you're an analyst or a lowly journalist like Paul and myself. But, that's the practicalities of it. And that will be sort of, where you kind of deploy that big team, you have all that technology to sort of try and help pass those things. I do think it'll be a really interesting test because often sometimes you see, kind of the big stories seemingly going in one direction for shares, but actually the market starts to respond to something else. No gym for anyone today, I suspect.
No gym, football later, and then we'll get them back on tomorrow to see if they survived. Tom Metcalf, Bloomberg's EMEA Finance Managing Editor, and Paul Davies from Bloomberg Opinion. Now, this is a picture for, there's one thing that we can't ignore is, of course, what's happening in the Middle East. So if you look at U.S. futures, they're pretty much down, but actually they're a little bit more stable than maybe we thought they would be this time yesterday, given everything that's going on, which is not only the Strait of Hormuz, but also we have the Kevin Warsh testimony. And then, of course, you have CPI later. Coming up, we'll discuss the outlook for the UK economy as Andy Burnham prepares to become the next Prime Minister. We'll have the full details of that next, and this is Bloomberg.
just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says the U.S. will become, quote, guardian of the Strait of Hormuz after completing a fresh round of strikes on Iran. Bloomberg learns that Samsung is in the early stages of exploring a potential U.S. listing after SK Hynix raised $26.5 billion last week. Plus, Wall Street's trading bonanza is set to generate almost $39 billion of revenue. Five of the biggest banks report earnings later today. Now, traders also boosting bets on a July interest rate hike driven by a renewed rise in oil prices and, of course, hawkish commentary from Fed officials. Now, upcoming U.S. inflation data, but also a Federal Reserve Chair appearance are set to further test market conviction. We're joined by Ven Ram, Bloomberg and Life strategist for currency and rates. Ven, it's quite an exciting day. I mean, it's CPI plus testimony. What are traders ramping up, or why are traders ramping up bets for a July hike from the Fed?
Morning, Francine. I mean, it's an absolute mayhem in the bond markets today, with bonds selling off across the board, except in JGBs. But I think that, with the CPI report that you mentioned, the markets are expecting a core inflation reading of 2.8% and a headline inflation reading of 3.8%. If those readings are anywhere near what they expected to be, I think that it will add pressure on the Fed to raise rates, because by the Fed's own projections, the economy is supposed to grow about 2.3% this year, and core PCE is going to be about 3.3%. So you're talking about nominal growth of well above 5%. So when your nominal growth is as much, it's not appropriate for the Fed's benchmark rate to be at 3.75, and therefore the markets are sensing the pressure that, look, the Fed will have to raise rates, and that's what we are seeing in the markets.
I mean, it cast me back to Sintra, where all the central bankers gave us a masterclass in saying as little as possible because they don't want to talk about forward guidance. European bond yield soaring today. What's the outlook for the ECB and the BOE?
Well, I think the ECB is on track to raise rates at least once more in the remainder of the year. I think that with them already having raised in June, I think the immediacy of the next hike is not in question. They're going to meet next week, but no one expects them to raise rates. But it's a different question for the Bank of England. They haven't raised rates in response to the Iran war yet. And I think that, the inflationary pressures that are building up are unmistakable. If you look at gilts, they are underperforming the rest of the global complex, suggesting that the markets fear that, the inflationary impact of the war is going to be felt very acutely in the UK. And I think that the markets are therefore pricing 2 rate hikes from the Bank of England. Whether or not the Bank of England will deliver those on those expectations remains to be seen, Francine.
Ven, thank you so much. As ever, Bloomberg M Live strategist Ven Ram. Now, as we've just heard, traders also boosting wagers on Bank of England rate hikes. It comes as UK Chancellor Rachel Reeves is expected to tell a City of London audience tonight that plans to boost the economy will only work with the support of financial markets. Now, her speech at the annual Mansion House dinner is likely to be seen as a warning to Andy Burnham, who is set to become Prime Minister next week and is widely expected to name a new Chancellor. Now, we're joined by Bruno Scarica, Morgan Stanley's chief UK economist, and Phil Aldrich, who covers the UK economy for Bloomberg. So thank you both for joining us. Phil, first of all, is there a chance that actually Rachel Reeves stays as Chancellor, or like 0.01?
Yeah, it's a very slim, very slim chance. I mean, she is going to be telling us about her achievements today at the Mansion House, and I guess that is an attempt to convince Andy Burnham that she should remain as Chancellor, but it looks like it's set that she's going to be moving jobs.
And Bruno, I mean, this is a very difficult time to inherit this economy, because if you look back, even Keir Starmer, and we won't talk politics, but there wasn't a real crisis. It's just that it was more of a temperament concern. So is this really an opportunity for Andy Burnham to change the economy? Like, what does this economy need to see growth?
Sure. So I think with respect to, as you point out, the problems that are brewing, and as Vem suggested, the immediate issue is that we are on course to see inflation in UK back at 3%, probably as early as July. Whether it accelerates beyond 3% or it stays there for the foreseeable, so for about 6 to 9 months, depends, of course, with what happens with oil and gas prices. So I think the immediate question is one of those inflationary pressures. Is there anything that fiscal and regulatory policy can do to help the Bank of England? And with less tightening in financial conditions, the Bank of England can actually take care of near-term growth as well. The question of potential GDP growth and medium-term plans is then something perhaps that can be ironed out in the budget, perhaps in October or November. I'm sure we'll find out shortly.
Yeah, and there's talk about them, the new Prime Minister announcing something a little bit bigger in the autumn. But what did Rachel Reeves get right on the economy?
So she inherited a pretty dismal fiscal situation, so she did have to fix that. And we did have, people may forget, but we had the jails, the prisoners were being released early to make space in jails for new inmates, and the NHS was on its knees. So there was a desperate need to raise revenue or to raise money for funding public services, and that was necessary. She raised about nearly 70 billion in tax. She borrowed about 30 to 40 billion, but the problem was that she arguably raised the wrong tax. The jobs tax was inflationary. It caused unemployment. It was definitely anti-growth alongside the national living wage. That put pressure on businesses as well. And so they weren't in the driving seat. So we basically lost a year. Burnham obviously is now going to inherit a much more stable fiscal situation. So he won't have to do as much hard work as she had to do. But there is a sort of sting in the tail because she left quite a lot of the hard work to the end of the Parliament. So there's tax rises coming, which Burnham's team will have to deliver, because that's one of her legacies.
But Phil, I mean, if you look at Rachel Reeves, I mean, or Keir Starmer, was the most difficult thing actually keeping the party together? And is that why these budgets kind of had a bit of everything for everyone, which means that at the end of the day you weren't really sure what you were looking at?
Yeah, I think the sort of defining moment of the political instability in having its impact on the economic situation was the planned welfare reforms at the spring statement in last year, where there was this enormous backbench rebellion, and rather than make it a confidence vote or try and assert power and discipline over the party, the government had to cave, and at that point, the markets were sent a clear message that the government despite its enormous majority, didn't seem to have control of the policy levers. And with the thin headroom, with rising inflation caused by the jobs tax, and then the lack of sort of ability to grasp the situation at the centre, all of that led to higher borrowing costs. Just the lack of faith in UK policy setting.
And Bruno, I mean, overall, and we were hearing from Andrew Bailey at Sintra, where he kept on repeating that they started the year thinking they would lower interest rates. I mean, it must be very frustrating for a central banker to kind of have what he thinks a plan, and then just because of the Middle East war, everything changes.
Depends. It is very difficult to operate in this uncertain macroeconomic outlook. I do think it's interesting and important for the BOE to highlight that the inflation data we're getting, March, April, May numbers, they were very, I would say, constructive in terms of the underlying inflationary picture. Sure, they're still above target, but about 80 to 90 basis points of that is motor fuel and heating fuel. So it is important to highlight that, look, the idea that we had in February, which is that underlying inflationary pressures are subsiding and then we can deliver rate cuts, okay, that has actually proven to be accurate. Now we just have to wait out to see how energy inflation pans out, or rather get some more confidence around it before acting next. So I do think that was a very interesting and I think an important message to highlight, and I expect we'll hear more from Bailey on that in the coming weeks.
But does Governor Bailey need to wait to find out basically what Andy Burnham will do with the economy?
I mean, you would expect that there is a little bit more coordination between the Bank of England and the Treasury, albeit the bank always takes Treasury announcements as they're announced officially. Having said that, by the time we get to the budget in October and November, surely we'll have a little bit more confidence around where oil prices will end the year. We'll probably find out what Low Pay Commission, for example, recommends for national living wage in September as well. And so I do think the bank will have a decent steer where the economy will go in 2027. And then, of course, you do get a little bit more information at the budget as well, and you can obviously provide the steer to the market at the end of the year too. So I don't necessarily think they need to wait for all the details, but it is an important input into their thinking. Yeah.
Phil, how quickly do you think we'll get a new chancellor? Quickly.
maybe we'll know this weekend. I mean, Burnham becomes Prime Minister on the 20th of July. I mean, assuming that it all goes ahead. So we ought to know before then. I mean, it's fairly imminent. Well, I mean, he has. What's happening in the markets right now, caused by the Strait of Hormuz situation, is a reminder that every leader of the UK seems to be damned with some kind of tragedy or some awful situation that they have to address. And Burnham for a while was looking like he was going to be coming in with interest rates beginning to look like there's a possibility of cuts and you get the near-term growth or whatever. Now there's 2 rate hikes priced in by the end of this year again. So he's facing a difficult situation.
It is a difficult situation. I just wonder whether a central bank kind of waits, because we don't really know what happens with the Strait of Hormuz, and it seems to be changing by the hour. So is there a point in just waiting to see how this develops until October, November?
I think you can't wait forever, right? We saw that in 2021 and 2022, right? At some point, you need to have an idea where the economy will go at the time when you're setting policy, which is about 18 months to 2 years. Having said that, you referenced Sintra, and I thought one of the big messages from those meetings was essentially we don't need to tell the market where interest rates are going to go next week, next month, etc., but we need to provide a clear framework as to how we operate and how we think about uncertainty. In April, the Bank of England provided that framework within the scenario analysis that they put forward. And if you actually look at oil prices, they're still running quite close to the most benign scenario, which is pretty remarkable given what's happening with the repricing in the front end. And so I think that's what I'm quite interested in hearing from Governor Bailey, perhaps in the coming days, maybe closer to the July meeting. Is that framework from April still valid? And if so, I don't necessarily think we'll be seeing near-term rate hikes. So the reinforcement of that framework of those scenarios, I think, would be very, very helpful for the market.
And Phil, in terms of financial stability, so we're expecting Rachel Reeves wants to talk about ring-fencing reforms. We heard from Sarah Breeden. I mean, in Sintra, she talked about AI concerns, and then there was a report last week. Like, what are you looking out for banks?
So I think she's going to be pushing on gradually with these ring fencing and trying to provide a sort of capital arrangements so that banks can increase the supply of credit to the economy, all these efforts to just boost growth. And on AI, I think the government is trying to look at it as a positive opportunity rather than, obviously, Sarah Breeden's concerned about the potential bubble risks and other risks. But, can we use AI to stimulate the productivity miracle again that we've been lacking? So I think that's going to be part of AI skills, that kind of stuff.
And we don't really have an insight into what the next government wants to do, right, with the banks.
With the commercial banks?
Yeah.
No, there's not been anything. I mean, inevitably the bank tax always comes up, and so far the banks have escaped that. So maybe they will continue to escape that.
There's always talk. Thank you so much, both of you, for joining us. Bruno Scarrica, Morgan Stanley's chief UK economist, and Phil Aldrich, our senior reporter for the UK economy. Now, Watches of Switzerland is in the spotlight this morning, both for its earnings as well as a potential takeover. Now, the top Rolex seller has delivered a positive outlook on profit growth. We're now joined by Andrea Felsted, opinion columnist at Bloomberg. Andrea, thank you for joining us. So, first of all, why is the earnings outlook so positive for Watches of Switzerland?
It's mainly on the US. More than half of Watches of Switzerland sales now come from the US, and the US is doing really well in terms of luxury because it tends to be correlated to stock markets, and stock markets are still, up to now, going strong.
So with this positive momentum, why would the company be interested in going private?
I guess it's what price it's offered. I mean, for investors, Watches of Switzerland is one of the only ways to play brands like Rolex that are private. You can't buy shares in Rolex, but you can buy shares in Watches of Switzerland, which is a proxy. We don't know who the potential bidder was, but if, say, it's private equity, then you would lose that, as an investor, you would lose that ability to invest in Rolex watches.
So, Andrea, what's the business model? Because I've seen it, of course, at airports. We've all seen it at airports, but they don't get a cut, right? So why would you go to buy through Watches of Switzerland instead of going directly through Rolex?
Well, you can't. I mean, as an investor, you can't buy shares in Rolex because they're private. As a buyer, there's probably not a lot of difference in going to Watches of Switzerland, going to a Rolex boutique. I mean, it just depends what's available. Part of the sort of magic formula of Rolex is that not all the models that you want to buy are available, and you have to go on a wait list.
And what's your take overall on a lot of the luxury sector? We've seen a lot of the new designers coming in, some hits and some misses, Andrea.
That's right. I mean, Chanel has just taken the world by storm. Chanel shows that if you get the product right, if you get the pricing right, luxury still has a pulse. I'm still very sceptical on Gucci. I don't think Demna is the right designer. We've yet to see it really take off. Dior is probably doing okay, but it's paling into comparison with Chanel doing so well. The saving grace really is the US. The wealth effect in the US is boosting luxury. That is making up for disruption in the Middle East and for China, it's going in the right direction, but it's a slow recovery.
Andrea, talk to me about football. I love a bit of football. So you have this great... I was in Italy last week, and by the way, it's like the World Cup is not happening because they didn't even qualify. But you wrote this really nice piece saying the UK economy needs an England World Cup win, and we all hope it's coming home.
Absolutely. I mean, there were some projections yesterday from the Beer and Pub Association that said, lots more pints will be sold on Saturday, if we get through on Wednesday. Now, the other thing is that the tournament has coincided with some warm weather. And while, there are lots of problems with the heat, for many people, it does make them feel better. I mean, last Saturday, lovely weather, really good time for the match. I think Wednesday's got quite good timing. So, I mean, it's all going in the right direction for the UK economy. Let's see if England carry on to the finals. If they do, then, happy days for grocers, for pubs, the consumer economy.
Yeah, it's quite exciting. Andrea, thank you so much. I have to say, I've spent so much in just, some of the cans where you have to try and find your team. And so you spend and spend just to make sure that you finally get your team. Andrea Felsted there from Bloomberg Opinion on Luxury and, of course, the UK economy. Now, coming up, EU ministers failed to endorse a new Russian sanctions package with some key sticking points. We'll bring you the details, of course, on those negotiations. That's coming up next. And this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, EU ambassadors are set to meet today after the bloc failed to endorse a 21st sanctions package against Russia. Well, that leaves the EU now at risk of undermining one of its key tools to restrict the Kremlin's oil revenue. Let's get the latest now with Oliver Crook, our chief Europe correspondent. Good morning, Ollie. So where do things currently stand for European efforts to support Ukraine?
Yeah, absolutely. You had those two meetings yesterday, the first in Brussels from foreign ministers who were assembling here to discuss the 21st sanction package, and of course that coalition of the willing meeting that was held by Macron in Paris. And neither of these meetings really yielded any of the concrete outcomes I think that those who are most supportive of Ukraine would have liked to have seen. For the European foreign ministers, they're getting bogged down into some negotiations about what to do with Russian LNG, what to do with the oil price cap with an Austrian bank also that has exposure over to Russia, and how to sort of move the ball forward with that. But the main issue, Francine, is that the oil price cap, that key instrument of the Europeans in order to try to diminish the revenue that the Russians can get from selling their oil out onto the open markets or the restricted markets, that expires tomorrow if they cannot get a breakthrough. So we understand now that foreign ministers are going to continue to push on that today, but there's no real guarantee that they'll be able to get over the line before tomorrow, something that might be kicked into next week. And again, that's something that is probably not ideal for the Ukrainians, not ideal for the biggest supporters of Ukraine, who feel that the tide is really changing, and that if the Europeans want to capitalize on that, the support of Donald Trump, and of course the stress that the Russians are under, that they really need to move forward with that. In terms of the coalition of the willing, again, not a major breakthrough over in Paris, though we did get this initiative, this idea that the Europeans will pool resources and research in order to build their own sort of sovereign anti-air missiles. So those are two things that we're watching. What Zelensky was really pushing for yesterday, and we heard him again talking about it today, is they want a winter package of Patriot batteries, 300 of them, to put them in position to be able to defend their energy infrastructure going into the winter.
Ollie, so Ukraine also continues to strike Russia's oil infrastructure. Are we seeing much reaction to these attacks?
Yeah, Francine, what's really interesting is obviously you see the reaction on the fossil fuels, and we had a great story out about this yesterday with Javier Blas talking about basically we've seen the price of oil go down over the last couple of weeks thanks to Iran, but what we've seen remain elevated, the prices of diesel, gasoline, and jet fuel, and that is in large part because the Ukrainians are absolutely decimating a lot of the refining capacity over in Russia. You had some more strikes overnight, another refinery that's just on the other side of Crimea that can process 180,000 barrels a day. The Ukrainians struck that also, so that's why you're not seeing the prices of those refined products come down quite as fast. But Francine, something else we're watching over the last couple of days is the price of wheat. We've seen some strikes by the Ukrainians in the Azov Sea, hitting a bunch of tankers, not just for LNG, not just for fossil fuels, but also some of those dry cargoes, and that has driven the price of wheat higher. So these are things that will potentially restrict the ways in which the Russians can have can generate revenue, but at the same time, Francine, for the rest of the world, will likely contribute to driving inflation.
Ollie, thanks so much. Bloomberg's Oliver Crook there with the latest from Brussels. Meanwhile, Bloomberg also understands that President Trump plans to support a Russia sanctions bill championed by the late Senator Lindsey Graham. Now, the proposed bill would intensify pressure on the Kremlin to end its war in Ukraine, bolstering efforts to punish buyers of Russian oil and gas. Well, let's get more from our executive editor, Chad Thomas. So, Chad, good morning. What do we actually know about the proposed bill?
Well, as is often the case out of the Trump White House, we're getting mixed messages. So we were hearing, our colleagues were hearing from sources that President Trump was going to support the bill. He was then talking publicly late last night and saying that, oh, let's take a look at it. We'll see what we can do. We don't know too many details of what's in the bill. The bill that Senator Graham had put forward several months ago would have been crushing tariffs, secondary tariffs on people who buy Russian energy, which of course would have really choked off the Russian energy. But at this point, we don't know what's in the bill other than that there seems to be an effort to move forward with it also in the Senate, in part as a tribute to Senator Graham.
And Chad, this also comes at a time where the White House is extremely occupied with everything that's happening in the Middle East because of the renewed flare-up with Iran. So where does this, are they distracted? Where does this leave Ukraine?
I think that does put Ukraine very much on the back burner. The question, though, is whether that relationship that we saw budding again between President Zelensky and President Trump at the NATO summit, if that moves forward. President Trump is very much someone who the projects he works on has a lot to do with personal relationships and how he feels about people. And they obviously had a very good meeting at the NATO summit, so some people took that as a positive, but clearly all of the focus is at the moment on Iran.
So at the same time, we've seen Hungary pass a law to try and remove the president, which is a Viktor Orban-aligned president. I mean, how feels very significant.
Well, this is a continued dismantling of the Orban system by the new prime minister. And what this also potentially means for Ukraine is that the new prime minister is far more Ukraine friendly, and the more that he dismantles this system that was in place beforehand, it's probably a positive for Ukraine. Of course, but also watching today in Ukraine, the parliament vote on removing the current prime minister as President Zelensky announced that reshuffle of the government that's coming this week. We still don't know who the new prime minister will be, but we are hearing it's probably going to be someone who's has at least connections to the energy sector because of their concerns about what will happen in the winter with attacks on the energy sector.
And we saw, of course, the Coalition of the Willing in Paris yesterday. I mean, does that come with money, or is it more of a show of solidarity?
I think it's more of a show of solidarity. There weren't messages out of that really said, here's billions that you can now spend. They talked a bit about anti-ballistic missile systems, but a lot of these discussions are about things that are coming in 3, 4, 5 years' time. Great for the European countries, but what Ukraine says they need is really they need aid now.
Chad, as always, thanks so much for joining us. Chad Thomas, our executive editor for Europe. Now, we're just getting some pictures in, of course, from Bastille Day, because it's July 14th, so happy Bastille Day, everyone. There's a big parade that will come through to the Champs-Élysées in Paris, and you're looking at live pictures there where President Zelensky will also be joining President Macron. Coming up, it's Bloomberg Brief, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
as an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
In New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump reinstates the U.S. blockade of Iranian ships, saying the U.S. will become, quote, guardian of the Strait of Hormuz. Brent climbs to above $87 a barrel now. Rate hike bets rise. Expectations for a July hike increase ahead of CPI data and Fed Chair Kevin Warsh's testimony on Capitol Hill. And a big day for big banks. 5 of the 6 largest released results before the opening bell. All right, it's been a huge evening already around the world. Let's get straight to where the action has been pretty volatile. Let's get over to Hong Kong now and Winnie Su for the latest.
Yeah, morning, Bonnie. It's been indeed a very volatile day in Asia. Now we have MSCI Asia slightly towards the upside with the Kospi, in fact, reversing earlier losses. And that, of course, is driven by how South Korea's SK Hynix rebounded after having fallen about 9% earlier today. So we are seeing foreign investors buying while retail investors continue to sell as investors continue to weigh how far this AI rally can really go. Now, when it comes to currency space, we do see South Korean won strengthening to its strongest in about 2 months, driven by those foreign flows and the dollar when it comes to the ADR listing of SK Hynix. Now you flip the board and take a look at Japanese assets because the bonds really in focus. We have yields falling across the curve after those comments from the finance minister Katayama saying 2 things. That one, they will potentially consider adding JGBs to Japan's tax-free NISA account, and also that the pension fund GPIF will be adjusting portfolios as needed. So that has also supported the stronger demand for the 20-year bond auction today.
Winnie, an awful lot going on across Asia. Thank you so much for the update. That's Winnie Su there in Hong Kong. Now let's get over to London and to Justina Lee. Justina.
Good morning, Bonnie. Now, it's an update for oil, so of course it's a down day all across European assets, with the Stocks Europe 600 down 0.8%. But all the biggest moves here are in the bond market, with the UK short-end bond yield up 7 basis points and the long end up 5 basis points. Now, what I find really interesting here is that we're seeing way bigger moves in UK bonds today than in German bonds. For instance, on the long end, the German bond yield is basically not moving. But we kind of want to see what's driving all this. We just need to flip the board here to look at expectations for rate hike by the BOE by the end of this year. And we can see a big move recently following that oil move, with traders now pricing in 2 more 25 basis point hike by the end of the year. And it's the same in Europe. And it seems like we're seeing some similar movement in the U.S. as well, Bonnie.
Yes, particularly after Governor Waller's comments. We'll get to that in a moment. Justina Lee, thank you so much. This is the oil picture. We're above $87 a barrel. A fresh U.S. blockade, a demand for what some may call a toll, a 20% reimbursement on cargoes from countries that are transporting those cargoes. And then we just had a fatality. A seafarer on a UAE flagged ship was killed after the UAE boat was struck. And all of that together, combined with more strikes on Iran and fresh rhetoric from Iran as well, pushing Brent up to 87 and change, and New York crude up to 81 and change. This is getting to be a little more testy, a little more humid, if you like. Humidity definitely rising. You can see it in European gas futures as well. 50 handle now. All of last week, when this was just percolating, European gas futures still were at a 40 handle. Let's take a look at other asset classes, because we also had Fed Governor Waller talking about a near-term rate hike. Markets immediately thought, oh, this month. Now, whether that means this month or not, we don't know, but they're certainly pricing it in. Equity index futures are mixed, as you can see. NASDAQ 100 futures mirroring what happened in Korea. Were lower, now they're higher. But for the Russell 2000 and the S&P, we're seeing fractional declines. And then those yields, because let's get to those yields. We have CPI data, we have big banks coming out with earnings. Look at this 2-year yield, 4.28. This is the highest we've been since February, not of this year, but of last year, February of 2025. So a massive rise in yields. We have a 30-year yield at 5.10 and change, but the 2-year yield is really where the action is at after Governor Waller's comments. And of course, before we hear from the Fed chair himself in front of the House today. All right, let's get to some individual market movers now before the opening bell with Chloe Mele.
Good morning, Bonnie. We are seeing Apple weaker this morning after the company was downgraded by key bank analysts, with the analysts saying that they see weaker demand in the US going forward, and that means that the estimates for iPhone sales might be actually a little bit too ambitious. So we're down about 1% this morning for Apple. Moving on to tech, which is seeing a bit of a rebound this morning. We are back in the green for the likes of Micron, Intel and Nvidia. We saw SK Hynix shares rebounding and re-injecting maybe some of that positive sentiment around the AI trade, which is translating here into some movements positive movements for some of those tech stocks. And finally, Ericsson over in Sweden is down this morning after flagging that it will see weaker margins because of rising costs for key components, and that is really weighing on the main unit, the networks unit for the company. And so we are seeing quite the plunge this morning for Ericsson, down almost 8% in Stockholm.
All right, there will be plenty of individual movers today, as well as, of course, the macro picture. Chloe, thank you so much. Chloe Mele will be back later in the hour. Also coming up this hour, we look ahead to the CPI data and the testimony with Abigail Watt of UBS. We're going to preview bank earnings with Saul Martinez of HSBC. Brent then up past $87 a barrel after President Trump said the U.S. blockade of Iranian ships transiting the Strait will be reinstated, along with that toll, from 4 p.m. Eastern today. Joining us from Dubai is Bloomberg's Abir Abu Omar. A double blockade, a double threat on tolls, and now it appears just one ship transited in the last 24 hours, Abir. Is that the current state of play?
A very complicated one indeed, Vani. That is what we're seeing. So a double blockade, President Trump saying that by 4 p.m. ET today, that blockade on Iranian ports will be reinstated. He said by 4:45, we'll see other attacks on Iran. Now, let's just bear in mind that Central Command in the early hours of our morning in Dubai had said that it finalized a third consecutive day of strikes on Iran, mainly some of those southern provinces that we've been seeing getting struck over the past few days or so. Iran retaliating in a fashion that is similar to what it has done over the past few months or so when it gets struck by the United States, hitting countries in the region. Namely, this morning we saw Jordan, an airbase there was hit, Kuwait, Qatar, Oman, and Bahrain. We also saw yesterday, Vani, as you have mentioned a little bit earlier in the show, 2 ships from the UAE being hit in the Strait of Hormuz, resulting in the death of 1 person and injuring 8 others. So we're seeing that we're back to a state of casualties as well. But when it comes to the Strait of Hormuz itself, President Trump didn't just say that a blockade will be reinstated. He also said that all other cargo ships that are not Iranian making their way through the waterway will now be privy to a 20% cargo fee. So our teams have calculated that that comes to around $30 million, or at least a little bit north of that with the current oil prices. Now I'm seeing that Brent crude is ticking higher by the second, $87 on the barrel. We did that calculation with the prices of about 85. So we're seeing even that fee coming higher as the day goes by. And so Iran's response to President Trump's new fee was essentially that it will be the guardian over the Strait of Hormuz. It will be the guardian forever, according to the foreign minister of Iran. So we're seeing tit-for-tat attacks happening yet again. We're seeing an escalation when it comes to the Strait of Hormuz yet again. And we're not seeing any clarity on whether those technical talks will go back to, or if we're going to see any of those talks coming back to the table. We haven't heard much from the mediators yet. Up until just a week ago, Qatar was one of the main mediators between the U.S. and Iran. And 2 days ago, Qatar was being attacked by Iran. So we're seeing an escalation in the region for sure. And we're seeing the Strait of Hormuz really coming back into focus with the other concessions in that MOU that was signed about 3.5 weeks ago, Vani, taking a backseat for the time being.
Yeah, and to quote Zia Daoud in the Dubai office, our chief emerging markets economist, President Trump's war with Iran has now turned abundance into a squeeze. This toll might be a new supply shock. Abir, thank you so much. Abir Abu Omar there. Meanwhile, traders are ramping up bets for an interest rate increase later this month. Two-year yields surging ahead of today's CPI data and Fed Chair Warsh's semi-annual testimony before Congress. Bloomberg senior editor Alistair Bull joins us now. Alistair, if the CPI data is hot today and we've seen the move that we've seen, can the Fed hold?
No. I think it's quite clear from the body language from Kevin Warsh's statements during the press conference last month that he's going to be very committed to getting inflation back to 2%. Now, our forecast is for CPI to actually tick down, to cool. And that would give him an opportunity to hold if he wants to. But I think that there's another argument here, which is if you get a benign reading on CPI, I think you'll hear the chairman say today, we need more information because we're going to defeat inflation. If it's hot, I think he isn't going to explicitly say they're going to hike, but he's going to leave no doubt that that's the direction in which they're heading. And a hike in July does two things. It establishes his credibility as an independent Fed chair who's going to be hawkish, who's not going to be afraid of defying the president, who, as we know, wants to lower interest rates. And it's also going to spare him the tricky task of, if he doesn't go in July, of having to hike in either September or October as he gets closer to the midterm elections. And you know, that's going to cause an awful lot of pressure from the White House, from the Republican Congress, if he hikes into those elections. So there's a lot of good reasons to think that July is live and is on the table. Now, if you get a hot print, I think that those odds for a rate increase are going to escalate. And if Chair Warsh sees a hike fully priced into markets, it's kind of unlikely he's not going to use that opportunity to go. Finally.
Yeah, to say the markets interpreted the data, and indeed that's how we've interpreted it too. If the committee does hike in July, Alistair, will the markets take that as a sign that a new hiking cycle has started? Or could it be one and hold?
So it could be one and hold. This could just be an insurance cut. And again, it's going to depend on the data. There's a lot of smart people out there who think that the Fed will hold all year if the data come on side. You mentioned the speech yesterday by Governor Chris Waller. He laid out two cases. One reason, cases for why inflation would remain benign and the Fed could stay on hold, and cases where the spread of higher prices into goods and service prices means they're going to have to tighten in the near term. But he used that expression in the near term, which is sort of code for an insurance hike, a one and done. So I think that possibility would remain very real in the market's minds, depending on what then happens with the data. But as we've seen in the last few days, oil prices are up above $80. It's very hard to have any high conviction about the course of inflation and the course of monetary policy.
Bonnie.
Yeah, and it's amazing how the MOVE index rose as well. It's the market repricing in an instant. Alistair, thank you so much. It's getting to be an exciting time again. Bloomberg senior editor Alistair Bull there. It's also a big earnings day. 5 Wall Street banks releasing second quarter results. Analysts expecting the best second quarter ever when it comes to trading revenue. Joining us now is Bloomberg managing editor of EMEA Finance, Tom Metcalf. So, Tom, who's going to win out on equity trading revenue?
Yeah, well, it seems like Goldman might well break the record. They only just set the last quarter, so they're expecting, or we're hearing, they might top $5 billion in revenue from those stock traders. But yeah, broadly speaking, all these banks were expecting to kind of release pretty strong capital markets results. So absolutely, I think stock trading will be most front and center. It's probably going to have the most eye-popping numbers. But you've also got deal makers kind of, really leaning into this M&A surge. And then, of course, just generally, the US economy continues to sort of move forward, and at least at the top end, the bit that, these kind of high-tier banks tend to see, it's all guns blazing for corporates and stuff like that.
JP Morgan is an interesting one because it's expected to come out with industry-leading results, right? Fortress, Diamond, and so on. Yet the stock is underperforming the other banks crazily. It's up something like 3.5% this year. Is it underperforming, Tom? I mean, even year over year, it's not performing like the other banks.
Yeah, I think it's somewhat disappointing, but I'd probably just keep in mind that the bar for a JP Morgan is so high given over the years. It's had such a sort of run-up, I suppose. And, of course, Diamond is a bit of a master of sort of taking some of the steam out of these things when he thinks perhaps, even for his own stock, things have sort of got ahead of themselves. But, yeah, I mean, that will be the first ones to report today, I believe. And, as ever, they'll probably set the tone. I'm personally expecting a pretty strong set of results, so I would think maybe that sort of share price performance ticks up a little bit at least today.
Absolutely. Tom, cannot wait for this barrage of earnings today. That's Bloomberg's Tom Metcalf. Now to other top stories trending on the terminal this morning. China exports hit a record $412 billion in June, blowing past estimates. Global demand for AI pushed exports 27% higher than a year ago. Imports rose the fastest in 5 years. Japan's finance minister is floating the idea of adding government bonds to Japan's tax-free investment program. The proposal aims to draw more money into domestic markets as the yen hits record lows. DeepSeek founder Yang Wenfeng is now the world's richest AI model creator. Yang's net worth more than doubled after the firm's most recent fundraising round. He's now worth $36 billion, up from around $17 billion, putting him well above Anthropic's Dario Amodei and OpenAI's Greg Brockman. Coming up, extreme volatility gripping AI darling SK Hynix. We look at this morning's whiplash in that stock next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. SK Hynix is higher after shares of the South Korean memory giant tumbled since its U.S. trading debut Friday. Not just that, but at one point today they were down 8%. Let's get a read on what exactly is going on here with Matt Bloxham, senior analyst at Bloomberg Intelligence. I mean, a 16% swing, you might see that in a meme stock, Matt, but in SK Hynix, what happened? What's happening?
Yeah, I mean, obviously there are jitters around the outlook for the AI trade, and whether the memory chip companies really can break this kind of boom bust cycle that we've seen many times before. Personally, I think what we're seeing here is kind of really more the kind of secondary effects, the mechanics, if you like, of these kind of leveraged ETFs. And obviously the US ADR has kind of brought an extra dimension into that whole swing trade too. So yeah, nothing really about fundamentals. I think it's more about levered ETFs kind of balancing their positions on a day-to-day basis, and the complexity of that ADR adding into the mix.
It also means that the Kospi's intraday swings are getting more violent, though, and that can't be good for market stability in Korea. And then, the markets that follow on.
Yeah, that's right. And obviously, I think that a number of people have been calling for kind of greater regulatory interventional scrutiny, and whether there's been perhaps too much of a kind of free market philosophy in how many of these levered ETFs have come up, and maybe there will be some additional guardrails that come into place. Obviously, been even some talk about that these kind of instruments should be banned. I doubt they'll go that far, but certainly it's kind of brought to light perhaps some need for some kind of more kind of some mechanisms to make markets a bit more orderly.
Yeah, I mean, in other crises, there have been extraordinary maneuvers. There was no short selling on certain stocks at one point. Remember, during the GFC. Interestingly, we just got a story saying Samsung Electronics is not reviewing the possibility of issuing ADRs. And it's interesting because earlier we were reporting that Samsung was said to be in early discussions and exploring a potential offering in the US of ADRs. Do you think the performance of SK Hynix is causing Samsung to rethink what it might have been thinking earlier?
I guess it's probably certainly had some kind of influence on their thoughts about this. But, I mean, there's lots of complexities for a company to add an ADR program. You suddenly kind of come within the purview of the SEC. So it's by no means a kind of a free and easy ride for a company. And I think, to some extent, you've kind of got the allure of raising relatively cheap equity capital, which is arguably what SK Hynix has done, and opening up the wider US investor base. And, I guess to some degree, perhaps Samsung are kind of taking a balanced view that, they have sufficient access to the international capital markets, and they don't need to add the complexity of an ADR program to kind of, boost perhaps the kind of US retail investor base. So, yeah, I think there's probably a lot of things that have gone into that deliberation.
Well, that simplifies things for South Korean stocks for the moment. Anyway, once again, Samsung Electronics is not reviewing the possibility of issuing ADRs, the company said in a comment via text message. Matt, thank you so much. Matthew Bloxham there of Bloomberg Intelligence. Coming up, a look at your front page news. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bloomberg Brief. I'm Bonnie Quinn in New York, and it's time now for your front page news. First up, the Washington Post reporting a federal judge denounced President Donald Trump's lawsuit against the IRS as an improper attempt to manipulate the courts and legitimize a controversial deal. That deal included establishing a nearly $1.8 billion fund for alleged victims of politicized prosecutions. Next up, the Wall Street Journal reporting data center builders and operators are working with bankers to sell majority equity stakes in their companies this summer. The potential stake sale talks with PE firms coming as owners seek exits and investor interest in owning physical infrastructure grows. And finally, the New York Times reporting the sister of the late Senator Lindsey Graham was appointed to finish his Senate term by South Carolina Governor Henry McMaster. Darlene Graham Nordone accepted the appointment, saying it would be a, quote, privilege to get to finish some of her brother's work. Let's take a look at your markets then this Tuesday as threats just ramp up in the Strait of Hormuz, including a fatality after 2 UAE flagships were struck. We do have Nasdaq 100 futures higher. This as we see a rebound in the semi-trade, particularly in Korea. The 2-year yield, though, at levels not seen since February of 2025 after Governor Waller talked about a near-term hike being a potential, and as markets await Fed Chair Warsh. And New York crude about $80 a barrel.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up
and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump reinstating the blockade of Iranian ships, saying the U.S. will become, quote, guardian of the Strait of Hormuz from 4 p.m. today, Eastern Time. Brent trading around $86 a barrel right now. Rate hike bets rise. Expectations for a July hike increase ahead of CPI data and Fed Chair Kevin Warsh's testimony on Capitol Hill. And it's a massive day for big banks, with 5 Wall Street banks releasing results before the opening bell. So let's get straight to those markets. It's going to be a whippy day. We're already at just under $87 a barrel on Brent. Another round of strikes on Iran, the reimposition of a U.S. naval blockade, a general demand from President Trump for a 20% reimbursement on cargoes from various countries moving them through the strait. And in fact, no ships really moving at all now, because we had an attack on 2 UAE-flagged ships and 1 fatality from that attack. And all this goes to escalating everything, and the price of crude in particular. European gas futures too, trading with a 53 handle. Markets, of course, also on edge. We may be looking at a hot CPI print in a few hours. Let's take a look at where futures stand. We had NASDAQ futures higher, S&P futures and Russell futures pointed marginally lower. The NASDAQ rebounding. We had a massively whippy day in Korea, and it's obviously anyone's guess where the chip stocks and the memory stocks trade today. And then yield-wise, a huge increase, particularly at the front end of the curve in the last 24 hours, with the 2-year yield now trading at 4.28, and basically a July rate hike all but a done deal. I mean, unless we get very soft CPI data today, which may give the Fed chair a little bit of leeway, but markets also will be listening to what the Fed chair has to say. Let's get over to London now, and Chloe Melle, you already saw her. She's got some individual movers. Chloe.
Good morning, Bonnie. Indeed, we are seeing Apple down about 1% this morning after being downgraded by key bank analysts, with analysts saying that they expect much weaker demand in the US, and therefore that the estimates for iPhone sales might be just a little bit too ambitious. And so we are seeing some weakness there in that stock. Moving on to technology, which is seeing a bit of a rebound. We're seeing Micron, Intel, Nvidia, SanDisk, all of those US technology names rebounding after SK Hynix shares also rebounded, and there seems to be some positive sentiment being injected once again into this AI trade, and we can see that reflected in those shares this morning. And we've got Micron in particular up almost 3%. And finally, we are going over to Sweden, where Ericsson is seeing a little bit of weakness, actually quite a lot of weakness, after warning that margins would come under pressure this quarter from rising costs for key components. That is really weighing on the networks business, which is the main business for Ericsson, and we are seeing shares down more than 8% this morning in Sweden.
All right, thank you for the steer. That is Chloe Melle there in London. Traders ramping up bets for a July rate hike ahead of today's CPI data and Fed Chair Kevin Warsh's testimony in Capitol Hill and after Governor Waller's speech yesterday. Joining us now is Abigail Watt, U.S. economist at UBS. Abigail, first, what are you anticipating for CPI today, the headline and the core as well?
Yeah, so our expectations, for the CPI print today, I think there's going to be kind of a tale of two numbers. I think expectations are obviously that, given the strong decline we saw in gasoline prices through June, that we should see energy kind of weighing on the headline. So we're expecting that you see the headline down by around 25 basis points over the month. But we do think you continue to see kind of the core CPI, not showing much progress. So our expectations are that you see kind of actually a 21 basis point rise in the core CPI, which is essentially the same as the rise you saw in the May data. So I do think there's kind of somewhat of a tale of two numbers, in the data that we're going to see on the inflation front this morning. And I think, when we think about kind of the kind of composition of kind of core CPI, I do think there's areas where we could continue to see progress. Our expectation is that, we continue to see kind of shelter prices, moving lower. We do think that you're kind of past the peak of the kind of pass-through of kind of tariff pass-through into kind of core goods prices. But I think that, obviously people will be watching to see kind of what we see in terms of kind of some of the AI inflation potentially in terms of kind of the tech components of the CPI too.
Well, if we do get a little bit of an improvement in some of those data, Abigail, would there not be a case for a hold at the July meeting? I mean, markets seem to be absolutely convinced that we're getting a hike this month, particularly after yesterday's comments from Governor Waller. But is Kevin Warsh tied to that,
So I think, we've obviously seen this kind of split in the FOMC. You saw it at the June meeting. We saw it in the minutes last week. And, I think the interesting thing is, we heard Governor Waller kind of harking back to, I would say, kind of some of the scenario analysis that we'd seen in the minutes and the discussion that took place at the June meeting. There's two scenarios here. A scenario where you potentially kind of do begin to see kind of more progress and more disinflation in the data. And that essentially would lead you to kind of remain on hold because you don't want to kind of hike into a situation where you're then going to see the progress kind of coming through. Equally, there is the other scenario, and I think the interesting thing in Governor Waller's remarks yesterday was the fact that he kind of talked to this idea of a potential for a near-term tightening in policy if you were to see kind of the kind of continued kind of pressures in inflation and inflation kind of remaining elevated and not see that progress. And I think the interesting thing in his remarks was this kind of timing element, this idea of kind of the importance of today's data and not just the kind of CPI print, but the PPI data that we'll get and the import price data ultimately, and that essentially, feeding through into expectations for kind of PCE prices, which is really what, the FOMC is targeting. So I think the kind of comments from Waller yesterday kind of really put a lot of emphasis, I would say, on this week's data in particular.
I mean, if we do get some elements of inflation coming in hotter, even if it's, some unexpected ones, we also have that weaker jobs report to think of. So, would it be a conundrum for the Fed chair and for the FOMC committee?
So I think, obviously we heard from Governor Waller yesterday talking about the labour market. And I do think that's an important thing to kind of note is that, when we think about kind of the dynamics we're seeing just now in terms of the rise in energy prices and the potential for kind of broader kind of supply constraints and that influence on inflation, I think a lot of people have been referencing kind of 2022. And I think that was one of the key things that was, came out of Waller's remarks yesterday was just that the dynamics are slightly different from 2022. That labour market outlook, yes, it's been more stable, but the kind of pace of job gains we've seen in the US economy just now is obviously well below the pace of job gains you were seeing in 2022. And I do think that, you have to think of that balance, obviously, between the labour market and the inflation data. But I do think, if you were to see kind of growing upside risk to inflation, potential for kind of broader supply chain disruptions, obviously we've seen kind of more headlines over the potential, kind of disruption again to the Strait of Hormuz. And I think, with potential for kind of broader supply constraints, potential upside from AI demand, a number of these kind of upside risks to inflation, I think it potentially kind of shifts the balance given that stability we have seen somewhat in the labour market.
So obviously, before we get that FOMC meeting, we're going to have the testimony of the Fed chair. I'm just curious what you think we might learn today or tomorrow, given that he won't be likely to give the markets a steer, but he may end up giving the markets a steer somehow.
Yeah, so look, I think the irony is that, Chair Walsh obviously has kind of said he's kind of not wanting to give forward guidance and wanting the markets to focus less on kind of Fed speak. And I think the irony is that, it actually has led to kind of an increased emphasis on, any comments that he does make. And I think markets will obviously clearly be watching, his testimony this morning. Our expectations are that we don't get a huge amount of colour from him. I would expect that, he wouldn't want to kind of prejudge the July meeting. And I think he could kind of, actually also kind of use those words of not wanting to prejudge that discussion. The idea that there will probably be, quite a lively discussion at the meeting around the outlook for rates. I think, in terms of his, characterization and the language that he uses, I think he'll probably kind of, hew very closely to the statement language that we had at the June FOMC meeting. And then I think, he's obviously, I think, going to clearly emphasize, as he did in his kind of Sintra remarks and as he did in the post-meeting press conference, this clear commitment to kind of restoring price stability and restoring inflation to 2%.
He said, markets, you interpret the data yourselves, we'll interpret the data ourselves, right? Is there any danger that if the Fed does move in July, having had this move at the front end of the curve, that then the Fed will be guilty of responding to the markets, if you like, and then the markets will push the Fed further, if maybe for another hike, I mean?
So I think the markets will be responding to the data, and I think the FOMC will also be responding to that same data. I think it's unlikely, I would say, that you would see kind of a significant difference in terms of the interpretation potentially of kind of the CPI data, I would say, between kind of what the FOMC is thinking and what the market is thinking. I think the key thing, though, will be kind of how the FOMC are feeling around those kind of upside risks to inflation, and whether they feel like now those upside risks are something they need to respond to, or whether they think they would like to continue to wait, have that patience, and see kind of whether you do see that kind of progress and that disinflation kind of coming through in the second half of the year, which, I think, you could see. I do think there's elements of the inflation basket that, should begin to kind of come off, and we should see a little bit less heat in the inflation data through the end of the year. But I think the question is whether the FOMC feel comfortable enough to kind of wait and see.
I mean, Abigail, is it fair to say that we're in a whole new world this week that we weren't in last week before this all kicked off again in the Middle East?
Yeah, look, I think it, obviously we've had a whole conversation here about inflation and the potential for kind of, the supply chain disruption risk to kind of broaden out. And I do think that is obviously an upside risk to inflation. But one of the things we haven't talked about is the potential implications for the growth side of the US economy, right? And I think, just now we've seen US consumers holding up relatively strongly, weathering this kind of stronger kind of price shock from energy prices. And I do think that's largely due to kind of peak fiscal support from, bumper tax refunds that we saw due to the OBBA. Now, there's a potential here that, that kind of peak in fiscal is happening now, and that isn't necessarily something that could be, sustained through the end of the year. So I think that's the other risk here is, obviously there's a lot of focus on the potential implications for inflation, but I think we also have to think about the potential implications for growth too.
All right, well, we will get to that data in the middle of all the bank earnings at 8:30 Eastern. Abigail Watt, thank you so much. Abigail Watt of UBS there. Now to other top stories trending on the terminal this morning. The US-Iran truce collapses. That's after American forces reimposed a naval blockade and launched another wave of airstrikes. Iran targeted US bases in Jordan and Bahrain and hit 2 oil tankers from the United Arab Emirates. DeepSeek founder Liang Wenfeng is now the world's richest AI model creator. Liang's net worth more than doubled after the firm's most recent fundraising round. He's now worth $36 billion, up from around $17 billion, putting him well above Anthropic's Dario Amodei and OpenAI's Greg Brockman. Chipotle is heading to Mexico, betting that an American brand can sell Mexican-inspired food in the country. Its inaugural store will open near Monterrey on Thursday, with a couple other locations planned through 2027. Chipotle will likely face challenges. Taco Bell flopped in Mexico after several attempts because its menu failed to resonate with locals. Coming up, we're going to be taking a look at big bank earnings with Saul Martinez of HSBC. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Big banks are poised for their best second quarter ever. Analysts are expecting a revenue rout from the banks, which are set to report this morning. For a preview, we welcome Sol Martinez, head of U.S. Financials Research at HSBC. So, Sol, give us the highlight.
Hi.
What bank is going to blow us all away and justify this massive run-up that we've had, not in all of them, but in many of them?
Yeah, look, I think they're all going to varying degrees, have good results. I think those likely who have more capital markets exposure and investment banking exposure are probably going to post, really good results. Goldman reports this morning, but I think in that we'd expect a really strong result there. But all in, I think this is a good quarter for the banks, generally speaking. We're expecting median EPS growth of 17% year on year. I mentioned the capital markets results being strong, but I think you'll also see good loan growth, net interest income growing okay, credit quality, doing well. The question, Bonnie, though, is durability. As you mentioned, many of them, not all, but many of them, and in general, they've performed really well. So can the good momentum, can the continued profitability improvements, can the continued upside to consensus EPS revisions, can that continue? I think the quarter is going to be more about sustainability, revenue sustainability. Can the exceptional capital markets results continue? Net interest income, can it continue to grow? And I think the bar is a bit higher, but all in, we think that, the banks, broadly speaking, are going to have pretty good results.
There's no danger that we're a little complacent or overconfident in these results. Is there anything that's going to surprise us, Sol?
Yeah, I think, we highlighted that in our preview. I think right now investors look at the big picture and say, well, there's nothing that is clearly going to derail the story that we can point to. But that runs the risk of growing complacency. I would say two things that are, risks that might show up in the results. I think the first one, which is perhaps more likely, it's not the base case, is net interest income being softer. I mentioned loan growth is good. One of the underpinnings of the positive thesis for banks is that, we have positive real rates across the curve, and that's a good thing for net interest income. But the funding costs are, maybe ticking up. And, you talked to your last guessed about monetary policy. Now we're pricing in 2 rate hikes over the next 9 months. So there is a concern that maybe funding costs and deposit costs will start to bite. And if the banks suggest that net interest income growth in the back end of the year is going to be a little bit lighter than it has been, that could be a cause for concern. And then the second thing is capital market sustainability. The market's results, trading especially, has been really, really strong. I think it will be strong again this quarter, but if there's any hint that the second half of the year, which does have tougher comps, we'll see slower growth, that might lead to some pullback and some concern about whether the capital markets results will continue to be a source of strength.
Yeah, I mean, already just in the last few sessions, that 30-year yield is at 5.10, right? So you would imagine that banks will have to have a different answer to questions regarding longer term yields and so on. What about private credit? There's no worries there, right? All across the banks, we've damped down all those worries, and we're not going to find out anything that surprises us.
I don't think so. I mean, I think when we had this discussion last quarter, private credit was very much front and center of the discussion. What the banks did do last quarter that was really positive was that they gave really good disclosures on their private credit exposures. And what it showed is that the overall levels of exposures are low single-digit percentage of portfolios, and that the risk profiles are good. They're collateralized by pools of loans. Advance rates, which are basically the max amount of loans relative to the value of the collateral, are pretty low. So you have to see really big losses in the underlying portfolio for that to be impacting the bank. So I think they'll update the disclosures perhaps, but I don't think it will, you never say never when you talk about anything related to credit quality, but I don't think that will be a big theme this quarter as much as it was last quarter and maybe the previous couple of quarters.
And now to get to the base question of stock prices and where they're at. You have upped your price targets by between 6 and 14% for the various banks. I am curious though, why is JP Morgan only up 3.5% year to date? And as for Wells Fargo, which is your top pick at the moment, I mean, we're down year to date by more than 5%.
Yeah, I mean, there's, in the case of JP Morgan, look, it entered the year at pretty elevated valuations, still trades at a premium. So the bar is higher at JP Morgan. I mean, they posted really good results, but the bar is higher. The stock price has done well for an extended period of time, and it trades at 15, 16 times PE, which is a pretty big premium to other traditional banks. So the bar is higher. I think the other thing that on the margin, maybe has impacted them is their net interest income. They didn't increase the guidance on the back of last quarter, and there was some hope that they would. And they are spending. That's not necessarily a bad thing. They are spending, they are investing. That positions them well for longer term growth. But it does lead to a situation where they're the only bank that we cover that is expected to not have positive operating leverage. So I think it's a combination of all those things. Wells Fargo, we did upgrade them to our top pick into the quarter. So this is, Citi had been our top pick for quite a long time. So this is a new, change. This is a change for us. And I think there are a couple things, but the big thing with Wells more recently was the net interest income dynamic. Again, similar to JP Morgan, but more extreme. They really underperformed in the first quarter. They had some pressure on funding costs and net interest income. There had been some hope that they would increase guidance as well, and that didn't come to fruition. And right now there is some perhaps some concern about the trajectory there. We think it's going to improve in the coming quarters, that trajectory. We think that will be well received. In the other parts of the story, excess capital, buybacks, loan growth good, investment banking is being built out, capital markets businesses are being built out, the wealth, the investment management business is doing well. We think all those things and a discounted relative valuation underpin why we're more constructive here than we have been for a while.
So thank you so much for giving us some of your time today. Get some coffee and get ready for the marathon of a day that it's going to be for you and your team. That's Saul Martinez of HSBC. And stay tuned to Bloomberg all day long for coverage of today's earnings. Wells Fargo CFO Mike Santomassimo will join the close this afternoon. This is Bloomberg.
is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Now a look at what's ahead today, or as much of it as we can get to. 5 Wall Street banks reporting before the opening bell. JP Morgan, Goldman Sachs, Bank of America, Wells Fargo and Citi. Then we get June CPI data, that's out at 8:30 a.m. Eastern. And Fed Chair Kevin Warsh gives his first semi-annual testimony before Congress, appearing before the House Financial Services Committee at 10 a.m. This even as war continues in the background. This is your picture. So while the NASDAQ 100 futures are pointed higher, the other equity index futures are pointed lower. The 2-year yield ramped up yesterday after Waller's comments. And New York crude is trading above $80 a barrel.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Earnings are exploding to the upside.
The market is very excited for this week. We're all expecting great things.
We don't want to overthink the secular trade.
We're still in a really strong earnings environment for U.S. stocks.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, gearing up for a big one. 5 big banks on Wall Street kicking off quarterly earnings, heading into the last CPI print before the Fed's next meeting as a rebound in oil is piling the pressure on a divided committee. The Fed chair is heading to Capitol Hill.
Let's just frame this. It is the World Cup today of finance. We are seeing the finals of the World Cup in finance, given how much news is really going to be coming out. There are a couple of really big questions for the day. Number one, is the window starting to close on AI financing? How much momentum is there behind some of what we're seeing with inflation? And how much are you truly seeing a hawkish Federal Reserve? Chris Waller setting the tone. Will we get sealing the deal? Kevin Warsh saying anything today in Capitol Hill.
Get to the bond market first, shall we? 2s, 10s and 30s. Let's start with rates. Let's start with the Federal Reserve. New levels on 2s, 10s and 30s. 2s close to 430, 10s around 460 and 30s comfortably through 5% right now. Governor Waller, if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. He got out front of Kevin Warsh, the Fed chair, over 2 days of testimony coming up.
And he pushed back against looking at a different metric, maybe the mean adjusted inflation metric that we've heard some discussion around as somehow ameliorating the inflationary pressure underpinning this economy, saying no matter how you cut it or what measure you want to use, inflation is up this year with increases recently quite broad. How much are we going to see that reiterated by Kevin Warsh?
This move in crude won't help. Bring it up. WTI Brent again this morning. A 2-day rally, and we add some weight to it this morning, up by more than 3% on WTI, $80 a barrel. Brent crude breaking 85, breaking 86, 88 this morning, and up by more than 4%.
The strikes continue in the region. The President of the United States is saying the blockade will begin once again by the U.S. military today. He's also saying, interesting, Iran's not able to charge a fee. He's saying now the United States will be compensated some 20% for allowing the passage. And remember the Houthis. They've been quiet for a while. They're getting somewhat involved by striking a Saudi airport. So things are getting a little bit more volatile, a little bit more hostile right now in the region, and you see that in the price premium in crude.
Who wants to translate this one? What does it mean to be the guardian of the strait? What does that even mean?
May the force be with you, Luke.
And if you want to go through a certain path right now through the strait, you pay a 20% toll to the United States. How does that even work?
So somebody put this into perspective. The toll that Iran was putting on different ships was about $2 million per oil tanker. A 20% charge by the United States would be about $30 million per oil tanker. So let's just, if we actually look at the finances behind that, that is untenable for pretty much any kind of investor or company that wants to transport some of these goods. That said, there is this question of if Iran's not willing to cooperate, how does the United States force its hand? And right now you can see that frustration, and it's essentially, we'll just take it over and push you out of the equation. Will that work? Will there be the political and financial will behind that? Will there be the allied support for a 30% or 20% tax? Probably not. Nonetheless, this is the path of travel.
I get it's uncomfortable, but this could be the muddled new normal. This could be it, a volatile negotiation filled with unworkable solutions, like the one in the last 24 hours, punctuated by a series of on-again, off-again strikes over the next 2 months?
Purgatory, where this is the standstill we are in, and potentially the higher oil price might push them back to the negotiating table, only for talks to fall through once again, and then we are once again back at this cycle. So the market's just going to have to get used to the tit-for-tat, start and stop of the negotiations and of the conflict.
More on the story a little bit later this hour. Later this hour, The earnings season story begins on Wall Street. We'll hear from JP Morgan. We'll hear from Bank of America over the next 60 minutes or so. So look out for those numbers over the next hour. Coming up, we'll catch up with Chris Ferrone of Baird Strategas, facing down a morning packed with event risk. We'll speak to the former Deputy National Security Advisor, Victoria Coates, as oil breaks back through 80. And Gerard Cassidy of RBC as 5 big banks report quarterly earnings through this morning. We begin this hour with stocks little changed heading into this morning's data and a ton of bank earnings. Chris Ferrone of Baird Strategas writing the following: with 99% of banks above the 200-day average, the group kicks off the 2Q earnings season on solid technical footing. Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here, John.
Is that what your focus is on this morning? Because we've got CPI, we've got Fed Chair Walsh. Is it earnings front and centre?
Yeah, I think this is going to start to take some of the attention away, both from the central bank and from Iran here. And, you know, our kind of main point here is when you look at kind of the setup of the bank stocks into earnings season, they are on very sound footing. Are they overbought in the near term? Yeah, they probably are. I don't particularly care because the underlying trends are so firm. These are still the relative leaders. After, frankly, what was a pretty funky, you know, March, April period, the banks have really, since about mid-May, come back and reclaim the bar of leadership. And you see it not just domestically, it's true in Europe, it's true in Japan. Even with JGB yields up, it's true in Japan that these global banks continue to act really, really well. So I think it's difficult to get kind of too worked up about financial conditions here when financial stocks are still in pretty good shape.
Well, let's talk about the US banks and the kind of exposure you want right now. So let's say on the far side, you've got a pure play on capital markets, and on this side is a pure play on Main Street. The closer you are to this side, as a general rule of thumb so far this year, the best you've done. In terms of Morgan Stanley, Goldman Sachs, those stocks have been flying. Where's the sweet spot now?
So that's now generally been true for about 2 years. If you look at like when Morgan Stanley and Goldman broke out, it was probably back in late 24, early 25. So they've really have carried the flag of leadership the entire time. I think what's maybe a little unappreciated, though, particularly when you go down the cap scale, there are so many regional and small banks that are acting great here, that are in good long-term uptrends, that have just finally broken out to new multi-year highs. So it's more than just the capital market stocks, which clearly there's been a story there with the IPO boom. But it's when you start to migrate down the cap scale, you do get some exposure and some very good charts in these small and mid-cap banks.
Just to build on what John's talking about, it's almost Main Street versus Wall Street. You've got Wells Fargo on one side of the extreme, and then you got Goldman Sachs and Morgan Stanley on this side of the extreme. And it seems like we've seen the fees that potentially are coming from some of these IPOs, some of these issuances. Is it going to broaden out where we start to see true, robust borrowing and lending from consumers and the broader economy?
To the degree to it extends to consumers, I'm unsure. I would say this: when you look at the credit landscape, and put aside the private credit names for a minute, we can talk about that, but public credit conditions are still extremely benign here. I mean, double B spreads yesterday made new cycle tights. That's true here. It's true in Europe as well. So I think, again, with bank stocks generally still an uptrend across the world, credit conditions pretty benign, I think it's premature to get too worked up or too bearish here. Listen, I recognize where we are seasonally. You can get a correction here for any reason into August, into September. We've seen that historically. But I think the underpinnings of this market are still in decent condition.
One big anxiety right now in markets is how long can this last? This incredible issuance boom, this incredible financing condition for anything related to AI. And we've gotten the sense that maybe in the margins it's starting to come back a little bit. Do you expect to get a sense of that, the sort of forward pipeline, or just whether it's starting to close?
So, Lisa, our kind of big view this year is that there is some interest rate out there where bonds simply become more competitive to stocks. And I just don't think we have found that interest rate yet. So to answer your question, when does kind of the capital markets boom end? I think it's when we find a bond yield that is meaningfully higher than where yields are today. We learned a couple weeks ago, I think the highs were 467 on 10s. That's not the level. It's some level meaningfully higher. People forget, you know, go back to 1999 when you were in that NASDAQ melt up. You know, bond yields that year went from 4 to 7 in the U.S. So it typically takes a yield so much higher than the consensus believes to truly be competitive. So I think we're in this environment where money is just sloshing around from group to group to group, but it's very reluctant to leave the asset class of equities.
Are you calling for 7% 10-year
No,
yields?
I'm just saying that it takes a yield much higher than what the consensus believes is right in front of them. I don't think 461 this morning is that yield that ends this kind of 17-year bull market that we've been in.
Is July 29th the first rate hike?
I think not. I don't think we get a rate hike in calendar year 2026. I'll give you 3 things to think about. Number one, I think, is the one we all know. Look at forward inflation expectations. They're relatively anchored by any metric, whether 5-year forwards or even just 5-year forwards.
Is that because the market's priced for hikes?
Well played.
Yes.
Listen, I think the shift in narrative this year has been so dramatic. We got to get back to center here a little bit. Let's think about some of the data. Number one, PMI right now is 53.5. Fed doesn't hike from there. Just look historically, that's not where your majority of hikes come from. The 3-month average on payrolls right now is about 125K. If you look at a distribution of Fed action, when the 3-month average of payrolls is in that 100 and 150 range, the likelihood of a hike any point over the next 6 months is less than 20%. So whether it's the payroll data, whether it's the PMI data, I think the likelihood that we get this Fed in particular moving to hikes in 26 is low. Reserve the right to change that opinion should the facts on the ground change, as always, but that's kind of the job of what we do. I'd be betting no hike here.
Even though Governor Waller yesterday made it very clear he's very concerned about inflation and also talked about he doesn't want to repeat the mistakes of the past.
Waller's not the chair. And I think we all need to come to this realization. The chair is the chair. Let's get back to that mentality. The chair is the chair. I think, as we've seen with these task forces, we're going to get less and less communication from regional Fed presidents, Fed governors. So I'm more inclined to kind of discount what Waller said yesterday. I think that at the end of the day, the likelihood this Fed goes in 26 is still low. That's how we're positioned. That's how we're thinking about things.
It's interesting you don't think the centre of power at the Federal Reserve has shifted somewhat, because I've witnessed the committee vote down a chair before, and in that case it was the Bank of England governor of a QE coming out of the financial crisis. He wanted more. The committee voted against him a couple of times, I believe, if my memory serves me well. The situation at the Fed, you don't think it's shifted? Just give us the why.
I think at a minimum, these task forces over the next 6 months do buy the new worst Fed time to kind of get an understanding of the new lay of the land. I also think the data is just not there. Right? At the end of the day, if this is a data-sensitive Fed, the data is not there, whether it's payrolls, whether it's manufacturing. I also think when you look at 10-year yields, are they escape velocity here? I would hardly say that. I mean, twos, you can make a case. Hey, twos are, 425 this morning. They're 50 bips above Fed funds. That's probably the one signal that I would say maybe pushes back in my view here a little bit. I wouldn't say it's as extreme as what we saw in late 21, early 22. I think by the time the Fed got around to hiking in early 22, the 2-year yield was something like 200 bips above where Fed funds were. So we're not yet in that category, but watch the 2-year yield here. That would probably be the one thing that would start to shift my mind.
Chris, it's good to see you.
Always good to see you.
As always, thank you, buddy. Chris Ryan there of Baird Strategas. Looking ahead to the data later this morning, 8:30 Eastern time, we get CPI. To Chris's point, and he's absolutely right, we've broken down to twos at 430-ish, tens around 460 again, and this equity market hasn't really broken down in a material way in the face of what we've seen in yields.
So I would love to play, yield roulette, where you start to figure out what that level could be that could start to crimp capital markets. And if you do have easy financing conditions, you have to start asking, should we? And how many people are going to say that? Are we appropriately borrowing and lending at a time where there seem to be parabolic moves? And I think increasingly people have been asking that question.
I think that's part of the conversation at the Federal Reserve right now, that's for sure.
I think it is.
More bank earnings later on this morning. We get JP Morgan and Bank of America this hour. Look out for that. Equity futures right now just about unchanged. With an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump reinstating the U.S. blockade of Iranian ships transiting the Strait of Hormuz. Trump also demanding a 20% reimbursement for all cargo shipped through the waterway. U.S. military forces will resume the blockade, he says, at 4 p.m. Eastern. Fed Governor Chris Waller says the central bank may need to raise rates soon, speaking to tame inflation.
Unless I see evidence of a significantly weakening labor market, my focus from here on out will be on inflation. And no matter how you cut it or what measure you want to use, inflation is up this year. Even accounting for the likely temporary direct effects of the oil price shock, it is running at levels inconsistent with the FOMC's 2% objective.
Or CPI data out at 8:30 this morning, PPI out tomorrow. Samsung may be exploring a potential offering of ADRs. Sources had been telling us here at Bloomberg the company held preliminary discussions with bankers. Samsung, though, responding to our reporting, saying via text message it's not reviewing the possibility of issuing ADRs. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. The amount of equity supply already. SK Hynix tapping the equity market stateside for $26.5 billion. Alphabet monster capital raise earlier on this year. We had a record IPO from SpaceX. It's really difficult to keep up. We'll talk about the banks a little bit later this hour. They're going to make a ton of money from all of that supply. But at some point, that supply becomes a problem for the market, doesn't it? Not now, but at some point.
Yeah, I mean, maybe that's what we're seeing on the margins with SK Hynix in terms of the incredible volatility there. You have to wonder, given how successful these IPOs have been, why wouldn't Samsung issue ADRs, given the valuation here in the United States?
We'll have that conversation later this hour. Up next on the program, controlling the Strait of Hormuz.
We're putting the blockade back. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
How do you do that? We'll speak to the former Deputy National Security Advisor, Victoria Coates, in just a moment. Live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
What a morning. Coming up later on this morning, this hour, we start with two of the 5 banks reporting earnings. We'll hear from Bank of America and JP Morgan. Later on, CPI data at 8:30 Eastern Time. Then after that, we'll hear from the Fed Chair, Kevin Warsh, on Capitol Hill. Look out for that a little bit later this morning. Equity futures into all of that, negative on the S&P by just 0.1%. A bounce back on tech. The Nasdaq 100 up by 0.4 yesterday. Yes, we've got a bounce back in crude, and that's driving this move in the bond market. But in addition to that, it's Governor Chris Waller. 2s right now close to 430, 10s at 460, 30s at 5.1%. I think we all had a similar question. How live is the meeting in July in a few weeks' time? Turns out it could be quite live after this data later this morning.
After his speech, it ran to almost a 50-50 chance when in the Fed funds futures market, because people are looking at commentary like all it would take is a little bit more of a sense that inflation was picking up in that broadening sense that he's already seen. Any way you slice it, he said inflation is broadening out. What is the threshold? Does this mean that a hot print today could really put him in a hiking position? And then what will Kevin Warsh say to that later today?
This won't help. WTI 80, Brent crude around 87, under surveillance this morning, controlling the Strait of Hormuz.
We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing. We're controlling the straits. We're putting the blockade back. I want to be reimbursed because we're protecting a very rich portion of the world.
So here's the latest this morning. Crude climbing as the U.S. reinstates its blockade of the Strait of Hormuz, with President Donald Trump demanding a 20% fee on cargo shipped through the waterway. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, the U.S. is set to reinstate the naval blockade at 4 p.m. Eastern today as the U.S. is looking to gain any sort of leverage when it comes to the Strait of Hormuz. We haven't gotten additional details from the White House when it comes to the president's proposal for that 20% reimbursement, though it could work out to some of the largest crude tankers paying more than $30 million per trip. Now, President Trump has previously floated that he would like to see the U.S. compensated for helping to secure the strait, but this move would mark a reversal from what has been weeks of the Trump administration saying that freedom of navigation means that there should not be a price tag involved. But it's very clear here that the U.S. is trying to gain some sort of leverage when it comes to the strait, considering that we saw the U.S. military last night conduct another wave of strikes seeking to degrade Iran's capabilities when it comes to striking commercial shipping. But even with the escalation, the UAE's defense ministry did confirm that 2 of its tankers were hit, and data is showing us that traffic in the strait has reached its lowest level on Sunday, according to what was analyzed by Bloomberg News. Now, the region, John, is bracing for the next steps, and I will point out that President Trump today is set to meet with Iraq's new prime minister as the White House is pressuring that leader to disarm proxy groups that are operating in the country, as we keep close eyes on some other Iranian proxy groups, including the Houthis in Yemen and some recent attacks that we saw from them overnight.
Tyler Kendall with the latest. Tyler, thank you. We'll catch up with Tyler again later this morning. To build on this conversation, we can speak to the former Deputy National Security Advisor, Victoria Coates. Victoria, welcome back. I'm struggling with this one, and I need your help. Is this a serious policy proposal from the White House?
Well, good morning, Jonathan. I mean, if you're talking about the move through the strait in terms of the policy proposal.
Oh, that's precisely what I'm talking about. Becoming the guardian of the strait and charging a 20% toll.
Well, but I don't see this as a toll. I see this as the United States sharing the costs of securing the strait. And so that's what's different. If you're paying a toll to the Iranians, you're paying them to not shoot you. If you are sharing a cost with the United States taxpayer is bearing a burden to try to keep that waterway open. And so this is something very different. You're just simply sharing a cost. So I think that's perfectly logical if that's how the president wants to arrange it. But the whole point is we need to keep that energy flowing. And what we've seen recently are prices coming down around $75 a barrel. That's right around the sweet spot for the United States. They're coming up today closer to $80 a barrel. Would prefer to have that lower. So no, I think this is a good security arrangement. I do think the Gulf is perfectly capable of paying for its own security. So I don't see this as a toll.
Oh, the Gulf has got the means. I'm totally with you. They've got the money. That's not in dispute this morning. Victoria, my struggle is the US has failed to demonstrate they have the ability to open the strait and get traffic through the strait back to pre-war levels, regardless of whether someone's got the means or not. Does the US have the capability to achieve what they're talking about achieving?
No, I think we do. And we also, I mean, there is a plan in place that CENTCOM has that will clear the strait. It would be fairly destructive to do, so I think the president would prefer not to do that. But if he has to do it, he does absolutely have the means at hand to do that. And I'd look at also where we struck last night. I was interested in the strikes on Bashir, which is one of the port cities along this side, also with an important nuclear program element to it. So they're starting to go after those targets, which degrade Iran's infrastructure, also going after their nuclear program. I think you're going to see those strikes continue over the next week or so.
Victoria, what do you make of the fact, though, that the industry has been somewhat caught off guard? The oil and gas industry, the shipping industry, they're caught off guard with the fact that this is an international waterway. Now, the president wants to make a new precedent where basically they have to give back to the United States some 20% to pay this fee to go towards the security of it.
Well, Emery, I think it's I mean, that's precisely it. That's going toward the security of that waterway. We're not the ones who have clogged it up. It's the Iranians who started making this an issue of you're going to get shelled if you go through. And I think 2 UAE ships or vessels rather, were hit overnight. There was another one. I mean, they're just taking pot shots at these tankers as they're going through. This is on the Iranians, not on the United States. And if we are going to expend the treasure and put our people in harm's way to clear the strait to make sure that these vessels can go through, I don't think it's unreasonable to expect others to share in that cost.
Hasn't the Fifth Fleet always been the, quote, guardian of the strait? Hasn't our Navy always been there?
Well, I mean, not always. I mean, since 1979, when President Carter, or 1980 rather, declared the Carter Doctrine that we were dependent on the flow of energy out of the Gulf, and we would ensure that it would be coming out. But now we're in a very different position, and I think that's a really important point. That when Carter made that declaration of the Carter Doctrine, we were dependent on that energy. We now aren't. And I think we just hit a recent high of about 13.6 million barrels a day that we're producing in terms of oil. I mean, the next closest two are Saudi and Russia, 9 and change. So we are now the world's largest energy producer. We're in a very different position vis-a-vis the Gulf. I mean, we don't, for our domestic purposes, have to have that energy. Now, we are a part of a global energy market. We don't want there to be huge price spikes based on what's coming out of the Gulf. But that's less of an existential threat to us. So yes, that's why the Fifth Fleet is in Bahrain. But I'm curious to see going forward if that's something that we need to have there.
Let's hope that we can avoid another spike. Victoria, it's good to catch up with you. Victoria Coates there, the former Deputy National Security Advisor. We've got another one this morning, up by close to 5%, $87 a barrel. It is an international shipping waterway. Shouldn't have to pay anyone. Does the Middle East have the means? Absolutely. The willingness, I've got no idea. But do we have the capability? The military might, to actually keep that strait open. What I've seen so far is that is difficult, much harder than it is to say you can. Coming up on the programme, Gerard Cassidy of RBC. Big bank earnings set to report. JP Morgan, Bank of America, up next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to to fund money and to cover this gap, but it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Live from New York City this morning. Good morning. Coming up, earnings from Bank of America and JP Morgan. Dropping right now, numbers from Wells Fargo. Looking at an upside surprise on investment banking fees. Expecting to see a whole lot more like that throughout this morning and into tomorrow. Fees coming in at 939. The estimate was 830.2. This, of course, not a pure play on capital markets and investment banking. Anything but over at Wells Fargo. A bit of an outlier compared to what we'll be talking about later on this hour.
Yeah, they don't necessarily have the same capital markets heft as, say, a Goldman Sachs or a Morgan Stanley or even a JP Morgan. They also have been lagging behind, as you pointed to earlier this morning, this idea that they have been the worst performing bank out there. That said, the fact that even Wells Fargo could come in with investment banking fees above expectations at $939 million versus the estimate $830, even as they can reaffirm their full year net interest income forecast, this gives a sense of just what we can expect from some of the others.
Yeah, net interest income, the big number for Wells Fargo. The second quarter coming in at $12.32 billion. The estimate $12.32 billion. The stock this morning positive by about 1%. Equity futures more broadly, your scores look like this morning on the S&P 500. Equities just about unchanged. On the Nasdaq, bouncing back for tech by 0.4%. In the bond market, new levels to talk about. Thank you, Governor Waller. 430, close to that level on twos. 10s through 460, 30s through 5.1%, in addition to some hawkish comments from the Fed governor. This move in crude as well. WTI and Brent pushing higher once again, breaking 80 on WTI, breaking 87 on Brent crude. As I'm discussing the oil numbers, JP Morgan drops as well. Some of these numbers coming out a little bit earlier than expected. JP Morgan dropping now. Bank of America will come in just a moment. Let's work through this together, Bramo. We've got adjusted revenue coming in at $58.02 billion. The estimate was $51.39 billion. I think it's fair to say that is an upside surprise. Investment banking revenue coming in at 3.9. The estimate was 3.06. Fixed sales and trading revenue at 6.05. The estimate 6.29. So that's a little bit lighter. When it comes to equity sales and trading revenue, though, check out this number. $6.03 billion. Okay, $6.03 billion. The estimate, 3.98. I think that is what you call a mega upside surprise.
I don't even know what you call a $2 billion beat at this point, given the fact that it is an upside surprise that almost doubles where the estimates were. Ultimately, this has been a quarter that was defined by those share sales that we've been talking about, by the IPOs, by some of the volatility, the single name and sector related volatility that evidently is the good type of volatility. Just looking through this, not everything was exactly a beat. I mean, you could see just managed net interest income came in just a touch light. Nonetheless, all around, a really big quarter tied to exactly what we've been talking about, the IPOs, the share sales, the volatility that's been bouncing around, the ball of money that is moving, but not necessarily moving down.
That equity sales and trading revenue number is a monster. The stock is down by about 0.75% this morning. Of course, the bar was already high coming into those numbers. So we've had Wells Fargo, just had JP Morgan. We'll spend some time on that in just a moment. In a few moments' time, a few minutes away, should be in the next 10 minutes, we'll hear from Brian Moynihan's Bank of America. Before we get there, 3 hours away, from the cash open. Let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing SK Hynix ADRs bouncing back up 6.6% in the pre-market after falling more than 9% yesterday. The rebound follows a recovery in South Korea overnight, reinforcing Korea's growing role as a key barometer for the AI trade, and also showing how this company, SK Hynix's U.S. listing, is increasingly linking trade between the U.S. and Seoul. Meanwhile, the memory and chip stocks are also bouncing back this morning, with names like Micron up 3% in the pre-market after yesterday's sell-off and after a volatile stretch for these stocks, as investors continue to grapple with this concern that the wave of spending by memory companies could flood the market with chips, putting pressure on prices and, of course, eroding all this pricing power that they've enjoyed during this AI boom. And we end on Apple, seeing some pressure after some sell-side action, down 1.1% after KeyBank downgraded the stock to underweight, saying expectations for iPhone demand may have gotten a bit too optimistic. The firm thinks that U.S. carriers are going to pull back on subsidies, and that means fewer people upgrading their phones and less revenue for Apple services. And with its high valuation, KeyBank thinks that this dynamic makes the stock look unfavorable. The stock is up 17% year to date, outperforming the Mag 7. John?
Yahira, thank you. Thank you for the update. This line from Jamie Dimon at JP Morgan, the CEO and chair. Revenue in each line of business hit a new record. That's quite a line coming out of that bank after 2Q.
Yeah, especially given some of the monster earnings that you've already seen in revenues coming from this bank, talking about how there has been incredible strength, particularly in capital markets. Jamie Dimon goes on to say the U.S. economy has demonstrated notable resiliency this year with stronger business investment and hiring, the strength being supported by AI-driven capital investment, fiscal stimulus, and the benefits of more efficient regulations, so that sort of deregulatory push. But going on to highlight the risks, as Mr. Dimon is wont to do, including potentially sticky inflation and some other geopolitical risks that we have continued to talk about, particularly in the Middle East.
Stock is down in the pre-market by just 0.5% on JP Morgan as we get five of the biggest banks on Wall Street reporting second quarter results this morning. Wells Fargo and JP Morgan first out of the gate. Bank of America expected any minute now. Jared Cassidy of RBC writing, we remain positive on bank stocks over the next 12 months. We expect to see continued stronger loan growth, a positive yield curve, and the return of excess capital. Jared joins us now for more. Jared, welcome. This line from Jamie Dimon saying the following: results are the product of a particularly favourable environment. I think that's an important issue right now, Jared. The weather was good. Is the weather going to be good in the quarters to come?
Jonathan, you put your thumb right on it. The weather is very good. It's an environment that's very positive for the banking industry, as Jamie Dimon has pointed out. The economy remains very resilient. Loan demand is picking up. The capital market numbers that you guys have just discussed are incredibly strong. And now the real question is, what does the next couple of quarters look like? And I think it's going to remain robust. We'll see, obviously, the third quarter is a slower quarter for capital markets due to the seasonality, but you have a very strong ECM calendar still with the IPOs potentially coming this year. And then I think Jamie pointed out the regulatory environment is as good as it's going to get, Jonathan, and that's a real big tailwind for the banks.
Jared, I want to talk about the kind of bank you want exposure to right now. I've been talking about the banks as a group on the S&P trading at record highs. But within that group, you've got some real performance dispersion, so to speak. The closer you are to Wall Street, the better you are right now. The closer you are to Main Street for the stock, the more of a struggle. Jared, where's the sweet spot for you for the year ahead?
I think the sweet spot, Jonathan, is on Main Street. The large money center banks and investment banks have had a very good run, and we've been constructive on them, but the valuations are very full, and you're going to need a continued record pace, I think, for those stocks to continue to work, which we may get. But what's interesting to us is that the steepening, the loan growth, anticipated improved loan growth, a potential healthy yield curve for the banks makes Main Street maybe more attractive than it comes to the Wall Street banks or investment banks. The other thing, too, Jonathan, the year-over-year comparisons become more difficult on the investment banking numbers in the second half of this year, and certainly the first half of 27 when you compare them to the first half of 26.
I'm struck by what you're talking about, Gerard, which is that Main Street's going to have its revenge or its comeuppance with respect to Wall Street. I'm noting that at J.P. Morgan, the charge-offs were below expected at $2.37 billion versus the estimate of $2.6 billion. Wells Fargo also seeing a much lower charge-off number than previously expected. What does this tell you about the acceleration in the U.S. economy, despite some of the concerns that Jamie Dimon flagged, in particular, stickier inflation?
It's interesting because credit has been very resilient. I think investors are finally recognizing that the banking industry post-financial crisis has been de-risked. Then you had the 2023 March Madness when, of course, Silicon Valley, Signature Bank, and Republic Bank failed. And at that time, Vice Chair Barr of the Federal Reserve brought out that summer the first Basel III proposal, which was very onerous. And banks had to go on at the time what they referred to as risk-weighted asset diets, shrinking their loan books. And so the banks, I think, have underwritten their loans very well. But this resilient economy is a main reason why the credit picture is as strong as it is.
Gerard, there's a routine that J.P. Morgan goes through every single quarter that always makes me smile. You get a headline from Jamie Dimon and he talks about risks shifting below the surface like tectonic plates, and then a few minutes later they raise the outlook. And Bramo, that's just what J.P. Morgan did again.
So after raising it, then lowering it earlier this year, now they see full-year net interest income of about $105.5 billion versus the $103 billion. So superseding the previous revision that they had downgraded earlier this year that caused a sell-off in the shares, now coming out and raising it once again above where it initially had been.
Jad, I'm not trying to get in trouble, but on earnings day, is it worth listening to Jamie Dimon?
Of course it is. Gosh, he's obviously iconic and he's the real leader of the industry. And you got to parse through his words, no doubt about it. But, oh, my God, yes, he's definitely someone to listen to.
You know why I say that? Because he talks about risks every quarter and they just keep raising the outlook and raising the outlook. And they did that again this morning. Also, this line as well, Jared, let's talk about this. Full-year expense guidance boost due to higher volumes. What's going to happen with expenses in the year to come, Jared, in a world where we're talking about a backdrop of technological developments, maybe taking out labour costs?
It's interesting, Jonathan, because when you look at the expense increase, and I expect this from others as well that have investment banking and trading businesses, the numbers are very strong. And those individuals that are have incentive comp are going to see higher comp because of the stronger results, which I think is contributing to those higher expense numbers. And when it comes to AI, we're not expecting it to be a cost reduction measure just yet. It's more of a productivity enhancement tool than it is reduced costs.
Jared, it's good to see you. You're going to stick with us. Gerard Cassidy there of RBC, breaking down the numbers from J.P. Morgan. We'll hear from Bank of America in just a few minutes. The standout line there, the headline, record revenue across each business line. Bramo.
It gives you a sense of just how well things are doing on literally every single front. You asked the question, just what kind of forward visibility do we have about how long this lasts? And ultimately, that is the key question for a lot of these banks. It's clear that Jamie Dimon is worried about some of those risks that are percolating, the tectonic shifts that are occurring under the surface. Nonetheless, there have always been those worries. Key issue is it seems like things are going very strongly, and you're getting this not only from the capital markets, but also on the Main Street side.
He often likes talking about the weather, right? Storms on the horizon, hurricanes, all that stuff.
Yeah.
This was a heat wave in 2Q for investment banking, right? And capital markets.
I think that is fair to say. It is a heat wave. Question is it going to be a heat wave akin to the one that we've seen over the past couple of months, particularly over in Europe, which we hear a lot about? Or is it going to be a heat wave like the one that we're going to get this week, and then it's going to fade by the weekend?
Stock is down by 1%. Don't get burnt. Forgive me. All right, let's get Bank of America in just a moment. Before we get there, let's get to the Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. U.S. Central Command saying it completed the latest wave of strikes on military targets across Iran. President Donald Trump saying the U.S. will hit Iran hard again today. Trump telling reporters the strikes target the country's capabilities for anything having to do with Hormuz. South Carolina's governor appointing the sister of the late U.S. Senator Lindsey Graham to serve out the remainder of his term through January. Her appointment comes as Republicans prepare for an August primary to choose the party's candidate for a full 6-year term. And turning back to the banks, JP Morgan reporting second quarter sales and trading revenue that beat Wall Street estimates. CEO Jamie Dimon saying revenue in each line of business hit a new record thanks to a favourable environment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, it's a high bar for the big banks.
We're all expecting great things, right? But can the mega cap banks really exceed the mega expectations that have been put on? There's sort of a potential for earnings downgrades because of higher deposit costs versus the fantasy of the capital markets revisions continuing to go up and up and up.
Bank of America dropping right now. 2Q trading revenue, $7.16 billion. The estimate, $6.21. It's another upside surprise. We'll break down the numbers in just a moment.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
It's going to be a high bar for this earnings season for the big banks, and you can see that with JP Morgan. The stock is down by 2.25% in the pre-market following record revenue across each business line. That's JP. Bank of America out of the gate just moments ago. The stock is higher by 1/3%. Another big number for equity trading. The number is $3.62 billion. The estimate was $2.69, a record for sales and trading revenue out of Bank of America, up some 33%, a record for equities as well. Investment banking fees at Bank of America up by 50%. The number's just phenomenal. Brian Moynihan calling it an exceptional quarter for our markets-facing business.
Yeah, ultimately riding the same tailwinds that we've seen from all the other banks, talking about how trading revenue ex-DVA was at $7.16 billion versus a $6.2 billion number. So really beating across the board, not just in the equities business, but also FICC, which we saw was a little bit different over at JP Morgan. Key questions here, as we've talked about, how big is the pipeline going forward? Is this as good as it gets, or is there some more under the hood? Also, are people going to start comparing which bank executed best, who is grabbing share under the surface? And that, I think, is what's going to be scrutinized after this.
The difference between the environment, a good one, and execution, we'll try and make that distinction throughout the next 24 hours. Looking at the banks then, Bank of America up by 0.8%, JP Morgan down by close to 2%. Under surveillance this morning, it's a high bar for the big banks.
We're all expecting great things, right? But can the mega cap banks really exceed the mega expectations that have been put on? It's going to be difficult to stand out. There's sort of a potential for earnings downgrades because of higher deposit costs versus the fantasy of the capital markets revisions continuing to go up and up and up.
So here's the latest this morning. Wells Fargo, JP Morgan, Bank of America kicking off a blockbuster day for earnings. Results from Goldman and Citi during the next hour or so. Gerard Cassidy of RBC has been standing by, working through the numbers. Gerard, welcome to the programme. Welcome back, I should say. Let's get back to this. The numbers from Bank of America just moments ago. Really good numbers. Records in some places. The name is up by some 1%. Lisa's asked the question. We heard from Erica Najarian of UBS just yesterday. The bar is so high, Gerard. Is this as good as it gets for some of these bank stocks?
That is the $64,000 question, Jonathan, is how much has been priced into these stocks? And when you're trading at 3 times tangible or over 3 times tangible book value, in the case of JP Morgan, there's quite a bit of optimism priced in there as well for Goldman Sachs and Morgan Stanley. Bank of America, on the other hand, doesn't trade as high as those multiples. Obviously, it doesn't have the profitability yet of those companies, so there might be more upside there in the Bank of America number. But that, it's a hard determination of what's priced in, and that's the valuation call that investors have to make. And just like art, it's in the eye of the beholder whether the stocks look cheap or not when you compare them to the non-banks in, the Mag 7 or any of the semiconductor stocks.
How do you determine, Gerard, what is execution versus riding the tailwinds of the overall economy?
Riding the tailwinds of the overall economy, and in particular the capital markets, is a huge impact on everybody's numbers this morning. And you saw it in 2021 when you take a look at the numbers that banks put up back then. When you remember the SPAC IPOs were very strong. And then when that fell off in 2022, revenues fell, in some cases, in investment banking by 50%. So a good portion of what we see today, of course, is market dependent. But execution is also important. And the big players have the economies of scale, and they're gaining market share, as evidenced by some of these numbers.
I'm looking right now, JP Morgan shares are falling after looking at or at least some people are attributing it to the full year adjusted expenses of about $107.5 billion versus the expectation of $105 billion. Bank of America second quarter compensation came out a little bit below expectations. I'm just wondering how you view compensation expenses in the scheme of overall performance. Does it matter to you, or is this just an excuse to sell really highly priced shares?
It may be more the latter, Lisa, because we're more focused on positive operating leverage than the actual expense number. And what I mean by that is, if revenue growth, the rate of growth, exceeds the rate of growth of expenses, that's what you want to see, because that leverage drives better earnings per share growth. And as a result, yes, you'd like to see expenses kept in check. But if you're growing revenues in incentive comp type businesses, where the folks that drive those revenues will be incentivized with higher compensation, then of course you want to see those expenses rise, because that means revenue is rising. But positive operating leverage takes precedent, trumps, if you will, the actual level of expense growth, in our view, at least.
And Gerard, that's the story at Bank of America this morning. 15% revenue growth, 8% expense growth. Operating leverage is improving and has been over the past few quarters, Gerard. That's a key goal, I think, for Brian Moynihan and the team. Gerard, are you expecting to see more of the same?
Absolutely. That is a key goal for Brian and his team at Bank America. It is positive operating leverage. They've been consistently delivering on that, and their focus going forward will be to continue to do that, as with many other banks. So we anticipate to see positive operating leverage throughout this quarter, and certainly Bank America delivered on that today.
From here, we've got the pure capital markets play, Jared. We'll be talking about Goldman Sachs in about 30 minutes or so. Tomorrow, another pure play, the likes of Morgan Stanley. Execution, this is something that Lisa was talking about. Environment's great, but let's talk about execution. What's the difference between a Morgan Stanley and a Goldman Sachs right now, Gerard?
The difference between the two, Jonathan, is primarily the wealth management businesses at Morgan Stanley may give it more stability and revenue growth through the full cycle. Goldman Sachs is not there yet. That's one of their priorities, is to build out their wealth management revenues, and they're working on that now. So that's the primary difference between the two. They are both premier investment banks and trading firms, but wealth management really stands out for Morgan Stanley as the differentiating factor between them and Goldman Sachs.
Gerard, it's early days. We haven't gotten Goldman Sachs. We haven't gotten Morgan Stanley. But so far, who's winning earnings?
I would say today, when you look at the numbers across the board, they were all very good. The JP Morgan numbers were quite extraordinary. So if you had to rank them, probably JP Morgan, Bank America, Wells, but they're all good. So I don't know if you could get 3 gold medals, but so far they're all good.
Jared, it's good to see you. Thank you, buddy. Gerard Cassidy there of RBC. Let's just stay on that board and look at the pre-market price action right now. The likes of JP Morgan trading a bit softer following the numbers. You saw a decent pop for Bank of America. That name is up by close to 2%. Wells Fargo doing nicely as well, up by 1.5. Going through these numbers, where do you want to be? You want to be in equity sales and trading, don't you?
Obviously.
After a quarter like that.
I mean,
right?
You're just going to get paid. That's your compensation increase. That comes from those equity traders
goodness,
that absolutely knocked it out of the park.
Those numbers are wild.
They're bonkers.
They're crazy, right?
It gives you a sense of how well Wall Street is doing and how much you're seeing some of these IPO shares prices and some of the volatility really underpinning some of these results. On the Main Street side, I know we're kind of glossing over Wells Fargo, which, as Erica Najarian was saying, has sort of been left for dead. But the commentary from the CEO is really interesting. Consumer spending is higher, charge-offs and delinquencies are lower, and savings and investments are growing. Going on to say concerns around affordability and inflation exist, but the labor market and wage growth remain strong. So we're getting the read on Wall Street from a lot of these banks. Heading to CPI and then Kevin Warsh. What's going on Main Street? Well, the read there is pretty positive as well. And that, I think, will have a longer storyline throughout the day.
This is part of the conversation, Lisa. I'm right there with you. The next phase of the bank's trade, it's been about the pure capital markets play amongst the big players on Wall Street. Do you get something that shifts back towards Main Street in the months to come? Bank of America up by, let's call it 0.75% this morning. JP Morgan trading softer. It's down by 2%. Coming up next, we'll catch up with Vinod Krishna of Barclays. We'll speak to Henrietta Trays of Vader Partners. Chris Marinac of Breen Capital joining us to break down the latest numbers from the big banks. And we'll catch up with the former New York Fed President Bill Dudley. Looking forward to catching up with Bill following some very, very punchy comments from Governor Waller ahead of the Fed's next meeting, putting a lot of weight on the importance of the next read on inflation. CPI dropping at 8:30. Eastern Time. From New York City this morning, good morning. The second hour of Bloomberg Surveillance. Up next.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
I really don't see a case for hikes anywhere.
I don't think there is a strong argument right now among Fed officials for cutting rates.
Now, frankly, the U.S. has too much inflation and everybody can see it.
From an inflation perspective, there are definitely some tailwinds and there's some headwinds. We have a problem if the CPI number's hot.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price section of scores look like this. The bank story, so far so good. Equities negative by 0.1% on the Nasdaq. Tech bounces back up by 0.5. New numbers on the bond board. Twos very close to 430. Tens through 460. 30s of 5.1% going into CPI later this morning. In focus following this move in crude. WTI and Brent this morning higher across the board, higher by close to 5% on Brent and closing back in on 90. 87.30 so far this morning. CPI 90 minutes away. Before we get there, numbers from Goldman Sachs rounding out quite a quarter, with Goldman Sachs and Citi on deck in the next 60 minutes or so. This is what we've seen so far. JP Morgan, according to Jamie Dimon, the CEO, a record in every single business line, a record for revenue. We saw more records over at Bank of America, and the trade, the stocks are a little softer off the back of this. They met a very, very high bar.
Yeah, and this is a question of who's expensive heading into this and where are the opportunities. And you could see that in the price action. Wells Fargo had been beaten up, and you'd seen JP Morgan lag behind just because the price to book had been so high. Bank of America with a similar type of trend. When you take a look at the actual earnings, though, in the rhetoric, this is Wall Street going gangbusters with respect to the IPOs, with respect to equity trading and sales and revenues. This is also Main Street doing incredibly well with charge-offs diminishing. And the sense, I keep going back to this Wells Fargo commentary, consumer spending is higher, charge-offs and delinquencies are lower, and savings and investment are growing. Even in the face of headwinds, the consumer continues to come up from behind alongside an absolutely red-hot capital market.
So how well priced are we for this story? And that's the earnings risk coming into quarterly earnings season. The bar was high. How much do you need to beat it by to squeeze out a little bit more of a rally in the stock? Bring up the board again and look at JP Morgan and Bank of America. Big upside surprises across several business lines there, including over at JP Morgan with this on the equity sales and trading revenue side of things. $6 billion against an estimate of just below 4 is a major upside surprise, and yet we trade softer. Look, I know it's early days, and I don't know where the stock will be in 5 minutes from now, never mind by the close, by later on this afternoon. But this will be a question for many people going through earnings season. We always say it on this programme. You can learn something from the data. You can learn something more from how the market responds to it, and that's going to be a key test for the next few months.
If this market was perfectly priced, these earnings were even more perfectly delivered, and yet that still wasn't enough. Does that give you a sense of how perfectly priced everything else is, or is this a specific story where people are unpacking expenses or any kind of excuse to sell? If that is your biggest excuse to sell the shares, then ultimately you are looking for a reason to buy on the rumor and sell on the news. Is this perhaps the foreshadowing for the rest of earnings season?
This is the early move. We'll see if it sticks, but JP Morgan's trading softer by more than 2% this morning. Want to turn back to crude. Got a big move on Brent, up by close to 5%, $87 a barrel on Brent crude. WTI through $80 a barrel a little bit earlier on this morning, and it holds at 81. The tension in the Middle East unresolved, and another potentially unworkable suggestion coming from the White House.
Not just unresolved, but you see actually more escalation overnight. You see the Iranians go after UAE vessels. You see the Houthis actually strike a Saudi airport. And the President of the United States saying the blockade is coming back on. That will go into effect today. And at the same time, even though they took issue, clearly, with the Iranians trying to charge a toll to go through the Strait of Hormuz safely, now this administration is demanding a 20% reimbursement for what they say is protecting all this cargo. But you keep bringing up the great point. They haven't really been able to demonstrate they can protect every vessel because we are at this point. If you go through the U.S. protected route that hugs the Omani coast, well, you're a target of the IRGC.
That's the latest out of the Middle East. That's a wrinkle for this market story. Here's another one. This from IBM, just moments ago. We were looking at the banks earlier, just a few moments ago, and we were talking about beating but not beating by enough to generate a rally. This is not the quarter where you want to miss. Second quarter revenue, $17.2 billion. The estimate, $17.86. The stock plunging. Lisa, by close to 15%.
Yeah, the IBM CEO coming out and saying what played out was worse than our expectations, saying this was an execution problem, saying in the last few weeks of June, we saw clients shift their quarterly CapEx spend towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of expected price increases. So this is the hoarding that we were talking about. This dynamic impacted client buying powers. While we anticipated some supply chain-related impact in our expectations, we did not anticipate the magnitude of what actually happened. And this ultimately is what happened, that CapEx differential of where people were spending. Again, it just highlights how quickly moving this is and how much people are underappreciating the speed in which the tech story really is shifting.
Numerous large deals failed to close on time. That stock is down by close to 15%. Coming up this hour, we'll catch up with Venu Krishna of Barclays, heading into an action-packed day on Wall Street. We'll speak to Henrietta Trays of Veda Partners following a renewed blockade on the Strait of Hormuz. And we'll catch up with the former New York Fed President Bill Dudley with Kevin Walsh heading to Capitol Hill. We begin this hour with stocks eyeing a rebound as the big banks meet the high revenue bar set by Wall Street. Venu Krishna of Barclays writing, we remain constructive on equities and would view any near-term positioning unwind as a buying opportunity. Venu joins us now for more. Venu, good morning.
Good morning.
It's good to see you. Let's talk about how high that bar is for this earnings season based on the evidence so far this morning.
If you saw our recent upgrade of our price target, we're seeing this upside, but the upside is limited because we've had the bunch of the upside already realized. And unfortunately, now we've entered a new regime where the macro risks have escalated. Oil is up, interest rate uncertainty is already there, so that is also going the wrong direction. Inflation is sticky, that's a problem. And within the AI narrative, there's been a shift. The most crowded trade was out of hyperscalers, out of big tech into semis. Now that's also being tested. So I think overall, though, if I think about why we are optimistic about equities, it is simply the power of earnings is too strong for the next, call it 18 months, because we do have visibility on that capital spending, because the folks who are spending have the earnings, the operating cash flows, and access to liquidity between credit, equity, and convertible bond markets. And that is sustaining a broader ecosystem of earnings.
3 months ago, that story wasn't well understood. Clear evidence for that. We had to price a positive earnings shock in this market really quickly. Earnings expectations kept climbing going into this earnings season. Is that story well understood and well priced now?
I think it is reasonably well priced. If you're seeing what's happening to multiples, they have been steadily declining. And now on top of that, to add a little bit more fuel to the fire on multiples, 10-year rates are back, over 4.6%. And we just about, call it a few weeks ago, we were in the 435, 440 handle. But what I would say is in this earnings season, what you're likely to see is a repeat of what you saw last quarter, which is if companies are beating their numbers, the reaction is muted. But if you miss, it's a punch on the downside. And I think it just tells you that the amount of idiosyncratic risk in the market is tremendous. We have noted on the derivative side that most of the volatility now is squeezed into earnings season. So that concept of earnings drift, where the market absorbs information and stocks eventually react to the earnings information, is pretty much gone. It's all packed into that one particular day and that one particular event. So this is a highly sort of dispersion-driven sort of market, where correlations are at historic lows, return dispersions are at historic highs, which means that this is an idiosyncratic market.
This is a forward pricing market. They're trying to look into the future and gauge exactly how much these earnings can continue. We've been talking about all morning how it's very difficult to get a read of how hot the capital markets will remain for the rest of the year. The IBM story really highlights how quickly this is shifting. It seems like underpinning this are the hints of Mythos and some of the concerns that came out with Fable and some of the other innovations that concerned cybersecurity experts in a dramatic fashion. How much can you get forward visibility from any of these companies when the C-suite tells you they have no idea where it's going, how fast it's moving, and how quickly their businesses are shifting?
I think your point is well taken, and that is consistent with the fact that we've entered this whole disruption phase of the AI story, where there'll be winners and losers, and we don't know which business models are adopting well and which are the new AI native businesses. If you look at the IBM number, from what I understood, based on what you just reported, the miss was marginal. Right? But it's just that the expectations are so high and the market is just punishing even marginal misses. That's what we have seen. But going back to your question of how much, we do have visibility. And that visibility is being driven by the dollar amount of capital spending. And that capital spending is funded, and which means all the beneficiaries of dollars are doing well. So what you need to care about is, are you overpaying on the beneficiary side? And are you underpaying for the strength of earnings stability for the guys who are spending, who are still posting well over 30% earnings growth? And so that is a setup. And that's why, we are still broadly constructive in technology, but you have to recognize, like I said, that this is a very, very idiosyncratic market. So this is not about making a tech call, but about mini and micro themes and individual stocks is the way to go.
Putting aside IBM for a second and just looking at the bank earnings, what's the argument, just looking at those, for a Federal Reserve not to hike interest rates?
It's a tough one. The biggest argument is that this inflation we are seeing is going to eventually start tapering off, by early part of next year, which seems to be at least certainly even our house call. But the problem is that if inflation remains sticky and if these Middle Eastern crisis again crops up and goes the wrong direction, and by the way, if it does, that is breaking the tradition of the last 3 decades of geopolitical risk, where generally speaking, it's been geographically contained and/or it's been resolved in a reasonable period of time. Not so it appears in this situation. So I think rates market already showing that uncertainty. Like I said, 10 years are up almost 25 basis points just in the last few weeks. And the higher the head, and I've said in the past, 5% is a critical threshold for equities. There's a very clear negative correlation empirically over a long period of time between 10-year rates going up and equities going down. And I think we're seeing that in multiples moderating. So it's not just rates and increased macro risk, but it's also the fact that the AI narrative has made people uncomfortable because the sheer amount of dollars spent is enormous. And so the market is sort of waiting to, that's why, and saying that the folks who are spending, even though they have earnings, we don't know what the returns are going to be. We don't know if this is going to be a permanently capital-intensive business or how long this continues. There's no line of sight on that. But we might as well benefit the players who are getting those dollars. But that is also, again, being tested now.
Venu, it's good to see you. It always is. It's a real test for this market this morning. Venu Krishna of Barclays. This is not the quarter where you want to miss. Captured by IBM this morning, trading lower by more than 17% in the pre-market. Let's bring up the stock and then look at how this bleeds across the sector. IBM's down 17. This is sparking a rout across software. SAP over in Europe, ServiceNow here in the United States. Those names all struggling, Pramo, off the back of this.
Yeah, because it wasn't just a question of IBM not exactly executing in certain ways. This was an overall read on a distracted business sector that was trying to plug any demands from cybersecurity. Again, we talked about Mythos. We talked about concerns as that was shut down by the U.S. government on behalf of a lot of companies that said, hold on a second, we've got a lot of holes that we're finding, and we could be really vulnerable. Also, a question of hoarding. How much are people trying to get ahead of the price increases from the chip sector and avoiding the software side of things? Again, is this a read on the SaaScopolis, or is this a read on the prioritization of hardware ahead of whatever is to come?
IBM, a miss on revenue. The stock is getting hammered in the pre-market. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Well, even beating doesn't guarantee you a bump these days. Bank of America and JP Morgan both lower in the pre-market, but both reported second quarter results that beat Wall Street estimates. B of A results are led by a surge in equities trading and also a deal-making resurgence. JP Morgan reported its highest quarterly profit ever, with CEO Jamie Dimon saying revenue in each line of its business hit a new record. He did add several risks are shifting below the surface like tectonic plates. As you were saying, IBM shares tumbling. The company reported preliminary second quarter results that missed street estimates. IBM CEO Arvind Krishna saying clients were distracted by cybersecurity concerns and numerous large deals failed to close on time. In sports, France and Spain face off in the first of two World Cup semi-finals at 3 p.m. Eastern in Arlington, Texas. Tomorrow, Argentina plays England in Atlanta. The winners of each game will face off in Sunday's final in East Rutherford, New Jersey. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. More from Vonnie later this morning. Up next on the programme, reinstating the blockade.
We're putting the blockade back. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up discontrolling the whole thing.
Henrietta Trays of Veda Partners joins us next, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Equities, futures, doing not much at all. It looks like a snooze. Equity futures down by about 1/10. On the S&P, on the Nasdaq, up by 0.5, away from the index. This is anything but a snooze this morning. Check out the banks first. Record numbers over at JP Morgan across every business line, according to Jamie Dimon. On revenue, the stock is down 2.5%. Bank of America, a record for sales and trading revenue. The stock is up by not even 0.1%. Beats this morning are not being rewarded. Misses are being absolutely punished and some. Check out IBM. IBM with a miss. The stock is down by close to 18%. And that miss on IBM sparking this move on other software names. You can see it across Microsoft, ServiceNow, others. Microsoft this morning down by 3 or 4 percentage points, Bramo. The last time I looked. Pretty ugly stuff.
Yeah, a real question around what software names are going to do given the shifting priorities and the rapidly shifting priorities away from software, unless it's related to security, and potentially toward the hardware, because that is where the focus was. IBM CEO talking about the inability to close some large deals, in part because people were front-loading purchases of memory chips and other software. And again, you keep wondering how disruptive is the likes of Mythos, of Fable, to really reignite a race into cybersecurity.
We're just 5 minutes into this, so I don't want to make too much of it. Things can change as the earnings season grows a little bit older, but the early takeaway, and we'll see if it's premature, but the early takeaway is this bar was very high. Beating it's not enough. You've got to absolutely smash expectations and some to generate a stock move. Based on what we've seen so far this morning, that can change. I'm open to that changing. But so far, what we've seen this morning, you miss, you get battered, you beat, you don't get rewarded.
If people get a sense that there is any weakness, there is an existential fear hovering over a lot of these earnings at a time of rapid shift. And I just wonder how much forward guidance we're actually going to get from any of these banks, let alone other companies, given the lack of visibility into the pace of change.
Goldman Sachs, the next bank, set to report in the next 10 minutes or so. We'll get to that. I need to talk about this as well. We do. Crude at 4% on Brent. $87 a barrel this morning. Under surveillance this morning, reinstating the blockade.
We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing. We're controlling the Straits. We're putting the blockade back. I want to be reimbursed because we're protecting a very rich portion of the world.
So here's the latest this morning. The president declaring the U.S. the guardian of the Strait of Hormuz, reimposing a naval blockade on Iranian ships and proposing a 20% fee for all other cargo shipped through the passageway. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, these moves threaten to escalate tensions further and, of course, change the economics of shipping energy through the strait. We haven't gotten further details from the White House on the president's proposal for this 20% reimbursement, though it could mean that some of the largest oil tankers would be on the hook for paying more than $30 million per trip. The administration isn't calling this a toll. They're calling it a reimbursement, though I will point out that back in April, when Iran was really pushing the idea of a toll, the Wall Street Journal did an analysis that found that Gulf states would be on the hook for paying nearly 80 to 95% of the total costs. It's unclear at this point if the Trump administration has been in touch with regional allies about the idea, as they are taking the brunt of Iran's retaliation. Overnight, the UAE's defense ministry confirmed that 2 of the country's tankers were hit by Iranian cruise missiles amid the latest wave of attacks by the U.S. designed to degrade Iran's ability to attack commercial shipping. And John, we're not just watching for reaction in the region. New this morning, we're hearing from China urging a reopening of the Strait of Hormuz. China's foreign ministry saying that they are, quote, deeply concerned ahead of the U.S. moving forward with this blockade today at 4 p.m. Eastern.
Tyler Kendall with the latest. Tyler, thank you. To build on this, Henrietta Trace of Vader Partners writing, the president's newly proposed 20% reimbursement fee he intends to charge and the renewal of the blockade of the Strait of Hormuz creates far more questions than the White House has answers for. Henrietta joins us now for more. Henrietta, welcome to the show. What's your number one question this morning?
Well, I think the reimbursement fee is more of a distraction. So my real question is, how exactly do you plan to get flow through the straits again? We need the EU and the UK involved in anti-mining efforts. We obviously have a renewed escalation on the military front. What is the objective and the goal here? And you and I have talked for months now about how the Ayatollah, in my opinion, is the most important dynamic in this entire war. We know what the nuclear file is going to look like. The president gave away the ballistic missile component. What we really need to resolve is this idea of taxation of the strait. Tax policy is extraordinarily complicated. It impacts every single Western corporation and country, whether you're an insurer or a bank or a tanker. You're going to have to deal with the IRGC, and that is just unsustainable. So I don't really care what the president is talking about on the reimbursement fee side here in the United States. I don't think that will hold. The margins are too high in terms of what he's asking for. I think it really needs to be resolved how Iran is going to be kept off of its idea of a port authority.
When it comes, though, to the Strait of Hormuz, and you think potentially this 20% reimbursement is a distraction, is it maybe a carrot and stick to try to get the Europeans and NATO to actually go support the United States in the Strait of Hormuz and defend it?
Yeah, absolutely, Emery. That's what they were talking about at NATO in Turkey. The idea that specifically France and the UK need to get in there and help with the anti-mining components is something that I've heard from military brass since the war started, and their abilities, their capabilities, and their desire to get a larger conglomerate of NATO allies in there with them. So not just the two nations, but maybe 20, 30 different nations to have a real sizable component. Now, what they have said in the past is we need some sort of permanent ceasefire that we can really trust before we'll send huge swaths of our military in to help the United States with this region and to secure peace. We're not there. We do not have peacetime. We do not have a ceasefire, even a 10-year.
Support this?
I would say the better way to say that is that they won't oppose it. So there will be renewed fights about how to give the president war powers and whether or not we should strip them back. That's what Democrats and Republicans in the Senate have voted on several times, and it's passed. And you've seen that the president has a real problem with the Republicans who cross the aisle and vote to rein in his war powers. That was with Senator Senator Cassidy and Senator Rand Paul just a few weeks ago. The president wants them not to get in the way. And so far, the senators have been accommodating. They're going to be distracted with the third reconciliation effort. And I think that will keep them off of major opposition to the president's war.
Just very quickly, who fills the Lindsey Graham void that did a lot of this fixing?
It's going to need to be a lot of people. I mean, his reach is across the Budget Committee, about this across the State and Foreign Operations Appropriations Committee, Judiciary. Should we get any kind of new nominations to the Supreme Court, you're going to have a lot of people step in to fill his shoes.
Henrietta, it's good to see you, as always. Henrietta Trace there, Aveda Partners, on the latest as we wrap up that conversation. Goldman drops. Fixed sales and trading revenue, $4.59 billion. The estimate, $3.76. That's where all the revenue went in FIC then. Second quarter equity sales and trading revenue came in at $7.42 billion. The estimate was $5 billion. I'll go through that number again, OK? $7.42 billion for equity sales and trading revenue. The estimate was just north of 5. That's another monster upside surprise.
They knocked it out of the park in pretty much every capacity that you could possibly imagine. The idea that you could see equities revenue coming in more than $2 billion, $2.4 billion beat. I think it's interesting when you take a look at some of the commentary coming from Goldman Sachs CEO, then you can see he sees this continuing. We expect this flywheel of activity to continue. Look for the forward look, because that ultimately will give you the true guide.
You need to smash it this morning. Goldman just did. The stock is up by 2.4%. Chris Marinac of Breen Capital joins us next.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Goldman, just reporting earnings. Check out the stock. The stock is up by just 0.9% after absolutely smashing estimates, which seems to be the story so far this morning. That beats are not being rewarded and misses are being punished. And we'll get into that in just a moment. But let's start with Goldman. Second quarter equity sales and trading revenue, $7.42 billion. The estimate was $5.02 billion. That is not just a record for Goldman. That is a Wall Street record. Goldman Sachs FICC sales and trading revenue $4.59 billion, the estimate $3.76. Wherever you look, you're seeing some major upside surprises.
Yeah, the firm's second quarter results are the third consecutive quarter in which the firm's equities unit has set an all-time record for any bank. Just to put this into perspective, I mean, this has been a bonanza for now 3 consecutive quarters. The magnitude of the beats is pretty notable, which is the reason why, even in the face of a skeptical market that is punishing other names for beating, they are rewarding this name. That is how big of a surprise this actually is.
And that's the reward, Bramo, 2%. Right, isn't that the story? Like, you get 2%. For smashing estimates, you get a 2% rally. And let's see if it holds. But that's what you're getting so far. Over at IBM, and we'll talk about that a little bit later, you miss, you get absolutely hammered. You lose a fifth of your value if you're a tech stock right now. That's a massive problem.
This is a market that has such high expectations and is so skeptical of getting beat that even incredible earnings from Goldman Sachs, but also the promise of more to come. I mean, again, you're asking the question. We've been asking the question all morning. What about the forward look? How long can this last? Is this as good as it gets? What we're seeing from Goldman Sachs, the chief executive officer, David Solomon, given what we see in our pipelines, we expect this flywheel of activity to continue. In other words, saying that there is more runway here. Nonetheless, you still see that skepticism percolating other places.
The capital markets business has been absolutely flying. The business has been doing tremendously well. It's why the likes of Goldman and Morgan Stanley have been rallying so hard. That's the latest on the banks this morning. Let's get to the others, including IBM. That stock is down by 19%. With more, with your morning movers, Yahira has that. Hey, Yahira.
Hi, John. We start with the big banks delivering blockbuster results, but that is not enough after a rally that's pushed many of those to record highs. JP Morgan, you just went through Goldman's numbers, which were astonishing, record-breaking. JP Morgan also posted a record $6 billion in equities trading. Bank of America and Wells Fargo also benefited from stronger trading and investment banking, underscoring how busy it's been for Wall Street with deal making and equity issuance on pace for the strongest performance in recent years. Turning to bank earnings, also highlighting, as I said, how strong capital markets have been, and that is seen through SK Hynix. Of course, it had the largest equity sale by a foreign company in U.S. history. Its shares bouncing back this morning, up nearly 7% after falling 9% yesterday. And we end on IBM, the name that we've all been looking at, down nearly 20% in the pre-market. The company says customers shifted spending late in the quarter, pulling money away from software as they prioritize the AI build-out, spending more on those pricey servers and memory needed to power that adds to concerns in the software sector, which had already been struggling over concerns about relevance in the AI age. And now this just adds to another worry for software. John?
Yara, thank you. Thanks for the update. That right there, that stock, that's a big warning to the tech story for the next month or so. Do not miss this quarter.
And it
Not good.
It wasn't a huge miss. I mean, again, this is really, we're talking about less than $1 billion and 17-some billion dollars of revenue. That was still enough to torpedo the name, at least in pre-market trading and the entire sector, because of the existential fear of how quickly this market is moving. And I think that that is the underpinning here. The idea that all of the spend could go away from software to hardware in one quarter and avoid really consolidating deals. Again, it just shows what potentially could be the risk.
I think by some measure, Goldman's beat on equity sales and trading revenue was larger than the miss over at IBM.
Oh, significantly more.
Right?
Oh, yeah, it was less than $1 billion in terms of the miss at IBM, and the beat over at Goldman Sachs on just the equities trading was almost $2.5 billion. So it gives you a sense of what we're talking about here.
Goldman Sachs this morning up by 2% in the pre-market. Let's turn back to the big banks. 5 of them reporting second quarter results this morning. Goldman, the latest cross in the wire. Chris Marinak of Breen Capital joins us now for more. Chris, you've had a few moments to gather your thoughts on this one. What's your reaction to these record numbers out of Goldman Sachs?
Well, John, I think there's more to continue. I wouldn't be surprised if we have another really good quarter in Q3. And I think as the point was made in the release, the runway is still very good for additional earnings. And I think that applies to other banks besides Goldman.
How well priced do you think we are for that story, based on the reaction we've seen to the numbers so far this morning?
So I think the marketplace may temporarily sell the news, but I still think people will come back to these stocks. They're not expensive on 27 earnings, and I think the attitude towards 27 should be more bullish, and I think estimates can rise for next year. Plus, I think the second half of this year will still be quite good. So I think estimate increases are going to drag stocks higher.
At a certain point, though, Chris, do you think that expenses are going to sort of be the weight on these names? We see that as the excuse being used for the JP Morgan share decline so far this morning.
I think credit costs are a piece of the expense puzzle. So if you look at overhead, you're correct. But I also think if you think about credit costs, they actually beat on provision expense and charge-offs. And I think that credit theme being positive is a huge factor in favor of these companies.
If you think that there's more to come, and that certainly seems to be what David Solomon is indicating in his commentary in the letter ahead of earnings, what is the argument here for the economy slowing down and, frankly, for the Fed not to hike rates?
Well, I think the banks are taking share, number one. I also think the way the curve is acting favors the way banks are positioned. There still is a refinancing of loans for many mid-sized companies from 2022 and 21 that is going to benefit net interest income and margin the second half of the year. I still think overall volumes are going to be consistently good. And then you layer in the operating leverage in the space plus low credit costs, that continues to factor into very good earnings. And then let's not forget the capital build that is in the space. And ultimately, that's going to lead to more buybacks and I think greater investor confidence, which gets back to the PE expanding.
This is the kind of economic activity that these banks can leverage. This is the kind of capital markets activity that these banks love. And, Chris, we've seen that through the pure plays, the likes of Morgan Stanley, the likes of Goldman Sachs. Those stocks have been absolutely flying. Chris, let's talk about is an area of this market that you know well. It's the regionals. The regionals are up by close to 18% so far year to date. That's outperformed many a big bank on Wall Street, with the exception of Morgan Stanley and Goldman Sachs. Chris, what's providing the regionals with this kind of tailwind right now? And away from capital markets and that business, is that set to continue?
I think it is because there's regulatory relief, John, and I think ultimately the way that the Fed and OCC has teed up the industry, there is a window for expansion in the space. I think you will see more M&A. I also think the companies themselves are getting this capital relief and I think a better regulatory attitude that ultimately leads to better earnings, a little bit less regulatory spend than what they were spending a few years ago. And ultimately, it weaves back into higher confidence about the earnings.
So, Chris, when we see these consumer sentiment numbers and they are rock bottom, they are absolutely awful. And I understand why. I respect it. The accumulation of problems when it comes to prices and inflation. And we'll see CPI again in the next hour or so. Are you saying that you're seeing activity that corresponds with a pickup in loan demand across small and medium-sized businesses, consumer demand as well, that's going to provide gains for these guys?
Yes, and I think historically, if you go back to the 80s, John, when we had early 80s inflation, the banking system had more credit and expansion of credit was definitely a theme. You can go back to the old Berkshire Hathaway annual reports to confirm that. I do think you're going to see better credit demand. The Fed H8 data has been rising in recent weeks. So I think this quarter is a trigger point towards a higher second half on loans.
Chris, you keep saying that this is a good regulatory environment, a really good one. And I wonder, when you say gaining share, if the banking sector is winning back business from private asset management firms that had been eating their lunch.
Yes, I think that's true. And I think we see a little bit this quarter, and I think we'll see a lot more of it the next 3 to 4 quarters.
Which bank do you think is poised to benefit the most from that share consolidation?
Well, certainly the regional banks who have lost a little bit of business and have been trying to fight back. So that goes back to Fifth Third. It also goes back to PNC and Truist, those who are still reporting as the week goes on. But I think to some extent the national players at B of A and JPM should benefit, and Wells as well. So I don't think it's just related to the regionals. I think it is a large cap bank, systemic benefit.
Is the read here that ultimately the economy isn't just solid, but that it seems to be reaccelerating? And I say this based on the fact that loan loss provisions have come down, that there is the expectation for this to continue even in the face of inflation and rates that potentially are going to stay where they are or go higher?
I think that's true, and I think there's a lot of regular way activity that the banks see. So we've talked so much about AI in recent quarters that the non-AI spend is still there. It may not be as big, but it is still positive. And I think the banks are picking up more of that. I also think there's been less distractions this year because you haven't had any problems in the banking system to kind of distract investors. That's part of my thesis, that you could see earnings get better, demand better, and also multiples expand on the 27 estimates.
Hey, Chris, it's good to see you. I know you're going to stick around. Stay close because we'll get Citi in the next 20 minutes or so. Chris Marinac there of Bring Capital. Check out Goldman. Let's bring it up. Look at the stock move. So they've just smashed estimates this morning. Knocked it out of the park when it comes to equity sales and trading revenue. And that stock is up by just 1.4%. Call it 2% higher so far this morning. If you're looking at Goldman on the year at the moment, higher by 20% year to date. Morgan Stanley up by 24, call it 25% higher. The market was anticipating a lot of this. Where there's pushback right now, the bar is high. And if you beat, you don't get a massive reward. But if you miss, you get obliterated. That's the story of the last 60 minutes.
Yeah, particularly when it comes to tech. And ultimately, the banking story is one of an entire market that is really performing well. On the flip side, there are some real fundamental questions about shifts under the tech sector, which we keep talking about with IBM. But with Goldman Sachs, watch this space, especially for the commentary. How much do other banks reflect that commentary? Also, what Chris was just saying there, these banks are all winning back market share from the asset managers like Apollo and KKR and others that have eaten their lunch over the past few years because the regulatory environment has gotten more favorable to them. How much will that be their gain at someone else's pain versus an entire market that is just heading in one direction?
Regionals have had a nice run. We talked about it, up by close to 20% so far year to date. Let's get you a wrap up of all the news right now. Let's get to your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The White House saying President Donald Trump will support one of Senator Lindsey Graham's last major legislative efforts before he died, a new sanctions bill on Russia. The bill would impose so-called secondary tariffs as high as 500% on countries that bought Russian oil or natural gas. Chinese AI startup DeepSeek is considering a fresh round of fundraising. The Financial Times reporting the company is in talks with investors for a round that would value it at $71 billion. DeepSeek completed its first funding round at the end of May. And recapping this morning's big bank earnings, Goldman Sachs beating its own stock trading record, posting a $7.4 billion haul for the second quarter. JP Morgan also reporting its highest quarterly profit on record. And Bank of America seeing a surge in equities trading and a major pickup in deal making. That is your Bloomberg brief. John.
Phenomenal numbers. Bonnie, thank you. When it comes to equity sales and trading numbers, we're talking about a pickup of 70% plus at Bank of America and Goldman Sachs compared to last year. Tremendous spike.
I believe it's more than 80% over at JP Morgan in terms of the gain quarter over quarter, year over year. So it just gives you a sense of the momentum. The fact that you can get record after record after record. Again, how long can this last? It seems like just a little bit longer.
Jane Fraser and Citi, over to you. 20 minutes away. Up next on the program, the case for hiking rates.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term.
Governor Waller getting people talking about a live meeting in a few weeks' time. We'll catch up with the former New York Fed President Bill Dudley. He joins us next.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're down a tenth. Go back to bed. Switch off the alarm. Nothing's happening here. Equity futures right now down by 0.1% on the S&P. On the Nasdaq up by 0.5%. That's not the story at the index level. The single name and sector level story is really quite remarkable so far today. It's an early test for earnings season, a very early test, but it's a test nevertheless. Check out the banks. Banks knocking it out of the park this morning. Goldman crushing estimates. Goldman's only up by 1%. JP's down by 2%. Bank of America's down by 1.7%. JP Morgan, as they pointed out this morning, record revenue across every single unit, business line, according to the JP Morgan boss, Jamie Dimon. I got a message from a Bloomberg subscriber just moments ago. If this is the reward for that Goldman number, it tells you a lot about market positioning right now. Goldman Sachs only up by 1.3%.
Yeah, this is redefining the idea of price to perfection as something that is so perfect that we could hardly imagine it, because the expectations out there truly were shattered, particularly by Goldman Sachs, and the shares not moving that significantly. How much does this speak to a general mood right now where people are just generally skeptical versus something that will actually last? Ultimately, we have to check at the end of the day to see exactly how people read this. The early read, though, gives you a sense that maybe people were waiting for the earnings season to sell the news.
It's the first few pages of the first chapter of earnings season, but this is the headline so far. This is the story. If you beat, you don't get rewarded. If you miss, you get hammered. IBM with a miss and down by 24%. If you miss, you can lose a quarter of your value in the pre-market, just like that. IBM down 24, it bleeds through software. Microsoft down by 3.
Yeah, the potential here for a broader market impact, given the fact that software really was not the area that people were spending on. That was what IBM highlighted, that it really was hardware. In other words, Semi's gain has been everybody else's pain in the tech stack. And that seems to be the story from IBM. How much this really speaks to, again, what could be ahead for any other tech companies that miss earnings, even by $600 million, gives you a sense of what's at stake here.
IBM down by 24% so far this morning. That's the equity picture. The bond market story. Yields coming in. Money going back into fixed income this morning. 2s back to 426. 10s around 460. Yields pushing higher in the last 24 hours following a very hawkish speech from Governor Waller. Under surveillance this morning, the case for hiking rates.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
So here's the latest this morning. Traders boosting bets. The Federal Reserve will raise rates later this month. Investors awaiting fresh inflation data. And Fed Chair Kevin Warsh's testimony on Capitol Hill a little bit later this morning. The former New York Fed President, Bill Dudley, joins us now for more. Bill, what was your reaction to that? And welcome to the show, buddy. What was your reaction to that speech yesterday? And what is the likelihood that this meeting this month is indeed live?
Well, I think it is live because inflation's been above the Fed's target for over 5 years. And the core inflation has stayed quite sticky over the last few months. Waller basically is providing the guidance to the market about how the Fed's likely to react if the inflation news is bad that Kevin Warsh has been unwilling to provide. This is one of the problems that Kevin Warsh, I think, has. If he continues to be as silent as he has been about how the Fed is likely to react, his voice is just going to be replaced by other people that are going to provide more insight into terms of how the Fed is likely to react. I think there's a strong case for tightening monetary policy. I don't see much evidence that monetary policy is actually restrictive right now. Financial conditions are extremely accommodative, and that's providing quite a strong impulse to the economy. And then you have the AI investment spending boom, which is likely to continue for a while longer. Both those things, to me, argue for the Fed to raise rates. The Fed isn't there yet. I don't think Kevin Warsh is there yet. If you look at what he said in his public remarks, pretty optimistic about AI, helping you on productivity, holding down inflation. But Waller, has put a marker down. And I think there's a lot of other people on the Fed that feel the same way.
Bill, do you think that's where we can find some common ground? There are some people that do think we are slightly restrictive. Many on the FOMC do not share that view. But can we find consensus around the following idea that we aren't sufficiently restrictive to get inflation back to target? Is that where we can find some consensus on the committee?
I don't think there's much evidence of that. We've been in this supposedly restrictive setting for several years now, and inflation hasn't come down in the economy, and the unemployment rate hasn't gone up. So it seems to me that the evidence that monetary policy is exerting restraint is really quite weak in the current venue.
Bill, we've been just getting bank earnings, and frankly, it seems like all cylinders are firing as quickly as they possibly can, record after record after record in capital markets, as well as Main Street activity that seems to be reaccelerating. By not hiking interest rates, do you think that this Fed is allowing some sort of capital markets bubble, effervescence, whatever you want to call it, to build?
Well, William Chesney Martin used to say that the Fed's job is to take away the punch bowl when the party just starts getting good. And I would say the party is getting really good right now. So this is, the flip side of financial conditions being very accommodative. And so I think that argues for the Fed raising rates a little bit. The CPI will get a good headline CPI this month. But that's not going to have as much weight now that the war in Iran has started back up and energy prices are headed back up. So it's really what's happening to inflation beyond energy prices that's really going to matter. And I think that's what Waller flagged this past week.
There's a question about the idea of outsourcing some of the commentary to other Fed officials on the part of Kevin Warsh, with Chris Waller really sucking up the oxygen in the room. Do you think that this is actually a desirable outcome, or do you expect Fed Chair Warsh to clip the wings, say, of a Chris Waller?
I don't think that the Fed chair has a lot of power to limit the ability of people to talk about their outlook for monetary policy. I mean, that's what Fed officials do. That's their job, is to conduct monetary policy. So I think the problem that Kevin Warsh might have is that as people like people like Chris Waller speak up, and Warsh does not provide similar kind of guidance about what his monetary policy reaction function is, it basically makes him less important and makes people like Chris Waller more important in terms of guiding markets.
So, Bill, what does he say today? His first testimony as the Fed chair before Congress on the heels of not just what Governor Waller said, but also CPI. Does he just stick to the script of his task force and I'm not going to provide guidance?
I think it's going to be more of the same. I think he's not going to provide much guidance about where he's going forward. I think where he's done himself a good job, done himself a good service, is basically underscoring the fact that he's committed to the independence of the Fed. So compared to where he was when he was testifying before the Senate Banking Committee for his confirmation, he's gotten a lot more distance from President Trump. And I think he's really reinforced the idea that he's not going to change the Fed's commitment to price stability.
Bill, picking up your point about financial conditions, they're easy in some sectors, but do you expect Kevin Warsh to double down that they're restrictive when it comes to the housing market?
Well, I think the housing sector is the weakest part of the economy. But the question is, why is housing weak? Is it weak because interest rates are too high? Or is it weak because we're not having any more immigration into the United States? And so the growth rate of the household formation has collapsed. And so with that, the demand for housing is much weaker than it was in the past. You know, when you're creating 2 million jobs a year, that created a lot of demand for housing. When you're not creating much in the way of job creation, the housing demand is going to be a lot weaker. And so I don't think the housing sector is weak so much because rates are too high. I think it's weak because we're not seeing a lot of growth in the labor force.
Bill, well framed. As always, sir, it's good to hear from you. The former New York Fed President Bill Dudley going into this testimony, semi-annual testimony from the Fed Chair Kevin Warsh later on this morning. To Bill's point, the party getting started. I mean, they've been spiking a punch bowl, haven't they? Well, like David Guetta turned up, played a full set. There's flares in the bottles of champagne.
I was listening to him. I was listening to David Guetta this morning.
June, what a month.
That's your never mind.
That gives you a sense of what we already expect from bank earnings. Look, I think that his point here is to take the punch bowl away, to raise rates a little bit. Is that going to be the view? Because we just removed the easing bias. We had an easing bias since the last meeting.
Baby steps with this committee, right?
This is not exactly one that's ready to wholesale, call the cops.
I said it in the question to Bill, where can you find some common ground? We've got to be able to find some common ground around the idea that we are not sufficiently restricted at this committee. Even if you think we're somewhat restrictive, can you really make the argument that we are sufficiently restrictive to get inflation back to target when you've been above target for this long?
I think that ship has sailed, given the fact that inflation hasn't come down. If you were sufficiently restrictive, then inflation wouldn't be running as hot as it was. And even if we're talking about downside surprise of 3.8% versus the 4.2% on CPI, it still has a 3 handle, really in the wrong direction.
2's at 426. This is a month rolled into a morning. 5 bank earnings, CPI, testimony from the Fed Chair Kevin Warsh. Citi, earnings from Jane Fraser in about 5 minutes' time. Look out for that. After that, CPI, 8:30 Eastern Time. The next hour of Bloomberg Surveillance. Up next.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Earnings are exploding to the upside.
The market is very excited for this week. We're all expecting great things.
We don't want to overthink the secular trade.
We're still in a really strong earnings environment for U.S. stocks.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. Equity futures on the S&P down by about 0.1%, on the S&P 500, on the Nasdaq up by 0.5. The index level story, not the story this morning. The headline is an earnings season at the stock and sector level. Bank of America this morning down by 1.3. JP Morgan down by 2.7. They were delivering record numbers across equity sales and trading revenue. Goldman Sachs knocked it out of the park, and we only see a bounce of 2%. The headline so far this morning, if you beat, there ain't much of a reward, but if you miss, well, you get absolutely obliterated. IBM this morning with a miss. The stock is down by 23%, and Bramo, that bleeds right through software worldwide.
Yeah, perhaps gives a sense of what's to come given the shift in spending away from software toward hardware, toward cybersecurity. The big banks clearly seeing that even small gains, small beats, not enough to get the job done.
Get another beat, but this is a small one from Citigroup. Second quarter equity sales and trading revenue, $2.3 billion, the estimate 1.9, might sound large. But compared to what we've seen elsewhere, that is a small beat. If you're looking at fixed sales and trading revenue out of Citi this morning, $4.71 billion, the estimate 4.56. That's a nice upside surprise. That won't get it done this morning. Citi in the pre-market down 1%.
Yeah, the bar has been reset for banking stocks. If you don't report some sort of not only a revenue beat, but some sort of 80-70% increase year over year in quarterly equity trading sales, or some sort of astronomical superlative type of quarter, you're not going to attract a lot of those investors. And that just really feeds into what we've seen all morning, which is essentially you have to be so astronomically high to even have your shares go up in any kind of way. Again, really speaking to that, because ultimately they beat across the board. Markets revenue, $7 billion versus 6.45. Wealth revenue, 3.2 versus 3.07. All of these, beat, just not enough.
It's not a judgment on the quality of the quarter or the execution of the management team and everyone working at, say, the likes of Citi. These are great numbers, and we've seen them elsewhere. This is about how the market is choosing to reward or punish those numbers so far this morning. You mentioned a bunch of numbers there. Net interest income for the second quarter, $17.13 billion. The estimate was 16.01. That's a really nice beat from Citi.
I don't see any misses here. So what is the excuse for the shares being lower some 1.5% right now? I'm not sure. Maybe people will point to expenses like JP Morgan. Will have to go through this. Nonetheless, it does follow the trend of the morning, which is ultimately people were waiting for the earnings to come out to sell just a little bit around the edges.
That's the broader story for earnings season so far. The early chapter, the first few pages of the first chapter of earnings season, this bar is super high. So far, Citi is down by 1.5%. So that's the earnings story for the big banks. 5 of them already reporting so far this morning. Now the story shifts towards inflation and this Federal Reserve. Coming up very shortly, 27 minutes away, CPI in America. And then a few hours after that, we hear from the Fed chair at 10 a.m. Eastern Time in front of the House Financial Services Committee.
And it almost feels like he's going to have a little pressure on him, not just because the CPI data, but what we heard yesterday from Governor Waller. Governor Waller said if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. What is Kevin Warsh going to say when he gives his first testimony today in front of the House, tomorrow in front of the Senate, basically responding to this? Because to Bill Dudley's point, if he doesn't, then his voice just becomes less important. Others will fill that gap.
Without a doubt, if you're not going to provide guidance right now, all you're doing is outsourcing guidance to someone else on the committee. And I think we saw that yesterday, to your point. Waller filled that gap.
That is the big question today of Kevin Warsh's testimony. Will he lean into what Chris Waller said, or will he push back? And if he doesn't say anything, that's akin to almost backing it, given where the market has moved.
Yield above 425 at the front end of the curve on 2s this morning, 460-ish on 10s and north of 5% on 30s. Coming up this hour, we'll catch up with Seth Carpenter of Morgan Stanley, counting down to Kevin Warsh's testimony. Chris Marinak of Breen Capital, he's back with us, looking at how the big banks blew past Wall Street estimates, and David Kelly of JP Morgan Asset Management reacting to the latest read on inflation. Results from Citi crossing just moments ago, they were okay. Results from Goldman, JP Morgan, Wells Fargo, all doing absolutely fine. Bank of America as well. But the reaction to the story so far is that the names have dropped. We're down by 2% on Citi this morning. The beats aren't being rewarded. The misses are being punished. The conversation now shifts to inflation. We begin this hour with stocks holding steady as markets digest a slew of record-setting big bank earnings. Seth Carpenter of Morgan Stanley writing, the incoming data support patience by the Fed. Our base case remains no hike in July and no hike through year end. Seth joins us now for more. Seth, good morning. Good to see you.
Hey, Jonathan.
What are you expecting to see in 25 minutes' time?
We're looking for core CPI to be, 20, 22 basis points, so a softening up. I think there's a clear message that we're taking from the data that core goods inflation boosted by tariffs, that's got to be coming off over time. I think there's some softness in shelter inflation. Bill Dudley was on earlier and he talked about sort of the restriction in immigration leading to less demand for housing. We think we're seeing a signal there where you're going to see some moderation continue in the shelter inflation. And so we think inflation actually is coming down. Is it going back to target right away? No. But is it coming down enough to the point where the FOMC is going to be able to say, no need to hurry, no need to hike now in July. Let's wait a couple more months and see what happens. That's what we think is the right
That's your
outcome.
forecast.
That is.
But how offside do you feel right now relative to what you're hearing from the committee?
So I think Chris Waller's a great example there. One of the points, so I was at the ECB's conference in Sintra, get this great opportunity to talk to policymakers. Everyone was talking about...
Fantastic opportunity, Seth. I'm right there with you. Good gig if you can get it.
It was great and beautiful setting.
Without a doubt.
So everyone was talking about Kevin Warsh's sort of non-forward guidance and what you can say and what you can't say. And I think the argument in favor of Kevin's point is that markets often just listen to one part of what policymakers said. What did Chris Waller say? He said, if we get another hot inflation read, then the committee will have to consider raising interest rates soon. And what did the market do? The market sold off saying, Chris Waller just said they're likely to raise rates in July. That's not what he said. He said, if we get another hot reading, then they'll have to consider raising rates in the near future. And I think that is the tricky part with any central bank's communication. What I'd like to say to policymakers is be as clear as you can be, but under no circumstances be more clear than that.
Do you disagree with Bill Dudley that essentially the Fed's job is to take away the punch bowl when the party is really getting started and heating up? And right now, the party is pretty hot, and it seems like it might be an opportune time to start removing some of the alcohol. I mean, do you disagree with that?
So I'm not sure I fully disagree, and I think if we keep that metaphor and then put it in the context of Chris Waller's speech yesterday, they want to take the punch bowl away before things get crazy, but they're not there to try to smash all the crystal and destroy things. Chris said they want to be, they don't want to be behind the curve. They want to raise interest rates if necessary to control inflation, but they don't want to raise interest rates aggressively and risk causing a recession, and that is the inherent challenge for monetary policy since time immemorial.
Based on the earnings that we just got, based on the commentary, based in the sense that it's not just Wall Street that's going gangbusters, but you're also seeing Main Street do really well with the delinquencies coming down, what's the argument against hiking rates just once?
I think against hiking rates just once is, I don't know what hiking rates once is going to do. Hiking rates once feels a little bit of spurious precision. I think the argument to stay pat is inflation was boosted temporarily by tariffs, temporarily by the energy price shock. If it's going to settle down on its own, then let's see what the economy can do. We don't know where the unemployment rate can ultimately settle. It's been going more or less sideways, but with much less job creation. So have you slowed the economy enough to settle into this slower growth rate of the economy?
How long do you wait? 5 years, 6 years, 7 years, 10 years?
Well, so for 15 years, my job was to argue inside the institution about what monetary policy should do. That's not my job anymore. Now I have to argue over what they're likely to do.
Good fun.
If you think about the median, though, from the last FOMC meeting, there was a median of one hike this year and then a median of a cut for next year. So it's not as though the committee as a whole is champing at the bit to just really hike interest rates a lot this year.
But if you think that last year, potentially if you're an official, you think that last year was about insurance cuts, then even if it's just one hike, it's taking away that insurance.
So I think that's a reasonable argument. Were the 75 basis points worth of insurance cuts necessary, given that the labor market did not collapse? And I could see that as an argument. And so maybe you pull back on that insurance cuts. I think that is a legitimate argument that someone could make and probably has made at the FOMC table and will make in the future. Again, I could see that as a perfectly valid argument. It's just not what our baseline forecast is for what the FOMC will ultimately deliver.
I'm curious now because I want your opinion. How big is the spread between what you think the Fed should do and what they will do?
Oh, my gosh. If we go back over enough years, there's been, at times, a huge gap.
How big's the gap for you right now, personally?
The hardest part to answer that question is that we can't undo history. Our forecast was wrong when they did the insurance cuts because I probably let myself slip into the mistake of arguing over what I thought they should do as opposed to what they will do. And they did the 75 basis points worth of insurance cuts. I was not convinced at all that the labor market was weak enough that it was going to be a systemic sort of collapse in the economy. And so our forecast was wrong, and they ended up cutting 75 basis points. It's a different question to say, if I could go back in time, I wouldn't do those.
Got it.
Versus now that we are where we are, should we hike 75 basis points and undo it? That's a very different
As an economist and strategist, if you don't mind me asking, you've learned from that experience. And I just wonder if that was a different Federal Reserve. And this is a changed Federal Reserve, a different institution, a switch in mentality, put on piles of pressure by this White House to loosen policy. And you can feel the institution sort of flexing, pushing back a little bit in some of the speeches that I've read more recently. Is this a different Fed?
So I don't think it's that dramatically a different Fed. We have a different chair. It remains to be seen specifically where Kevin Warsh's preference are for policy. The rest of the committee is unchanged. Now, you're right, they've lived through this experience. It was an insurance set of cuts, so to speak. They're a little bit past the political pressure, so maybe they want to go in the opposite direction. But then I would just argue back to where the summary of economic projections is. They only had a median of one rate hike for this year, and their forecast for inflation is at 3.3% for core at the end of this year. We think it's below that at 3%, and that's before you factor in this potential revision to methodology from the BEA that could lower inflation even more. So is it changed? I mean, possibly. Is it a dramatically different institution that fundamentally wants a different outcome? I don't think there's evidence of that.
Seth, it's good to see you. It always is. Thank you, Seth Carpenter there of Morgan Stanley, breaking down his experience covering this Federal Reserve. CPI drops in 28 minutes' time. About 90 minutes after that, we'll hear from the Fed chair, Kevin Warsh, on Capitol Hill.
Yeah, right now, at least the earnings seem to be supporting the idea of a insufficiently restrictive Fed, at least not restrictive policy. And now the question is, will CPI give us the insight to need forward-looking, given the fact that oil prices had gone down and are now inflecting upward, right? So you're going to have to strip those out and strip out the secondary effects that potentially could have come through. it's going to be a messy practice.
These guys are human beings. This institution is not a machine or a robot, and I can sense the personal anxiety about being above target for 5 years. And the energy story, I think, has exacerbated that anxiety more recently. And you can see AI come up repeatedly in the minutes when it concerns price pressure. And I don't know if this is about signal right now, that they're looking to anchor inflation expectations by signalling a willingness to tighten monetary policy in the near term, or whether it reflects a real itch that they need to do something and do something soon.
That, I think, is the key question. Do they have to act to continue market jawboning the way that they have? Or can they say, well, next meeting might be live. We still could potentially hike, and push them back month after month after month, meeting after meeting, and still get the price reaction that they're hoping for.
This is the circular nature of the conversation right now. Chris Verone was on the programme earlier on this morning, and he said, look, inflation expectations are well anchored. And we responded very clearly. Are they well anchored because we're priced for rate hikes? Isn't that the story right now?
What you saw was yield curve flattening as soon as you saw Kevin Warsh really reassert the independence of the Federal Reserve, this idea that there was confidence that they would inflict the necessary pain to bring down inflation should they have to. If that isn't necessarily as present in market understanding, does that shift inflation expectations in a more material way?
We're 50 basis points above the policy rate at the Federal Reserve on twos. And I remember the argument that came out of the Treasury not so long ago. When two-year yields were below the policy rate, the Treasury Secretary was making the argument that monetary policy was tight. And that was evidence for it. Now you've got a two-year trading 50 basis points above Fed funds at the upper bound of the policy rate. It's an argument right now this market is making that we're about to see high rates.
And argue that that's actually necessary, because every single banker that we talk to say that 25, 50 basis points of a rate hike isn't going to make a difference for the financing flywheel that we're hearing about from all the big banks.
And this whole conversation could change in 15 minutes' time. Two-year yields are down by 2 basis points. Sport, right? 426 on twos. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Citigroup rounding out this morning's big bank earnings. Shares lower in the pre-market even after the company reported beats across the board. Revenue from equities trading surging to a new record there as well, 45% higher than last year. IBM shares, though, sinking in the pre-market. The company reporting preliminary second quarter sales that missed analyst estimates. CEO Arvind Krishna saying that clients are shifting capital away from software and into servers, storage, memory to head off industry-wide supply shortages. Chipotle is headed to Mexico. The American company is hoping it can sell its Mexican-inspired food south of the border. Its inaugural store will open near Monterrey on Thursday, with a couple other locations planned through 2027. And that is your Bloomberg brief, John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus. Chris Marinac of Breen Capital, as blowout bank earnings struggle to meet some sky-high expectations from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
When you look at the numbers across the board, they were all very good. Riding the tailwinds of the overall economy, and in particular the capital markets, is a huge impact on everybody's numbers. Investors are finally recognizing that the banking industry post-financial crisis has been de-risked.
And the numbers have been absolutely fantastic. There was Jared Cassidy of RBC joining the program a little bit earlier, following numbers from JP Morgan, from Bank of America, from Citi, from Wells Fargo, from Goldman Sachs, knocking it out of the park. Futures this morning on the S&P down by just 0.2%, on the Nasdaq up by 0.4. At the single name level, looking at the bank sector this morning, you wouldn't really know that anything could happen. You certainly wouldn't guess that something amazing had happened, like record revenue across several business lines across many of these businesses. You don't see much evidence of that this morning at all.
No, in fact, you've got most of the bank stocks that have reported are lower on the day. The one that's the exception is Goldman Sachs, but they're just positive after blowing it out of the water. The idea that a 3% gain comes after a $7.4 billion equities trading revenue. That is 23% larger than JP Morgan's at $6 billion. It is more than double Bank of America's at $3.6 billion. So it gives you a sense it is 70% higher than it was at the same time last year. Shocking numbers. Maybe we'll give you 3%. It's probably going to fade. I mean, this is sort of how the morning's been going.
We'll see if it holds. I know I sound like a broken record, but this really is the headline so far this morning. Beats aren't being rewarded, but misses are being punished. And misses are being really punished, obliterated. In fact, IBM with a miss earlier on this morning, and IBM losing about a quarter of its value. IBM is down by 23% in the pre-market, and that's picking up across software names in the United States, and it's picking up across software names around the world as well. SAP over in Europe being one example of that.
Yeah, with existential risk being really at the forefront of a lot of people's minds, the idea that if software names cannot lock in big deals at a time of a lot of uncertainty, and instead a lot of corporate clients are going to the hardware, are going to cybersecurity, are putting priorities elsewhere, does this represent the SaaScopolis that people were talking about earlier, and perhaps a taste of what's to come?
Equity futures this morning then doing nothing, but bank names, software names doing a whole lot of something. Software not so good this morning. Microsoft, IBM, Accenture trading lower in the pre-market. Let's get you some morning calls. First up, KeyBank downgrading Apple to underweight, expecting slower US demand and weak service revenue growth. The stock is down by 0.75%. Your second call from HSBC downgrading IBM to reduce and cutting its price target to a street low, saying investors can replicate its software exposure through its competitors. And your third and final call from Evercore, initiating coverage on SpaceX with an outperform rating, saying its upside potential is, quote, too compelling to ignore. That stock is up this morning by, let's call it 0.1%. Three of your calls so far this morning. Let's turn back to one of our top stories. JP Morgan, Bank of America, Goldman, Citi, all reporting earnings that beat Wall Street estimates. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, let's park the price action just for a moment. Let's just go through the numbers. Sure. How phenomenal was that quarter for these banks?
Yeah, you said it right. The banks really hit it out of the park. That was really driven by equities trading results that had high expectations heading into the quarter, and the banks easily cleared that, highlighted by JP Morgan's equities trading revenue up 86% year over year. All the others that reported thus far had very similar results, so strength all across the board. Capital markets was strong as well across equities issuance, fixed income issuance, and M&A. And then your traditional banking side, decent loan growth, margins were fairly stable. So all in all, the revenue picture looks really strong.
And the environment was fantastic. The weather was tremendous. Is the next quarter, the quarter after that, going to bring more of the same?
Yeah, I think that's what a lot of the analysts will be asking for. How sustainable are these results? recall that in the JP Morgan press release today, Jamie Dimon was a bit measured in his comments, talking about shifting tectonic plates and risk that's really, bubbling below the surface. How that changes remains to be seen. But all in all, I think you can expect the overall trading revenue environment to be really constructive, at least in the near term.
Herman, it's good to see you. As always, Herman Chan there of Bloomberg Intelligence. Chris Marinak of Bring Capital is back with us. Chris, welcome back. Let's talk about the durability of this. The tailwinds through Q2, are they durable through into year end?
Oh, I think they are, John. I think you have operating leverage from the expense side. This quarter was good. As we talked earlier, I think the lower credit costs really do matter. I think the sustainability of the bank model is quite good. We still have higher interest rates actually helping because there's a lag between any shift of higher rates on funding costs, and the banks will reset loans and earning assets faster. So I still think there's a very good case here for the widening of net interest income, net interest margin the second half of the year, and then layer over the rate of growth on expenses should be limited. That's going to help profitability continue. Plus, we still have buybacks, and we still have, I think, overall the opportunity for more business to be won as share shifts back to the banking industry.
Right now, the JP Morgan earnings call with media is ongoing, and we're hearing from both the CFO saying the U.S. consumer is a little bit stronger this quarter, so really speaking to what we've heard across the banking sector about the Main Street side of the book. And then Jamie Dimon saying that markets are booming right now, and it's pretty broad-based. Of course, we also have the caveat of there is a tipping point that can come even with such strength. What are you looking for a potential turn in the cycle, for some sort of end to what we're seeing?
Well, I think if you have stock prices go down, not just in the financial world, but really across the board, that's going to limit the opportunity to place new equity and debt. I think if you had a drop of M&A activity because, again, prices weren't cooperative, that would also be an end. But right now we're seeing the opposites. That's kind of why I think the attitude and the bullishness into third quarter and fourth is still quite good.
Chris, always good to catch up. Thanks for standing by. Chris Marinak there of Bring Capital on the bank sector so far this morning. The numbers so impressive that we've not talked about succession planning at JP Morgan once. Imagine the call might be different. There'll be lots of questions about that over at JP Morgan, but the attention firmly elsewhere.
Yeah, just to answer the question of how long it can continue and talking about how, if anything, it seems to be accelerating when it comes to the economic strength of the consumer, even if it's just a little bit. And you're hearing that across all the different companies. I mean, who's reported earnings so far? We've gotten Delta and we've gotten the big banks, and they all have come out and said that the consumer is incredibly strong. Where there is some skepticism is on the AI side of things in terms of where the money is flowing, and that's what we saw from IBM in terms of the investments. That's maybe where the fireworks come into play.
I often call earnings season cherry-picking season because we can also talk about Pepsi and story on the consumer not so great over at PepsiCo.
Yeah, although some people saying that might be a bit more of the execution thing, but you're right. You're right. Okay, cherry picking or apple picking.
It's cherry picking season.
Is it cherry season? I think
it is.
Cherries are good, yeah.
Yeah, they are. They actually have been really good this season. The fruit's been very good this season.
Okay, good. So, an endorsement on fruit from Bremo. Good stuff, all right. Let's get back to inflation.
Americans weren't snacking.
How much are those cherries? CPI up next. There you go. We'll break it down with Tiffany Wildig of PIMCO in just a moment.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Inflation data in America, CPI, 20 seconds away. Your scores into it look like this. Equity futures on the S&P just about unchanged, down by close to 0.1%. On the Nasdaq, up by 0.6, round it up, 0.7. In the bond market, 2s, 10s and 30s, yields pushing higher through yesterday's session. This morning, falling 3 basis points to the front end. 2s at 425, 10s at 460, 30s at 5%. With some breaking news, here's Mike McKee.
Good morning, John. Kevin Warsh makes no news in his prepared testimony. There is no guidance on interest rates, although he does reiterate that inflation is still the focus for the Fed. And as far as inflation is concerned, there's some particularly good news for Chairman Warsh this morning as CPI comes in down 0.4 on the month. This is the first negative print since 2026 years. Core CPI is flat for the month, and that puts the year-over-year at 3.5%, down from 4.2% for the headline, and for the core, 2.6%, down from 2.9%. Now, 1 month does not make a trend, and obviously the Fed and the White House will take credit for some of this, but they're going to have to wait and see how things break out going forward. Most of this is, as far as we can determine, from energy, of course. Now, Warsh, it's a kind of a dramatic opening he makes in his statement this morning, but again, no guidance. He says the U.S. is at a hinge point in history, and their task is to ensure that the economy excels into the future. In the text of the testimony, Warsh says the key to that is bringing inflation down. Quote, while monthly price fluctuations are inevitable, especially in an unsettled world, underlying inflation over long time horizons is determined largely by monetary policy. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability. Now, what's missing from that statement is any mention of how they plan to do that. Whether they plan to raise or lower interest rates or hold them, nothing on that in the text. The economy, he does say, is solid. Consumer spending is moderate. Manufacturing moving up steadily, and the labor market broadly stable in his sort of economic outlook. The only laggard is housing, which is a victim of interest rates, but again, no mention of where rates are going. He does mention AI, which came up as a concern in the minutes of their last meeting. We don't know the extent to which the economy will benefit from the AI build-out, Warsh says. Even so, new opportunities for the economy introduce new challenges for policymakers. We at the Fed are monitoring the implications for inflation and the labor market. And the rest of his 6 pages, which are, by the way, about 2 pages longer than Jay Powell has had in recent years, he outlines the 5 task forces that he has appointed, and he offers praise for the late Alan Greenspan. Again, though, no policy possibilities. That'll have to wait until members get a chance to question him.
Mike McKee, thank you, buddy. Let's get to the bond market board. 2s, 10s and 30s. That's a downside surprise on CPI, and this is the sound of the door closing on a July rate hike. Two's down by 10 basis points, 418, removing the urgency to hike anytime soon in the minds of many, I'm sure, in this market. That can change. 10's right now down by about 8 basis points to 455. Turn to the equity market, unlocking this move. In equity futures, on the S&P 500, on the Nasdaq, on the Russell, the Nasdaq up by 1.3%. Your outperformance, where you'd expect there to be outperformance to be. The Russell 2000 up by 1.5%. Want to return to that quote from Governor Waller. If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. Bramo, we got a cool reading on core CPI just moments ago.
Yeah, and that core reading came in significantly below expectations, which is the reason why you're seeing essentially what was one of the biggest moves that we've seen in the 2-year going back to September of last year. That's retraced some of it, but down more than 10 basis points at one point. People pointing to this, as you said, closing the door to a July meeting and potentially in general. What I find interesting is that the equity move is as significant. And I'm looking, for example, at the shares of Goldman Sachs taking another leg higher on the heels of that. How much does this just add fuel to the enthusiasm that we're seeing in some of these earnings that we've gotten this morning?
Well, let's start on the rate debate. So in the near term, the urgency to hike. We had a soft payrolls report. You've had a soft CPI. I think in the near term, you remove some of the urgency. But does it settle the debate? I don't think so. Not with core inflation still closer to 3 than it is to 2. Anxiety that we've been above target for 5 years. Unemployment close to 4%. And sticky inflation around themes like AI is going to keep these guys on the back foot for the time being. Now, when the chairman is going to come out and say we've got no tolerance for above target inflation, let's work with that. What does that mean in practice? That's what we need to get into today. You've said this a few times now, and I hear this from various guests, and I heard it from Mike McKee just moments ago. We've heard this repeatedly from you. What do you intend to do about it? We understand now. We've got the picture. I've heard the message loud and clear. What are you going to lead the committee to do to counter it?
Yeah. Is it going to be something that can be executed with rates? Is it going to be balance sheet? Is it something else? And do you think that you can afford to wait for the task forces to be done before you make any of those decisions? Do you think that the Fed can be put on hold while deliberations continue? And if not, do you think that you are supportive of your potential colleagues who are giving guidance and are affecting market pricing? I mean, again, there's some really important questions, and if he doesn't answer them, that will speak as loudly as if he does.
Because removing the urgency to hike and settling the debate to hike are two different things this morning. And with two still around 418, yes, we're seeing a 10 basis point move lower. We're taking back the Waller sell-off in some ways. You're removing the urgency. Do you settle the debate this far, this high, above the policy rate? Fed funds right now 50 basis points lower than where twos are. I don't think you've settled the debate just yet.
And just to build on that, oil prices did come in, which was a big part of the headline number, declining for the first decline going back 6 years. On the flip side, oil prices are inflecting higher again. How do you factor that in, given the fact that the pass-through is significant, and it's not just coming in the form of gasoline prices, but also diesel prices, food prices, pretty much the inputs for everything that people buy?
We've turned down the heat on the stove, but this debate is still simmering. Mike McKee's got a second look at this inflation data. Mike, what'd you see?
Well, food prices did rise 0.2%, but gasoline wiped out all of those gains. Gasoline down 9.7%, more than accounting for all of the decline in the CPI this month. New cars were flat. Apparel prices were down 0.6 on the month, and used car prices were down 0.2%. Owner's equivalent rent up just 0.2% after a string of readings above that level. And airline fares were up only 0.2%. Remember, we were watching them rise because of the price of jet fuel. So a lot of things down in price this month. But as Lisa just pointed out, the war back on, some of those things are going to go back up again in the July reading. So while it does probably eliminate the idea of a July rate increase, it doesn't take it out of the room for them to discuss.
Mike, looking forward to your coverage of the testimony later this morning. Mike McKee there breaking down the inflation data and the prepared testimony from the Fed Chair, Kevin Warsh. He confronts the House Financial Services Committee at 10 a.m. Eastern Time. I'm sure it won't be that combative with the Chairman, French Hill, a little bit later this morning. And then tomorrow, in front of the Senate Banking Committee, 2 days on Capitol Hill. I don't envy that. Can you imagine that? 2 days on Capitol Hill, in front of the House, then the Senate, to talk monetary policy and all these crazy questions about finance and the backdrop right now.
What's the pre-hearing breakfast? I mean, seriously, because you have to really have enough energy to get through it.
Got a carb load.
Yeah, carb load, do training, sing Eye of the Storm in the bathroom while beating your chest.
Is that what you do, Bremo?
She's on the David
No
Guetta
comment.
David Guetta kick.
Eye of the Storm? In the shower?
I did that once. Not in the shower, but moving on.
If that's what you do in the morning, like stretches to like hype socks, like Rocky. OK, all right. Tiffany Wilding and PIMCO joins us now for more. Tiffany, not more of that. We'll talk about the data. What's your reaction to CPI dropping just moments ago?
Yeah, well, I thought you guys laid out a very key list of questions there that Chairman Warsh and the FOMC committee will have to answer over the coming months and quarters. I think in addition to those questions that you laid out, one of the key ones has been this year. What is really driving inflation? Is it a kind of a sequence of supply shocks and one-time price level adjustments, or are we genuinely seeing some resilient demand that is lifting inflation? And I lay out that question because it's really key to how monetary policy makers should react to what we're seeing. If it is indeed just a series of supply shocks, then they can afford to be patient. But if it's not, and it's underlying demand, then that's when you really need to offset that with higher interest rates. And I think there's certainly evidence that supply-related factors are contributing here, but there's some ambiguousness as well. And I think Waller sort of laid out the case yesterday to basically say the longer that we get a continued sequence of elevated inflation prints, the more the case builds that this is really demand that's keeping inflation elevated as well. So I think this data today will be a sigh of relief for many FOMC members. As you guys suggested, it won't close the door to interest rate hikes in general, but it basically is now a nod in the direction that, yes, we did get some one-off tariff adjustments. Certainly energy prices are not back to the war-related levels yet. And we're getting this sort of AI-related price increases in tech components and stuff like that. So, I think this print does suggest that, there's reason to believe that cools down in the second half of the year. But clearly the onus is on the data. It needs to cool down for them to hold. And I think Waller again really laid out the case that we could need some modest adjustments higher, if inflation continues to rise.
It gives them the time, if they want it, the much needed time to have a longer conversation through the summer. Tiffany, it takes me to this quote from Kevin Warsh, the Fed chair. Prepared testimony, and he says this: "The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability." So, Tiffany, we have seen persistently above target inflation, and they have tolerated it for 5 years. When he says we share a resolute commitment to restoring price stability, what's your best guess as to what he means and what they intend to do about it?
Yeah, well, I mean, I think he's clearly, saying that, he wants to maintain a Federal Reserve that the markets view as credible, because ultimately in the longer run, if you have price stability, that's good for the economy. He wants to manage inflation expectations. He wants to make sure that they're anchored, because ultimately that keeps that results in an easier job for the Federal Reserve if inflation expectations are anchored, in order to get that price stability. So he is clearly saying the right things here in terms of keeping those inflation expectations anchored. But at some point, if inflation does turn out to be more of a demand-driven phenomenon above target inflation, if you have several more years of that, then again the risk is that you have inflation expectations that are starting to drift higher, and the Fed does have to react. I think they are, and I think Chairman Warsh is basically saying we're prepared to act if we need to, but as of right now, at least with today's print, it does buy them a little bit more time to see a little bit more data and to maybe clear up some of that ambiguity that we're seeing in terms of demand or supply-related factors driving inflation.
Tiffany, how long can jawboning work without action? In other words, how long can they signal that they are willing to act without acting with inflation squarely above that 2% target?
Yeah, well, I mean, I certainly think that, at some point, if the data is not, and if inflation is not going in their direction, absolutely, they will need to act. But as of right now, at least, you know, if you have a sequence of inflation prints that are, you know, that are giving you more evidence that inflation is headed back to target, you know, then I think, again, that kind of buys you a little bit more time. I mean, we have had just an unfortunate set of, you know, sort of events with the increase in energy prices, of course, tariff-related inflation, you know, inflation that was coming on the back of the pandemic, you know, which was both supply and demand-related factors. You know, all of that has just kept inflation above target. We think the Federal Reserve has done a very good job, you know, certainly at bringing it back down. You know, and of course, as we look forward, we expect them to continue to do that and work to moderate inflation.
Tiffany, it's good to see you. Always is. Tiffany Wilding there of PIMCO, getting up early on the West Coast to look at this data. I don't know how they do it over at PIMCO.
I don't either. I mean, waking up at what, 4?
Right, over in Newport.
Can you imagine waking up at 4?
At 4? I do that every morning. Wake up at 3.
I'm kidding, at 3.
But they've got to be in the office at like 3.
Sometimes I don't go to bed.
Right?
Yeah, it's true.
Crazy. Let's get back to that data. So CPI. Core CPI, month over month, coming in at 0. The expectation, the estimate in our survey was positive 0.2. So year over year, we go to 2.6, down from 2.9. The estimate was 2.8. So that's a material improvement there. Of course, when you look at headline in at negative 0.4, the expectation was negative 0.1. Month over month, I'm talking about here. Year over year, headline inflation comes in at 3.5 against an estimate of 3.8. Certainly, it's better than 4.2. And far better than 3.8. There's some energy noise in this. And energy, of course, this morning is bouncing back. So this can be noisy again in the next month or so. The conclusion, though, the early conclusion on Wall Street is this will remove, again, some urgency to hike interest rates, but it won't completely settle the debate with inflation still above target, where it has been for much of the last 5 years or so. So what do you see in the market? Front end of the curve, a rally. 2's down 10. Down 10 basis points at the front end of the curve. Got that. Once you see that in the bond market, you can guess the equity market reaction. Equity futures up across the board. The S&P up by a third. Outperformance on the Russell. Nasdaq futures doing nicely. The Russell this morning up by 1 percentage point. Chairman Walsh is the next risk event on the horizon. He's saying the committee won't tolerate persistently above target inflation. But inflation has been above target persistently now for 5 years. When they talk about doing something about it, how credible is that? Or is that just a communication exercise? Because what I just heard from Tiffany was essentially the latter, that it's just a communication exercise at this point.
That's the speculation on Wall Street right now, and that's the reason why you're seeing the reaction in markets. This will be a good excuse for them to hold off, that the bias is still to not hike rates if they can, not necessarily to use any data point as an excuse to hike. That is a difference between an easing bias or a hiking bias, and it's still underneath this Federal Reserve, there is ultimately more of an easing bias than a hiking bias. I don't know if that's the case, and I don't know if we're going to hear anything from Chair Warsh. Ultimately, if he doesn't say anything, is that going to feed the credibility argument or not? I mean, ultimately, we're just going to be playing the Rorschach test of who is Kevin Warsh.
Someone else will do the communication for him, and we saw that yesterday from Chris Waller, the Fed governor. The Fed chair is 1 hour and 15 minutes away. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, let's recap the inflation data we just got moments ago. June CPI falling 0.4% from a month ago. It's the first negative print since 2020 and likely, as you say, takes some pressure off the Fed to raise interest rates, at least in July. Fed Chair Kevin Warsh set to testify before the House Financial Services Committee at 10 Eastern. In his opening statement published moments ago, Warsh saying the FOMC has, quote, no tolerance for persistently elevated inflation and remains committed to restoring price stability. South Carolina's governor appointing the sister of the late U.S. Senator Lindsey Graham to serve out the remainder of his term through January. Her appointment comes as Republicans prepare for an August primary to choose the party's candidate for a full 6-year term. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with David Kelly of JP Morgan Asset Management.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's really key to how monetary policymakers should react to what we're seeing. If it is indeed just a series of supply shocks, then they can afford to be patient. But if it's not, and it's underlying demand, then that's when you really need to offset that with higher interest rates.
Can we just say thanks to Robin Vince over at BNY, to Ted Pick over at Morgan Stanley for choosing tomorrow to report earnings and not today with everybody else.
We could take a breath,
right?
Drink our coffee, look at their earnings. Thank you.
What a morning. We've had 5 banks reporting earnings already this morning. We've had CPI. So on the bank side of things, the test, super sky high expectations, some beats here and there, insufficient to generate a big rally. And then we got some better news. CPI just below expectations, significantly below by some measure, unlocking these gains. Cross-asset. Equity futures higher by 0.25% on the S&P. On the NASDAQ, up by 1 full percentage point. And the bond market yield dropping at the front end of the curve. Bramo, we're down 10 on 2s.
Taking a July rate hike off the table. Question is, how much are we going to see Kevin Warsh take a rate hike off the table for the rest of the year? Ultimately, it's going to be really, how do you execute price stability at a time where we haven't gotten that for more than 5 years?
Investors looking ahead to Fed Chair Kevin Warsh's testimony on Capitol Hill. That starts in about 1 hour and 10 minutes time. David Kelly of JP Morgan Asset Management joins us now for more. David, welcome, sir. Always good to hear from you. Your reflections on what we saw in the data moments ago and what you anticipate to hear from the Fed Chair later this morning, please.
Well, first of all, the news on inflation is good. It was better than expected. Usually if that happens, it's because of some special factors. And if you dig into the data, we saw a decline in airline fares, but we saw a 1% decline in electricity prices that bounces around a lot month to month. We saw a 2% decline in auto insurance. Remember, that one was causing a huge problem a few years ago. We saw a big decline in tobacco prices. So these are special factors which is causing the decline in inflation that we've expected all along to occur a little faster than we thought. But overall, we don't have an underlying inflation problem, at least not one that monetary policy can solve. This is the inflation caused by the tariffs, by the oil shock, by the fact that shelter costs just don't keep up with the real world. And it is gradually fixing itself. So I think inflation's on the right track here. It's coming down. I think it will be just a little over 3% by December. I think it will be down at 2% year over year by next May. I don't think the Fed should do anything. We'll have to see. We'll have to see what Chairman Warsh says. I think he'll talk tough, But ultimately, I don't think the Fed does anything this year.
David, a lot of people have come on the show, including Bill Dudley, formerly of the New York Fed, and talked about how he sees a lot of places where inflation seems to be picking up, and not only tied to AI spending and all of the issues that you mentioned, like tariffs and oil prices, but consumers are spending, and the upper end of the K is doing very well. Delta's saying that they're going to raise prices more if oil prices go back up. Where do you see the progress being made so significantly?
Well, I think what we're not seeing is a lift-off in the spending of lower and middle-income consumers. Yes, the upper end of the K is doing well, and I suppose that's going to push up the cost of expensive restaurants and so forth. But we're not really seeing that much in airline fares because it is a very competitive industry. And more than that, I think the big thing that we're not talking about is the demographic drag here. A population growth in the United States, at least a population of adults, has essentially slowed to a halt because of what's happened with immigration. Now, the result of that is we're now at an 8-year high on rental vacancy rates. We've got an extremely high number on unsold new homes. That is dampening down the cost of housing. It's dampening down demographic demand for a lot of basic goods and services. And so I think a lot of the basics are not seeing a lot of inflation. I understand people think the prices are high. Of course they're high. But the rate of increase in prices is low because, frankly, you're not seeing lower and middle income households have gains in real income that would allow them to spend more in these areas. So I'm not seeing it broadly. I'm seeing it at the upper end, but not broadly.
David, what do you make then of Governor Waller saying no matter how you cut it or what measure you want to use, inflation is up this year? At some point, don't they need to address that, the fact that it is up and it has been up for 5-6 years?
I think that central bankers think that monetary policy has got much more to do with this than it actually does. Look, we got inflation in 2022 because of the pandemic, the policy response in Ukraine. We got inflation in 2026 because of tariffs, of the Iran war, and some legacy of these high shelter costs. But it's not caused by an increase in the quantity of money. It's not really being caused by interest rates being too high or too low. That's not what's causing it. And the economy will heal itself. Inflation will heal itself at a measured pace if if Washington just leaves it alone. And, for my mind, interest rates are about at a reasonable place. The Federal Reserve should not mess around with them and not pretend that they're the ones that are actually governing the inflation rate, because they're not.
David, it's good to see you. As always, sir, it's been your message for quite some time. They need to stay out of the way. David Kelly of JP Morgan Asset Management. Stay out of the way across several dimensions, including maybe the Middle East, because right now, crude's bouncing back, and these numbers we're comfortable with this morning could change in a month's time.
Yeah, because a lot of these inputs really are directly connected to the price of oil, and not just oil, but also the distillates, because that is the refineries that haven't necessarily come back online. This is going to be the key question. Do you see this natural process that can bring us down to 2% still in effect, or have there been enough one-offs to shake the confidence not only of the Federal Reserve, but also of markets that maybe are adjusting their inflation expectations to the expectation for rate hikes, not for remaining on hold?
One more risk event to go. 2 down. Bank earnings behind us, for this morning at least. CPI better than expected. Kevin Walsh, Fed Chair, an hour away. Coming up tomorrow, Steve Chevron of Federated, Ed Yardeni of Yardeni Research, the BNY CFO Dermot McDonough, and the former US Commerce Secretary Gina Raimondo. From New York City this morning, good morning, what a morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
The door closes to a July hike 30 minutes ago until the start of cash equity trading. I'm Danny Berger.
And I'm Bonnie Quinn. Bloomberg Open Interest starts right now.
Coming up, inflation falls for the first time since 2020 as Fed Chair Warsh heads to Capitol Hill.
Oil rises, though, as the U.S. prepares to reinstate a blockade of Iranian ships transiting the Strait of Hormuz.
And big banks deliver another blockbuster quarter while IBM issues a surprise earnings warning.
Well, you won't be surprised to know that the stocks we're watching today primarily are the banks. So JP Morgan, Goldman Sachs, Bank of America, Citi all blew past earnings estimates last quarter, with Goldman beating its own stock trading record set last quarter. Banks have a high bar set for the rest of the year, though, as they capitalize on volatility driven by AI and geopolitics. You can see a little bit of a diverging performance. Goldman Sachs just continues to rip in the market. Bank of America higher too. Citigroup, though, taking a little bit of a breather, and JP Morgan Chase, well, I guess more was expected of it, Danny.
I mean, it was up 25% year to date, still beating trading for equities by $2 billion with Goldman and JP Morgan. Huge numbers. And look, I know it's been a really busy morning between CPI and bank earnings. Kind of all I was interested in is what IBM said. So it had prelim earnings revenue for the second quarter, and it missed the average analyst estimates. It was really interesting commentary. They basically said, our bad, we made a mistake. Customers are shifting their spending to servers, storage, and memory. They're basically buying chips, and that means less money to buy IBM software money. Bonnie?
For now, at least. Well, we'll see what happens with the inflation data as time goes on, Danny. Maybe they'll have a few more cents in their pocket. CPI falling for the first time since 2020 as Fed Chairman Kevin Warsh says policymakers have no tolerance for high inflation. Let's bring in Bloomberg International Economics and Policy correspondent Michael McKee. A little bit of a surprise, I think, Michael, the headline number, the core number, to see, you know, a minus sign in front of anything to do with CPI was maybe a little bit of a relief. At the same time, the war is kicked off again now, so are we going to see these numbers rise again?
Yes, we're going to see those numbers rise again, and that's going to be a problem for the Fed. As you mentioned at the top of the show, it takes the rate rise at the end of July off the table, but it does keep it alive for some time this fall as we get new numbers into the data. You're right, we did have a decline. That was kind of expected, but the magnitude of the decline on a month-over-month basis was not, down 0.4%, and it pushes the headline number back below 4%. Core comes in just flat on the month, and that also lowers the year-over-year core rate to 2.6%. But most of that came from energy prices. Goods prices were up 0.8%. Services prices, which has been a concern of the Fed, were flat during the month, but it was apparel, used cars, And then gasoline, that really made the difference. Gasoline accounting for more than all of the decline, down 9.7%. And with the war resuming, we're going to see inflation start to rise again, at least in those categories. And that'll be something I'm sure Kevin Warsh will be asked about an hour from now when he testifies to the House Financial Services Committee. He offered no forward guidance in his prepared text, but he did say inflation remains their focus.
To that point, Mike, if we can max post the CPI numbers, what do we do with that? No tolerance for persistently elevated inflation. You add to that a Waller from yesterday, sternly staring at inflation until it melts before our withering gaze is not an option.
It means that the hawks are still in charge, but it doesn't necessarily mean that the hawks are going to push to raise rates. They'll have to wait and see how the rest of the economy is doing. We get PPI tomorrow. On Friday, we get import prices, and that should be a reasonably good number as tariffs have sort of faded for now. But they're coming back. The war is coming back. Gasoline prices are going to probably go back up. So that'll work its way into those numbers. And also, some of these numbers don't translate the same into the PCE that the Fed uses. We'll get that at the end of the month. I think we get that the same day as the Fed meeting. And if that doesn't show the same kind of progress, then you're going to hear more hawkish comments from Fed officials, even if they aren't actually moving the ball. Now, the hardest thing for Wall Street is, of course, the people on trading desks want to know, well, what's the Fed going to do if inflation goes back up? And that, I think, Kevin Warsh is going to avoid talking about today.
All right, Mike, thank you very much. That's Bloomberg's Michael McKee. Looking forward to that big speech, that testimony from Kevin Warsh, and your coverage of it. Mike, thank you very much. Elsewhere, big banks kicking off earnings season. Strong results. Let's get more for Bloomberg Intelligence senior bank analyst Herman Chan. Herman, huge numbers this quarter. I keep coming back to the big beats throughout the banking stocks. Looking at, Goldman and JP Morgan, $2 billion above their estimates for equity trading. Bank of America grows theirs by 70% a year, 72% for Goldman. Again, these are just huge numbers for these banks.
Yeah, they really knocked it out of the park in capital markets, particularly in equity trading, but also investment banking was strong as well across the board. Equity underwriting, debt underwriting, M&A. The question going forward now is how sustainable are these results, particularly in equity trading? There was a question on the call at JP Morgan about what was really driving it and how sustainable it is. The bank conceded that a lot of it was driven by some of these blockbuster IPOs. SpaceX in particular really created a lot of good trading opportunities for the banks.
Yeah, I mean, if we hadn't seen these beats potentially, we would have been really disappointed in the sense that there was so much going on, right? Even the retail trade, pattern day trading rules went away. There was so much in the bank's favor. In the time that we got the earnings, we saw yields drop basically 10 basis points. How will banks be thinking about the yield curve going forward and how to make it work for them?
Yeah, that's right. So as Michael said earlier, we're taking the July rate movement off the table, but there's still expectations for a potential hike later in the year. So banks are going to have to weather that. That potentially means higher deposit costs going forward, given the fact that we're seeing really strong lending activity as well. And that has some potentially negative repercussions for net interest margin. So that's something that we're looking at for the second half of the year.
All right, Herman, thank you very much. That's Herman Chan of Bloomberg Intelligence. And tune into the close. They're going to have an interview with the CFO of Wells Fargo. That's at 3 p.m. New York time. Vani.
Well, Danny, Brent trading above $86 a barrel once again as the U.S. prepares to reinstate a naval blockade on Iran this afternoon. The news coming as tensions continue to escalate between the two nations. President Trump spoke yesterday in the Oval Office.
Mr. President, just on Iran, you have said now to Congress that we are back at war. How long do you expect this to take, and what's the legal basis?
Take what? Take what?
The war.
Well, I think it's going very fast. We had a deal yesterday or the day before yesterday was all done, and then they broke up that deal immediately. We're not going to put up with it.
For the latest, we welcome Bloomberg Washington correspondent Tyler Kendall. Tyler, the president reimposing the blockade apparently from 4 p.m. Eastern and then also wanting some kind of a reimbursement or toll by any other name. How does that get enforced? Do we have any details?
Vonnie, at this point, we haven't heard further from the White House on President Trump's proposal for this 20% reimbursement, though it could mean that some of the largest oil tankers would be on the hook to pay more than $30 million per trip. It also would very likely impact regional allies the most when it comes to who would bear the brunt of those costs. There's big legal questions here on how the administration would seek to implement this, though we do know there's a provision under one UNC treaty that does allow for costs to be linked to services rendered, but that typically is for those territories that border the waterway, which, of course, in the U.S. in this case wouldn't apply. Still waiting for details on how exactly this is going to evolve as we see the U.S. really escalate the tensions overnight, attacking more Iranian assets in a bid to try to degrade capabilities when it comes to Iran's attacks against commercial shipping, though we've seen the opposite. At this point, Iran is trying to tighten its own grip as the UAE confirmed that 2 of its tankers were hit overnight by Iranian cruise missiles. But importantly, these tankers had their radar off. They were so-called part of that dark fleet that was transiting through. And Vonnie and Danny, that has significant risks here because it threatens one of those ways that shippers were trying to safely get their cargo through the strait.
This is a president, though, that said that the attacks allowed the United States to degrade Iran's ability to attack commercial shippers, and at the same time talking about being a guardian in the Strait of Hormuz. Tyler, what is the reality on the ground? You mentioned some of the attacks in the strait, but have any ships been able to traverse it?
So at this point, Danny, the satellite imagery is really difficult to track because those ships that are trying to get through have turned off their radars. But as we're seeing with this example with the UAE and those ships that had their radars off, there is still significant risks here. According to data analyzed by Bloomberg News, Sunday marked the lowest level of transits through the strait since the Memorandum of Understanding was signed, which just increases the risk even more. We're going to also be talking about risks in other waterways as well. I'll point out that we saw the Houthi proxy militia group that's backed by Iran seek to attack some targets in Saudi Arabia. This has been something that we've been watching really closely, including when it comes to what sort of threat that could pose in the Red Sea. Danny, later today, President Trump is set to meet with Iraq's new prime minister. And one of the big agenda items is that the White House is trying to pressure that leader to disarm Iranian proxy groups in that country, too.
Tyler, thank you so much. That's Bloomberg's Tyler Kendall reporting in Washington, D.C. So a lot for markets to take on this morning. Trading, though, along the lines of a cool CPI across the board, most components missing estimates. And that gives us a rally in the NASDAQ 100, up 1%, with the S&P up 0.2%. Two-year yields at one point were down 10 basis points, now just 9, as virtually the odds of a hike this month evaporate. Brent crude, though, still trending higher, still above $86 a barrel, Vonnie.
Yeah, it's fascinating. We just got that rally just right after that CPI data came in. Let's get some single movers on our radar now. SK Hynix climbing. It's up more than 9% after yesterday's 9% drop. That's kind of mimicking what happened in South Korea.
And Apple gets cut to underweight from sector weight, with KeyBank saying that higher prices and weaker demand will weigh on American growth.
IBM preliminary revenue for the second quarter came in below estimates, and it is tanking today.
Coming up, we're going to speak with Baird's David George about whether strong bank earnings can keep this rally going. What does the outlook look like? That's coming up right after this break.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Now to high interest, to look at what's making headlines around the world. Samsung may be eyeing Wall Street. The tech giant is exploring a U.S. stock listing through American depository receipts, though Samsung did text Bloomberg and suggest that it's not reviewing those plans right now. No decision has been made, but rival SK Hynix's huge U.S. debut is sparking fresh interest. New York is hitting pause on AI infrastructure. Governor Kathy Hochul will issue a one-year moratorium on new hyperscale data centers while the state develops regulations, citing concerns over higher utility bills. Business groups warn the move could cost jobs and investment, while supporters say it's needed in order to address AI's growing energy demands. And Warren Buffett is accelerating his philanthropy, donating another 12 million Berkshire shares, Class B that is, to charities led by his children and his late wife's foundation. Buffett says he'll give away all of his remaining Berkshire stock by the end of 2034. Notably, the Gates Foundation was left out of this year's donation plan. Wall Street's biggest banks are cashing in on the trading boom. Goldman Sachs posted a record $7.4 billion in stock trading revenue in particular, and $20.3 billion in quarterly revenue, while JP Morgan delivered its highest ever quarterly profit, fueled by a record $6 billion in its equities haul. Both also topped expectations in investment banking as deal making accelerated. Danny.
Let's get more on today's bank earnings. Joining us now is Baird Senior Research Analyst David George. And Dave, it's perhaps useful to start with JP Morgan, because I'm just looking through your first take, and it feels to encapsulate the mood this earnings season, that they post an all-time record for managed revenue, excellent core trends, but a slight miss on FIC, but a pullback in the stock. You say it is very much so buy the rumor, sell the news reaction to their earnings. Is that the case for these banking stocks? Excellent results, but excellent is already priced in?
Hey, Danny, good morning. And I think you said it well. I think so. This has been 2026 has been, as you know, obviously the year of semiconductor stocks and AI, but bank stocks have actually done quite well in 2026. So they have outperformed the KRE and the BKX, have both outperformed the broader market. And over the last month alone, the money centers, the regionals are all up 20% plus going into the numbers. And I've been doing this a very long time, almost 30 years. And this is probably one of the best quarters or starts to the earnings season that I can remember. But again, as you noted, Danny, this is just a very high bar. And we're sensitive to the fact, and Jamie Dimon has corroborated this, that we're of the view that the banking industry is approaching a peak in ROEs, and I think it's something that market participants need to be sensitive to, particularly given the fact that banks are cyclical, and the earnings can move around based on some of these capital markets movements. And I think it's unrealistic to expect that the kind of trends we've seen in markets are going to continue over the next several quarters.
David, has banking been de-risked? There was absolutely no mention of anything like cockroaches. Charge-offs were lower than forecast, and although Diamond did warn of, tectonic shifts potentially, he didn't really give any color there.
To your point, all the revenue metrics across all of these big banks have been very good, and as you mentioned, credit has really been benign going back to just after COVID. Banks took a number of charges to kind of front load potential credit losses coming out of that COVID timeframe. And we really have been, knock on wood, on one of the best credit environments that we've seen. And I think most bank management teams would agree with that. I think that the industry has been de-risked, Vonnie, to some extent. And I think that's come in the form of just the fact that they've been stuffed with capital coming out of the GFC. Many of these banks, particularly the money centers, are 3 or 4x the capital levels, the tangible capital levels today that they had then. The granularity of these loan books is also very good. The industry did a great job last quarter kind of debunking this private credit narrative that was a little bit of a cloud over the sector earlier this year. So the risks in these companies is definitely lower than pre-GFC, but they do take risks. And banks are in the business of taking risk, and it's really all about risk-adjusted returns. And as you said, right now, things are very, very good.
Isn't this the irony, though, David, that, sure, they've de-risked, but they're more able to get back into risk because of easier regulation, and that is go back into some of the areas of lending that private credit had really stepped into. We saw a big shift during, post-GFC, but especially during COVID as the banks pull back. This time around, when we're looking at things around AI lending, for example, it seems like the banks are very present. Just how competitive are they at the moment for their compared to their private market counterparts?
I think that these are somewhat apples and oranges, Danny. There are some deals that I think banks would consider as it relates to just this AI build out. But the banks aren't really going to be able to compete with what private credit does from a structural perspective. Private credit lenders are willing to do highly leveraged transactions, more cash flow centric transactions, rather than most of the commercial banks, Danny, are going to be largely focused on secured loans, more conservative loan to value constructs, and a more conservative leverage profile on the part of their borrowers. So to the extent that we have issues in private credit, I do think that there's an opportunity for the banks over the intermediate to longer term for the market maybe to come their way a little bit. And that could lead to a little bit better loan growth and a little bit better structures at the same time.
David, how do you estimate Wells Fargo's performance? Because obviously it beat on certain metrics, but the market is not rewarding Wells Fargo. It hasn't been for a long time. It's down this year.
Yeah, it's the stock has done. It's not been a great year for Wells Fargo shares, but the company's done a very good job executing. If you go back to COVID, I remember upgrading the stock was at 20. There was a lot of concerns around their ability to navigate this asset cap. Charlie Scharf and his team have done a great job navigating the cap. They've made very significant investments in their capital markets businesses over the last several years, and that has paid dividends, as you see in the most recent quarter. The stock is up a lot over the last couple of years, and this management team should be rewarded for how well they've done fundamentally, and the market has rewarded Wells Fargo appropriately. It's just more of a function of coming into the year with very high expectations, perhaps unrealistic expectations. So we don't really see any fundamental issues at Wells. They continue to execute very, very flawlessly, honestly, and it's just a function of a very high bar and an expensive valuation. Money center banks now trade at a premium to the regional banks. For most of my career, they've traded at discounts simply because of the risks. They're exposed to almost everything, as you mentioned. So nothing wrong with Wells, just a very high bar going in.
And Charlie Scharf also just pointing out how strong the consumer spending is higher, charge-offs and delinquencies are lower, and savings and investments are growing across consumer segments. Moynihan also echoes that. There's a willingness to spend, borrow, and invest, also lowers provision for credit losses and its consumer business. David, I wonder how much you can extrapolate these earnings to the overall health of the consumer. We did have a guest on and said, look, the lower consumer, they're doing buy now, pay later. They're less present in some of these banks' earnings. I wonder if you look at this and what sort of snapshot you get of the overall economy and of the consumer.
Yeah, I think it points to, and I'm tired of hearing the K-shaped economy acronym, but I think it kind of points to that. JPM, B of A are really focused, Danny, on the prime part of the market, on the credit card market, and that data continues to look very good and kind of is consistent with unemployment trends being at a cyclical low. But that should bode well for the banks next week, and particularly the consumer finance stocks, the credit card names at Capital One, Amex, and Synchrony. We think that Cap One and Synchrony in particular look pretty interesting from a stock perspective going into earnings next week. But yeah, from my perspective, the consumer appears to be in relatively good shape. There's some concerns, obviously, around the volatility in oil prices and to what degree that's going to put a crimp in the wallets of the consumer.
Yes.
But again, this data this morning definitely suggests that the consumer is in pretty good shape, evidenced by this loan demand and credit.
David, thank you so much, and well done on an amazing morning. That is Baird's David George. And don't miss our interview with the CFO of Wells Fargo on the close at 3 p.m. Eastern.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Check out markets just minutes away from the opening bell. We're up 0.25% in the S&P 500. Solid bank earnings plus a CPI that was cooler across the board also allows for a rally in the front end of the curve, down 9 basis points to trade below 419. And Brent crude still up 3% as escalation continues in the Middle East. We begin the trading day with strategist Gabriela Santos. World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market. Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Seconds until the start of trading. You're watching Bloomberg Open Interest. I'm Danny Berger, alongside Vonnie Quinn. Matt Miller still off. We're up 0.2% on the S&P 500. The NASDAQ, that goes up even higher. Chip stocks are rebounding. CPI much cooler, basically beating all the estimates. People had it firmly up 0.2% for core. It comes in unchanged. Dow Jones, though, that is still lower as yields drop across the board, but especially on the front end, down some 9 basis points. We have I think it's called IA40. Basically, it's a competition for the best venture capitalists who are investing in AI, presented by Madrona, itself a VC firm. So I think you have some of the top contestants here. I don't know if they've announced the winners, but good for them for making it into whatever this competition is. Some faces you'll recognize. It is Zoom, the pandemic golden child. It's down 74%, though, in the past 5 years, considering the big fall for grades. It is up 22% this year. They are celebrating their 15-year anniversary, so congratulations to Zoom. We had a really busy day. So we had 5 of the big bank earnings. We had CPI. We're going to get a Warsh testimony. But first, we're digesting this. That is the big bank earnings. Huge beats, especially for their equity trading revenue. Just to put it in perspective, JP Morgan and Goldman both beating by $2 billion. Goldman Sachs sets a new high watermark for both itself and Wall Street. It's worth pointing out, despite these really good figures, we are looking at some drops, especially for JP Morgan. Baird's David George, though, put it well. They've run up a lot. So, buy the rumor, sell the news. A high bar to beat. JP Morgan down 1.8%, Vonnie.
All right, Danny, thank you. IBM, meanwhile, reporting preliminary revenue for the second quarter that missed the average analyst estimate as customers shifted their spending to servers, storage, and memory. At least that's what IBM said.
Let's bring in Gabriela Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. Gabriela, I know that it's a big day with CPI and bank earnings, but honestly, I couldn't stop looking at IBM. I thought it was such an interesting story because IBM comes out and says, look, our customers, they need to spend on chips. They need to spend on hardware. Their things are getting really expensive, so they kind of have less of a cushion to spend on software. We've been talking a lot about the huge chip spend, and I wonder for a lot of companies if this is like the second wave of threat for a lot of tech companies and software companies that basically CapEx are being absorbed by just how expensive chips are right now.
Yeah, I think this is really an example of how software is the poster child this year for investors thinking and pricing in not just AI disruptors, but also those that are most at risk of being disrupted. Not because of fundamentals themselves. If we look at the software group as a whole, grew earnings close to 30% in the first quarter, set to still be strong.
But of course, there are questions around the business model. And we think still a lot of CTOs are very focused on the AI story, AI adoption, rationalizing token usage. So maybe there's still some wrinkles for the group in the short term. But medium term, there's still a lot of very solid businesses within the software group, especially those that really have very vertical businesses, proprietary data, and that can add AI solutions on top of it.
I mean, this is why the banks did so well equity trading, right? Because IBM drops literally a fifth of its market cap in one day, and then it sort of clambers back up, and you have the memory stocks selling off and so on. Yeah. What about inflation? Are we out of the woods?
There's so much excitement within the market. I do think still tech and these AI questions are driving a lot of that action beneath the surface. But undoubtedly, the macro news that we got this morning is a relief for investors, especially listening to Governor Governor Waller yesterday in his speech. One of the more hawkish voting members talking a lot about how he was worried about the reacceleration in core inflation. This month's print is a huge relief. Now, as he said yesterday, 1 month doesn't make a trend, but at least having seen softer prices across the core components, at least takes a hike in July off the table and can keep the Fed on hold, we think, for the remainder of the year. That's a big risk that we're seeing decrease for markets.
Waller was like poetry yesterday, can I just say? Sternly staring at inflation until it melts before our withering gaze is not an option. But it almost feels like if you were to stare at this month's report and pray for a similar one, that it is withering away. And the pass-through from higher energy costs, it's not there. Do you expect that to repeat? Or considering that war has reignited in the Middle East, or at least escalation has, that there will be elements of pass-through of higher energy costs?
I was in the room there at that lunch with Governor Waller, and he got a lot of laughs, including for that one poetic line. I do think one of the things that he and other more hawkish Fed members have been pointing to is, look, we're not just worried about the headline. Of course, sustaining around $4 a gallon for gasoline is an important, necessary, but not exclusive condition for the Fed to get more comfortable around inflation. And he was really honing in to core inflation. And that's why this flat reading this morning is a big relief. And if sustained, could really take the pressure off from these more hawkish members. And it was undoubtedly good. I think it's just also worth mentioning. It wasn't just a couple of special items. There were some that declined, like auto insurance. But if you look at other important components of core services and core goods, they were soft, especially shelter, really only rising if you look at rent 0.1 or owner's equivalent rent 0.2. That is a more normal pace of price increases.
It does feel, though, that this market and any investor in it is a little bit not quite on solid ground. I mean, you had a 10 basis point move in one direction with the 2-year, and then it reversed that move precisely because we didn't know what we were going to get, Gabriella. So what do you tell investors? I mean, how invested should they be in growth, in the riskier stuff? How invested should they be in, less risky items?
I do think still this macro question, and specifically the inflation and rates question, is still key if you look at the fixed income market and if you look at currencies. And so really, I think the short end of the curve is where you've seen the biggest adjustment post Iran war kickoff. Still short end, that's price for inflation, price for a Fed rate hike. The 2-year has moved up 80 basis points this year. And actually, we think creates a lot of value on the short end because we don't think we'll see sustained inflation pressure in the core, and then ultimately the Fed won't have to hike. So opportunity there. For stocks, though, that's where really the intra stock churn is the most important question. And that is all about AI, and specifically AI CapEx. And that's where the upcoming few weeks of tech-related earnings are going to be so important. The market is so jittery, especially looking at your high-flying semiconductor, especially memory names, to any kind of whisper of a deceleration in the pace of CapEx.
Well, the Bank of America team is pointing out that investment in asset managers are very, very bullish right now. Their cash levels dropped to 3.6%. It was above 4%, saying that it rings the contrarian alarm bells. What are you seeing among your clients? Is there exuberance in equities right now?
What we're seeing is a lot of enthusiasm for investing in across the capital markets and really the giant sucking sound of AI. And so a lot of enthusiasm in following the money from the hyperscalers, the CapEx spenders, to the whole AI ecosystem supply chain that's benefiting from those CapEx dollars. I mean, the kind of earnings growth we're seeing is extraordinary, 100%. Earnings growth for the semiconductor group. We're seeing close to 40% for hardware, for power. It's just astounding. And really, we're seeing a lot of excitement investing in across public equities as well as private capital as well to fund this whole AI CapEx surge. Now, where we are seeing some more concern for investors is just how far things have run. And we have been talking to a lot of investors about thinking about, are we thinking about sizing and actual stock selection carefully? Because these AI tantrums that we started to see in June seem to be a feature now, not a bug.
And you have to imagine the Fed is thinking about that as well, right? Because there's a part of this economy that is very dependent on that wealth that's being created by the stock market. Just on that, are you at all concerned about the labour market? Because you don't see any rate hikes for the end of the year, but it does feel like if we got one more soft jobs report, maybe we'd suddenly be starting to think about a cut again.
I think this was what was interesting about the speech from Governor Waller yesterday, who was one of the most dovish members last year, very worried about the labor market. It was basically no job creation for the vast majority of 2025. And then things have really improved since then. I wouldn't say it's a hot labor market, but it's normalized to a good, healthy pace of about 111,000 jobs created over the last 3 months. So I do think for those that might have been worried about something breaking in the labor market, the past few months of data have really calmed these fears. It's an okay economy. And I think if you think outside of AI, that's where you don't see a lot of interest. It's not an economy falling off the cliff, but it's also not that exciting. So where is just good enough economic growth good? I think banks fall in that camp. Yeah. But we would not be chasing what was a initial rotation into your more cyclical consumer names.
Just very quickly, Gabby, because we're basically out of time. Did you take comfort in the bank numbers this morning?
I think you're seeing really good numbers, not just from capital markets, which there was already a lot of expectation about, but also about loan growth picking up, including C&I loans, good regulatory environment, and very low defaults, delinquencies, and net provision. So I do think the macro read-through is very good, and including for banks, which we like.
Well, the good news is we got through a lot of risk events this morning. Just one more to go through in the form of Chair Warsh. Gabby, thank you so much for joining. Gabriela Santos of JP Morgan Asset Management. 10 minutes into your trading day, have a rally on our hands. A lot of things, breath is okay. 282 stocks moving to the upside, so nearly split for gainers and losers. The big gainers, it's the chip stocks. Again, these are becoming a very high beta play. You have a risk on day. The chip stocks do well. Micron, AMD, Lam Research, Intel, all there at the top. SanDisk, you also have some of the banking stocks sneaking in. Just want to point out, JP Morgan Chase has now flipped to gains. It was lower at the start of the trade, now up more than 1% to the downside. It's anything that's software-ish getting wrecked by IBM. IBM down 24%, saying that its customers need to spend more on chips and hardware, making software from IBM less savory. So you see some of the other software type names like Palantir, ServiceNow, those are falling. We also had some bad earnings, an early release from HCA Healthcare that's bringing down some of the healthcare names. Eli Lilly, Johnson & Johnson, Stryker, again off the back of poor earnings from HCA Healthcare. So looking at the various sectors, we don't have them at the moment. Here is a beautiful login terminal screen, so I will leave it there, Vonnie. I can promise you that healthcare is a little bit challenged alongside with tech doing better because of the chip stocks bouncing.
Yeah, I think we got a little bit of an idea of what's going on. Danny, thank you. Coming up, we're going to dig into bank earnings as investors digest another round of strong results. This is Bloomberg Open Interest.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It is time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC downgraded IBM to a sell just before the company's second quarter results missed expectations. IBM says customers pulled back on software spending and instead spent more on servers, storage and memory. The CEO also said the company didn't execute well enough and several big deals didn't close when expected. Next, Apple is getting a rare sell rating today from KeyBank. The firm says Wall Street is too upbeat on future iPhone sales. KeyBank says phone carriers may cut back on deals that help people upgrade, and higher Mac and iPad prices could hurt demand. And finally, energy and industrials dominate the positive calls today, with Halliburton getting upgraded at Piper Sandler. The firm says the recent pullback creates an attractive entry point and its fundamentals remain solid as drilling activity improves. Danny.
The big bank earnings delivering strong results with profits soaring across the sector. Let's get more with Bloomberg Intelligence senior bank analyst Herman Chan. They soared across the board. JP Morgan quarterly profit up nearly 41%. Goldman is up 80%, its best quarter in 5 years. Citi posts the highest quarterly revenue in a decade. The numbers are staggering, but are they repeatable, Herman?
That is going to be the question of the day. We're seeing that particular question asked from the analysts on the calls already, and at the JP Morgan call in particular, that question was posed. The bank itself said that equity trading results probably, you shouldn't expect that to be repeated in the third quarter. But on the other hand, this positive backdrop that we're seeing in trading is sustainable.
So where is the competition most fierce?
Yes, it's most fierce really on the equity trading front, where you're seeing the U.S. companies really dominate. But on the other hand, the European banks are coming back, and you see that as they re-engage. And we'll see more of that with earnings from the European banks next week. But we're expecting to see really strong results all across the board, particularly in equity trading.
We also saw expenses move higher for JP Morgan, and maybe that accounted for some of the initial jitters in the stock, although it is decisively higher this morning. When it comes to the expenses, there had been this idea that you incorporate AI, you get a more productive workforce. Maybe you don't even need to grow your workforce as much.
Right.
Is that narrative on pause? Is it turned on its head? Why the higher expenses?
It's happening over the longer term, and you're seeing banks talk about extracting some benefits from AI, particularly in areas like the call center or areas like fraud and mitigating fraud loss. That being said, we just talked about the banks hitting it out of the park on the trading side and investment banking. These banks have to pay their employees and their bankers and traders. So the reason why we're seeing a higher expense level is because of the strong revenue backdrop, which in our view are really good expenses.
When Diamond says that he sees, several risks shifting below the surface like tectonic plates.
Right.
What did the analysts get him to say in terms of color on that? What are these tectonic plates?
He's always been a bit guarded with his outlook for the bank and the industry, and that really reflects some of the geopolitical tensions that we've seen in Ukraine and also in the Middle East. He's also talking about potentially stickier inflation and also the elevated trading results that potentially could not be as sustainable.
But he makes it sound
term.
like any of those could turn into a real crisis for the market, and we've proven time and time again over the last few months that none of these things is turning into a crisis.
I think that's right. So over the short term, all of these positive, constructive areas that we've just talked about could be sustainable. That being said, the bank is a very risk-averse institution, so they're always looking at the potential issues around the corner that a lot of others may not see. So I think that just speaks to the fact that he's a very conservative person in general, and his comments really reflect that.
All right, Herman, thank you so much for joining us. Herman Chan of Bloomberg Intelligence, and catch the CFO of Wells Fargo on the close this afternoon at 3 p.m. New York time.
Well, coming up, IBM tanking on a preliminary revenue miss. We'll be speaking about that next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
You're watching Bloomberg Open Interest. Let's get a check on equity markets after CPI comes in much cooler, basically across every single component, allowing this market to rally. We get the green light and a green market. NASDAQ up 1%, being led by the chip makers. Russell 2000 up 0.6%, with 1/3% of a gain for the S&P 500. Look at what's happening in yields. 2-year yields are down nearly 9 basis points. 10-year yields come in 5 basis points. We're still, though, above 4.5%. We have seen them rise in recent days, given the price of oil has been moving higher, and it still is today, up nearly 3% as we continue to get escalation in the Strait of Hormuz. The president says that a blockade is fully enforced. The bank earnings check out Goldman Sachs, a record when it comes to their equity trading, beating by $2 billion. We're off to the races, up nearly 7%. This is a huge gain for Goldman. Not seeing as big of a gain for JP Morgan, but it was down earlier. SK Hynix off the back of some nerves, especially in the Korean session to start the week. On Monday, the biggest decline ever. Today, we're up by 12% for its ADR. The same fate is not true for IBM. IBM down a whopping 23%. Vonnie, their customers basically saying chips, hardware is too expensive. We can't spend on your services.
Well, here's a scary statistic just forwarded to us, Danny, by Dan Curtis. The Black Friday drop for IBM was 22.96%. So we are actually above that right now. So let's see if it holds to the close. But let's discuss the whole thing with Bloomberg's Carmen Reinicke, who's been following the story very closely. So, Carmen, I mean, this is a shocking sell-off. The CEO was throwing out every excuse under the book. Customers were buying other things. We didn't do well enough. We didn't get deals closed. I mean, at some point, you have to take responsibility and, you know, maybe do something about it. What is he going to do about it?
You know, that's such a great question, and it's something, you know, that we're thinking about a lot when you think about the winners and losers in the AI space. We've seen that people are spending so much more on semiconductors and the memory chips. There have been shortages in this space. It looks like people are trying to sort of get ahead of that, get their orders in so they get what they need for their data centers. And IBM is just on the losing side of this right now. People aren't spending the money on mainframes. At least that's what the CEO is saying ahead of their results. So hopefully we'll learn a little bit more in the coming weeks when they actually give their official results. But it seems like this is what, you know, can be done at the moment, is sort of prepare the market for a potential miss there.
And it's interesting to see the CEO saying that we fell short, when it feels like, Carmen, just what you're saying. I mean, I don't know what else they could have done. And I wonder if this is a warning for other tech companies. When you have hyperscalers, the big CapEx spenders, 1/3 of their budget going to chips, some estimates are that grows by 50%. Isn't this a problem for the entirety of the ecosystem, unless you're one of these chip makers with 86% margins?
I mean, I think that's right. And it's interesting because people are also really worrying about the peak spending there for those chip makers. And it looks like maybe we're not there yet. This is where people are expected to continue to spend. I think the other thing that's interesting for IBM and some of the other stocks that we're seeing down today are these big software players. So Microsoft's down, you know, Adobe, some of these other big companies. And those are sort of the two big things that IBM does, right? It's mainframes and then it's software. And these are both parts of the market that we're seeing not get the AI shine.
I mean, it's big blue, right? It's not supposed to ever fail, you know, but I mean, these companies do have huge repricings. Would now be a good time to buy back some stock?
You know, that's something we're definitely going to be watching for. I know I'm going to be on the phone with investors all day asking, you know, is this the time? I mean, obviously it's trading at a pretty big discount. I mean, at the intraday low, it looks like the worst performance since the 60s. So I'm sure we'll see some dip buying at some point.
Carmen, thank you so much for joining us. Great to have you on. That's Bloomberg's Carmen Reinicke. Coming up in the next hour, we got a busy one for you. We're going to be hearing from Fed Chair Kevin Warsh. He'll be testifying on Capitol Hill as inflation falls for the first time since 2020. Core comes in flat. Expectations were 0.2%, giving Chair Warsh some much-needed breathing room. His prelim statements, though, show a commitment to taming inflation. That's all to come. You're watching Bloomberg Open Interest.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, streaming live at Bloomberg.com as well. Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. At any moment, we're going to bring to you Federal Reserve Chairman Warsh. He testifies before the House Financial Services Committee in the Federal Reserve's semi-annual monetary policy. We're going to begin with Warsh's opening statement, and we'll carry his testimony in full as well. So that's what's coming up for most of the next 2 hours. We're also going to check in with Herman Chan, senior analyst. He covers all the banks here because, boy, he's been busy today. Bank of America, JP Morgan, Wells Fargo, you call it, Citi, Goldman, all reporting numbers. So we'll bring that to you. Chris Condon, if we have time, Bloomberg Federal Reserve team leader, to preview Federal Chairman Warsh's testimony coming up. So mostly are going to be spending time with it. the Fed Reserve Chairman Warsh and his testimony. Right now, let's kick this whole thing off with Alexis Christophers and get a Bloomberg Business Flash. Alexis.
All right, thanks a lot, Paul. And this Bloomberg Business Flash is brought to you by IBKR. For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Blowout earnings reports this morning from some of the nation's biggest banks, together with a cooler-than-expected read on consumer inflation. second quarter sales that fell short of expectations. It's attributing the miss to customers shifting their spending to chips and servers amid AI-fueled shortages. Meantime, JP Morgan Chase posting yet another record profit, though fixed income came in a bit softer than expected. That's why shares of JP Morgan are down a bit. Actually, they are now up about 2%. See that, Paul? You blink and the market just changes direction.
Exactly.
It was down for most of the morning, but I got to tell you, folks, the major banks are all higher now. Many of them were under pressure in the pre-market. So JP Morgan Chase up more than 2%, Bank of America up more than 2%, and Goldman Sachs racing ahead here, up better than 7%, leading the advance for the Dow Jones Industrial Average after yet another record profit. Quick check of oil. Brent crude, 85.51 a barrel, up more than 2.5%. West Texas Intermediate crude up better than 2% at 79.77 the barrel. And I just want to give a shout out to the dollar. It is lower this morning, down 0.5%, 12.1569 there. That is your Bloomberg Business Flash. Paul, back over to you. Paul, is it just you?
It's just me. Scarlett's on her way. She has a little appointment earlier, but she's on her way.
Nice to hear it.
No reason to. I said, hey, stay away. We're going to be taking Chairman Warsh's testimony all morning. So
any moment now. That's right.
Absolutely. Yep. All right, thank you so much, Alexis. It is Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As Alexis was just reporting, stocks are higher today. Let's see what's happening out there with individual stocks. Take a look at some of the stocks on the move today. We can do that with Bloomberg's Judy LeGroux. Judy, what are you looking at today?
Hey, Paul. So first and foremost, IBM, right? Historic day. Wow. Stock is plunging as much as 26% on track, as we've heard, for its largest drop on record. And for a company that went public in 1968, that is no small move. Just for some context, in 1968, the Green Bay Packers won Super Bowl II. Hey Jude was the most popular song on the radio. So definitely big movement there. Software and IT stocks are also lower on that news. Accenture, ServiceNow, Salesforce, and Adobe all lower on this. And the company really saw, as a result of quarterly CapEx spending in June shifting and large deals failing to close on time, this preliminary revenue falling short of consensus estimates is a really big deal, just because we're in advance of earnings for the company. So a space to watch.
It's just an extraordinary day for IBM. Again, the last biggest decline of this nature was actually October 19th, 1987 during the crash. Oh, wow. And that was just extraordinary. So just totally unexpected from them. How about Goldman Sachs here?
Sure. Goldman Sachs, the stock is climbing as much as 5% on the day. The company posted a $7.42 billion revenue for the quarter here. A lot of this movement is really coming from the firm's equities. Their result jumped 72% from a year earlier. So looking at investment banking fees from advising on mergers and underwriting as really the powerful move behind this these results for Goldman.
It's just extraordinary out of Goldman, and you expect that. But I'm looking at it across the board here. The bank's just done extraordinary. And the expectations were very high for these companies. HCA Healthcare.
HCA Healthcare, this is a really sort of a big look into healthcare. Ticker HCA. The stock is sinking as much as 9.4%, and it is on track for its largest intraday drop since April and its lowest intraday price in about a year. And what is happening with HCA Healthcare is that they cut their guidance for the year, and they cited more patients are struggling to access health insurance on the Affordable Care Act exchanges. So healthcare providers generally are really grappling with these shifting trends as the expiration of some Affordable Care Act subsidies are really prompting millions of people to drop coverage. So that is really having an impact on the balance sheet of this company, and we're seeing it through the cut guidance and the stock movement as well.
Yep, interesting stuff out there. Our big moves today, big companies all in the news. So Judy, thank you so much for that. We appreciate it. Judy LeGroux, Bloomberg News, bringing us some of the stock movers here today. For conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. As Judy was mentioning, a lot of movers out there in the marketplace, including the big banks, because, man, it's the busiest day I've ever seen for big bank earnings, just all coming in on one day here. So we've been checking in with our good friend Herman Chan, who covers all the banks for Bloomberg Intelligence. So I guess my takeaway, Herman, is they beat expectations generally, and expectations were high coming into this
right.
quarter. What are they saying about the back half of the year? I guess that's probably the bigger issue.
Yeah, that's right. That's the chief question on the earnings calls today. We had robust results, knocked it out of the park, particularly in equity trading. Can this be sustained? At least from the JP Morgan earnings call earlier this morning, management said that while it's hard to replicate the second quarter earnings results from equity trading in particular, there's still a constructive backdrop. Some of the activity in the second quarter was really driven by the trading activity from SpaceX and the like that may be a bit more idiosyncratic to the quarter, but still really strong trading results expected for the back half of the year.
What are the banks with the big lending books like Wachovia, like B of A, like Citi? What are they saying about the credit quality out there?
Yeah, credit quality has been really strong. You see that in Wells Fargo in particular. Their net charge-offs for the quarter, their loan losses were down about 10 basis points. And that was really led by much lower commercial loan losses in particular. So the commercial borrowers have been able to weather some of this economic uncertainty and expectations for rates to be higher for longer. So we're actually pretty sanguine about the credit quality for the group, at least in the near to intermediate term.
What are some of the return ratios that you and bank investors look at, and how are they trending these days?
Yeah, returns and return on tangible common equity in particular is the key banking metric that we look at. And those were strong across the board. You see this in JP Morgan's adjusted ROTC, 23%. Their target over the longer term, 17%. Even banks that are at the lower end of the spectrum, banks like a Citi, we're seeing ROTC at 13%, and their target for the year is only 10 to 11%. So they're vastly outstripping their targets and their expectations, and that's happening across the board for the banks that reported today.
All right, so in that context, how the easing regulations on the banks, how have they impacted their performance and those types of ratios?
That's right. So that's another positive story for the banks, particularly the big ones, where we have easing capital regulations that will create more flexibility on the balance sheet. So that's in terms of both buybacks, that's in terms of dividends, that's in terms of increasing their lending capacity. And that means there's less equity component on the balance sheet, which is inversely related to returns. So returns will go higher systematically because there's lower equity capital ratios.
Yep.
So all in all, a really good story. You just saw from the stress test where after that, in the aftermath, banks really lifted their dividends by 10, 11, 12% across the board.
All right. It's a good time to be a bank investor, bank analyst. How about that? We were talking about Citi. It's up 2% today, up 23% year to date, up 64% over trailing 12 months. So it looks like Jane Fraser, the CEO, has really got that thing in turnaround mode. Herman Chan, thank you so much. Appreciate that. Senior analyst covering all the U.S. banks for Bloomberg Intelligence. Again, we're waiting testimony of Fed Chairman Warsh. He's going to be testifying before the House Financial Services Committee in the Federal Reserve semi-annual monetary policy. And when he makes his opening statement, we'll go to that. Let's get a little bit of a preview of what we might hear from our Fed Chairman. Chris Condon, he's a Bloomberg Federal Reserve team leader, joins us here. Chris, we saw the statement and basically said the Fed, are going to be very, very focused on getting inflation down. He calls it intolerable, the current level here. What do you expect to hear from him today?
Well, first of all, he's going to repeat those prepared remarks. So we'll hear him in person making those very strong, hawkish remarks about not tolerating inflation. And I would add that he was given a very nice gift with the very soft CPI inflation print this morning. As people have pointed out, that allows him to look very muscular on beating back inflation without the risk of it being seen as suggesting a near-term rate hike. A number of other topics could come up outside of economics and monetary policy. He'll likely be asked to repeat his pledge that the Fed will be independent and not listen, in other words, to President Trump. He may be asked about his financial disclosures. We don't know. We haven't seen any proof yet that he has met his pledge to divest of certain financial assets that he had promised he would divest from before he joined the Fed. Could get that. Could get questions about banking regulation and supervision. And I think Fed watchers are hoping that lawmakers will push him to be a little bit more detailed in articulating how he sees the economy evolving at the moment. He has been, as we know, very reticent to provide what they call forward guidance, which is a signal about where rates are going in the future. But economists and investors are really keen to hear not so much of any kind of pledge of where rates are going, but just how he thinks about inflation, unemployment, and how they relate to interest rates. If X happens in the economy, how might monetary policy have to respond? Or if Y happens? He hasn't really done that. And he's been causing a bit of frustration in markets over that lack of details. So there's a lot of hope that lawmakers will push him to provide some of those more details today.
So one of the issues is people feel like this 2% target maybe is unrealistic in a world that is decreasing its rate of globalization, or kind of onshoring and friendshoring a lot of parts of the economy, manufacturing in particular. Maybe that results in just higher underlying natural inflation out there in the economy. How does he view that?
He would not agree with that.
Okay.
He will make, and he makes very clear in his prepared statement, as he has before, that inflation is ultimately in the control of monetary policy. There are a lot of things outside the Fed's control, but in the longer run, inflation is always a result of monetary policy decisions. So they have it within their means. He does not go so far as to say what this suggests about where he wants rates to go. But ultimately, if rates remain, if inflation does remain high, and there, as you have pointed out, there have been a number of shocks. It looks like we're in a world where supply side shocks can be expected with more frequency. If we are indeed in that world, then monetary policy will have to respond eventually with higher interest rates. And at the same time, let's not forget, you're getting a big boom in investment from the AI build out. That is raising demand potentially above the capacity of the economy, which is inflationary. So aside from things that central bankers may be tempted to look through, like an oil price surge or tariffs, general inflation caused by higher demand linked to this crazy investment boom in AI could be generally inflationary in a way that central bank absolutely cannot ignore in the longer run. So he may not articulate today that he's prepared to confront that with higher rates in the near term. In fact, I'm quite sure he will not say that. But ultimately, he may have to be forced to confront that issue. And the other members of the committee will be prepared, of course, I think, to confront that with higher rates.
Yeah, you mentioned some of the short-term issues, and I guess the most immediate one is just the price of oil. We saw that to the positive effect in the June CPI report when we had energy coming down due to the ceasefire, but that may be flipping this quarter. Chris Condon, thank you so much. Appreciate it. Chris Condon, Federal Reserve team leader for Bloomberg News. Right now, let's head down to Washington, D.C. We're listening as Federal Reserve Chairman Warsh testifies before the House Financial Services Committee in the Federal Reserve semi-annual monetary policy. Let's take a listen.
Federal Reserve history is Alan Greenspan, who passed away about a month ago after a century of life. We at the Fed recall the chairman's strong and steady leadership, his strong hand in a period of rapid economic change. And today we honor his memory. As a country, we just marked our 250th year. And when Americans count our blessings, we include an economy predicated on the brilliance of our constitutional design and a system of ordered liberty, an economy without equal in all it's done for human flourishing. Some forms of Fed communications, which I've spoken about previously, are discretionary, but not this one, and for good reason. It's a prudent and wisely conceived obligation designed to keep the Fed accountable, responsible, and faithful to its congressional mandate of full employment and price stability. These obligations are of a piece with the Fed's rightful independence in the conduct of monetary policy. Stepping back, I would say today as we sit here, Mr. Chairman, we're at a hinge point in history. It's up to all of us to meet this moment. The task for this generation of policymakers and of individuals and households in the private sector is to ensure that the American economy excels far into the future. Now, at the Fed, our number one objective is getting monetary policy right. That's our clear and constant aim, the star we steer by. And if we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past. Just a month ago, I chaired my very first meeting of the FOMC. My colleagues and I recognize that high inflation has been an undue burden on American households and businesses. And while monthly price volatilities and variations are inevitable, especially in an unsettled world, underlying inflation over longer time horizons is determined largely by monetary policy. As the chairman said at the outset, inflation's a choice. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability. This was the focus of our June meeting, at which we decided to hold the target range in the Fed funds rate at 3.5 to 3.75%. Now, naturally, our work at the Fed demands a proper reading on economic conditions. As you see in our report, economic activity grew at a solid pace, showing remarkable resilience in the face of recent developments. Household consumption, moderate. Manufacturing output, it moved up steadily this past year. The housing sector, however, gives a somewhat different picture and continues to lag. I want to highlight the most striking feature of this economy right now, and it's business investment. The rapid pace, which appears to be accelerating, reflects in part the construction of data centers and other infrastructure, and the immense demand for AI-related equipment and software. Investment in equipment overall increased about 8% for the year in the first quarter. Within that category, high-tech spending logged an especially impressive growth rate of nearly 25%. At the Fed, we don't yet know fully the extent to which the economy will benefit from AI. Yet it seems inevitable that that which we're now calling AI investment will soon just be called investment. Even so, new opportunities for the economy introduce new challenges for central bankers. We at the Fed are monitoring the implications for employment and for inflation. That brings me briefly, I'll end here so I don't go afoul of the time commitment, to the supply side of the economy, which deserves equal measure of discussion. Productivity growth has been strong, predating gains from AI adoption. America's labor force appears stable. Job creation has in fact kept pace with the workforce. The unemployment rate is low and changed little over the last year. And we've seen relatively few layoffs. In closing, I will say this. I came to my new position as a believer in the very best of the Fed's traditions. I'm heartened by the welcome I've received and by the encouragement of my colleagues in considering how best to advance the conduct of monetary policy. We have a duty to point this institution forward, to take a fresh look at current practices, to make sure we're serving the objectives you gave us, and we're going about it systematically. I've appointed task forces that you've already referenced in 5 key areas to improve the broad conduct of monetary policy. 1, Fed communications. 2, our balance sheet policy. 3, our use of existing data sources. 4th, productivity and jobs in an era of remarkable transformation. And 5, and not least important, the Fed's inflation frameworks. The purpose of this initiative is to equip the Fed to make better decisions in monetary policy and put these years of high inflation behind us. We're starting a new chapter, Mr. Chairman, at the Federal Reserve. In this consequential time for our nation, I can report to you that we at the Fed intend to be fit for purpose and focused on the future. We are the Federal Reserve, Mr. Chairman, and we're determined as ever to fulfill the mission that Congress has given us. Thank you, Mr. Chairman. I welcome your questions.
Thank you, Mr. Warsh. We'll now turn to member questions. I'll recognize myself for 5 minutes. As outlined in your statement, inflation is the result of many factors. Of these, the Fed has control only over one, monetary policy, as expressed through its interest rate and balance sheet policy. Today, a potential second surge of inflation is appearing due to factors outside the Fed's control. What the Fed can control is how it reacts. Though upward pressure on prices may diminish on its own, it's not a sure thing. The Fed may be able to look through these inflationary pressures, but the Fed has believed that before and has been wrong. High inflation affects Americans in the here and now, not in some hypothetical future composed of long-term projections or of inflation expectations. Mr. Chairman, I was very encouraged to hear both in your testimony and your opening FOMC statement about restoring price stability as a top priority for you. When we think about that in the near term, though, how do you and your colleagues on the Open Market Committee plan to accomplish that given the policy tools at your disposal?
Well, thank you, Mr. Chairman. We want economic growth to be more broad-based, and we want the change in prices, the increase in inflation, to be more limited. There are a lot of things that are happening that are outside of our control, as you mentioned, conflicts overseas and the rest. We can't have and shouldn't have a direct control on that. But inflation's a choice. We monetary policymakers need to choose lower prices, and that's the commitment my colleagues have made. In direct answer to your question, I would say we're doing three things. One, commitment, which you heard at our first FOMC meeting, and I hope you heard today, is we're committed to the Fed to deliver price stability. We're committed to the 2% inflation goal. And so for businesses or households or market participants who came into this saying, well, they said before they were committed, but they seem to have tolerated a higher level of inflation, that commitment is resolute. Second thing that we can do is take ownership. This isn't a time for us to pass the buck, to blame others. The Federal Reserve can and will deliver price stability. We have the tools that you mentioned, both interest rates and balance sheet policy, that can help us achieve that aim. And we have the tools to deliver that. So it's a function of commitment, responsibility, and tools, and we're 3 for 3 and we'll deliver.
Thank you. I referenced in my opening statement about the 2020 decision on tolerating higher inflation and that it's now been abandoned by the board. Clearly, I think that was a policy error. It was praised by some at the time in August of 2020, but I found it alarming at the time it took place. First of all, do you agree with the FOMC's decision to abandon that? And secondly, how do you consider this past 6 years of experience when you look at the task force work on the framework question for looking at inflation?
Yeah, so there's no secret that at the time that the framework in 2020 was announced, the new framework, which was intended to get inflation higher, that at the time and in subsequent years before finding my way into this job, I was very critical of it. That central bank wasn't the first central bank to ask for a little more inflation and end up with a lot more. It was a mistake. The framework did not succeed in its objectives, and I am pleased that before my arrival, that my predecessors took that and cast it aside. All central bankers are going to make some share of mistakes, but when they make a mistake, they've got to call it out. Had that mistake been called out sooner, I don't believe we would have been burdened with this undue tax over the last 5 years. It's nearly the same degree. That's why we are reform-oriented. That's why my colleagues and I are so driven by these task forces to think about them anew. And in final response, I'd just say one of the task forces you mentioned is to revisit the inflation frameworks that the Federal Reserve uses so that we can better understand what will cause inflation to rise and fall and what we can do about it.
Well, thank you. And you also referenced courage in your opening statement, and you've just outlined the toughness of the set of policy choices that you and your fellow governors have. So difficult that your longtime predecessor, Arthur Burns, described that mission as the anguish of central banking to try to cope with the different structures. So in the last seconds I have left,
Ranking member, you've given us a big job. We've begun in 6 short weeks to tackle the big job, and I'm focused on that.
Well, let me just go further with the prediction markets. I'm deeply concerned by the potential for regulators to profit from the use of material non-public information on prediction markets. There's a pattern of insiders appearing to profit ahead of market-moving Trump administration decisions, like when officials with close ties to the administration make trades prior to major tariff announcements. Chair Walsh, what oversight does the Fed conduct over its employees with regard to insider trading? And given the rise of prediction markets, is the Fed increasing its oversight for its employees profiting from the use of material nonprofit information?
Ranking member, at the end of my very first week on the job, I sent a letter to the 23,000 employees of the Fed, reminding them the best of the Fed's traditions, which is our culture. And included in that culture is integrity. Included in that culture is ensuring that we abide by the law and the very highest standards. That's a commitment that we've made to each other and will make to you.
Well, thank you. Chair Walsh, in 2019, I posed a simple question to former Chair Powell. I asked, if you get a call from the president and he said, I'm firing you, pack up and it's time to go, what would you do? Chair Powell said, of course, I would not do that. The answer would be no.
Gentlewoman's time has expired.
I asked further. He does not want me to go any further. Do you think the president doesn't have the authority?
He can answer that answer. He can give you an answer in writing, and I'm sure he will do that in a timely way. Thank you so much. The chair recognizes the chair of our Task Force Monetary Policy, Mr. Lucas of Oklahoma. You're recognized for 5 minutes.
Thank you, Mr. Chairman. And, Mr. Chairman, I want to start off discussing these task forces.
Listen to Congressman Frank Lewis, Republican from Oklahoma.
Force idea is catching fire as we see this go across the landscape. What do you anticipate the result of the task forces to be? Can we expect public reports or other documents? How do you envision presenting the results of these findings, Mr. Chairman?
Thank you very much. Right now, they're in discovery mode. I've given the 5 task forces a tall task to go back to first principles, see what we're doing, see what can be improved upon. They were starting with a blank sheet of paper, and you had a highly credible central bank running the most important monetary policy in the world. What would we do? Are there existing practices we could improve upon? Are there hard questions we could answer? The changes in the economy relevant to that? In terms of disclosure, we're going to make sure that the external independent task forces, which are staffed by some superb Fed staffers, that they get to share their views first with the decision makers. There are going to be 19 of us around the table that are committed to listen to them with an open mind and make decisions. But there's going to be nothing held in secret here. This is a public discussion on these 5, and I'm happy to share the results and the thinking periodically between now and the end of the year, at which point I hope we've got some real conclusions.
Of course, the committee task force is very sensitive on this thing. Let's move to the communications and balance sheet. A concern I raised with your predecessor is the potential for confusion on the purpose of adjustments to the Fed's balance sheet, absent clear and frequent communication. For example, the trading desk announced yesterday it's continuing the $10 billion in bill purchases this period, presumably to maintain ample reserves. I understand not wanting to preempt the work of the communications task force, but can you share your thoughts on balance sheet policy communication? Will you make it clear to the markets when shrinking the balance sheet is intended to tighten monetary policy rather than a deregulatory effort to avoid market distortions?
Yeah, you raise a couple of very good points. First, that some of the boundaries of these task forces will overlap. In some sense, each of the task forces are charged with obligations that are ultimately the FOMC and the Board of Governors. So the communications task force and the balance sheet task force, there might be some overlap in their work. But let me cut to the chase. The balance sheet policies since the global financial crisis when I last served, the balance sheet regime has changed quite significantly. The size and duration of assets the Fed's holding have changed massively. They changed first in a period of crisis. That was the design of this new balance sheet policy. I don't want to prejudge decisions that this task force makes, but it's no secret of my long-held views, and I'll just state them 3 ways. One is the balance sheet is part of monetary policy. Monetary policy is made both through interest rates and through the balance sheet policies. The balance sheet isn't merely about plumbing. So that's point 1. Second, I want to assure you that if there were a change in balance sheet policy, that we would preview it, explain it, debate it, and no changes in balance sheet policy would happen without good advance notice to the likes of this committee and broadly financial markets. And 3, as we think about balance sheet policy, we at the Federal Reserve have to do, I think, a strong and compelling job to stay clear of fiscal policy. We want to be out of the fiscal policy business, which is between you and the Treasury Secretary and the President, and focus on monetary policy. Those are among the big questions I've asked this group of 3 distinguished leaders to take on, and I look forward to hearing what they have to say about it.
The composition of Treasury purchases continues to trend towards more price-sensitive market participants. The MPR details this trend along with the strong demand and increased liquidity, though we know from experience conditions can worsen quickly in the crisis. How are you thinking about financial stability and the threat of fiscal dominance as Congress fails to get spending under control while the demand for our debt, including the Federal Reserve, continues to change?
So it's an excellent question. As we sit here today, the average duration, that is the average outstanding stock of assets that are held by the Fed and U.S. Treasuries is about 6.5 years. The Treasuries that held in the market are about 4.5 years. I understand in periods of crises, like the 2020 pandemic and the 2008 crisis, central banks by design needing to step into markets to create a fair price. But in more benign times, when our overall holdings are larger than the market, that's something where monetary policy is, in the language of former Chairman Volcker, on the edge of its authority. These are among the questions that this task force will look at.
Thank you, Mr. Chairman. Yield back, Mr. Chairman.
Gentleman yields back. Chair recognizes the ranking member of the House Small Business Committee, Ms. Velasquez of New York, for 5 minutes.
Right here. Welcome to the committee. I would like to start with a straightforward, simple question. Do you work for Donald Trump? Yes or no?
If I'm permitted to say, we're an independent central bank. We're honored to be independent. Our independence came from you.
Okay, that's enough. Thank you. What steps would you take if the president or others in the administration target you or your fellow governors because he doesn't like how many of them are voting?
Nydia Velasquez, Democrat from New York.
So it's not my intuition to engage in hypotheticals, but I'll tell you this: the Supreme Court said
that's an easy way out.
The Supreme Court said that the Federal Reserve and the conduct of monetary policy is independent. To the extent there were questions about it, the courts answered those questions.
So what would you do?
I would continue to do my job.
Okay, good. Chair Walsh, do you agree that current monetary policy exists in an extremely polarized and politicized environment?
Outside the four walls of the Federal Reserve, there's no doubt a lot of politics. But my goal inside the central bank is for there to be no politics. To the extent there's politics there, we're going to get rid of them.
Well, I, along with many on my side, will say that the attempted firings of a sitting Fed governor and Fed chair in the central bank's 111-year history is quite the politicization and polarization of the Fed. Chair Walsh, at your nomination hearing a few months ago, you said, and I state, I am committed to ensuring that the conduct of monetary policy remains strictly independent. You just said that. Are you still committed to conducting independent monetary policy today?
Absolutely.
Given the current mistrust of government and the political environment surrounding your appointment, the decision to limit communications and offload Fed objectives to clandestine task forces with no clear transparency calls your motivations into question. Can you commit today to institute an explanatory framework that details the reasoning of the Fed's actions following policy changes?
I'm here today, Congressman, to do just that. And I think I've demonstrated in my first 6 or 7 weeks in office a commitment to independence and a commitment to reform. Those two are of common importance, and I'm going to deliver on both of them.
I'm glad to hear that.
Thank you.
Chair Walsh, at your first post-AOMC meeting as chair, you were asked how you intend to handle Fed communications going forward. You answered, and I quote, We made some changes today. I expect more changes to come, and some of those might well be worthy of a press conference. To me, that is not a very definitive standard. Can you commit today to creating a fixed public standard for which FOMC decisions and procedural changes trigger a press conference rather than deciding case by case which ones might be worth it? Yes or no?
So if I can be a slightly longer than yes or no, the last 63 months, maybe 64 months of high inflation above the Fed's objective suggests that it is immediately important to think about reforms, including in communications, and that's what we're going to do. I don't expect any of the change in communications to be about hiding the ball. The purpose of a change in communications is to do one thing right, which is to get monetary policy
I
right.
hear you, but are you instituting any standards that will qualify for a press conference as a worth news for the public and hear us in Congress?
So in a word, yes, and we have a task force that's going to help us think about how to do that and do a better job of getting policy right and making sure that you know what we're doing and why.
Can you give me a single objective or criteria right now on how you will determine whether or not a change at the Fed is significant enough for you to hold a press conference on it?
Mr. Chairman, I'd invite you to answer that question in writing, please, for the gentlewoman from New York. Chair recognizes the gentleman from Texas. Mr. Sessions, you're recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome. We're
Now
delighted
listening to Congressman Pete Sessions, Republican from Texas.
You'll get used to coming back. You'll be here twice a year. So your report to Congress is important, and we do count on the factual nature of that. I'd like to refer, if I can, to 3 questions and allow you to speak instead of myself most of the time. Number 1, housing interest rates, that would be on page 21 and 37. Then understanding better the agricultural stability of that marketplace. I represent a hugely agricultural district. And second, or lastly, the labor market outlook, that's page 16. I'll let the gentleman please move forward, and I'll prompt you now on the first one, housing interest rates. You would please talk to us, your view of that. It's higher than what I want, but you're the person that's in the seat today.
So as I mentioned in my opening statement, prepared remarks, the economy is solid. Financial markets look like they're in very good condition. But when we look at housing markets, the story is much more uneven. 30-year fixed-rate mortgages, which is really the relevance of much of this discussion to a lot of hardworking Americans. It's higher than it's been, and in part, that's because of inflation that has been above the Fed's objectives.
Okay, and looking forward?
So we have
your goal. What can we look at you and say, what is our new chairman going to do about that?
So he's going to deliver price stability with his colleagues at the FOMC. And what we can do in making sure that people are confident that the change in prices is at such a level they don't have to think about it and they don't have to talk about it. That is consistent with long-term Treasury yields being lower, and that's also consistent with mortgages being more affordable.
Well, I agree with that, and I'll look forward to that. Agricultural outlook, as you know, farmers, the farm economy is going through some changes. Your viewpoint on that?
Yeah. As you know, the Fed does not target particular sectors, but that doesn't mean these sectors aren't incredibly important. The housing economy matters to the economy, the overall economy, and so does the ag economy. It's the breadth and diversity of the U.S. economy that gives it its strength. It's the dynamism of what's happening in each of these sectors, including in agriculture, that gives us great comfort that economic growth can be materially higher than it is. We are not afraid of productivity-led growth, and that's not unique to AI. That's across all sectors of the economy. As I mentioned to Chairman Hill, we're looking for growth to be broader, and the change in prices, the inflation in prices to be more limited, agriculture is not immune to either of those developments.
Well, the Agriculture Secretary has been added to some of your important committees to make sure there's discussion. I hope that you will listen to her. It is important for you to understand that when people talk about the stock market or investment, farmers and ranchers look out in their backyard at the cost of their equipment, at the cost of their land, at the cost of things. They don't have a stock market. They have their own investment. And I think that the Secretary can be there to completely continue to remind you of that. Labor market outlook really looks good. Page 16, sir, your take.
Yeah, so the labor market has been remarkably resilient. The increase in nominal wages has been solid. You might have heard in my comments at the beginning of this a bit more focus on the price stability part of the mandate. I want you to know, though, that there is no disfavored part of the legislative remit that you gave us. The dual mandate is your word to us that we're going to focus on price stability and on full employment. I intend to do just that, and if I could add one other thing, in my view, the two parts of the mandate are not in conflict. This is not an either-or proposition. The more we can do to deliver low and stable prices, the more we can get it such that people aren't worried about inflation, the more employers are going to want to hire more workers. So you gave us a remit. We take both parts of it seriously. As we look out the window now, the labor markets look to be in pretty good balance. We've got some work to do on the inflation front.
Well, we in the One Big Beautiful Bill encourage people to go back to work. And that is why we do not tax overtime pay and why we do not tax what would be tips. We need to get people back in the marketplace. We hope you helped us out. Mr. Chairman, welcome to us. Mr. Chairman, thank you for your time.
Gentleman from Texas yields back. Chair recognizes the ranking member of our Capital Markets Subcommittee, Mr. Sherman of California, for 5 minutes.
Mr. Chairman, first I want to commend you for looking to improve
Listening
the
to Brad
data
Sherman, Democrat of California.
Base your monetary policy decisions. Up until now, we've relied on survey data as a substantial part of that, and increasingly Americans just don't voluntarily answer survey questions. I want to commend you for declaring your independence. We saw what happens in Argentina, Venezuela, and most notably Turkey when federal central bank independence is eroded. I would say ironically that had your predecessor caved to Trump and lowered interest rates below what economics would call for, we would have much higher inflation today, and that would have been bad for Americans. It would have been absolutely terrible for the Republican Party. So the independent, your agency has saved Donald Trump from himself. And finally, I would say don't rely on this distinction between the Cook and the Slaughter cases. The idea that every congressionally created independent agency isn't independent except yours, you don't want to be relying on that. The distinctions the court makes between your agency and every other agency are rather weak historically. Our capital markets support our business expansion and our economy. Money market funds are an important part of that, buying short-term commercial paper from corporations. Our payment system is designed to meet the needs of honest Americans. That's why we have an anti-money laundering, know your customer rule that makes it a bad system for drug dealers, sanctions evaders, et cetera. There's a rival to these institutions, and that is a cryptocurrency, which literally means hidden money, and is designed to, and then we have in particularly stable coins, which are just like a money market fund, except you earn zero interest, and everything is hidden. Now, the Federal Reserve established liquidity facilities to support money market funds in the last crisis. Will the Federal Reserve support cryptocurrency or stable coins if they face a run-on from investors?
So, Congressman, thank you for mentioning many of those issues. We talked about a lot of them in your office, so I appreciate it. I I still have the scars from the 2008 financial crisis. I still have the scars from the extraordinary efforts that my colleagues and I, under Chairman Bernanke's leadership, had to do. That is not something we want to repeat.
Can you assure us
that we need are
that
to
you
try
will
to
not
mitigate that.
be bailing out stablecoin and cryptocurrency?
So I don't want to, I can be more broadly than that. We do not want to be in the bailout business, full stop.
But your predecessor did provide a liquidity function for money market funds. If, God forbid, we faced a similar circumstance in the crypto world, would you bail them out?
So I want to be very clear. We're going to do everything we can to mitigate those sorts of extraordinary risks. If and when they were to come in the next 4 years, we want to be in a position we're not bailing out anybody, including crypto.
You're not really answering the question. Obviously, everybody prefers our economy works well. And I'm certainly concerned with giving non-banks direct access to the payment system, and this Kraken filing with the Kansas City Fed is concerning, but I want to move on to Basel III. Your predecessor said that the capital requirements for banks in 2019 were about right. The current reproposal substantially raises those capital requirements. Were capital requirements about right in 2019, or should they be higher than that today?
So the good news is we have a proposed capital rule that's out for comment. I'm quite interested in getting the reports and the comments on that, and I look forward to reviewing those and making a judgment. I would say, as a first principle, strong capital ratios, strong liquidity ratios, strong supervision, and strong market discipline, they're all of a piece to ensure we don't find ourselves in a world where there's unsafe or unsound institutions.
We, of course, want strong limits. On the other hand, if you go overboard, you hurt economic growth and hurt the economy. I hope in that review process you'll look at low-income housing tax credits, where you've already moved from 400% to 100%. It should be closer to 20%. These are very stable assets.
Gentleman's time has expired.
My time has expired.
Appreciate you, Mr. Sherman. The chair recognizes the chair of our subcommittee on financial institutions, the distinguished gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. And Chairman Warsh, congratulations on your confirmation and swearing.
We're listening to Andy Barr, Republican from Kentucky.
Reserve. I am grateful for your commitment to reforming the Fed, and that appreciation is surpassed only by our shared love for Kentucky thoroughbreds and your love of the great sport of horse racing. Let me just ask you, first of all, since you're swearing in over 7 weeks ago, things seem quite a bit different over at the Fed. A few examples: elimination of forward guidance, abstaining from the dot plot, creation of these 5 specialized task forces, and maybe most impressively, taking accountability. Instead of blaming inflation on the pandemic or supply chain interruptions or tariffs or the Strait of Hormuz, you are saying that inflation is always and every time the result of the Fed supporting printing too much money. Tell me, Mr. Warsh, you appear to be quite different from your predecessors. How are you different?
So I've known 5 of my predecessors. I've learned particular lessons from each of them. I can only be my own man. I served before at the Fed for about 5.5 years under Chairman Bernanke, and I learned a lot of things then. But you're right. In 6 weeks, we have caused, I think, a sea change in new thinking, the beginning of a set of reforms that are going to be put in place across at least 5 dimensions in monetary policy. And it's a broader discussion about reforms that will be forthcoming in everything we do, including supervision and regulation, where there's already been a good start, in payments and the rest. We made a lot of progress in 6 weeks, but I think it's important to use this opportunity wisely. The 63 months of inflation above target has been an unfair burden and has been a tax on the American people and businesses. We plan on getting rid of that tax. If that means we need a regime change in policy and we need new consideration of practices, some of which have been working, some of which haven't, that's what we aim to do, and we're just getting started.
Well, I appreciate your commitment to being different. Let's talk about overhauling Fed communications. This from a Wall Street Journal editorial on June 15th. They write, few innovations since 2008 have been as counterproductive as the adoption of forward guidance as a policy tool. The constant yammering, long policy statements, press conferences after every FOMC meeting, nonstop speeches by Fed officials, and above all, the quarterly summary of economic projections has exposed how little the Fed understands about the economy and trapped officials in errant policies. Chairman Warsh, why is it important to do away with the dot plot and end once and for all forward guidance?
Well, Congressman, I've made no secret probably over the last 15 years of my views on communications. I think when central bankers speak like I am before you, it's either one under obligation or in this case under obligation and purpose, which is to share a set of new reforms so that American households and businesses might say to themselves, this is a regime change in policy. We're only beginning it. I'm keenly interested in the views of these 5 task forces, and ultimately these are decisions that are going to be made jointly. The best of the Fed's traditions are to work collegially, and I've really been quite impressed how open-minded my colleagues have been to take it up, specifically in communications. If we were to share with you our every passing thought, I worry not that there's anything wrong with us, but we're human. And if we were to give you my projection today about what we'll do when we meet in 2 weeks, what we'll do over the course of the year, that we then find ourselves sort of taking information that's consistent with our priors and rejecting information that's inconsistent. It's not the way we want to do things. We want to get policy right, and I think being somewhat more circumspect in our communications, at least for me, is a better way of calling balls and strikes.
Finally, thanks for your commitment on dealing with this mission creep. In recent years, the Fed has concerned itself with matters outside of its dual mandate, including diversity, equity, inclusion, climate change, and the like. That's why the Fed's joining the network of the greening of the financial system distracted the Fed from the very important job of price stability. How will you keep the Fed from rejoining the network for the greening of the financial system or veering into these peripheral and distracting matters that go beyond the statutory remit of the Fed?
By being very clear of our obligations. You told us that our job is full employment and price stability. You gave us plenty of other hard work to do. We'll have a series of reforms outside of monetary policy. Our plate is full. We will not be wandering into other areas, I can assure you, Congressman.
Thank you. I yield back.
The gentleman from New York, the ranking member of the House Foreign Affairs Committee, Mr. Meeks, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And congratulations, Mr. Chairman.
We're listening to Gregory Meeks. He is the Democratic representative of New York.
About the Federal Reserve's, and I quote, rightful independence in the conduct of monetary policy, which is good. Now, as the Chairman Hill has indicated, I also do some foreign affairs work. And I'm very concerned about what's taking place in the Strait of Hormuz and rising cost of gas, because we know that when those prices go up at the pump, it gives higher transportation and energy cost, and they work their way through the economy, generally making groceries higher and household goods, et cetera. So it depends upon handling it. So if the administration's handling of the conflict with Iran contributes to another inflationary shock, will you make the decision you believe is in the best interest of the American people and the American economy in that rightful independent stance?
Congressman, that is always our commitment, to make the best decision we can, consistent with the remit and our understanding of the world. And as I said to the chairman at the outset, we'll deliver price stability.
So, and that's, still based upon what we've seen from the president thus far. Now, I just want to be clear, make sure that, because I got to be clear on this, that if the president publicly pressures you to pursue a different course than the one you believe is in the economic, that you believe the economic data supports, will you follow the president's wishes or follow the data?
My commitment to you is to follow the law and follow the data, follow our very best judgment.
And that's even if he publicly criticizes you for doing it. If you decide this is the way to go, this is what the data shows, and he publicly criticizes you and tells you how disappointed he's in you and all of that, will you still do what the data tells you to do.
I will, Congressman.
You ready for that?
I'm ready to follow the law, and I'm ready for the Fed to deliver on the expansive remit that you gave us. I'll make only one other note. We have a wide lens. We're interested in what's happening in the war. We're interested in what's happening in military conflicts around. We have to take that all in, but then we have to shut the door and make our very best decision. That's what we're going to do in a couple of weeks, and that's what we'll do in the remainder of my tenure.
Thank you. So now I want you to know that I support innovation, but I also believe that the Federal Reserve has a responsibility to protect the integrity of our payment system from political pressure and short-term enthusiasm. And I believe that the administration has made expanding access to fintech and digital asset firms a clear priority of his, but the Federal Reserve has long evaluated access to its payment infrastructure based on safety and soundness, operational resilience, and effective risk management, and the stability of the financial system. Not politics, not political priorities. So, can you, and what I should say this also, because what I'm concerned about is that there are firms that's connected to our nation's payment infrastructure that must have robust cybersecurity, fraud prevention, compliance, and operational controls, because failures can undermine public confidence in the financial system and leave consumers exposed to significant harm. So, my question is, can you commit that decisions about access to the Federal Reserve's payment rails will remain grounded solely in the Fed's independent assessment of systemic risk, safety, and soundness, and not political direction?
We're going to keep politics out of the Fed. We're going to stay focused on the responsibilities you've given us. And I think you highlight something very important. This new technology revolution, which is hitting the Federal Reserve and the economy, provides huge opportunities. The United States can lead in payments. Our economy can be the strongest in the world and improve its growth rate, but it's not without risks, and we at the Fed are going to strike the right balance between the challenges and the opportunities in payments and more broadly.
Let me just ask this, I got 28 seconds, but what objective standards must any firm satisfy before you conclude that the benefits of innovation outweigh the risk to consumers and the broader financial system?
I like the way you think. A benefit cost test is a good test for economists like us, and if the benefits exceed the cost, then that's the kind of policy, procedure, and objective we want to pursue.
Thank you.
Thank you, Congressman.
Gentleman yields back. The chair recognizes the chair of our Capital Markets Subcommittee, Ann Wagner of Missouri. You're recognized for 5 minutes.
Hi, thank you, Mr.
We're listening to the Federal Reserve Chairman Warsh testimony before the House Financial Services Committee in the Federal Reserve semi-annual monthly monetary policy review. Right now, we're listening to Ann Wagner, Republican from Missouri.
More options and access to our markets, giving the everyday investor and the local employer better opportunities to grow their financial future and kind of on their own terms, I'd say. Under the previous administration, we saw a heavy-handed regulatory approach that aimed to strip risk out of our markets entirely. And time after time, the Biden-Harris administration pushed policies that limited financial freedom and stifled growth. Our capital markets are, as we all know, the envy of the world, and that is because we allow Americans to weigh risk and reward for themselves and make the financial decisions that are best for them and their families. Chairman Warsh, at a high level, how do you view the Fed's role relative to the financial system, both as a central bank and as a bank regulator? And I guess what I mean is, should the Fed try to engineer all risk out of our economic system, or should it act as a prudent observer that only intervenes when truly necessary?
Congressman, it's a leading question, which I can answer with a we need to strike the right balance. We are not trying to take risks out of markets in normal times. The economic growth that I mentioned to your colleague just a moment ago comes about because of a certain dynamism in our financial markets, which comes from a dynamism in the real economy. That isn't created by the Federal Reserve, but we can be a foundation with clear, steady policies, delivering on the remit that you gave us so that the American spirit and American economic growth can continue to be the envy of the world.
Something on the top of mind for myself and certainly for my constituents in Missouri's 2nd Congressional District is the state of the economy, including the cost of living, job growth, and interest rates. Though it is often characterized as being tasked with a dual mandate, the Fed, in fact, has multiple statutory mandates, including stable prices, maximum employment, moderate long-term interest rates, and financial stability. When the Fed leans into one of these goals, sir, it can create ripple effects on the others, forcing a balancing act between competing priorities. Chairman Warsh, how do you weigh these different mandates and the trade-offs between them?
So I'm a little different than some in the economics profession on that, Congressman. I do not think we have a cruel choice between stable prices and full employment. I think the mandate that you and Congress gave us are entirely consistent. If we can ensure stable prices, the American economy can thrive, businesses can hire more employees, and the dynamic economic engine we talked about can continue to be the envy of the world. I don't think we have to run a balancing test. I don't think it's an either-or proposition. We're in the business of doing what we can to ensure financial stability over a business cycle and financial cycle, and we're always in the business of ensuring stable prices and full employment. At different times, our focus, our lens has to turn to one of those priorities, but I think they're entirely consistent with each other.
Which leads to my next point here. There are some who believe, Chairman Warsh, that the Fed should be used as an everything regulator, where instead of acting as an observer of markets, the Fed attempts to actively manage them beyond its statutory responsibility. Chairman Warsh, how does this mission creep affect the Fed's reputation? And should the Fed take actions beyond those specifically authorized in federal law?
We should follow the law. There is a tendency when circumstances get tough for any regulatory agency, any agency to go to the edge of their authorities, but that's when politics enter the door. My objective, the objective of my colleagues is to keep politics out, and the way we do that is we steer clear of things that we aren't authorized to do.
Gentlewoman's time has expired.
My time's expired, and I think that's the answer we're looking for. I yield back.
The chairman recognizes the ranking member of our subcommittee on digital assets, Mr. Lynch of Massachusetts, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chairman Warsh.
Now listening to Stephen Lynch, Representative Democrat from Massachusetts.
I was pleased to see that in your opening remarks you spoke to the issue of artificial intelligence. And as the ranking member on AI and crypto, I was just curious to try to tease some more of your thoughts out on that. You know, not only in the financial services context, but AI in general. I mean, in the past, the Federal Reserve has been able to identify risks of impact to the financial system, but also in a wider context as well. And I wonder if you'd share some of your concerns about that. And I guess I'd like to know, under your leadership, what will be the Fed's approach on AI and how you protect the system from some of the risks that may be attendant to the adoption of AI.
Yeah, thank you, Congressman. We talked about this a bit in your office, and I appreciate the time. This is perhaps the most significant change in our economy in my adult lifetime. I take the new investments in intelligence, in some sense, to be one where we have to recognize it's a huge opportunity, but it also comes with risks and challenges. It is not the job of the central bank to provide or be certain of what the consequences are over the next 12 or 24 months. But we recognize that the United States is likely to be a big winner. The United States is at the forefront of these technologies. Both the human capital and the capital provided from investors are happening here. So the efficient frontier of these technologies are happening in the United States. This is a benefit broadly to our economy. But I don't want to sound overly complacent about it. These technologies also offer threats when they find their way into adversaries' hands. The infrastructure at the Federal Reserve, the infrastructure at our banks, large and small, they must feel new pressure as people are looking to use these technologies to do harm. So these technologies can be used for good and for harm. Over the long term, I think the U.S. is the winner. Over the long term, I think there is a material improvement in productivity, which should have a material improvement ultimately in wages and the strength of the economy. But the long term it can be quite far out, and we've got to monitor things month by month, quarter by quarter as we get there.
Yeah, the thing that troubles me is every time we talk about AI, I hear about this race, and it's us against China, or it's us against South Korea, or countries in the EU. The problem with that thinking is that in this race, and we're seeing the velocity of change is enormous. It's exceeding obviously our ability to regulate AI. At the end of the day, I don't see the United States as the winner. I don't see China as the winner. I see artificial superintelligence as the winner. That's where we're rushing along this course. And at the end of the day, we're creating either us, and it doesn't matter whether the creator of artificial superintelligence is a good guy or a bad guy, or a good gal or a bad gal. That superintelligence itself will be the entity that we have to confront. And I just worry about the broader impact of what's going on right now. There's tremendous resources, as you know, being poured into AI. I just hope that the course of regulation does not meet the same fate that the regulation of crypto did, where the crypto industry spent close to $250 million up here on Capitol Hill, and they got the bill they wanted. If that happens with AI, we are in serious existential trouble, not only in this country, but in this world. And I do believe that the Fed, in your position, has influence, has the ability to seek out those dangers that others may not identify. And I just ask you to please consider your role and the resources that you have, that maybe you can put a task force together to look at the broader implications of the adoption of AI. They can't even show us, they can't even explain some of the things that they're using right now. The explainability gap is enormous, but I welcome you. I wish you the best. I really do. I wish you the best for all of us.
Gentleman's time has expired.
I yield back.
Chair recognizes the gentleman from Georgia, the Vice Chairman of our Financial Institutions Subcommittee. Mr. Loudermilk, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Walsh, welcome. Thank you for being here, and Godspeed with the position you now have, and we wish you the best of luck.
Thank you.
First, I want to talk about Operation
We're now
Choke
listening
Point.
to Barry Loudermilk, the Republican from the state of Georgia.
Operation Choke Point 2.0 involved partisan actors at the Fed using, as quote, reputation risk as a means to target and debank firms and individuals in the digital asset ecosystem. The energy industry and really anyone that partisan actors at the Fed believed unworthy of a bank account or loan. This was especially egregious given the fact that the Fed does not have a statutory authority from Congress to supervise for reputation risk. While I'm happy that reputation risk has been wiped from the Fed's guidance to examiners, can you please tell us what steps the Fed can take to durably ensure that statutory silence is never again abused by partisan actors to attempt through the Fed what they cannot make through law in Congress, and also what actions that you may be taking?
So thank you, Congressman. Reputational risk has been removed from the dashboard that supervisors and regulators will have anything to do with. My view is that being a good supervisor and regulator is tough business, and we don't need to make it harder by bringing politics into it. Vice Chair Bowman has begun a series of reforms before I arrived in this, and I think you're going to find in the coming quarters and years we're going to continue to reform and refine our regulatory system so that we can have a safer and sounder financial system, and I'll add a more competitive one too.
All right, thank you for that, and we appreciate your work.